तय करना होगा कि जब ये संकट का काल है और हमारी देशभक्ति हमें ललकार रही है, तो कम से कम 1 साल के लिए हमें विदेशों में जाने की बातों को टालना चाहिए। भारत में बहुत सारी जगह है, वहां हम जा सकते हैं। एक जमाना था जब संकट आता था, कोई युद्ध होता था, तो लोग देश हित में सोना दान दे देते थे। आज दान की जरूरत नहीं है, लेकिन देश हित में हमको ये तय करना पड़ेगा कि साल भर तक घर में कोई भी फंक्शन हो, कोई भी कार्यक्रम हो, हम सोने के गहने नहीं खरीदेंगे, सोना नहीं खरीदेंगे। विदेशी मुद्रा बचाने के लिए हमारी देशभक्ति हमें चुनौती दे रही है और हमें इस चुनौती को स्वीकार करते हुए विदेशी मुद्रा को बचाना होगा।
Dr. Soumyakanti Ghosh is with us, Group Chief Economic Advisor at State Bank of India. Dr. Ghosh, good morning. Good to have you with us here. Thanks for joining us. So we've heard the Prime Minister make that appeal. So 2 questions. One, do you think this will make a difference, make an impact, make a dent? Second, is this a precursor to some actual rationing measures, fuel price hikes? Maybe, yes, as a mechanism. But in terms of actual rationing, is there reason to worry? We've seen lots of countries in Asia do it. We've avoided it so far. Your thoughts?
Yeah, thank you, Prashant. Good morning, and thank you for having me on the show. I think I will take it, I'll look it at it a little differently. I'll not say it's rationing, but specifically it's an appeal to save the precious foreign exchange reserves. I think the numbers and the war continues to, the war continues to happen, and the recent statements actually doesn't augur well for the war to end anytime soon. So given this context, I think some sort of an decline in the foreign exchanges use could actually go a long way in preserving the current account deficit. Because just some number I want to tell you, I think at $100 per barrel, if that is the average, the current account deficit hits 1.5%, growth hits around 6.6%, and inflation hits 4.6%, which is the current assumptions of the Reserve Bank of India. So any numbers beyond 110 actually pushes the current account deficit towards 2%, and the danger is actually when the crude touches 120 to 130. But these are assumptions for the full year. So in my sense, at this current level, yes, there are concerns on the growth, but current account deficit and inflation are still manageable. But my sense is that there are some steps which are required so that the external sector remains cushioned and possibly somehow insulated from the current West Asian crisis.
So in terms of actual measures, this is an appeal, but in terms of actual measures, is there any way to tell whether we'll see something? On LPG, we saw something, right?
I think, Prashant, some sort of steps could be forthcoming. I think on terms of the hike in the oil prices, I think that could be one of the last options. But if you remember the 2013 taper tantrum crisis, there were several steps. There was a bouquet of steps apart from the short-term interest rate hike of 300 basis points. Then there was the FCNRB deposit window. Then there was also restrictions on the LRMS, basically that capital account transact, which the Honorable Prime Minister has been talking about. So I think there were some restrictions. All of this came through. And after that, I think rupee staged a smart recovery. So whatever steps the government or the central bank will take, I think that will be in unison. And we don't rule out some of the steps which were similar to what happened during the 2013 crisis.
Okay. Mr. Soumya, morning. This is Rima here. Prime Minister Modi also particularly called out on import of gold. He said avoid buying it, makes an appeal to avoid buying it for nearly 1 year. Do you think that could be a precursor perhaps to a hike in import duty on gold? We've seen it in the past. It happened in 2022, then it was rolled back in 2024. Do you have a view on this? And if it does come through, will it have a tangible impact?
Rima, I think I will make 2 points over here, one related to gold and one somehow not related to gold. On the gold, I think it's always a very tricky issue. I think if you remember in the past also, whenever the import duty has been hiked, I think there has been always I think the problem of the secondary market of the imports going up. So I think it is going to be a tricky, and it remains to be seen how that is tackled. Whether there is a counter-cyclical increase in hike, basically the way where I think we had those hikes which were done earlier when the crude prices went down and went up. So that is one option. The other option is on the capital, I think there was a lot of talk about the FCNRB deposits and other things. I don't know whether that's a feasible option or not, given the significant increase in cost right now. And the third option, possibly, there are many other options. Third option also possibly, as there has been reports of suggesting that capital account restrictions, if you actually pull out the data, the overall capital account outflows in the LRMS regime last year could be well in excess of US 20 billion, out of which 75% actually is because of the factors like equities, immovable properties, travel, and other things. So maybe, and it was, I think the same thing happened also in 2013. So maybe some steps on that account. But my sense is that it could be a combination of several steps, maybe a graded approach, or maybe together, so that the news goes that we are there to help the external sector cushion the shocks.
All right. Good morning, Mr. Ghosh. This is Nigel on this side, sir. Thanks for joining in this morning. Quick word with regard to the Indian rupee. You briefly mentioned about that, and there were some reports that suggested in the past that maybe a Forex bond issue could be on the anvil. Do you think we'll be looking towards that direction, or do you think not needed as of now?
I'm not sure about the bond issuance at this point of time, because if we compare with the 2013 crisis, and the current swap cost, the hedging cost, the rate of interest globally, I don't know how much will be the increase in, how much will be the cost of that FCNB deposit mobilization. That is always an option on the table, but we have to be also significantly mindful of the cost involved in the mobilization of a deposit-like scheme at this point of time, because the things are completely different from what it was in 2013 and what it is in 2026.
Okay, so on gold, Dr. Ghosh, there is a chance of a import duty hike?
Possibly there could be a possibility. I'm not sure. I'm just guessing there could be a possibility. But as I said to you, that there is always a problem of this black market and secondary market.
Yeah. Every measure will have
Yes. But one option is that, Prashant, I want to mention is that already the banks have a scheme of these gold loans. So maybe some changes in the gold loan scheme to make it more attractive.
Yeah. And LRS also, you said something similar to what was done in 2013, possible? 2013
for a temporary period is possible. It's just guess estimates. I'm not sure, but that I just said the numbers in front of you.
Yeah. Now, the other thing was you said FCNR like scheme, right? I think Bloomberg reported 2-3 days back saying that it's not a FCNR type scheme, but maybe a dollar bond issue. So that is different. I mean, that is deposits, this is debt. You think possible?
I think in terms of the cost involved, if you look into the 1919, the Millennium bonds and other things, I think the cost involved even in terms of a bond issuance are going to be on the larger side. So that's exactly the point. So even if it's an FCNRB deposit scheme or it's whatever is a bond scheme, any fund mobilization schemes in whatever form will involve explicit cost, and for that, I think the last time, if you remember, the central bank both the hedging costs and also the central bank, there was the exemptions on the regulatory dispensation. So I think even if you rule out those regulatory dispensation and the cost, the implicit cost which will actually entice the depositors to come into India will be on the larger side. But I think that's always an option which is on the table in times of foreign crisis. But I'm not sure whether that could be the option, the first option now. Maybe some graded actions, and later on see how it takes from there. And
in terms of petrol, diesel price increases, small adjustments, right?
Nothing. I think petrol, diesel price adjustments is a possibility, but maybe the government is looking at it as an option which is not on the list immediately. Maybe at a later stage if the things doesn't improve.
Yeah, but I mean, frankly, I would have thought we should have had it by now. But they've held back, and they've taken...
I think more often measured, Prashant, I think some steps may be required from the monetary policy. I'm not talking in terms of any rate hikes or anything. But if you remember, in 2013, there was a temporary period when the short-term rates were significantly increased. And that actually was one of the factors which ensured that the rupee was protected. The increasing interest rate as an exchange rate defense, as a defense of the exchange rate is not a option in an inflation targeting regime, but it could be always one of the options in a short term without resorting to any rate hikes, so that the short-term funds became more attractive. And also the fact, I think one of the important factors which I mentioned, I think also the fact on the taxation issue. I think there has been a lot of discussion has happened on the taxations and FPI. Maybe that could be also one of the options on the table from the government point of view. You remember that after 2023, it has changed, and maybe some leeway from that could make the portfolio capital.
Is there active discussion on that front, or this is just like a wish list, Dr. Ghosh?
These are all wish list, and then I think the wish list is always large. But
because if we get into wish list, it's a much longer list.
I think there are the measures are not significant. The wish list is not significantly large. There are only a couple, 3 to 4 wish lists. But hopefully, I think over a point of time, some of this wish list, if it's implemented, that could be better. But my only point to note is that given the current balance of payment and the fact that it will stay in the negative zone for the 3rd consecutive year, we indeed need a measure to comprehensively address the balance of payment structural issue.
Got it. Thanks very much, Dr. Ghosh. Appreciate you joining us and running us through what you make of the appeal by Prime Minister Modi, and of course what perhaps may follow. There are lots of things, lots of tinkering which can happen. We'll see how much of it happens. But Dr. Ghosh, of course, gave us a framework in terms of how to think about some of this stuff. Well, let's just put out some of the stocks we're going to address on Top 10 in just a bit. Tata Consumer Products, Bank of Baroda, MCX, JSW Infra, Bal Krishna Industries are stocks on our radar. On the positive news flow front, jewelers, OMCs, travel hotel names, Swiggy, ABB India are stocks on the radar, likely to open in the red. Coming up, all of it with our research team on the other side.
Welcome back. You're watching Bazaar Morning Call. It's time now to talk stocks. Our research team is standing by with CNBC TV 18's list of top stocks for the day. Mangalam, you go first. And good morning, guys. Do you expect an impact on the jewelry companies?
Yes, I do. And that's because the Prime Minister has urged the citizens to go ahead and defer purchases of gold jewelry in particular for the next 1 year. This move is obviously aimed at protecting Forex. India imports about 60 tons of gold every month. So if citizens were not buying gold, then maybe this could save on Forex is the intent. There would be a sentiment impact of this. But what the real impact will be is that analysts are saying that this could actually be a precursor to the government in some way or the other announcing some curbs for gold imports. Way back in 2012 and 13, where we were in a similar situation, the government over the course of 12 to 18 months had increased customs duty on gold import from 2% all the way up to 6%. So all these factors would put a bit of a brake on the kind of moves that we've seen on all the jewelry stocks. Remember, over the last year or so, the one thing in the consumption space which was shining bright was the jewelry space, with all the companies seeing over 40-50% growth. A large part obviously led by gold prices, but buyer declines did not happen. So all these factors, given the sort of outperformance that we've seen and the fear that there could be some curbs on imports, will keep these stocks gains in check. In fact, I would see some correction on these counters.
All right, thanks a lot for that, Mangalam. Well, let's hop across. We'll also be joined by the management of Senko Gold in just a bit. Mr. Suvankar Sen will be joining in to help us with some insights on that front. But moving across to Sonal, she's here to tell us about OMCs and travel and tourism as well could get hit. Hey, Sonal, good morning.
Good morning, Nigel. Well, yes, important advisory coming in from the Prime Minister. The advice is on fuel conservation, work from home and domestic travel versus international travel unless necessary. He's asked public to use cooking gas, diesel and petrol judiciously. Now, remember, last week itself, we got numbers from the Oil Ministry where they indicated that oil marketing companies are incurring losses of 30,000 crore rupees per month on sale of auto fuels. So that's the level of losses made by these companies. So all eyes now will be on pricing of petrol and diesel from here on. And crude oil prices have also jumped, so the losses are only getting wider. So all these stocks will be on our radar. Oil marketing companies continue to be under pressure. Now it could be a volume hit as well. And of course, travel stocks or hotel stocks will see some green because of big push for domestic tourism.
Thank you very much for that. Back to Mangalam. Tata Consumer, solid set of numbers.
A very good set of numbers coming in. In fact, one of the best that we've seen in the consumer space so far. And given its size, 16% underlying volume growth as against street expectations of just over double digit is something that the street will definitely like. And if you look at across the board, there was a strong beat coming in on the revenues, which came in at 5434 crores. The street was working with a number of 5270 crores, so an up move out there as well. EBITDA shy of 800 crores. The street was working with a number of around 750 crores. The margins have been a beat as well, and on the back of which the net profit, our poll indicated numbers shy of 400 crores. The company has gone ahead and reported 424 crores. What did well for them? India Beverages out there, volumes grew 4%. The expectation was anywhere between 3 to 6%. India Foods, volume growth at 15%. Here too, the expectations were 10 to 12%. And a large part of the growth was led by some of their growth businesses. Sampann actually grew 69% as against expectations of 35 to 40%. So seeing green on Tata Consumer.
And Bank of Baroda, let's find out how the numbers looked. SBI was a big disappointment on Friday. Ritu joins it with her analysis on Bob.
Well, Reema, it was it was a healthy quarter for Bank of Baroda. Profits grew by 11%, and that was led by a very good growth, actually much better than most of its peers when it comes to the loan growth. There was margin expansion, lower OPEX, and that offset some of the weaker treasury income that we've been seeing across public sector banks. The core income, net interest income, grew by 8.7%. Loan growth was at 16.5%. Margins expanded to 2.89%. Asset quality also improved. Gross NPA at 1.89%. Net NPA even lower at 0.45%. The bank used some of the IT refunds it got in the quarter to create about 1,500 crores of floating provisions to strengthen its buffers ahead of the ECL guidelines coming in. And going ahead, margin is expected to stay in this range of 2.75 to 2.95. Credit growth is raised to about 12 to 14%, and deposit growth at 9 to 11% for FY27.
So thank you very much for that. Good quarter and a guidance raise on the credit growth going forward to 12 to 14%. Back to Mangalam on Swiggy.
Well, Swiggy is a mixed set, because their food delivery business did extremely well, 22.5% plus GOV growth. The street was working again with a number between 18 to 20% because of their guidance, and it's industry beating. It's done better than Eternal as well. There was margin expansion, but quick commerce, on the other hand, actually reported slower growth than peers because the companies said that they are focusing on profitability. So if you look at the reported numbers, they're in line with what the street's estimated range was. Revenue of closer to 6,400 crores, EBITDA loss of around 700 crores, net loss of around 800 crores. Nothing that the street wasn't anticipating. But here, the mixed nature of these numbers will perhaps keep the street on tenterhooks when it comes to stocks, because food margins expanded, gross order value grew 22.6%, but Instamart NOV grew just 60% was the expected 80% plus growth. EBITDA loss it was in line with street expectations of 800 to 900 crores. And if you compare it now to Eternal, the food delivery business is comparable, 22.5%, 22.6%. But quick commerce, look at the gap. Eternal grew at 95% at a much larger base, whereas Swiggy grew just about 60%. And Eternal's contribution positive, whereas on an NOV basis, Swiggy is minus 2.5%. They have half the number of dark stores, but they still have enough cash. So let's see how the stock goes. I'm going with a mild red on Swiggy because of the weakness that we've seen in quick commerce.
All right, Mangalam, thanks very much for that. Well, let's focus on ABB, which was, I guess, a little disappointing with numbers. Vinny is here with details. Vinny, morning.
From ABB in Q1 calendar year 26, miss on all the fronts that you're seeing, whether you look at revenue, profits, or the margin of the company. Now, margins, obviously, this time they were impacted. Why? Because there was raw material inflation, rupee depreciation, revenue mix, as well as pricing pressure. So margin contraction and came in at around 12.85% versus 18.6% last year. Now, order inflow, that continued to do well, right? We're seeing a 25% growth in terms of order inflow. 4,280 crores is what the orders stood at. What was supporting it? Orders came in the data center space, railways, renewables, utilities, infrastructure segment. Do not forget, from this quarter onwards, the company has actually completed that sale of the robotics business as well, which is in line with what the global parent ABB has also been doing and has announced as well. Concall highlights also came in. They said that there was an impact of West Asia that came in. PAT margin guidance that they gave for the next year would be in the range of 12 to 15%. The company has taken price hikes already, and they could consider some more in terms of the price hikes as well. Large projects, they highlighted that they were seeing some ordering continued, but with some elongated time for decision making. So delay in decision making was a concern. Automation, industrial capex projects, especially, that they were seeing some bit of a delay coming in. And automation segment, that's why has seen a bit of a weakness this time as well. Competition that came in from Korea, Japan, China, that continues as well. So that will be key to watch out for. But weak set of numbers, and brokerages have downgraded the stock as well.
Okay, all right. Thanks a lot for that, Vinny. Well, let's hop across to Divyani. She's here to tell us about MCX. Those numbers look quite good. Divyani?
Well, a strong growth coming in from MCX, and that's despite a high base that was set in Q3 of FY26. Now, keep in mind, commodities by themselves had a great quarter, ended March 31st, 2026, and with gold and silver touching all-time highs globally, massive intraday volatility that was seen across bullion, crude, that is energy, as well as metals, primarily on the back of the West Asia tensions. And as a result, average daily turnovers have reached 5.4 lakh crores for the full year FY26. Now, this is also reflected in the numbers seen by MCX, with Q4 actually beating estimates across the board against Bloomberg estimates. Now, revenue came in at 889 crores, up 34% on a quarter-on-quarter perspective, with EBITDA coming at 666 crores, up 35% on a quarter-on-quarter perspective, with margins expanding to 75%, up 50 basis points since last quarter. Now, net profit reached 530 crores this time around, up 32% since last quarter. All in all, a strong showing from the company, going with the green on MCX in trade today.
Okay, well, JSW Infra in focus. Devani, thanks for that. Vivek has got this one. Vivek, morning.
Well, good morning. Remember, JSW Infra had highlighted during the course of the quarter that one of the terminals in West Asia had been impacted, and the street was fearing the worst in terms of numbers. But the numbers have come in healthy, and the company has managed to meet its FY26 EBITDA guidance. Revenues higher by 18.5% on a year-on-year basis. EBITDA up by 20%. Margins quite strong, a 50 basis point improvement. Profitability down by 18%. This on account of a 68 crore hit that the company took on account of the hit that they faced in the liquid terminal at Fujairah. Cargo handle volumes managed to go up, inch up almost 1% on a year-on-year basis. The company has given granular details for FY27 in terms of the guidance. Revenue expected at 6,850 crore, operating EBITDA at 3,000 crore. One important thing to watch out for in JSW Infra would be the management efforts at going ahead and diluting stake or reducing stake, and this could probably be via an offer for sale route or an equity raise route. JM Infra has gone ahead and said key triggers to watch out for as far as JSW Infra is concerned is tariff hike at Mangalore, ancillary services, group cargo performance, and the ramp up in the logistics segments. Remember, they've recently acquired Navkar as well, going with the green.
Thank you. And one final one, Bal Krishna Industries. Sudarshan joins in with the numbers.
Good morning. So it was a steady set of earnings from Bal Krishna Industries and supported by the volume growth that company has seen for second straight quarter. In Q3, it was up 6%. This quarter too, it has increased by 5%. And because of that, revenue has increased by 7%. EBITDA too has seen a jump of 5%. Margin continues to remain hold the levels about 21%, 21.4% versus 21.9%. But beyond the earnings, company also has given the outlook for 2030 and expects revenue to increase 2.2 times and margin after completing everything that company is planning to remain in the range of 23 to 25%. So I'm going with green.
Thank you very much for that. Lots of stocks, all important ones to track today. We can't, can't take our eyes off from crude. Crude prices are rising. Manisha joins in to tell us what's happening.
Morning, and thank you for that. Really, as we've seen, it's quite a surge coming in. Remember, last week was nearly 6% of a decline. This is after US and Iran, in some sense, agreed to a peace proposal, is what the markets thought, but clearly it is not happening with the kind of statements we've seen come in from US. Now, the original US proposal, as per report, says that they're asking Iran for a 20-year halt to Iran's uranium enrichment activities, removal of highly enriched uranium stockpiles as well, and dismantling of key nuclear facilities in exchange for sanction relief. Now, Iran's been asking for an end to U.S. naval presence, lifting of sanctions, security guarantees, and recognition of Iran's right to continue some nuclear activity, clearly not meeting on a middle path for both of those countries there. In the meanwhile, you have the world, which has lost 1 billion barrels over the last 2 months. There are renewed the clash that we saw in the previous week as well. And then a state Kuwait's army saying that they have detected and dealt with several hostile drones in the country airspace, seem to be adding geopolitical premium back in case of crude oil prices. The street will, one, watch out for development from this. And then, of course, the U.S. President's Beijing meeting, which is between Wednesday to Friday. The focus is likely on trade, Taiwan, and the Iran conflict. So there's a lot to watch out for. Within all of this, we've seen strength come back in case of dollar index, which is weighing on various other commodities. And then you have the China producer prices, highest in last 4 years, kind of supporting the metal prices. So when you look at copper, that's up 1%, and many other base metal prices trading in positive as well.
Thank you very much for that. Get into a break. On the other side, we'll connect with the management of Senko Gold to discuss Prime Minister Modi's advisory on gold purchases amidst the West Asia crisis. Stay tuned.
All right, welcome back. Well, with gold, with tensions escalating in West Asia and fears growing over disruptions in global oil supplies, Prime Minister Narendra Modi has issued a national advisory. The Prime Minister also stressed on reducing gold purchases, saying gold imports consume a large proportion of foreign exchange. To discuss this and see what exactly could the impact be if in case there is some curbs, we're now joined by Mr. Suvankar Sen, who joins us on the show, the MD and CEO at Senko Gold. Hi, Mr. Sen. Good morning. Good to see you again. What do you make of Prime Minister's comments? Are you bracing for some kind of import restrictions on gold? Your initial comments.
So, as citizens of the country and members of the industry, we need to understand that, based on what, situation our Honorable Prime Minister has been, announcing these various curbs. It is the Middle East crisis, which doesn't seem to end while everyone is hoping for peace and the crude oil prices going up. The bills for import of crude oil is going up. So I think that maybe for a short period of time, we all must, as citizens, try our level best as industry that how we can help the nation to overcome this challenging situation. We need to keep certain facts in mind. One is that, in the whole of last year, if we look at the import of gold, and especially the import of gold related to jewelry consumption, it's down by almost 20%. Even the Q1, as per World Gold Council report, we've seen that the consumption of jewelry and the gold import related to that is down by almost 20%, 14 tons, and the investment demand has been higher than the jewelry demand. So that is number one. Number two is that in the industry overall, if you look at it, about 50% of the consumption is led by old gold exchange. So therefore, it's not that consumers are buying with their money, but also exchanging their old gold. And as an industry, we've been in talks with the government for quite some time. And I think that right now it is more needed that the government and the industry comes together on ensuring that this 20,000 tons of gold and more than that is lying in our economy, lying in our country in various forms, whether it be household gold, temple gold, how we can use those gold and then use it for the industry, because for the industry, it is providing jobs and employment to so many karigars. It is a source of income from exports. So the gold lying in our economy itself is a great resource, and we can aramse reduce the import if we can use the gold lying in our economy. As an industry, we are promoting and exchange, ensuring that the consumers are exchanging their old gold.
Suvankar,
so that's how it is. Yes.
Yeah. So the import of gold for jewelry consumption, how do you different? I mean, you said it's down 20%. How do you differentiate? Gold comes in as gold, right?
Yeah, gold bars are coming in, but then as per the research, whether it is going to ETFs, whether it's bought by mutual funds or, for investment demands for bars and coins. So there are these research reports done by World Gold Council that states that, okay, so much of quantity of gold is used in investment purposes and so much quantity of gold is used in jewelry purposes. And that is where it has been seen for the first time in the last quarter that the investment demand has been higher than the jewelry demand. Okay. Usually, jewelry is about 40-45%, but this particular last quarter, it's been about 25-30%, while the investment demand went up by 50%.
And 50% of what you said, gold jewelry sales in India is led by exchanging of old gold, basically, right? That's what you said. Exactly. This is across the board.
Exactly.
Yeah. Do you think there will be import duty hike?
Well, based on our Prime Minister's thought process, if there has to be certain policies that has to be done in order to discourage, import of gold, duty hikes could be a possibility. But till it is being done, these will only be, speculation whether it will happen or not. But because there is another, at the other side, there is a World Trade Organization mandate across the various countries that we must reduce duties on gold. So that is one mandate that is going on. Parallelly, this crisis is also there. So it's a speculative thought process, but it is always a possibility like the past.
So just hypothetically, going with the possibility that there is perhaps an increase in the customs duty on gold imports. It's happened in the past. And when it did, can you tell us how did the imports of gold come down by? To what extent? And did it slow down growth for the organized sector?
So, 700 to 800 tons, no matter what the prices have been. Because out of the import of 700 to 800 tons, about 20-25% of the gold gets used up for exports, and the remaining 75% is used up in either domestic consumption for jewelry or for investment. So it will maybe create a dent of about 10 to 12% reduction in terms of the volumes that gets imported. So that's one impact that we must take. But from an industry perspective, I must tell all of you that over the last 1.5 to 2 years, anyway, the industry is working towards, because the gold prices are so high, that how we can ensure that the consumers can keep buying. So we are reducing the weight ranges of our product. We are trying out with 9-carat jewelry, 14-carat jewelry. So if we can go back to those olden times in 1970s and 1980s, when there was gold control, then that was the time when a lot of stones were being used in the jewelry. The purity of the jewelry was lower. Right now, hallmarking is there for 9-carat, 14-carat, 18-carat. So even the consumers are opening up to experimenting with lower caratages for the jewelry that they have. I think that, yes, till this war is over, industry, consumer, government, we all work together and ensure that, yes, as long as the industry's income comes from the making charges. So as long as we can make the overall budget lower and can ensure that the job workers are getting the jobs and the industry is going on. But
Mr. Sen, sorry to interrupt. So you're saying that if there is an import duty hike, there is a possibility of a reduction in volumes, and your guess would be 10 to 12%. You also made one statement, and maybe I missed it, I didn't hear it correctly. You're saying India will import 700 to 800 tons irrespective of the gold price?
That's been the historical past. If you ask me, I think this particular year, because seeing the Q1, like Jan to March, the import that has been done, it is around 140 tons approximately, which if you can multiply it by 4, then maybe this particular year gold import will come down to around 550 tons approximately in a conservative approach. So we can already see that the import of gold is going down in our country.
Yeah. Got that. Absolutely. And good that you came on and answered some of this stuff and spoke with us freely. Always appreciate it, Shivankar. Thank you very much for joining us here on CNBC TV 18. It's a pleasure. So we'll see what comes through. But I mean, the appeal from the Prime Minister is clear: cut back, and it's with gold, it's with oil, it's with a bunch of other things as well. We'll take a quick commercial break here. We're going to come back. Dharmesh Kant of Chola Securities is going to be with us for some fundamental stock conversation in just a bit. Stay with us. Okay, welcome back. Dharmesh Kant is with us with a quick sense of things. Dharmesh, everything which has happened, let's identify where stock-wise, where action, or maybe group of stocks where action will be most concentrated in. How do you think about it?
Yeah, very good morning to you, Prashant. Thanks for having me for the show. I mean, the appeal which was made by the Prime Minister is quite scary if you put the dots together. I mean, 45 days back, he has addressed thrice that ye lamba chalega on the wall in the parliament as well as in the public address. And now this appeal has been made. The unit economics goes to even, individuals making a foreign travel and consuming gold for marriage ceremony, which is quite sentimental for Indians. So it's a very strong appeal. Usually appeal is followed by, the rollout, depending upon the acceptance of the appeal, which happens. So this is quite scary. We have highlighted this in our 38th of March strategy note about the things which is about to come and how it was tackled in 2013 when FCNR and gold import duty hikes and everything was there. Maybe that is in the offing. As of now, to our mind, I mean, going by it, Prashant, when this is rolled out, when the appeal turns into a rollout, I think that will mark the bottom of the market because then you know what the hit can be there. The measurements are already in place. And the fundamentals are still strong of the economy going forward. So that is what has happened in the COVID. The day the lockdown was announced, that was the day of the bottom of the market. So we are looking at it constructively, maybe a couple of weeks of more volatility. But where the numbers have panned out, I mean, I will just give a highlight of Q4 numbers. Around 320 companies we have measured on aggregate basis, which is ex-Nifty. There, for the financial year, the number has grown by 15% on a PAT basis. But if you look at Q4 numbers, it has grown by 33%. So, I mean, underlying fundamentals of the economy has been pretty strong. Only Nifty 50 has been a bit soft-ish of around 7.5% kind of a growth. But otherwise, it's going strong. Jewelers will definitely take a hit today, depending upon what the appeal has been made. But apart from there, I mean, stock-specific plays should not be there on the positive side.
Hi, Dharmesh. Good morning. Good to see you, Ben. Well, SBI, that was a big casualty, right, on Friday. The street didn't like the numbers too much, and the stock really took a sharp knock. What's your take on the numbers, and how would you approach the stock? Now it's closer to around $1,020 in comparison to that $1,150 earlier.
Yeah, good morning, Raj. I mean, that's the problem. Q3 numbers of SBI was still a set of numbers, and then we saw a strong uptick in the stock price. And see, it's a very big company, around 50 lakh crores of AUM is there. And on that basis, 1,000 crores of slippage is minuscule to my mind. The numbers were not that bad. The problem with all the banking space, if you look at the numbers consecutively, is like that. The advances growth has been around 15-16% on an overall basis, but the net interest income growth has been in single digit or high single digit, and that is where the problem is rising because that percolates to a lower, profitability of pre-provisioning operating profit. Why this has been there? Because of a declining interest rate trend. This is normally the scenario. I think from here the interest rate will be stable if it is not hiked by the measures taken by the government. So it's a buying opportunity to my mind. But the best number which came out from the public sector banking space was of Bank of India with 16-17% kind of an advances growth and 10% plus NI growth, 10-11% kind of a profitability growth. So I think, and they have already made most of the provisions. And valuation wise is cheap. It's trading at 140 rupees stock price, which is 0.7 times price to book value on the TTM basis. So a catch up can happen there. So any declines in the market, I mean, should be used to buy both. I mean, SBI and Bank of India.
All right, and I think you were positive on Bank of India earlier as well, and then I think the stock went up, and then you advised profit taking, but you're saying it's providing a good re-entry opportunity at around 140 rupees. Is that correct?
Yes, sir, definitely, yes, Nigel.
And you would be looking at a target of?
So initial target now, since the numbers have rolled out, it's been revised to 170 now on the 1 year forward basis.
Okay, all right. Quick word on Concord. Our Prime Minister Narendra Modi, he's also spoke about rail freight, and he was encouraging that. Now, Concord is a stock that's come out drastically from the top, but if in case there is some kind of movement towards rail freight, then from road to rail, then they could be a potential beneficiary. I think that could be one of the stocks, maybe on a sentimental basis, but it could be one of the stocks to watch for today's trading session. What's your view on it?
Definitely, yes, Nigel. I mean, warrants are trading better at the current levels. I mean, valuation and multiples can be hard to assign because it's more of a situation specific and a cyclical kind of a trade which can play out. But looks like, I mean, petrol and diesel price hike can also be there in the offing very soon. I mean, it's about to happen. That is what our understanding is. So Concor merits trading better, but fundamentally from a long-term basis, I mean, 2 years, 3 years. We are not very constructive on this space.
Okay, thank you very much for that. We will slip into a break. We'll come back and get in the pre-opening rates. We'll also be joined by Bernstein's Pranav Gundapapale to talk about the key banking earnings over the weekend. We'll also connect with a technical analyst for some trading ideas. Welcome back. Brace yourself for a gap down opening. Crude prices have risen to $105 per barrel, and Prime Minister Modi's appeal sort of highlights India's vulnerability, fragility when it comes to the current account deficit, the INR, and that perhaps could weigh on the markets. Mitesh Thakkar, Sudhanshu Sukhani are now joining in for a few technical trading ideas to prep you up for the day and the weighing. Gentlemen, good morning. Thank you for joining in. Mitesh, begin with you. Still in that range on the Nifty, get pushed back a bit. What's the call?
Good morning, Nima. I think yes, very much. See, what is most important is that the indicators are still flat. And while, we've gone to about 24,480 and then bounced back from 23,800, 850 zones, I think there's no sign of a directional bias happening. So I'm presuming that this range will extend for a few more days at least. And on the upside, as I've said, 24,400 is the level above which a closing can at least signal some kind of upside. But till that happens, I think we are in this 23,850 to about 24,400 kind of a range.
Okay, all right. Good morning, gentlemen. Sudarshan, coming across to you. What's your view? Be brave, don't be brave. What's it like?
Good morning. Don't be brave.
Don't be brave.
Nigel, first we went to 23,800. That was a correction. It was a buying opportunity. The second time we went there again, it was a test of the lows. That test was successful. The Nifty went up 700 points. Now, why are we going there for the third time? That's a cause for big worry. So this is not a buying opportunity. This is something we have to wait and see if is 23,800, 850 going to hold, or has the market finally decided on a direction which may be on the downside. We don't know, but we don't want to buy and find out we were wrong. This is a complete avoid now.
Stocks, Sudarshan, would you play the stocks? Because there's so much action, momentum in the broader markets, the mid caps, small caps.
You asking me?
Yes, Sudarshan.
Okay. See, stocks normally follow the broad market, the Nifty, but within that, there are buying opportunities. Astral is a buy with a stop under 1535. HDFC AMC is a buy with a stop under 2790. There are two short sells. Policy Bazaar is a sell, stop above 1680. And KPIT Tech is a sell with a stop above 740. So two buys, two sells. Don't rush for the buys. If the market decides to go down, nothing will hold it.
Mitesh, what would your stock calls be? More long or more short?
No, I think like Sudarshan, I have two buys and two sells, and yeah, a similar kind of approach that buyings are recommended on a mild decline. So buy on Coforge if it comes down by about 10-15 points, so let's say around 1360, 1355. Buy Coforge with a stop below 1335 for a target of 1410. Also a buy on NBCC around 99.5, 99 zone. Keep a stop below 96.5. Look for targets of 105. And on the selling side is Dalmia Bharat. In fact, it was a sell on Friday as well in the closing show. So Dalmia Bharat is a sell now with a revised stop at 1855 for a target of 1760. And a sell on ABB. I think first signs of profit booking after a very good rally over here. So ABB is a short-term trading sell with a stop of about 70.65 and a target of 6,840.
Got it. Okay. All right, gentlemen. Thanks a lot for joining in and giving us those details. Mitesh, quick word on ABB, the sell call and the target prices?
Yeah. So the target price is 6,840 and the stop loss is just about 70.65.
Suggesting it's going to start off a little lower. So I think we'll have to revisit that call. Maybe at 9:10 we'll have a relook at that because it's could be possibly starting at around 6,300. So we'll come back to you, Mitesh, with regard to that call on ABB. Thanks, gentlemen, for those calls. By the way, keep an eye out on the Indian rupee. Straight out of the blocks, it's headed towards the 95-odd mark. So we closed at ballpark around 94.5 odd. It suggests a start closer to around the 95-odd mark. That's not a very, very good sign. Some kind of weakness, but I think that was on expected lines. So we'll just wait for that rate to stabilize out there. But let's turn our attention to the banking names. State Bank of India had reported a mixed set of numbers. That's the Q4 numbers. The weakness was impacted the profitability, while asset quality remained more or less stable. Let's listen into what Chairman Mr. Sethi had to say on their Q2 performance and the way ahead.
NII impact in Q4 was essentially because there's been a repo rate cut in December 15th last year, and that has been fully factored in the Q4. That is number one. Number two, I think there's been a good improvement in our EBLR portfolio. That is also adding to certain amount of NII reduction. But I believe that our guidance in terms of NIM being above 3% still holds good for the current financial year, and we have no concern in terms of managing those margins. So the credit growth, as we have witnessed in the last year, is going to be broad-based across the retail segment, agriculture, MSME, and corporate. The current pipeline itself gives us visibility in terms of what could be the corporate credit growth, which gives us confidence. And as I mentioned, I think we are witnessing continued robust credit growth in the current quarter also. So based on that, assuming that this West Asian conflict has not lingered longer, we are very hopeful and confident that 13 to 15% credit growth is eminently feasible. Guidance for the current financial year also is remaining the same level of our usual guidance of 50 basis point credit costs, and the gross and the net NPAs, as you mentioned, are the decadal lows, and we have not seen any stress at this moment in terms of the asset quality at in any sector at this moment.
Well, that's SBI for you. Big miss on numbers on NII, on net interest margins, and stock cracked nearly 6-7% yesterday. This morning, pre-open, it's flat. We have with us Pranav Gundapalli, Senior Analyst, India Financials at Bernstein, now joining in. Pranav, do you think this is going to be a one-quarter negative number for SBI and it bounces back immediately in Q1? Or it sort of lingers because the stock has gotten re-rated very sharply. So valuations are not what they were, say, 2 years back. What is the call now on SBI and your view on the numbers?
Morning, sir. I think on SBI, the NIM drop that we saw this quarter, we do think is one-off, and we expect that to bounce back soon. So not particularly concerned on the NIM, and there is a clear driver for that, including the sharp growth in corporate credit, very high rated corporate credit, which is also visible in the drop in risk-weighted assets, etc. But taking a step back, looking at the overall PSU picture, we think the risk-reward isn't that great, given that we will see a moderation in profitability. I mean, not to the same extent as what we saw this quarter, but the direction of travel is towards a lower ROAs. And second, you also have potential headwinds coming in from ECL implementation in 27. So we'll get more data around the potential impact of that in the next few quarters. And we also have, the usual macro risks that kind of linger on. So not particularly bullish. We prefer the private sector over the public sector banks. But specific to the NIM miss, we do think it will change or it will correct in the next few quarters.
Now, we're not going to be rushing in to buy SBI post this correction, right? Or do you believe risk-reward is attractive?
We don't think the risk-reward is particularly attractive. There are probably better prospects with the private sector banks, which appear a lot more cheaper versus their history. So maybe there versus the SBI.
Okay, so private versus public sector banks is what you think. And off late, we have seen in the recent past, at least, the PSU banks actually have outperformed. But you're saying that now private is top of the list. Quick word, Pranav, with regard to these measures that could be announced in the coming days. And our Prime Minister's comments overnight, they seemed a little bit cautionary. It could slow down the economy a little bit. What kind of credit growth are you working with for this year? And any kind of rate action from the RBI is what you're factoring in?
Okay, we are not factoring in rate action. We are at around 14% credit growth for FY27. That is what we expect. And built into that expectation is an assumption of almost a stable rate regime, with liquidity being not in a borderline deficit in liquidity. So RBI stepping in to manage currency, which means your liquidity will remain tight, and hence credit growth will remain at 14%, which means it will be slightly lower than where we are today, at close to 15 to 16% mark, and led by a generally tight RBI policy to protect currency.
Pranav, do you look at Bank of Baroda? Numbers look good. They have gone ahead and raised the guidance on advances to 12 to 14%. A view there?
I think loan growth for the PSPs in general should remain higher. They should get to that mid-teens growth. Given they have excess liquidity, there is a surge in corporate credit growth, given that the corporate bond yields have inched up significantly, making banking credit more attractive. So credit growth, we don't think will be a challenge across the board. But for the sector itself, we think we are looking at about 14% growth. So which means your Baroda guidance would be roughly in line with system at the upper end of their guidance.
I guess growth also gets boosted by the ECLGS, the 5.0 scheme for many of the PSU banks. So your top pick in the banking space, one where the risk reward is most favorable?
We like Axis and HDFC. Axis more as a tactical positioning where they have the right capital and a few other things working for them. HDFC, given potential for asset quality deterioration, that remains our top pick as well. So Axis and HDFC would be our top picks.
Okay. Pranav, do you track the gold financiers?
Oh, yes. We do track Muthoot. And it becomes a proxy for gold. Yeah, sorry, go ahead.
That's true. No, Pranav, the reason I asked you is because suddenly, we have heard these comments overnight about delay your purchases of gold and maybe import duties coming in for gold as well. That could put the sector in a bit of a tizzy. Gold financiers did well when gold ran up. What's your view right now with these restrictions coming?
See, I think restrictions on gold, jewelry or import would result in a hike in price, right? So I think which actually works to the advantage of Muthoot and the gold loan segment in general. I think the concern with Muthoot would be, and gold financials in general, would be any RBI action specific to the segment and to a broader slowdown in consumption, because most of these are, at the end of the day, consumption loans. So it's more macro risk rather than specific action on imports, because that eventually drives gold price up, which is actually good for these lenders. So don't see them as directly impacted by any potential gold import regulations compared to jewelry names or other names that are more directly impacted.
As of now, you're positive on both these two names, Muthoot and Manappuram?
We remain positive on Muthoot. There is, of course, a proxy for gold price, but assuming a stable-ish gold price, we remain positive on Muthoot.
Appreciate you joining in, Pranav. Wishing you a good day ahead. And thanks a lot for your comments on both the PSU as well as the private banks and a brief take on the gold finances as well. Have a cracking day ahead, mate. Well, let's get in. Sudarshan back on the show. Sudarshan, tell us what's your 910 call?
It's a HDFC AMC buy with a stop under 27.90.
Okay, got it. HDFC AMC, that's the buy call coming in. Mitesh, you want to revise that ABB call? I think we should get that rate that is settled out. And also if you have a fresh call for 910.
Yeah, in the morning I was not aware it will open with such kind of a gap down, so it's difficult to figure out, in pre-markets, how do we stack, how the stocks will open. So ABB, of course, you can't now take a trade if it's opening about 5-6% gap down. But yeah, I think Dalmia Bharat, if you get it, I think that's a good call in this sense out.
Dalmia Bharat. Thank you, gentlemen, for joining in. Let's talk about ABB India. That could be the casualty of the day when he joins in to tell us exactly what disappointed the street when it comes to ABB India.
Hi, so yes, for ABB India, the numbers overall were a miss from what the street was expecting, what we were expecting at CNBC TV18 as well. Revenue just saw a growth of around 5.7%. So there seems like a bit of a slower execution that's come in some of their segments as well, specifically the automation segment, which has seen a weak growth this time, and in terms of slower execution as well. Margins, obviously, that also saw an impact coming in. What impacted the market margins? Raw material inflation, rupee depreciation, revenue mix change, as well as pricing pressure. These are the big concerns that come in for the margin front. Revenue profitability also was affected by that West Asia war. Now, order inflow, that was stable at 25% growth. What led the growth there? Data centers, railways, renewables, utilities, infrastructure, that continues to do well for the company, but other segments are not doing well. The company also has, completed that sale of robotics division, so there is that one-off that comes in for the company in that case. Now, Concall highlights, they talk about margin guidance, PAT margin guidance to be in the range of 12 to 15% next year. They said they've taken price hikes already in select segments, and there could be some further price hikes, so they're considering that as well. 12% of the current order book comes in from the data center business. Large projects are seeing some bit of a delay in terms of decision making, specifically for automation as well as industrial capex side. There is some bit of a delay, and there is some competition that continues to remain from Japan, Korea and China in their segments, so that also is a concern for them. And because of all of this, we've seen downgrades coming in from brokerages as well. Prabhudas Liratar has downgraded the stock to a hold. Target price is at 6,523. Nuvama has downgraded the stock. Motilal Oswal has downgraded the stock. So we're seeing a lot of downgrades that are coming from brokerages. Weak numbers, clearly.
Thank you very much for that. In pre-open, the top gainer is Tata Consumer. Top loser is Titan. That's down 3.5%. Both stocks that Mangalam looks at very closely. But Mangalam, let's talk about Tata Consumer. That's the only bright spot today.
Well, that is a bright spot today. 16% volume growth is what the company has reported as against street expectations of double digits. So it's a good set that has come in. Even if you look at their revenues, they've been much ahead of street expectations at around 17% growth. And the EBITDA margins at 14.6% as well have a mild beat as against our expectations of a little over 14% too. And all of this has meant that the bottom line has also beat street expectations. If you look at the other parameters of growth, beverages, they grew at a volume of around 4%, pretty much in line with the street expectations. But food business, their volume growth was mid-teens, and that's above what the CNBC TV18 poll threw up. And Sampann, which is the growth business of the company, grew over 69% as against 35 to 40% sort of growth that was expected. And add to all of this, the prognosis for growth for the next year as well, leading to their go-to-market strategy for a lot of their brands is extremely good as well, and which is why the stock is higher in trade today.
All right. Mangalam, thanks very much for that. Tata Consumer in focus. I think maybe a quick read-through of all the names that we've put out since the morning with stocks which are going to open up and lower. Jewelry, maybe if you have a hotboard, sort of a quick sense of where these stocks are opening, we should have it up. Kalyan is there, Titan, Senko, etc. should come up on your screens as well. Titan is down 3.5%, and Senko management we spoke to just a while back is down about 4.5%. IOC, HP, BP, maybe just a quick look at those, and then we'll get into some of the result reactions and how they're reacting. So IOC, small, 1.25% lower on these names. Fertilizer is another pack, right? Maybe look at Coromandel, and Chambal and RCF and some of the others, and look at nothing very much. I mean, flattish, right? I mean, Coromandel, Chambal, etc., down in line with, I guess, what the market's going to start down by. First rate should be up on your screen shortly. The Nifty is going to start down by how much? 23,900 is the level on the Nifty at this point. The Nifty Bank starts at about 54,670. The small cap index, do we have a rate yet on the small cap index, or I don't think we do. We'll just wait for it. The advanced declines, this is very, very initial, but and not very much seems to be changing, but it will as we go on. Small cap index is down, 1% lower. The mid cap index is down as well. So everything is down uniformly by about 1%. Mid and small caps, of course, huge outperformance. We've seen in the month of April. Actually, the small cap index had the best April in a long time, I think in over 10 years or so. So you're coming off very, very strong gains. Of course, bounces off the lows, but they are gains nevertheless. The heat map should give you a quick sense of where the Nifty 50 stocks are starting. I think that'll be something to look at. Titan, Indigo, SBI, Shriram Finance are lower. Tata Consumer, ONGC and JSW Steel are stocks which are starting in the green. It's a 1% cut, 250 points. Rima.
Well, all the gold jewelry companies are under pressure. Titan right on top, that's a 4% knock coming through. But pull up a Kalyan, pull up a Senko, these stocks down 7-8%. So bigger cuts coming through. The street is clearly worried about a sentiment impact. Will demand get hit? Senko and Kalyan both down 8% in trade. Interglobe Aviation, so travel tourism, that's the other pocket under pressure. Interglobe Aviation, and plus there's been such a rise in crude prices, 105.5 on Brent crude prices. SBI continues to see selling pressure for the second day in a row. On Friday, it was down 6-7%, another 3% lower on SBI. Auto companies are weak in trade. So M&M and Maruti Suzuki are losing about 2.5%. Shriram Finance caters to many of these auto companies in terms of lending. That's under pressure with a cut of about 2.5%. In terms of the bank Nifty, the Nifty Bank is down nearly about 0.9%, so moving largely in step with the frontliners. On the way up, it's Tata Consumer. Stock has hit a fresh 52-week high. Stock has surged 3.5%. So that's the only one where there is some green, and you've got Max Healthcare and a couple of these IT names which are in the green. But again, not a whole lot. It's a soft start. It's a weak start. 250 points lower on the Nifty. 24,000 level on the Nifty has gone, and now we're closer to 23,900.
Got it. All right, Rima, from the broader markets, there are a lot of stocks doing a thing of their own. Quick heel, the stock is up 10%. Mr. Vijay Kedia, I think, bought into the stock, in Friday's trading session. That was what came out on the block deal. So that explains why that stock is up 10%. Rain Industries is up close to 12%. They reported their best ever quarter in multiple years, I think. So, the EBITDA number is now close to around 700 crores. A few quarters ago, they were reporting numbers between 300 to around 350 crores. Just around 4-5 quarters ago, the rough average on an EBITDA basis was around 350 crores. Refinancing of debt, though, remains in the key trigger from here on. They're sitting on a massive debt of more than $800 million, but that's up 13%. Birla Corp from the cement pack, that's delivered a good set of numbers. We at CNBC TV 18 will be quizzing the management at around 10:30 a.m. today. So, stay tuned for that conversation. For the timing, the stock has popped up in trade. Niva Bupa, we'll be talking to the management in a few minutes from now. That stock up and about in today's trading session. Sterlite Technologies, a stock that started last week at around 300 rupees. This week, it opens up at close to around 400 rupees. That's the kind of momentum that we're seeing on this stock, and it's already locked in upper circuit. Big up move is what we're seeing on that name. Bank of India, another management that we'll be talking to. That stock is up close to around 2%. Net, the Nifty is down close to around 250 points. Broader markets under pressure. Let's see if the dip gets bought into. But the initial reaction is negative for now, with the Nifty Bank down 650 points.
Absolutely. Let's just look at the ABB move is large, right? 9.5% lower on a large name like ABB, urban company. Lots of, all of this. Not related to oil and all the cutback appeal from Prime Minister Modi. I mean, enough happening outside of all of that as well with regards to earnings and what companies have done. Gautam Chachoria is with us. He's head of global markets at UBS. Gautam, great to have you with us here. Thanks for joining in. I mean, what do you make of it, the appeal by the Prime Minister, and do you think this is a precursor of things to come? And what things, in your opinion, if you were to just sort of think through this, Gautam, in your sense?
Morning. Look, that's what investors are talking about. That is this a precursor or not? It's tough to guess or speculate. But if we go by history, obviously India has had policy measures around gold imports. We still have the local fuel prices being behind versus where the international prices are. Very unlikely any changes happen to LRS, etc. But who knows? But that's what the investors are talking about in the morning. Is this a precursor or not?
What are you telling them, Gautam? When they're asking you this, they're looking for answers. What are you telling them?
Look, it's a question of probabilities, right? Like if you just go by history and where India's macro situation right now is and how vulnerable it is to a prolonged Middle East scenario, like measures to increase local fuel prices, I think is quite likely. Degree and extent timing is debatable, but quite likely we see increase in prices. The others, well, it depends on the tenure of the stress from Middle East. Like we will see any measures around gold, etc. I think that will take more stress possibly than what we have seen till now.
So Gautam, when you speak to investors, what else are you talking to them about? What are the key points top of mind? Like once again, when I look at the Asian markets, I can see a Kospi up 4.5%, with Samsung up 6-7%, SK Hynix up another 10% plus. I mean, what are the top talking points now, and what's your response to that?
So look, the global investors in equity markets, their sentiment, etc., are back to before the Middle East conflict. I don't think we are at a scenario where they are too worried about this prolonging. Unlike, say, crude or parts of say, currency, the equity side, the narratives around AI, semiconductors, capital goods, both narrative as well as positioning and ownership are back, as if they won't be impacted or there shouldn't be much to worry about. The broader equity risk positioning globally is more like neutralish, but back to pre-conflict levels. Not yet signs of a more bullish narrative. Like I think the pre-Middle East scenario, we had scenarios of investors starting to move from large caps to small caps globally, etc. That's not yet happening globally. But the usual or more popular holdings and narratives around semiconductors, AI, capital goods, that's back to normal trend.
Hi Gautam, good to see you. Gautam, should we throw in the towel and not expect the FI money to come back with the kind of moves that you've seen in other Asian markets, some of the emerging markets as well? They don't seem to be in love with us.
So look, the way to put it is it's still early days for them to come back in any meaningful way, because it's not that they're not in love with India or they're giving up on India, etc. The holdings in India still remain sizable, somewhere in the range of $700 to $800 billion. They're still engaged with us regularly on bottom-up ideas and opportunities. They still make trips to India to look at opportunities. So the belief about the longer-term potential still remains there. Obviously, there have been some investors who've been more worried about the impact of AI or lack of AI in India, especially including the semiconductor part. But I don't think that fundamentally anything has changed where they really want to get out of India. I don't think so. What we need is two simple things. One, obviously, globally, we are in a period where the growth in the AI and tech-driven economies and markets are just very attractive. And linked to that, the valuations also are very reasonable. While India has seen a cyclical downturn over the last 2-3 years, we were seeing uptick in the last 3 to 6 months just before the Middle East thing broke out. And if this thing stabilizes and we go back to the growth which we are seeing early in this year, I think there will be enough opportunities to attract foreigners back. But yeah, for the near term, at least for the next 3 to 6 months, doesn't look like they're going to come back in a hurry.
Okay, all right. But as long as they're still interested in various pockets, that'll be good news. Gautam, if you had to pick up your top 2-3 themes that you're looking at, give us top 2 themes. I remember you talking about consumption, QSR, if I remember correctly. In the past, that was something that we had spoken about. Defense and some energy as well. Those are the themes that we spoke about 6 months ago. A lot has changed since then. Top two themes that you have to give us.
Yeah, I think those themes remain broadly similar. Nothing dramatically has changed. Consumption in a broad basket way, but including pockets in FMCG are looking interesting. Secondly, the entire industrial, defense, capital goods, but also with a focus on energy, which I mean power, whether it's renewable or the traditional ones. That's looking very, very interesting because these are the pockets which should not be impacted by what happens globally or the local cycle. And finally, financials still look interesting. Many stocks, there are at attractive valuations, and I'm saying attractive on an absolute basis, not just relative basis, which is not easy to find in the Indian market despite the time correction we have seen. So financials is the other theme which still look very, very interesting from a risk-reward perspective.
And in financials, PSU, private banks, NBFCs?
So we don't have a sector-like strong view because every sector has an interesting idea. But if I had to consolidate our financial services analysts' recommendations, I would say the bias is towards privates and non-bank financials, the bias. And specifically, both private and NBFCs have enough absolute risk-reward opportunities.
The UBS team downgraded India to a neutral. I think that happened sometime in March. At what point, does the situation that's taking place right now, if it prolongs, warrants another round of downgrades?
So that downgrade came from the other part of the business, which is the wealth side. Our EM strategist in our business has been underweight India for, I think, more than a year and a half now. And that stance has still not changed. He remains underweight India in the EM context. And again, it goes back to what we discussed earlier. The mix of earnings and valuations is still not in India's favor on a relative basis versus EM.
So should we expect any returns for the Indian markets from here on, say, till end of the year?
Look, in Indian markets in general, when you have nominal GDP growth in high single digits or 10-11%, there should be some growth irrespective, right? But the rupee has already moved. So in that context, the dollar returns might be tricky. But we should see some returns from India. But in an EM context, we still remain underweight.
Pretty depressing talk for a Monday morning, Gautam. We should.
I would say depressing. There are always pockets where investors are making money and should make money.
Yeah, no. There's always as they say, there's always a bull market somewhere, right? So yeah, I mean, we've had pockets and maybe very niche segments. So talk to us about those where within the manufacturing universe, right? I mean, if you go down the list, there is stuff happening. I mean, and stocks have done well. It's not as if stocks have not done well. And I could pick out one or two, and you'd say, well, that's just one or two. I mean, it's not a broad swath of companies which are seeing rip-roaring rallies. Maybe it's gotten tougher in that sense, right? It's not a huge, big sectoral move, but there are moves still. Gautam?
Absolutely, and that's the point. And India is a very bottom-up stock pickers market. It has been and is still the case. There are enough opportunities as we discuss, and even though it looks less attractive on a Monday morning, there are enough opportunities bottom-up. Like even the last month and a half, we have seen how small mid caps have responded to things, first signs of stabilizing in the Middle East. So clearly, there's lots happening in terms of business growth, earning, and translating into earnings growth. So these mid caps, small caps, when you talk about, there are enough individual level, stock level opportunities, which is backed by actual earnings growth and attractive earnings growth. When I say India and underweight in the EM context, that's a more broader index level market phenomenon. That's where the risk reward in a relative basis may not be attractive, but pockets of the economy and the markets, they seem very, very well placed even now. And having said that, the other point I'll point out is that when you talk to local investors here, again, the large mutual funds, but also when we talk or try to get intelligence around the local HNIs, etc., looks like there is a hope coming back or building up. So that's also interesting, and that showed up in the small mid cap indices or stocks behaving the way they did in the last month and a half. So clearly, if the things stabilize in the Middle East, we could see some pickup in select sectors and stocks, as we discussed the themes which we like. But yeah, manufacturing at a broad sector level looks very, very well placed.
You know, I was just thinking IT services, Gautam, right? Now, that's a space which is beaten down. Nobody's looking at it. Maybe there are real problems and you should stay away. But have you looked at it really hard and maybe, you know, because, you know, it's a space where I guess a lot of people just say, well, there's too much happening. Who's going to keep track of what new model comes through? And at some level, there is that. It's kind of too hard and too muddled and too fuzzy. So let it all settle down. You think that is what is happening here, or it's kind of now well understood that structurally things are going to be tougher and low single-digit kind of growth rates is what we should continue to expect here? What's your sense?
It's a mix of both. I think it's a mix of both. It's too early to be sure. It's still muddled and fuzzy, as well as there are pockets of investors who have kind of given up on IT as a long-term opportunity. So it's a mix of both views out there. And I think our analysts track it obviously very, very closely because it's one of the sectors where there is still a lot of ownership and engagement by the institutional investors, both locally and globally, though globally investors have cut down their IT services ownership in a material way. I think what will be relevant from a tactical positioning also is one, do we see signs of earnings surprising positively? Because in the near term, there is an opportunity for some of the IT companies to pivot their models faster and actually benefit from the AI adoption. And secondly, I think the more relevant part, which there's a healthy debate out there, is valuations. Despite the correction the IT services are seen, compared to the peer group globally, they're still at a premium. So that's the other part of the debate and goes back to the same basic earnings and valuation debate. So at a holistic level, at this stage, not yet attractive risk reward given the uncertainty around how this evolves, and also a view, some part of the markets having a view that this could be bad news longer term. But yeah, we will look out for opportunities, and we have been recommending tactical opportunities when we see specific companies pivoting faster and therefore surprising on the earnings part.
All right, Gautam, great chatting with you. Thank you very much for joining in. May we speak in better times next time. Let's move on now. We've got lots of corporate earnings to track. So Bank of Baroda is the second management on the show now. Healthy set of Q4 numbers, strong growth, stable margins, better asset quality. We have with us Devadatta Chand, MD and CEO of Bank of Baroda, now joining in. Thank you very much, Mr. Chand, for joining in. This is Rima here. Let me begin with the bank raising the loan growth guidance to 12 to 14%, an increase of 100 basis points. What is driving that? And if you could particularly talk about gold loans, because that is doing very well, and even the corporate growth after going through a flat patch has bounced back smartly, 10% plus growth. So the overall numbers, the confidence that you get to achieve this, and these segments.
Thanks, Rima. You said right. We had one of the strongest quarterly growth in last 10 quarters as far as the advanced growth is concerned. And the advanced growth, as against the guidance of 11 to 13, the advanced growth was 16.2%. And the good part of why we assumed a higher advanced growth for guidance as far as 26-27 is concerned, reason being the deposit growth has been very encouraging as far as we are concerned. I think the deposit market, the money is coming back to the banking system. That's something very, very positive. Secondly, we have outperformed our guidance significantly in last year. And thirdly, the basic assumption of the geopolitical issue, we are slightly optimistic with regard to the timelines. So considering all the three factors, we upsized the guidance, the loan guidance by 1%. As against 11 to 13%, we made it 12 to 14%. Specifically talking about the corporate book, always we say the Q3 and Q4 are always productive for us. And because that allows us to significantly, and that's the busy season as far as the economy is concerned. And going like initially Q1 and Q2, slightly the growth was less, and ultimately we ended up at 11.2%. So I think in the same way, if you look at the overall economic scenario in terms of the demand and the area where we operate, particularly the renewable sector has done extremely well. Similarly, the ECLGS is going to give a boost up also this year. So I think we go by the same guidance of around 10% for the corporate loan. Gold loan, my base is low as compared to other banks. So in terms of percentage, it looks higher. But then as far as the asset quality overall, it looks very good as on today. So in the same way, we're still positive with regard to the gold loan.
Okay, all right. Hi, sir. Good morning. Good to see you. When you've reduced your dependence, I think, on bulk deposits, if I look at, the recent quarter, could you tell us what kind of CASA ratio are you looking at, in the coming quarters, if you could help us out with that? And your CD ratio, I think, is holding at around 85% odd. Where is that one headed as well? If you could just give us some brief details.
Look, CASA has been one of the strong points as far as we are concerned, and we have been focusing on CASA for last many quarters. And if you look at my growth of the CASA is 9.8% and the saving is at 9.1%. And we have been the median of the bank's average. We are able to outperform that for last many quarters. We have strengthened the CASA in terms of product, process, service, everything, and that is what possibly is the outcome in terms of a higher growth. So the CASA percentage as on 31st March was 38.9%, which I believe is one of the top quartile in terms of the banks. You would have seen the number. At the same time, going forward also, I think we maintain the similar number. We don't give a CASA guidance, but always the bank's efforts has been to maintain the CASA. If you look at year to year, the loss of CASA is only, CASA percentage is only 100 BPS, 107 BPS, which is again one of the lowest cut that we have seen in the market. So in that way, our focus on CASA, both in terms of product, in terms of improving the processes, in terms of bundling products, in terms of getting into bulk tie-ups, I think those are the things which the bank continue to do. And in the same way, we'll be in a position to maintain around 39% going forward.
39%.
As far as the credit deposit ratio we talked about, globally, yes, we are at 85, but domestically we are almost at 83. So earlier also we said that we are comfortable operating in the range of 81 to 83 as far as the domestic CD ratio is concerned. The reason being, we have huge alternative resources in terms of raising to manage liquidity. We are one bank who raised the green infra some time back. We got a good response. We have been raising infra loan. We got also a lot of refinance from other institutions. So in that way, the resources are quite strong as far as the bank is concerned. We'll be comfortable operating, as far as domestic CD is concerned, roughly between 81 to 83 in that band.
So while you have guided for cost of funds to have bottomed out at 4.78%, generally your loan yields have been trending lower if I look at it over the last couple of quarters. When do you expect the loan on yield to go up? Because that can push up your NIMs higher.
You're right. If you look at, the good part happened in this quarter. The growth in interest income has been higher than the interest expenses. So that's something positive, and that's why the NI has gone up by 9.7%. My NIM has improved vis-a-vis the last quarter. So saying so, going by the current geopolitical and the consequent impact on the market, it looks on the liability side, the cost is going to be sticky. So last time we gave a guidance of reducing, but we are no more giving. The cost is going to be sticky therein. The moment cost is going to be sticky, possibly there may be realignment of rates happening both on the advances and also on the deposit. Subject the liquidity continues to be as it is. If the liquidity position improves significantly, possibly again we may see a lowering of both the yield and also the cost side. But they are all because the situation we are in is a particularly slightly different because of the geopolitical issue, and we need to factor that in. But as on today, what I look into, the cost on the deposit is sticky. We are not looking at any further reduction therein.
And the loan yield? I think it was 8% in Q4 FY26. It stays here?
There are two aspects here. One aspect is a repo link, right? So as long as the repo is the same, the benchmark rate can't increase, but the spread can undergo a change depending upon the regulatory guidelines with regard to the time we can realign the spread. MCLR still, I would have seen it was sticky in terms of reduction therein. The only segment where I see a bit of a upward trend in terms of yield is corporate book which is not aligned or which is not linked with MCLR. There is almost now 20-21% of the corporate book which is again non-MCLR, typically linked to T-bill, GSEC or any other similar rate. So that is a segment I am looking at where there can be an upward change happen in case the liquidity persists to be tight and the rate matrix also continue to be tight in that manner.
All right, let's focus on asset quality then, sir. Slippage went up a wee bit, though asset quality on the whole has been stable or in fact improved. Could you give us some guidance on that parameter? How do you see asset quality pan out and also on the slippage ratio?
Yeah, if you look at asset quality again, like on the business side, one of the best in last many years, I would believe, in terms of the asset quality. GNPA at 1.89, net NPA because of the floating provision of 1,500 crore, and net NPA now at 0.45. The credit cost excluding floating provision is at 0.32. The slippage ratio at 0.76. These are all within our guidance that we give. So going forward also, I mean, we maintain to keep the asset quality the same. It has been one of the strength of the bank for last many years now in terms of asset quality. But let us also factor in there is a geopolitical event which is again something beyond us in that way. So we need to factor in any impact coming big time because we run a large international book also. So considering that, we're not revising or improving the guidance with regard to slippage or credit cost. Our slippage ratio continue to be 1 to 1.25, although we have been consistently below that for last many quarters now. Similarly, the credit cost would be below 0.6. The credit cost for full year is 0.46. So in that way, I think I do have headroom in terms of guidance in case any geopolitical issue impacts the market big time. Otherwise, I think the journey of the bank in terms of improving asset quality would continue.
Got that. Mr. Chand, good morning, sir. Prashant here. Sorry, my question is not so much about the earnings bid. You would have heard the reports, etc., suggesting that maybe the Reserve Bank is looking at a dollar bond issuance through public sector entities, through PSU banks, PSBs. Have you heard anything around this, sir?
I mean, as on today, if you, as far as we are concerned, there is not much conversation on that. But then let me tell you also one thing. In a geopolitical, scenario like this, your reserve, the Forex reserve is one of your key strengths. And any measures to strengthen that is always something, the players like us or anybody can consider on that. So as on today, no conversation, but then, these are measures which can really boost up the Forex reserve of the country. And banks like us are quite well positioned in that manner.
So this is not like the FCNR scheme, right? Back in 2013, what was discussed, right? That was a deposit scheme. This is debt in that sense, right? So
I understand dollar bond. We are talking about a MTN or a dollar bond issuance or any other measures like that. But then anything to augment the reserve of the country, where the money, when you really bring that money back into India and convert into rupee, I think that's something always would be on the table. And I think bank like us can play a big role. But as on today, I have nothing to
No, I understand. We're just talking theoretically at this point, as you said, you're absolutely a point taken. So you would get dollars, right? You would issue bonds. I mean, you would give the dollars to the Reserve Bank. They would give you rupees, and you would hedge the dollars at a certain, I'm assuming, discounted rate with the Reserve Bank. Pay a certain rate of interest to the dollar holders, and then lend the rupees here in India, right? That's how it would work.
Plain simple, anything that brings dollar into the Indian economy is something that we do, and there are different measures available to do that. So, and currently, if you look at the scenario, is not very, like, we have seen scenarios which are very difficult at different points of time in the past decades.
Absolutely.
In that way, we're adequately cushioned in terms of any external shock in that manner. But I don't think anything, any measures that requires a intervention, something the bank would be quite, well positioned in that regard.
Yeah. Well, just one thing. Again, theoretically, because you'll have to offer a high enough rate of interest to attract these dollar deposits, would that kind of push up the cost curve for other Indian companies who have dollar debt?
Not necessarily. It doesn't. You have to offer a higher. See, like globally, we as a bank operate, right? We borrow big time with regard to the global borrowing, and the cost is very tight at this point of time. In the sense, very fine at this point of time. Recently we raised money, 500 million. So in that way, the only thing that I have to decide whether I keep the money outside or keep it back into India, right? So that's a scenario. So not necessarily somebody has to offer a higher rate to attract deposit, means bonds, debt outside India.
Okay, fair enough. I get that. But this would be technically debt on the books of banks, right? Of course, I mean, in a way guaranteed by the Reserve Bank, but that's how it's different compared to the deposit scheme. Just again, theoretically, if this were to happen, we don't know if it will happen or not. But
about any scheme per se, what I'm talking about, is there a need for India or Indian entity to bring dollar back into India just to augment the forex reserve? There are multiple measures, multiple schemes therein, and at this point of time, I don't think any real scenario where there is because such scenario have been handled beautifully well earlier also.
The past as well.
If there is a need, we'll discuss. But as on today, as I said, there is no conversation as on today. If there is, bank like us are well positioned. That is what I said.
Got it, Mr. Chand. Thank you very much, sir, and thank you for taking those questions and sort of talking through it. As you said, and just want to make it absolutely clear, we're just talking theoretically with regards to some of the reportage which has happened. There is no discussion at currently on, but BOB saying that they're well positioned to facilitate something like this if this were to be done. Thank you very much once again for joining.
But I just add only a couple of points here. I mean, as a bank, we crossed 30 lakhs crore of business as on March 31st. And also our profit for the year exceeded 20,000 crore. And that's something I think two critical milestones the bank achieved in this year. Thank you very much.
Congratulations, sir. Congratulations. And wish you all the best of luck as you continue to execute. Thank you.
Thank you.
Okay, take a quick commercial break here. The management of Niva Bupa will be with us on the other side. Fourth quarter performance in focus. Stay tuned.
Welcome back. Well, the market's still under some pressure as we speak. We're actually at the lows of the day, but individual stocks are doing the thing of their own. And Niva Bupa Health, that's buzzing in trade today after reporting a good set of numbers actually in Q4. The net profit was up more than 60%, strong growth in gross written premium, as well as net earned premium. So that explains why the stock is actually outperforming today. To help us out with what went on in the past quarter and the way ahead, we're joined by Mr. Krishnan Ramachandran, the MD and CEO of Niva Bupa Health Insurance. Hi, sir. Good morning. Good to see you win. Well, congratulations on a good showing in Q4. What led to that outperformance that we saw in Q4? And for this year, if you could give us your guidance, on 2-3 parameters that you're targeting for the coming year. Please go ahead.
Firstly, thank you very much for having me on your show, and it's a pleasure to be here. Look, rather than speaking of Q4, I'd say any business is a continuity, and we look at our business not in quarters, but in what we need to do over longer time periods. And Q4 is really the outcome of the strategies that we've been executing, which you're probably quite familiar with, which is our focus on product innovation, on being a partner on healthcare journeys, our emphasis on multi-channel distribution, our emphasis on technology and analytics, talent, and so on and so forth. So really, it's the continued steady focus on inputs that I believe drive our ongoing performance. And Q4, in addition, has definitely seen a tailwind from GST. In fact, both Q3 and Q4. So really, that's what, nothing specific about Q4, but really the outcome of a lot of the inputs that we've been consistently putting into driving performance with the company.
All right, let's focus on a couple of numbers. Then the gross written premium as well as the net earned premium. What's been the initial trend first in terms of a start to the fiscal, because April numbers would already be in? And give us guidance on both these two parameters for FY27.
So look, in terms of guidance, I prefer to talk again in terms of a slightly longer term rather than in year. And Again, it's consistent with what we've said in the past that we believe we will grow 5 to 8 percentage points faster than market. Our expectation is retail, which is a big area of focus for the company, will continue to grow 17-18%. So to that extent, our growth CAGR over 5 years, would be between 23 and 25%. So that's broadly how we look at, growth for the market and our growth in that context.
Okay. You're also looking to bring down your combined ratio. I think it currently stands at 101.4%, and you plan to bring it to sub 100%, 99%, I think, by FY29. How is that going to come about?
That's absolutely right. And the numbers you're quoting are on an IFRS or INDAS basis. And the good news, we've had a lot of noise in the past, and we've discussed that on the show as well, on how Indian GAAP is really not a good reflection of our economic value. So the good news on that front is INDAS has been notified, IRD has notified it, and we as a company, along with several others, will be moving on to the Indian equivalent of IFRS 17, which is INDAS. And our guidance, the 99% combined ratio number that you referred to by FY29, that broadly stays the same. 98, 99% is where we think we'll land at, and that translates into a mid to high teens return on equity. So we very much are on course to get there. And what will help us get there? Clearly, the big lever is going to be operating leverage. As we get larger and larger as a company, the costs on the renewal side of our book dramatically fall. And that is going to be a big lever, in addition to all that we do around operational expense management, using technology, driving AI. But the big lever is going to be really operating leverage.
Yeah. I got that. Just a quick word, sir. Morning, Prashant here. The distribution regulations, we understand we reported that's going to be pretty comprehensive, and it's going to come out by the end of the month. So it's going to be a discussion paper, consultation paper, and then of course there'll be feedback, and then probably something will be firmed up. But if you had to identify one or two things which you, and then this is obviously a consultative process, and you must be aware of what you as an industry have presented. Could you talk to us about one or two things really consequential?
No, I'll only make two comments. One is I do believe the single limit on expense of management has been a transformational reform. And this is our point of view as a company. I think my personal view is that there should be continuity on that. And, reform should be taking that forward. And I'm confident that I guess the second part I want to say is, whatever the regulator does, I'm confident we'll be keeping in mind the interests of all stakeholders. And as Chairman has repeatedly mentioned, in his public statements, it will be a process which will be gradual. It will not be disruptive. And of course, the interest of the policyholder will be kept in mind. So our belief is that whatever happens, whatever comes out will be...
Sir, is that it could be effort-based?
To be honest, I'm not aware of those discussions within the authority, and I'm not qualified to comment on that.
Okay, all right. We'll leave it there. Thank you very much for joining us. Good speaking with you. Good luck as you sort of continue to operate the business. Stocks up, by the way, 7% in a market which is not up, market which is down, 300 points lower at this stage. Market breadth is pretty negative. 650 odd stocks are higher, and about 2,300 stocks are lower. So it's pretty one way at this point in time. I think we have the management of Bank of India now joining us, and the stock should come up on your screen. So I think it was a good quarter for the bank across all parameters, I believe. Profitability is improved sharply, and provisions were lower, which essentially is delivered earnings growth, healthy earnings growth. We have the management now joining us. Mr. Rajneesh Karnatak is Managing Director and CEO at Bank of India. Sir, good morning. Good to have you with us here as always. Thank you for joining us. We are for 2 years now. Last year was the same in some ways. We've been waiting for the shoe to drop. the other two should drop, but the shoe did not drop last year. I'm referring to last year, the big top-down macro watchers all saying there's a recession coming in the second half because of tariffs, etc. Not in India, but I mean generally a bit of a setback globally. Nothing happened. Here now, expectations are that everything which is happening, which is a higher energy price, etc., will hit sometime in the second quarter. So just wanted to get that out of the way, sir, with some numbers, if you can, for your bank, for Bank of India. What are your expectations around, growth for FY27?
Yeah, thank you for having me here. So yes, for FY27, the growth numbers, like we have already grown, as you see that our global business has grown by 14% plus. Our global advances have grown by more than 15% plus, and global deposits have also grown by 13% plus. For FY27, we are saying that our global advances should grow at around 15 to 16%, and global deposits should grow at around 13 to 14%. That is our guidance, keeping in view the fact that the geopolitical situation is also there. But we feel that this should phase out by the next quarter, the second half of this financial year. And on the domestic side also, our advances growth has been more than 16%. If you see, the SCB growth is also at around 16%, and we have also grown by more than 16% as far as domestic advances are concerned. There also we are very confident that we should grow at around 16 to 17% in FY27. And as far as the domestic deposit is concerned, there we have grown at around 14% plus, and the scheduled commercial banks have grown as per the RBI data in March 26 at around 13% plus. So there also again we are saying that we should be growing domestic deposits at around 13 to 14%. Somewhere around 14% plus. We'll maintain that growth momentum in the domestic deposit also.
Sir, talking about your advances growth, I believe you're also targeting some of these high growth new gen sectors like green energy, data centers, rare earth to improve your margins. So how much does it currently contribute? Do you have a pipeline for these high growth new tech sectors that you are looking to target? And you also said that this will help you improve your margins. So what are the NIMs what are the kind of margins, yields that you can enjoy if you lend to these sectors?
As far as the pipeline is concerned, credit pipeline is concerned, we have a credit pipeline as on date of around 75,000 crores. Out of that, around 15,000 crore is the RAM advances, which is the retail, agriculture and MSME advances pipeline, and the remaining around 60,000 crores is the corporate credit pipeline, which also includes the new gen sector. Within that, I may clarify that we have around 20,000 crores of infrastructure pipeline also. So that includes, as you rightly said, the green energies which are there, data center is there, warehouse is there, pipeline thing is also there, which is also there. LPG pipelines are also there, wherein we have done certain fundings over there. EV is there, PV voltaic cells manufacturing also there, and all these things contribute together to around 60,000 crores of corporate pipeline. So as far as the margins are concerned, we are very clear that good margins will be had when we shift more towards the MCLR advances, number one. So we are targeting more of MCLR advances and also the increase in the RAM advances, where the margins are better and the NIMs are also better. And apart from that, we have 19 ECCB branches from where we are targeting mid-corporate advances also, which are the emerging corporates, for the fact that they give better rate of interest and also LCBG commission and process fee. So overall, with all these things, we are very confident that we'll be able to improve the net interest margins in this financial year FY27.
You've also, I think, promised to bring down slippages to 4,000 crore rupees. It currently stands at 5,500 crore. What will help you achieve this?
Yeah. So presently our fresh slippages in FY26 is 5,500 crores. I had said that we'll bring it down to 4,500 crores. That is the management target that we have kept for ourselves. This is at the backdrop of the fact that we have a very robust zonal collection center. If you see our fresh slippages, which were 7,500 crores in FY25, we have brought down them to 5,500 crores, and our fresh the slippage ratio has also come down to 0.83% only, and it has been brought down by nearly 30 basis point. So for the FY27, we are very confident that we will bring down the slippage ratio to somewhere around 0.55% for FY27.
Unfortunately, Mr. Karnataka's short conversation, but we've got lots of numbers to track, but this has been helpful. Thank you very much for joining in. That's the word coming in from Bank of India. Good set of numbers. Stock is up 2.5%. Now, moving on, MCX reported a strong growth in Q4 as gold and silver prices hit all-time high levels. Ms. Pravina Rai, MD and CEO at MCX, is now joining in. And we also have Manisha here with us to take us through that interview.
Well, thank you for that, Ms. Rai. Thank you so much for joining in as well. And the fourth quarter numbers have seen all-time highs in case of bullion, followed also by a sharp increase in volatility and volumes as well. Do take us through numbers and tell us on what commodities really contributed to this rise.
Well, certainly, Manisha, it's been a good year and a good quarter. All our segments have done well, but clearly, if I were to make a pick, then that would be the bullion segment, both gold and silver. So energy has always been a very important segment for us, contributing to throughput as well as the revenues. Now, bullion this year was a standout performer, and we are very happy that we now have two strong segments that hold up our portfolio.
Mr. Rai, do also take us through your numbers, and also after those tech disruptions that we saw in FY26 and much of that in the previous quarter as well, what concrete architectural changes have been implemented to ensure stability during especially the peak volatility sessions?
Yeah, I think all the numbers have more than doubled. So we're very, very delighted about that. If you look at the headline numbers at 2,429 crores, that's at a consolidated level for MCX in terms of total revenue, and the PAT at 1,332 crores. So both these numbers have doubled, and underlying to that is the daily throughput, which is really the fundamental parameter, and those numbers have increased by more than 2.5 times. So that's been very, very pleasing. Now, this has happened, as we spoke, on the back of growth across the segments. We spoke of metal, we spoke of the bullion, we spoke of energy, and we also saw a very good turnaround on the metal segment. You touched upon technology, Manisha. Yes, technology, when we spoke last time, if you remember, we said that we're going to get ready, and we were getting ready for a 10x growth. We spoke of 10 billion transactions a day, and we were at about a billion a day at that time. We've already seen and handled 2 billion transactions a day as the kind of peaks that we've seen in these quarters. So I will say that that journey towards 10x is very much on the way. Now, this has been delivered with a lot of work on technology, investments on technology, continuous improvements on technology, because this is not just simple, steady, slow volume growth. We're seeing spurts, and the kind of market requirement requires us to be able to handle those. So we've invested very significantly in the last couple of years to the tune of close to 400 crores. And we will continue to have those kind of investments in the year ahead as well.
Mr. Rai, while the previous quarter, of course, saw a lot of volatility, how has the first quarter of FY27 started so far? And if the volatility cools materially in FY27, how should then investors think about sustainability of current earnings and operating leverage?
I think early days are good, but of course, we will focus on discussions of last year. The fundamental baseline had opportunity for growth, right? So we've seen that sort of very healthy participation come in across user base, right, from retail users, corporate participants coming in for more hedging, FPIs, domestic financial institutions, prop members. So if you look at the whole participation, it's been very healthy, and this provides a lot of resilience to the growth. So we're quite positive that each one of these segments has a growth opportunity, and that's what we're getting ready for this year.
And the latest one from the book here clearly has been the electricity futures, which are now live. What early participation trends are you seeing from utilities, generators, industrial users, and what more contracts are in the pipeline from MCX than the investors can watch out for?
Yes, I think electricity was a key highlight. This is a a day ahead market, which really looks at a base load contract. So it really covers a 24-hour cycle on electricity. The simplicity of the contract is very beautiful, and I think it's been very well accepted by market. We see participants, including participants from producers to consumers, coming onto the contract. So we may have other contracts also as we move forward within that segment itself. We see solar being a very, very significant component. The year has been a big one for renewable energy and solar for India. So that becomes a very critical play in the way this whole category plays out. So if you look at the energy category for us, we've got the crude oil and natural gas, and now we've got electricity as a base load contract, and we will look to actually fill this segment covering all parts of that portfolio. We've also, of course, been in the news, and we have announced the approval we've got from SEBI on the coal exchange. So that sort of sits there nicely, creating those synergies, though it will be a different entity working on that platform. We do have a healthy pipeline of products, and we will look at this across all our segments, as we always do, so that the need of the market in each one of these is addressed suitably.
Continuing with energy then, and the energy market share competition seems to be thickening, with other exchange with different expiry dates now into the market, eating into MCX's market share. How are you seeing that?
Yes, competition is thickening. There is a lot of opportunity here. The opportunity is really in identifying market needs and addressing them. India is a large market. We're growing fast. We have a number of segments where unmet needs are there. So as an industry, the more we explore segments where the industry needs hedging platforms, we need the commodity derivatives platform to operate. Those are really value-added activities. When we look at change of dates in existing contracts, which have very high level of depth and liquidity within MCX, that is a bit of a shallow play. And I think we are watching it closely. It's important. I think it's a very large player having these plans and following them through. So we will take actions. However, rather than reacting, really look at what the market requires.
All right. And finally, is MCX now seeing a structural increase in retail commodity participation, similar to what happened in equity derivatives over the last few years?
I think we are in early days. Commodity as an investment asset class is just getting understood. We've seen our traded numbers. While we do have a large number of UCCs on board, our traded numbers have grown about 60%. We're close to about 20 lakh users when it comes to the retail side. And if you look at the participation that one sees on the asset class on equity, there is a lot of headroom available here. I don't believe that everybody who is an equity investor will really find the knowledge base required on commodities, but clearly a lot of increasing interest and headroom for growth there.
Ms. Rai, Manisha, thank you very much for taking us through that interview. 23,900 on the Nifty is also gone. We're now inching towards the 300-point fall on the Nifty, while the Sensex already has sold off more than 1,000 points. Urban Company is down 10%, and the company in their call said that they're losing 447 rupees per order on InstaHealth as the competitive intensity has intensified with Snabit and Pronto raising significant amounts of money via fundraise. 447 is the loss per order on their domestic health business, InstaHealth. That stock is down 9.5%. Get into a break. We'll come back with more on the markets.
Welcome back. We've got the market down about 280 odd points. Market breadth is negative though, but to be expected, 3:1 in favor of what is down right now. Shireen is joining in. I mean, the big talking point, of course, is Prime Minister Modi's appeal to basically cut back on a bunch of things. Shireen, I mean, you've been talking to people in policy circles. What are you picking up? I mean, what are all this aimed at? And as many guests since the morning have told us, the question people are asking in market circles at least is this like a precursor of things to come, and what could those things be?
Morning, guys. I think that gives you an indication of what the thinking is within the government as well. I mean, the Prime Minister making this speech yesterday in Hyderabad after the swearing-in ceremonies have concluded across the various state governments that just went to elections. And what we are given to understand at this point in time is that it's not so much about growth, but about the current account deficit. And that's the number one concern and the number one challenge that the government is faced with. In fact, I'm given to understand that there was a meeting last week.
Okay, I think we dropped the line. I think we lost the line. We'll just get Shireen back and go back to her in just a bit, but I think the line just dropped. This is the flashes are at the bottom of the screen in terms of the what Shireen is picking up from sources and what the thinking behind or the motivation behind Prime Minister Modi's comments yesterday were. And of course, I mean, with regards to what perhaps is the thinking with respect to actions which may follow the comments. So that's the big one, right? And that is essentially what everybody's trying to second guess. But I think we'll have Shireen back in just a bit to talk to us about that in a second. I just want to make a quick mention of the top volume-led cuts that we're seeing. SBI is the number one volume-led loser. So from Thursday's close, which was close to 1100, stocks at 980 very quickly. Remember, Friday was that big correction after the numbers came out. So, for a large name like State Bank, that's a pretty large swing on the way on the downside. Then you've got Titan, which is down 8% or so. Again, a big swing down. ABB, of course, on the back of results, and Bharti and others which are coming through. But I think we've got Shireen back. Shireen, we lost you there. Go on.
Yes, sorry, the network is a bit patchy. But what I was saying is that I think the question about a fuel price hike, that probably is something that we will have to watch out for. It looks like it is imminent. I cannot give any indication of the quantum, the exact timing, but that looks fairly imminent. In fact, what I was told by a highly placed source within the government yesterday is that the high oil price burden has to be shared between the government, the oil marketing companies, and households. So that's clearly something we need to watch for. And of course, a whole host of issues that the Prime Minister raised yesterday, avoid international travel, avoid buying gold. Now, the Jewellery Association is meeting with officials in the Prime Minister's office tomorrow. Our colleague Manisha Gupta is reporting that as per sources. So I would think that, on the back of what the Prime Minister said yesterday, it could also be testing waters. It will, I'm sure there'll be many industry groups who will now petition the government about the measures that are being considered.
Okay, I think we lost the line there again. We'll try and have her back in just a bit. Should we just take a break, come back maybe with that line, on a better line with Shireen? So let's do that. Let's take a break and we are back with that story and more in just a bit. Welcome back. We've got the market, which is down 290 points. MK Surana is with us, former CMD, HPCL, and Rajkumar Dubey is former director, BPCL. Gentlemen, great to have both of you here. Thank you for joining us. Prashant this side. Mr. Surana, I was saying in the morning that I'm not wishing for a price hike, but kind of a bit of a mystery why we've not seen a hike so far. Maybe there were elections, but elections are also now, they wrapped up more than a few days ago. Mr. Surana, what's your sense, sir? Mr. Surana, I think line trouble here as well. Let me ask Mr. Dubey. Mr. Dubey, good morning. If you heard my question, sir.
Yeah.
Go on. You think a hike now, perhaps imminent?
See, if it don't, it has to show, this volatility has to show somewhere. Either it has to show in the petrol pump, or it would show at company's balance sheet, or it will show into government finances. That now it depends on how all the three things come together. So, eventually it has to show up somewhere. We cannot keep mitigating costs, for in a longer term. For a short term, we did a wonderful job, in looking at managing supply somehow. And this time we were much better prepared than what it was earlier.
Yeah.
But now, having said that, that demand management is also important. And I mean, we heard the Prime Minister talking about, how you curb demand. So this would also, a transparency in pricing will also, bring in some kind of curbs in demand naturally. And also,
do you think, Mr. Dubey, do you think you will see actual sort of measures to rationing? I mean, that can mean a lot of things, but basically that kind of price hike is one thing. But do you think that like lots of countries have done, we could see some rationing as well if this goes on?
So lots of countries have gone in for direct price rise, ranging from 20% to 50%. I think we will have different mechanisms here. Depends on our fiscal conditions and, of course, how long these things continue.
So you've been in the industry for a long time. Have you ever heard the Prime Minister making this kind of an appeal to cut back on non-essential things, which can be done, whether it's work from home? We had that in COVID, but COVID was more of a demand issue, and this is on account of supply. And generally what happens? What is the signaling that the government is trying to give perhaps to the oil marketing companies with this?
There are two ways to look into this. One is a conscientious, way as a citizen, as a responsible citizen, we reduce, we know there's a crisis in the world. It is not in India, it's in the world. So therefore, as a conscientious, citizens, we would reduce our consumption, especially the unnecessary consumption, so-called. But the other part is also important, where when there is, the transparency in price, there is an incentive to shift, which there is always, there's always inertia to shift into other forms of energy. Now, this can be one way of, shifting it, slightly looking at a long-term perspective here.
Mr. Surana, the former CMD of HPCL, is also joining us on the show. Mr. Surana, many countries have undertaken price hikes of 20, 30, 40%, but India so far has held back. Are you surprised? And do you think, it's likely anytime soon? We've already seen a move on commercial LPG, but do you think pump prices are likely to go up?
Good morning. And no, not surprised that the price hike was not taken, because the government since last 4 years or so has maintained the prices the same, considering that probably too much volatility in the prices creates the inflation and impact on the macroeconomic factors. And therefore, I'm not surprised. But at the same time, we cannot shy away from saying that the constant under-recoveries on the part of OMCs does have a strain on their financials. And also, government has taken already an excise duty cut of 10 rupees. So there is a limit to which the government will have a choice to bear the loss. So I think that longer it goes, the stress is increasing more and more, and rather at a disproportionate level. And I think there will be a limit to which it can be absorbed, and there will be a situation where it will be inevitable to take the price hikes.
I think the oil ministry already said, right, oil marketing companies are absorbing 700 to 1,000 crores a day. That's potentially 30,000 crore a month. As you said, at what point is this limit tested?
Yeah, actually, I also heard that the Petroleum Ministry has said that Now, the question is that what is the actual amount of under recoveries that will depend on what is the prices when the crude is brought, etc. But there is no denial that currently the price of the product is lesser than the cost of the raw material. And therefore, it is becoming more and more unbearable, and there will be a limit to which it can be done. And one more thing we should not forget, that currently we are having twin issues. One thing is the crude prices. Second is the exchange rate variation. So higher exchange rate has got the further stress. Every rupee increase in the exchange rate to dollar almost has the same impact as every dollar increase in the price of the crude. And therefore, we are having the twin whammy on that. It will also impact the liquidity of the oil marketing companies, because you have to pay to the crude for which we are procuring, and if we are not recovering it from the market, then it may lead to the liquidity issues also for the oil marketing companies in the longer run. In spite of the good and strong financials of the oil companies and the creditworthiness, for a long time it does affect the short-term borrowings.
Mr. Surana, one is, of course, oil. The other is products, right? Diesel, ATF, and prices have gone absolutely skyrocketed. There was news about we've seen this before, maybe a 3-day ceasefire. It ends today, by the way. I'm talking about Russia, Ukraine. It's gone on for so long that we've just taken it as something we live with. Do you think if it actually ends, there is the ceasefire turns permanent? What in terms of energy markets, product or oil, will it make a difference?
See, I think the Russia-Ukraine war, the market had digested to be a going on things, and therefore the immediate impacts you won't see. But one thing which worries is the damage to the energy facilities in Ukraine and Russia, which does have an impact on the overall oil market, global oil market. And therefore, the definite ceasefire there will help in reducing the risk premiums on the freight, on the insurance, and also the cost which gets built in because of the uncertainty if some of the dispatch locations gets impacted.
Sir, in such difficult times when the oil marketing companies, the industry is bearing such heavy losses, will there be a move perhaps to cut back on their Capex or rethink the kind of dividend that they have been doling out? Is that a risk?
So the Capex consists of two parts. One thing is when you are having a long-term projects, let's say you are a refinery, a petrochemical complex, terminals, etc., which is already, if you are committed, then no purpose gets served in stopping the projects in between, because it will only increase the cost and delay the projects. But every year there will be certain amount of Capex which is taken, which is, let's say, with the timeline of 1 year, or maybe there's some of the non-essential Capex which you take. There will be a recalibration of that. And when every year some new projects are also taken for a longer term, probably that may be a deferment to that extent in the Capex cycle. But as you know, the oil industry projects are a bit long gestation projects, and the longer view is taken rather than a very short-term view on this. So you may defer it, but you don't shelve those projects generally. And you may only reset the starting time, or you may reset some of the activities on that. Like there is a whole lot of things which you do from office in terms of design, etc. You may delay the thing in taking it up on the ground.
And dividend risk, a dividend cut risk?
Dividend is between the government and the oil company generally. So it is a question of that. If the government is also bearing, oil companies are also bearing, then who has the shot to say that what can be cut and what can be paid? But yes, dividend is one of the things which will help the oil companies to retain some of the liquidity with them.
We'll leave it there. Mr. Dubey, thank you very much. Mr. Surana, thank you for joining us. And, we'll see what happens. Price hike, perhaps, the quantum, etc., staggered. That's the expectation. But, depends on who you ask. But that's the chatter, that's the talk that anyone is having this morning. Markets, of course, are down about 300 points. The last I checked. Yeah, exactly 300. 23,874 on the Nifty. It's a wrap on this edition of Bazaar. Chartbusters will take the action forward. Stay tuned. Coming up.
As India continues to grapple with the macro fallout of the West Asia war, PM Modi pushes for spending restraints, urging Indians to postpone gold purchases for a year. Management of Senko Gold flags a 10 to 12% reduction in volumes in case of probable import duty hikes. Jewelry stocks crash.
Persistent tensions in West Asia keep crude prices above $100 a barrel mark. Additionally, Prime Minister Narendra Modi appeals to travellers to rethink international trips and opt for domestic tourism amid growing regional uncertainties. Shares of Interglobe Aviation tumble in trade.
Tata Consumer bucks the overall market trend to gain over 4% right now. The company delivers a beat in the March quarter, underlying volume growth of 16%. The management joins us shortly to discuss the numbers.
Weaker than expected earnings sent shares of ABB India lower. Raw material inflation, dense margins. Automation takes a hit on account of slow execution timelines. However, the management continues to eye a 12 to 15% profit margin and marks possibility of further price hikes.
Swiggy allays concerns over quick commerce slowdown, reiterates that it remains on track to achieve break-even contribution margins in the first quarter of FY27. Stock skids in early trade as food delivery GOV comes even at a 15-quarter high. Losses narrow. The quick commerce worries as the stock lower.
Well, hello and welcome to Chartbusters. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. And as you can see at the top of your screen, the market's under pressure because of some cautious comments that came in from our Prime Minister Narendra Modi, and crude oil prices have spiked up. But it's all about earnings, and more earnings. So, Mangalam, let's get straight to one of the two managements we have on the show.
Let's get straight to that, Nigel. You know, the worry is that with the Prime Minister asking for people to exercise restraint while discretionary purchases are made, would that impact on earnings or not? By large, something that we will be tracking. But no problems for Tata Consumer Products. A solid beat in this quarter, strong volume growth, margins ahead of estimates as well, led by robust performance across the board. MD and CEO Sunil D'Souza joins us now to decode those earnings, but more importantly, give us an outlook of what lies ahead. Thanks a lot, Mr. D'Souza, for joining in. 15% revenue growth in FY26. You've crossed the magical mark of 20,000 crores. Let's start with the basics. What are you targeting for in FY27 when it comes to revenues, margins, as well as volumes?
So Mangalam, we had a good quarter this Q4 FY26, 18% top line, 27% EBITDA. And like you mentioned, it was a 15% top line for the full year with a 12% EBITDA growth. Broad-based growth across all the business segments. For the year, beverages has grown 8, salt has grown 14, Sampann has grown 49 for the quarter, ready to drink is up 23, organic up 24. International has come to the party for the quarter, 30% top line growth in the US, 17 in UK, and 19 in Canada. Overall, even for the full year, they've been good. Financial metrics looking good. Our ROC has gone up 110 bips. Working capital. Our working capital today is less than what we started 6 years back. We are now at 21 days. India is -2.
Right.
We're getting scale leverage, 220 bips of costs, leverage on the P&L if I remove materials. Channels are firing, the channels of the future, whether quick commerce growing at 60%. Innovation, 4.5%. Very strong results.
So, D'Souza, we have those data points from last year. Yeah, what we want to know is what lies ahead.
Nothing changes from the guidance that we've given, Mangalam. We will line on revenue. We will improve EBITDA ahead of top line. Our innovation to sales will continue at 5% target. We will continue to expand distribution, focus on the channels of the future. Yeah, all in all, just focusing on basics, product branding, distribution, and innovation.
So double-digit revenue growth, EBITDA ahead of revenue growth, and innovation to sales at 5%. These 3 points?
Yeah, so that's, and the other pieces, we've got a set of growth businesses. They will continue to grow at 30%, contributing to 30% plus of the India business. That is where the top line growth gets powered up, while the base business continues to provide the margin leverage.
Right, and on the growth businesses itself, I had to ask you this because, you know, in the fourth quarter, there was strong growth coming in from Sampann, 69% growth. Obviously, that is an outlier that will perhaps normalize to 30%. Similarly, your ready-to-drink was up 23%, and there wasn't much growth in Capital Foods or Organic India either. So do you think all of these, which were underperformers, will normalize back to 30%, and what grew above 30% will come back to 30% as well?
Overall, we hope to grow sometime above 30, but the guidance is we've kept it for 30, ready to continue to grow at 30. Capital Foods and Organic India, very, very specific issues. We had large-scale supply. Organic India, roughly 50% of the business comes from international. And in Capital Foods, roughly 20% comes from international. While India grew double the international business because supply chains got completely whack. In March, even for the US, we do a lot of transshipments via the Middle East. That went out of whack. April, there has been a catch-up. So we remain confident of driving 30% plus for Capital Foods and Organic India as we go forward.
Hi, Mr. D'Souza. Good morning. Good to see you. In e-commerce and Q-commerce, I think they're 19% of your total mix, and I think they grew to a large extent on a lower base, 50-60% in FY26. What's the contribution headed to, point number one, and what's the growth rate?
So Nigel, overall, Quick Com and E-com contributed to roughly 21% in Q4 versus 15% the same quarter last year. And it overall grew at close to 60% for the year. Quick Commerce grew 100%. Now, yes, I wouldn't try to put a forecast to it. Just that in markets like China, Quick Com, E-com is roughly 30 to 40% in grocery category. So I think that's where we are headed. Our job is very simple. We remain focused on making sure we delight the consumer wherever the consumer is. If the consumer is shifting to Quick Com, we will be there. And by the way, we are market leaders on tea. While overall we are number 2, we are market leaders on tea on e-commerce and Quick Commerce. That shows the strength of our brands and the fact that if we close distribution, we are in a good place. So I would say you would see very, very high growth for Quick Com for some time to come.
All right, high growth for there. What was interesting, two things. One, you said newer channels accounted for about 200 crores in annual run rate in the fourth quarter. Where does that number settle at, say, 3 to 5 years from now? How much do you expect coming in from there? And the second part, you said that to ensure more focus on growth businesses in tea and salt dominant markets. This is with regards to GT expansion. So together, both of these will be how much?
Mangalam, we've incubated 3 new channels last year. That was the vending business. We had started a food service business. And we started a pharma channel. Now, all these 3, actually, the annual run rate is close to 300 crores. 100 for vending, 170 for food service, and 30 for pharma. I would say you would see strong 25-30% growth in these channels continuously as we go forward. Because, I mean, the TAMs in all these 3 places are very, very, very significant. So I wouldn't pull back on these channels per se.
All right, Mr. D'Souza, what about Starbucks? It grew by close to around 7%, I think, in quarter 4. And for the year, I think the number of stores added were around 23. Are you slowing down a little bit there? What kind of addition are you looking at for this year and what kind of growth?
So the good part, Nigel, is this is for Starbucks, it is the 3rd quarter of same-store sales growth. There was a bit of pressure, I would say, for 1 year, 18 months coming into Q1. After that, we've started to see the consumer come back into discretionary. You've seen the pressure across all QSRs, and we had taken calibration of store openings when we saw that happen. Now that we're seeing the consumer come back, you will start to see an acceleration in stores. Apart from just the base stores, we are also focused on growing the brand as well. So you'll see reserve stores also coming up. We had one at Mumbai, we opened one in Gurgaon, and now we opened one in Calcutta. So Starbucks, secularly, coffee will grow in India, in-home, out-of-home, and therefore we see no reason to slow down.
All right. We'd have loved to speak to you about some of the newer categories that you're looking to enter. I remember you speaking about protein, hydration, functional beverages as part of that. But more on that as and when you launch those products. Just before we let you go, Mr. D'Souza, 2-part question. One is on the international business. Fourth quarter grew at around 11% constant currency. The street was working with a slightly higher number because of the West Asia crisis, etc. If you could give us a sense on how international business is likely to pan out this year. And in India itself, on a consumer sentiment basis, given the comments that have come in from the Prime Minister and the increase in raw material prices, etc., do you think the growth path that we're on could face some hurdles on international and India? Give us a sense.
So let me answer the India question first. Mangalam, the good part is I am in the not in the discretionary space. I am in the essential consumer food and beverage space. So Therefore, the impact on us will not be as pronounced as some of the discretionary spaces. Number two, I'm not sure how to model for any disruption which happens. We've already tackled supply chain issues. We've tackled fuel issues, moved from LPG to dual burners, and wherever we had found other LPG sources. If prices continue to go up, if cost continues to mount up, we remain confident in our portfolio, the brand equity, and our execution to take price hikes, calibrated price hikes to make sure margin is back on track. So for me, not a big worry. I would take a call as and when I see it starting to impact margins. On the international piece, we had very good growth for the quarter overall in the base businesses, right? The US grew 30, UK grew 17, and Canada grew 19. And in UK and Canada, we saw volume growth as well. Even for the full year, even the US grew 24%. So I would say broadly, we've always said the international businesses will grow mid to high single digits on top line. We've come better than that. Margins will continue to improve as coffee prices start to soften in the US, which is the primary impact on the P&L, both for the US and for TCPL overall. So we remain confident. And by the way, in the US, we've had 6 successive quarters of market share gain. So we remain confident of our international business.
All right, you remain confident of your international business and the current raw material situation as well. Thanks a lot, Mr. D'Souza, for joining in. The next time we have a conversation will be around some of your new launches, and are you looking at any other M&A or not as well. With that, give you good luck for the next year. But speaking about what the Prime Minister said yesterday and a lot of corporate commentary that we've gotten around that, Sunil Bharti Mittal of Bharti Enterprises has backed the Prime Minister, saying that India cannot escape difficulties that the world is currently facing, urges industry players to take the Prime Minister's word forward. Let's listen in as we slip into a short break. On the other side, we have another management lined up for you for earnings.
These are difficult times. We, as a country, have been moving at a fantastic speed, growing at 6-7% year on year. Generally, things are looking very, very good. But there are situations that develop which are beyond anybody's control. And the current problem in the Middle East that we are all facing, creating a tremendous amount of pressure on the global economies. And India is no different in that aspect, and we can't escape the difficulties that the world is facing currently on economic terms. His message yesterday was very profound. I think we in the industry need to play our role. We need to play our part. We have employment of millions of people. We can take his message forward in a very deep and meaningful way. We need to get away from this obsession of import of gold. We need to lower our energy costs. We need to move more faster towards renewable energy in our industry. And importantly, we need to vote with our feet within our country. Spend more here, put more Capex here. We need to invest more. This is not the moment to shy away. This is the moment to invest, double down in our own country, because the underlying growth is there. This is a continent of consumers, large, young population wanting more products and more services. And let's give them more from India, make in India, from India, serving India.
Well, a bit of a wobbly morning, as you could see. Most of the indices are trading in the red, but there are a couple of good earnings reactions. We just spoke to the management of Tata Consumer, and now we have Birla Corp. Good rebound in profitability is what we saw in the past quarter. It was aided by higher capacity utilization levels, higher contribution from premium cement as well. And that explains why the stock is holding with solid gains. To help us out with what's to be ahead, we're joined by the CFO of the company, Mr. Aditya Surogi. Hi, sir. Good morning. Good to see you in. As always, congratulations on a good show. Your stock price had corrected by close to around, I think, from around 1,500 rupees to 1,000 rupees. But these numbers deserve special mention. That said, let's get a couple of details. For the past quarter, what was the incentive income that you received? Point number one. And point number two, any one-offs on the cost side? Because the costs were relatively lower.
Yeah. Thank you, Nigel, for having me on the show. See, in terms of incentives, we have accrued about 140 crores, out of which about 90 odd crores pertains to earlier year, and about 50 odd crores pertains to this year. And within this year, if we were to look at quarterly numbers, probably the quarterly run rate is around 25 crores, and in this year we have accounted for 50 crores. The 90 crores that pertain to earlier year, we have shown as exceptional item in our results.
Okay, all right. So in the sales numbers, you're not accounted for this, right? This is in the other income.
Yeah.
Okay, got it. And on the cost side, sir, any one-offs or everything was in line?
Cost side, Nigel, typically in the last quarter, some of the provisions that are taken on an estimated basis, they always get chewed up. So I would not call it one-off as such, but that's a recurrent feature every financial year.
Got it, sir. Great. Let's talk about on the cost side now. Cost per ton will go up, right, in quarter one and quarter two. Could you quantify what is the increase? Because diesel prices, input costs have moved up on the power and fuel cost side. And also packaging costs have gone up. So could you quantify per ton, how much has it gone up? But also there have been price increases that have been taken. So how much higher are prices today on an average in quarter one in comparison to quarter four?
So price hikes were taken in the first part of April. Some of it got rolled back also towards the month end. Mm-hmm. On an average, the price hike for us has been around 50 rupees a ton. Yeah. And in terms of the cost, the impact compared to the previous quarter for this geopolitical issues would be around between 150 to 175 rupees a ton.
Okay, 150 to 175, sir, for quarter one, or this will impact in quarter two onwards?
No, quarter one also will have this, quarter one and quarter two. It's expected to be at similar levels because some of the factors that are more prominent in quarter one, we expect them to abate a bit in quarter two, and some factors, for example, fuel, will get the benefit of some stocks, those will abate in Q2.
Okay,
so
all right.
They will kind of adjust each other.
So a third of the cost spike has been passed on via price increases. Fair to assume?
Yeah.
Got it. Give us two big numbers then, sir. What kind of volume growth are you looking at? Because you're functioning at higher capacity utilization levels in comparison to the industry. So congratulations on that. But what's the volume number we should be looking at for this year? And what about EBITDA per ton? As you had mentioned earlier, second half of the year will see an improvement from the first half of the year. That's precisely what happened. But could you tell us what is the band we should work with? Give and take everything, premium sales, input cost spike, and maybe some operating leverage that could play out.
So in terms of volume, we're expecting a mid-single digit growth in this year, which in absolute terms, we should be closer to 20 million tons compared to 18.75 which we did in FY26.
EBITDA per ton?
EBITDA per ton, we have done around 800 for the last financial year. For this financial year also, we expect to be at the similar levels.
800 rupees per.
Yeah.
All right. And just two numbers, sir, from my end. One, what's the updated debt on your books? What's the repayment schedule here? And the second part, jute business. You did indicate that it would be closer to 500 crores. Where does that number stand at and the guidance here?
Our debt is around 2,100 crores as of 31st, net debt, 2,100 crores.
And that's come down from 2,450 odd crores, right?
2,200, I think, in the last financial year.
And the repayment plan here?
At next financial year, we'll have some repayment and we'll take some debt for expansion plans. So it should be close to 2,000 crore by the next financial year. That's what we expect.
All right. And on the jute business, you said it will be 500 crores. Where does that number stand and what's the guidance here?
Jute number is at, I think because of raw jute prices, we have not been able to do very well on jute front in this financial year. So it's very difficult to give a specific guidance as far as jute is concerned. It all depends on how the correction, we expect the raw jute prices to vary. It all depends how that correction pans out.
But I'm just curious to know, Mr. Saraogi, why do you keep holding on to the jute business? Do you at some point don't feel like selling it off because it's non-core, or there are some synergies?
There are no synergies, but it's a more than 100-year-old business. So we would not like to part with that business. Rather, we would like to invest in that business and make it more profitable.
Okay.
Fundamental reasons.
Yeah.
Will it be so profitable in this year, but because the raw jute prices have moved up, so that's what's impacting profitability. Production as well as come down.
The croppage has been very good, so we expect the raw jute prices to come down drastically in the coming season.
So then this vertical will be profitable in the coming year, right?
Yes, yes.
Okay. All right, got that. So any other non-core assets you have? And also if you could help us out with the Capex guidance for this year, since you're talking about debt number, it's at 2,100 crores. You're saying you'll be incurring some Capex. That's why you'll have to take fresh debt, but there'll be repayment as well. So you'll end the year at around 2,000 crores. So any non-core assets that you're looking to sell, point number one. And point number two, if you could help us out with the Capex guidance.
We have certain non-strategic investments which will be probably worth about 600 crores today. But we do not have any intention of selling those investments.
Okay.
Because we don't really need those cash.
Capex?
Capex, we are working with a figure of around 900 crores for this financial year, which includes project Capex as well.
And what about two large players going a little slow on their capacity addition plans? That's Shree Cement as well as Ambuja Cements. Will it be better times for the industry?
Yeah, it should be better. And I mean, we are really glad that those senses prevailing. It does not make sense to operate at 65-70% capacity and continue with the Capex plan. In our case, since our capacity utilization is north of 90%, it makes immense sense for us to continue with our Capex plan.
It's a pleasure talking to you, Mr. Saraogi. Wishing you and your team all the very best. Thanks for detailing what went on in the past quarter and your plans for the year ahead as well. All the very best.
Thank you.
Well, time to slip into a short break. Come back, continue to focus on markets as well as stocks that are moving around. Stay with us.
Welcome back. You're watching us here on Chartbusters. In a market as wobbly as this, let's get you some ideas of profit coming in from our colleagues at Money Control Pro. Neha Dave joins into the stock that she's been tracking.
Today's stock idea is DCB Bank. DCB Bank saw its highest ever net profit in FY26 despite one-off expenses related to new labor code. The bank is on a steady growth path with net advances rising to rupees 60,000 crore as of March end, registering a growth of 18% YOY. Management expects to double its balance sheet in the next 3 to 3.5 years with annual loan growth target of around 18 to 22%. Net interest margin of the bank improved to 3.4% in Q4 FY26, and management has guided that the gradual expansion in the margin will continue till Q2 FY27, that is over the next 2 quarters, assuming no further rate changes by RBI. The bank's asset quality improved meaningfully in FY26 with gross and net NPA ratio trending downward, and management has guided that credit cost will remain below 45 basis points. Overall, DCB Bank is poised for healthy loan growth, margin expansion, stable cost to asset ratio, and a very low credit cost in near to medium term. This guidance is very encouraging. Moreover, the bank is looking to raise equity capital of around 1,000 to 1,500 crore in sometime around Q2 or Q3 of this fiscal. The most encouraging aspect about DCB Bank is the valuation. The bank is currently trading at around 0.8 times book value estimated for FY28, which is very attractive. The valuation can inch closer to 1 time forward book value, which along with the healthy earnings growth can translate into a meaningful stock upside in near to medium term.
Thanks a lot for that, Neha. Well, on that note, though, we'll wrap up on this edition of Chartbusters. That's it from Mangla, myself, and the entire team that put the show together. The team of Trading Hour is waiting by.
Hello and welcome. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu, with me Hormaz Fatakia as well as Ritu Singh. The market's a deep shade of red right now. A couple of factors worrying the street. One, the spike that we've seen in oil prices, but more importantly, the commentary coming in from the Prime Minister yesterday exercising the nation to exercise restraint when making discretionary purchases, limiting foreign travel, at the same time limiting purchase of gold, as well as the fear that maybe all of this could eat into earnings, domestic discretionary earnings. So these are factors that are worrying the street. The Nifty below that 24,000 mark, 2,200 stocks which are in the red for about 800 which are in the green. Ritu.
That's right, Mangalam. Good morning to all of our viewers. It's not looking very good. It's a deep shade of red. The market breadth tells you about the kind of, anxiety that there is in the market. You have almost, 3 stocks that are declining for 1 stock that is advancing. And the India Volatility Index has spiked by as much as 10.5%. So that's the kind of anxiety you're seeing on the street, the frontline indices, the broader markets. The pressure is pretty much broad-based across sectors. Realty Index, one of the top losers today. The gold, players also in focus on the back of the PM's comments you were talking about. Indigo, one of the losers on the back of those comments about avoiding foreign travel. What you do have holding up is the IT and the pharma pack, just about in the green. But other than that, it's a sea of red. Hormaz, good morning.
Good morning. It's not been a very good morning for the markets, though. Although we are still in that range of 23,800 to 24,300, but now we are at the lower end of the range. The bulls would hope that even if the markets are lower today, they still manage to defend that 23,800 mark on the downside, and that's what is happening at least as of now. But the bigger factor, as Mangalam was pointing out, is oil prices. Right? Brent is now past 105, nearing 106 now. NYMEX has hit the century as well, so it's now past $100 a barrel. This is, of course, for the June contract. Brent is for the July contracts. A lot of reaction coming in on the Prime Minister's remarks yesterday, and the most of them, of course, coming from the jewelry stocks that have taken a hit. Titan's down 6.5%, so it's possibly given up everything that it gained after its results on Friday. Kalyan Jewellers is down 8%. Senko is down 9%. PN Gargil is down 7.5% as well. Although all of them were Kalyan and Senko were both down over 10% at one point, they're still holding on to some steep losses. What is also, look at the fall that they have had. Kalyan has the biggest single day fall since Jan of this year. For Titan, it's the biggest fall since July of 2020. For Senko, it's February of last year. And for PN Gargil, it's for September of 2024. So this is the kind of fall that you've seen in these jewelry names. The other impact has been felt on the travel and tourism names. Indigo, of course, down 5% after the international travel remarks, and a lot of these travel portals as well. TBO Tech, Ixigo, Yatra Online down anywhere between 2 to 5% in today's session. The encouragement to electric vehicles has had an impact on these electric mobility names as well. Ather Energy, which has more than doubled over the last 1 year, continues to move higher, 3.5%. Ola Electric, an underperformer, is up 2.5% as well. And JBM Auto at one point was up 7.5%, still holding on to gains of around 4%. Now look at the result reactions, the negative ones as such. They have been very steep as well. Urban Company is down 9%. ABB, after a slew of downgrades, is down 9.5%. Blue Dart is down 8%. Bal Krishna Industries down 5% as well. And after SBI's results last week, the stock is also extending its losses now 4% lower on SBI. So that's an 11% cut in the last 2 sessions. Bank of Maharashtra and PNB too not doing very well for themselves. And lastly, some names that are bucking the trend, some are positive result reactions. You just heard the management of Tata Consumer, that's up 3.5%. Niva Bupa is doing well for itself, and HFCL continues its record-breaking run, up already 100% year to date and still adding another 6% in today's session. And Bank of India is also a positive earnings reaction today.
All right, Hormaz, thanks a lot for that. You did speak about a bunch of these result reactions that have come our way and the fact that the market's lower on account of the West Asia crisis. Let's go across to the management of Gateway District Parks. Those shares also weak in today's trading session because their fourth quarter earnings too, just like a lot of the other logistics companies impacted by the West Asia war. Samvid Gupta, who's Joint Managing Director, joins us now to discuss the numbers, the quarter that went by, but more importantly, what lies ahead for the company as well. Thanks a lot, Samvid, for joining in. Now, if I look at your fourth quarter performance, rail volumes grew 4.2%, much lower than what your anticipated number of double digit was, and CFS volumes too saw a contraction. Could you quantify the impact of the crisis on your numbers in the fourth quarter? And at the same time, give us an updated volume target for FY27 for both your rail and CFS businesses?
Yeah, hi, good morning. Thank you for having me on the show. Yeah, it was impacted mainly due to the West Asia situation only. So it wasn't just the containers that we have exposure to Middle East that were affected by this, but the overall shipping cycle has been disrupted. So even Europe, America, Africa volumes got impacted because shipping line schedules aren't calling properly. About Middle East, about 10 to 15% of our exports is for Middle East. But like I was saying, more volume got impacted on account of this. It's hard to quantify exactly what is the number due to impact for FY27. We're still waiting and watching. The target remains a double-digit growth, but we'll have to wait till there's more clarity on the overall situation.
Okay, double-digit volume growth is what you're guiding for. We'll see, how the West Asia conflict plays out. But some of the cold chain margins have also fallen to about 1%, very sharply from 6%. What happened there, and any guidance you could give us on that front? That's one. And secondly, my colleague Nigel's pointing out that the promoter shareholding has been going up from September, about 32% all the way to almost 34% as of March. What's going on there?
Yeah, so on the cold chain business, there were some one-offs, especially with the wage code impact that came in. On an operational basis, it was more or less the same performance as previous quarters. Consumption has been slightly on the weaker side, but we are seeing some pricing corrective actions that we are taking. So we expect overall margins to get back to normal levels by next quarter. On the promoter shareholding, yes, we have been picking up from the open market. We are close to 34% now. We find the price levels attractive, and we were thinking about doing it for a while. So that was on our mind, and maybe we look at doing it a bit more also in the coming year.
All right, you've been guiding for that over the last 8 to 12 quarters. In fact, now Snowman is consolidated in your overall businesses, and that's reflecting in your consolidated numbers too. And you have stated the intent of taking it all the way up to 51% as and when time and regulations persist. Just talking about a couple of other factors. You said you're targeting double-digit volume growth. Could you break that volume growth for both the rail business and the CFS business for us? Also give us a target for EBITDA per TEU and the margin targets.
Right. So the double-digit growth would be for the rail business if things are on a normalized basis. But we have to, again, like I was saying, we have to wait and see. Day by day, the situation is different. The CFS side on a normalized basis would be a similar 3 to 5% growth as last year that we targeted, as we have more capacity utilization at both those places. But again, we'll be looking to take some pricing corrective actions on the CFS side. Yeah.
And EBITDA per TEU for both?
So on the rail side, no pricing corrective action as such, unless there's a fuel increase, then we'll pass that on as per our contracts to customers. On the CFS side, on the normalized basis, we would like to increase our H&T rates if possible.
Well, in that case, Samvid, 2 questions. First, what are your Capex plans for this year? And what kind of capacity expansion are you planning, if there is any, this time around? If there is a planned capacity at Indore that you're planning, but beyond that, is there anything on the annual, and how much are you spending from that? How are you likely to fund it? And of course, your double stacking targets for this year.
Right. So double stacking, I'll take that first. So it would be targeted anywhere around 43, 44%. This will be slightly higher because we expect Bombay to get double stacked within a month or two. So that will help contribute towards this. On the Capex plans, we have over the next 2 years about 250 to 300 crores planned, out of which 100 crores further is for Indore. We've already spent 50 on the land and some minor works. Indore will come in by beginning 2028. So that's the big project that we're working towards. Ankleshwar is an asset-light model, which the domestic operations started last year, and the ICD operations would be starting sometime middle of this year. Other than that, we have Jaipur. We're hopeful that gets cleared up later this year, and then we'll start construction there as well. We're also looking at buying some EVs for first and last mile fleet, as well as 3 new trains this year. So that's the majority of the 300 crore Capex that will come. Minor additions to existing capacity by warehousing or expansion of container yard will also be taking place at our existing locations.
Samvid, what about the Western Dedicated Freight Corridor? When do you expect that to start, and how much incremental revenue are you factoring in, if any, when that does happen?
So it's not an incremental revenue thing. It's more a cost advantage that we have the full section of double stacking that will happen. And also the turnaround time will become better. So we expect more productivity of our trains. The trials are going on right now. They've completed the track work, but the double stacking component will probably take another month or two as per reports.
So what's your double stacking target for FY27? And could you finally leave us with your current market share versus Container Corp across the country and in markets where you specifically operate?
So 43 to 44% is the double stacking target. Market share, we're actually trying to come out with a new metric because we can't compete with someone who's working at 70 terminals. So our market share numbers would appear differently. But the main one for us is NCR and Ludhiana, where our market share is about 18% for NCR, and Ludhiana is close to about 27%, where we're the market leaders.
All right, Samvid, we'll leave it at that. Thank you very much for your time here today. We appreciate it. Thanks very much. Well, moving on, Union Minister Ashwini Vaishnav has backed Prime Minister Modi's call to the nation, urging businesses to take cognizance of his call. He's urged citizens to cut down on expenditures that involve Forex spends. Take a look at what he had to say.
It's very important that we as citizens also play our role in this entire effort. We as citizens, as our Prime Minister has asked all of us to, can reduce our expenditure on everything that requires foreign exchange to be spent. So I'll request all of you to take cognizance of Honorable Prime Minister's call to the nation, and within your own means, within your own enterprises, within your own businesses, try to do whatever best you can.
We'll take a short break. On the other side, we focus on the bond markets with Manisha Gupta, even as the markets are looking to recover from the lows of the day. Welcome back. Shifting focus to the bond markets. Manisha Gupta is here with the latest. Manisha.
Well, thank you so much for that. It's a weak market, clearly, with the kind of cues that we are getting in from the Indian and the international markets as well. The rupee has declined quite sharply versus the US dollar, and that clearly has been the case with various Asian currencies. You're looking at the crude oil prices in the meanwhile trading 4 to 4.5% on the higher side, back above that $105 a barrel mark, with markets still believing that with the elections done with now, the day is not too far away, that you could be looking at a hike in petrol and diesel prices therein. The PM voice as well resonating the same, where he's talking about less travel, work from home, and then not getting into the obsession of buying gold. also is moving towards concerns about the current account deficit with the way the crude oil prices have been and how the gold prices are up nearly 85% in the matter of last 1 year as well. So the first quarter of this year, we saw the gold imports quite strongly. For the month of April, there have been various concerns. The imports are near record lows. And with the PM statement coming that there could be some curbs or measures coming in, is something that the street will watch out for there as well. In the meanwhile, RBI also said that 11 states will be raising 145 billion via bond sale. This is going to happen on Tuesday. And the indicative calendar for state borrowing for the June quarter as of now stands at 154 billion therein. There are various private bond issuances as well happening in the day-to-day as well, where you have bidding coming in today. Bajaj Finance is one of those, looking to raise 90 billion rupees through 2 bonds of different maturities. There's also Tata Capital Limited on the list there. They are looking to raise 17 billion, and they are doing this via 2 bonds or different maturities as well. You have Bajaj House Financing as also into the markets, looking to raise 15 billion, and they are doing this via 5-year bonds therein. The next on my list is M&M Financial Services. They are looking to raise 10 billion rupees, issuances of bonds maturing 21st of Feb 2028. And then you have Shriram Finance Corp as well on the list. 500 million is what they are looking to raise into the markets. The bidding for that is today. And they're doing this via bonds which are maturing on 12th of Jan 2028.
All right, Manisha, thanks very much for filling us in with all the action on Bond Street. We'll zip into a short break on that note. Up next, we're going to be back with Prudent Corporate Advisory Services Management on their 4th quarter numbers.
Welcome back. Let's continue with our corporate conversation, even as the market's slightly under pressure right now. Sanjay Shah, the Chairman and Managing Director of Prudent Corporate Advisory Services, joins in to decode their 4th quarter earnings. Thanks a lot, Mr. Shah, for joining in. I just have a 2-part question to start with. One on the mutual fund business, where there have been TER impacts, etc. You do believe that NIMs will hold on out here, or the yields will hold on, despite you having about 100 basis points in terms of yields? That's one. And secondly is the insurance business, where it's surged about 69% as against a decline that we saw in the mutual fund business. How scalable is this, and where do you see insurance as a part of your overall mix over the next few quarters and a few years? If you could give us a short to medium term guidance on that. Insurance and the yields on your MF business because of the TER rules that have come.
Good morning, Maglam. Good morning. And let me first of all talk about the TER change which has been brought in by the regulator, which has been applicable from 1st of April. So there are answers to two questions. One is my existing book, and we believe that because of this change, there are two parts. One was GST and another was the 5 basis point of exit load, which has been removed by the regulator. So we believe GST is a revenue neutral for almost all the players who are part of GST regime. So I don't think there will be any impact because it's just a change in calculation. Previously, we used to get 100 rupees. Now we'll get 85 rupees. We need to raise an invoice for the GST and they'll reimburse the GST to us. So that is one part which is revenue neutral for book also from the existing new business also. As far as the additional 5 basis point cut, we believe I think at my book level, I'll have the impact of about 2 to 3 basis points. As far as my old business is concerned, till 31st March, we have a book of about 1,20,000 crore. I think 2 to 3 basis point impact will come. However, from April onwards, whatever the new business which is we are going to have, I don't see a significant impact because I think their pricing power has remained more or less same. However, I can tell you this is a huge beneficiary things for us because there was a lot of anomaly between GST registered and non-registered partners, and those who are small players and not falling in GST regime, I think the revenue will shrink by about 15 to 20%, and this will pave way for people to consolidate to a quality platform. And we being one of them, I am sure will be the huge beneficiary of the consolidation which will happen into the industry. Talking about your second question about the insurance, as you knew, Mangalam, since last couple of years, we have been hugely concentrating on the creating another alternative line of business, and insurance become a significant for us. If you look at my last full year, out of 100 rupees of revenue, almost 14 to 15 rupees has came from insurance. And normally insurance Jan, Feb, March is a very, very strong period. And we also had one of full year additional revenue which we are supposed to get from the insurance company has been booked by us in the month of Jan, Feb, March. That's the reason revenue has grown up significantly. However, we believe that insurance is going to be a huge growth driver for us going forward. That does not mean that mutual fund will not, because I think we believe mutual fund itself is going to grow into a higher double digit, but insurance is a small kitty in our pie. I think growth will be significantly better.
Well, Mr. Shah, going back to what Mangalam also mentioned about the TER and the exit load changes that have come in, do you believe that because of these regulations, the smaller players would exit / consolidate faster? And is this a very big opportunity for a more organized player like you to increase your market share in this segment?
Yes, sir, definitely, because we believe that the advantage which people were having because of GST was not something which was going to sustain for a long period of time. So I think it's a rationalization of structure, and you are very, very right that the player who are not falling in the GST, the revenue will go down by 15 to 20%, and they have to be a part of some quality platform. I can tell you that's the reason in the current year we are going to grow our network to beyond 30 cities significantly. So we currently have roughly about 140 branches, and we are planning to reach add another 32 branch in the current year. So almost 20% more branch we are adding, because we believe tier 2 and tier 3 city will offer a lot of opportunity to us. So yeah, sure. It's a great opportunity from a consolidation perspective.
Okay, Sanjay, you're going to be adding new branches, but generally in terms of the expansion plans you have this year, and you're talking about the regulatory changes, opening up the space for GST compliant players like you, will some of this growth come in organically? Are there any acquisitions you're evaluating that are on the table? What is the size of acquisitions? In what spaces would those be?
No, I think we already did one acquisition last year of about Indus Capital, which is a Pune-based company. That entire integration of that acquisition has been very, very successful. We bought that franchise for all cash deal of about 135 crore. We have been regularly looking out, because I assume that this business is a business which doesn't require any kind of investment. It's a cash cow, and we generate roughly about 260 crore cash every year. So we are consistently looking for the acquisitions, but it's a slow process, right? Because there are a lot of things which you need to evaluate. So I'll not be able to say anything which is very, very clear as of now, but regularly that process is going. It's a work in process for us.
All right, work in progress for you. Just a final question from my end, sir. All things said and done, whatever we've discussed so far, if you could boil that down to what it means for your P&L going forward. What's the outlook for FY27? The key growth drivers? What are the margin expectations that you have?
Mangal, if you look at last year, I think we had one of the best year as far as my gross sales, net sales is concerned, my SIP book addition is concerned, partner addition is concerned. So on all parameter, last year has been significantly better. Only thing which has not supported us was during the full year, mark to market has not supported. Rather, last quarter, we added about 4,300 crore of net sales, but around 15,000 crore of mark to market losses were there. So from a futuristic projection point of view, we assume that this year may not be a huge, what you call the drainer as far as your mark to market is concerned. So I'm assuming in the full year, if we have about 10-12% of mark to market gain, then I'll definitely be able to easily add about 10 to 12% by way of net sales, because my SIP book is now about 1,200 crore. So I think roughly we can easily assume that on a full year basis, I should do about 14,000, 15,000 crore of what you call the net sales. So all put together, I think I assume that my mutual fund should generate a revenue of about 20-22%. I think last year was also spoiler on my treasury income because of the January, February, March. I think that also would not be a part of current year. And insurance, I think we are very, very positive. We have a huge target as far as health is concerned. Only thing which I think I'll not be able to say very comfortably, because we're expecting some significant change as far as revenue is concerned from the IRD also. So when that change will come and how industry will absorb that change, I think that's a question which is I think it's not very clear as of at this point of time.
Sanjay, just one clarification, if you could leave us with the liquid loan product. It seemed to be contributing to your revenues last year, but for some reason, you've chosen to discontinue it. Was there a regulatory reason behind this, or any other particular reason you could highlight for us?
If you look at last year, there are a lot of changes which has been brought in by the RBI, and they said that the entire P2P model has to function based on some 6-7 key changes which they have brought in. And I believe that entire P2P model was non-sustainable, keeping those changes in mind. And hence, not only probably me, but entire P2P industry has gone through a consolidation, and we decided not to continue selling. And by this time, I think because my book on P2P at the peak was roughly about 650 crore. I think when I'm talking to you now, I think my book, outstanding book, as the maturity is happening every time, hardly about now, I think about 10-15 crore. And within a 2 month or two, I think it might be a zero AUM as far as liquid loan is concerned.
Mr. Shah, thank you so much for sparing time and joining us today. Wish you good luck for FY27 as well. The management of Prudent Corporate Advisory. And well, the markets are recovering from the lows of the day. The Nifty is back above the mark of 23,900. There is some semblance of recovery from lower levels. It's about 60-70 points off the lows of the day. Saumil Mehta from Mirae Asset Sharekhan is joining in for a quick chart check and some trading ideas as well. Saumil, good morning. Thank you for joining in. We've tested the lower end of the range again today at 23,800. Do you believe that we continue to remain in this range, or this downside with the way it has happened today has the legs to take it below 23,800 as well? If so, what happens to the index and your stock calls for the morning as well?
See, my is the same. My view has been range bound, and I think the market should remain range bound between 23,700 and 24,500. So it's a broad range. I'll be expecting markets to stay in this range. Now, in the medium term outlook, we are still, trading below 200 daily exponential moving average, which is 24,750, which will remain a very, very crucial hurdle from here. However, we'll have we'll have a lot of pockets where we can, use this correction as an opportunity to buy in. I think pharma is looking good. The power is looking good. FMCG is looking good. So all these sectors has opportunities in them, and we can nibble into them. Now on the upside, if we close above 200 daily exponential moving average, which is around 24,750, the next level is definitely 25,300, 25,400. So these are my targets. Stock specific, I have large caps. One is from FMCG and one is from the pharma. HUL is what I like from the FMCG pack. It has broken out of an inverted head and shoulder pattern, trading very close to 200 daily exponential moving average. consolidating in the last 2 weeks. So I think HUL should perform well from here, breaking above 200 daily moving average. Target would be 2,450 and stop loss should be 2,200. The second stock is Zydus Life from the Pharma pack. Zydus Life is looking good as well. Was consolidating a little bit around the averages. I'll be expecting this consolidation to break on the upside, trading about 20-40 daily moving average. Target would be 985 and my stop loss would be 920.
All right, take that point. Thank you so much for joining in and giving us your view on a bunch of these stocks. HUL is something that you like. The FMCG pack just doing a lot better than the other parts of the market, which are slightly worried right now. But good time to get in the F&O perspective on the indices as well as we stand. All the frontline indices, they are all lower in trade right now. We have the Nifty Bank, the mid-cap index, all of them fairly lower. And they are lower with rising fear. So the India VIX as well is up in double digits. So it tells you that maybe, there are a lot of fears in the market right now, along with the advance decline ratio, which is way more in favor of declines than the advances. So with the market falling, fear rising, advance decline in favor of declines, the mood generally is on a somber note. And it's led further lower by, look at the jewelry stocks. Titan was up 6% on Friday after its numbers. And the entire gain has been given up because of the comments coming in from the Prime Minister. We have Kalyan Jewellers down about 9% as well. Senko, Tangamail, all of them down between 9 to 10%. The Nifty having fallen below the 50-day moving average after today's fall and failure to stay above the 20-day moving average as well stands out. And which is why there are more calls written than the number of puts. In fact, on Friday as well, the FIs wrote 5 times the number of calls, telling you there was much more supply on the way up than there was support on the way down. Today, 24,000 call. That's seen a fair amount of writing. That comes up for you on the screen. 87 rupees in premium, telling you upwards of 24,100. There would be supply which will re-emanate. 23,900 call as well. Equally fairly written, 136 rupees. So basically, supply zone is between 24,050 to 24,100. But the street believes that there could be some demand coming in closer to 23,800, which is about today's low. 23,850 to 23,800 is where we're expecting support, which is what the action in the 23,900 put indicates. The 23,900 put comes up for you, premium of 100 rupees, telling you between 23,800 and 23,845, which is today's low, is where we'll find some support. A lot of stocks on our radar. Swiggy, most of them earnings related, weak earnings in their QCom business, so a lot of long positions being unwound out there. And then a lot of shorts added on Bharti Airtel, on Lupin, and on State Bank of India, which was another stock that fell about 7% on Friday, post its numbers, seeing another round of selling. So that's the F&O picture right now.
Some fresh shorts seen on Lupin. And of course, Bharti now down 4%. So among the top losers, SBI extending its losses as well. So a lot of these underperformers from Friday's trading session continue to extend their losses as well. Take a short break. On the other side, we get you more on the market. Stay tuned. Welcome back. Now, with tensions escalating in West Asia and fears of the higher oil prices as well growing over disruptions in the oil supplies, Prime Minister Narendra Modi has issued a national advisory. Now, addressing a public gathering in Hyderabad, Prime Minister Modi framed the appeal as an economic and national responsibility. Now, he urged citizens to use petrol and diesel sparingly, travel by metro, opt for carpooling and adopt electric vehicles whenever possible. Now, the Prime Minister also stressed on reducing gold purchases and also suggested avoiding non-essential foreign travel, overseas vacations and destination weddings while promoting domestic tourism. He also urged the farmers to reduce the use of chemical fertilizers by 50% and adopt solar-powered irrigation pumps instead of diesel-run systems. He also stressed the importance of reducing edible oil consumption, linking it to both national economic interests and public health. The Prime Minister also proposed reviving work from home, online meetings and video conferences that were developed during the COVID-19 pandemic. Now, based on all of this, let's also go across to Ritu to understand what the Prime Minister's message could mean for the Indian macros.
Well, Prime Minister Modi's appeal to citizens to cut back on petrol, edible oil, chemical fertilizer use, avoid buying gold for a year, limit foreign travel, all of this to help navigate disruptions posed by the West Asia conflict has immediately led to this question being asked in policy and market circles if this is a precursor to any formal measures. Now, if you look at these four items alone, petrol and diesel, gold, edible oil, chemical fertilizers, they cost India a combined $241 billion in imports last year alone. Petrol and diesel, the highest, $135 billion, gold, $72 billion, and then edible oil, nearly $20 billion, and fertilizers, $14.5 billion. Now, every dollar that was spent importing these widens our trade deficit, and that in turn puts pressure on the rupee, and that pressure is very real right now. So India's current account deficit, that is projected to widen to more than $54 billion next year. The rupee is already down 10% in the last 12 months. Now, Forex reserves, while they're still healthy at about $691 billion as of last Friday, which is roughly 11 months of import cover, have already slipped $38 billion from the February peak, and that is because of RBI drawing down reserves to defend the currency. Now, we've been in this position before, at least a similar one in 2013. During the taper tantrum, the rupee fell 14 rupees in just about 100 days. The current account deficit had widened to its worst ever of about 4.8% of the GDP, and the response was cutting gold import duties being hiked sharply, overseas remittance limits were cut, and the RBI launching a special NRI deposit scheme, which pulled in $34 billion in just a few weeks. Now, that 2013 playbook is seemingly back on the table. So we looked at a few potential measures that can perhaps be discussed. They could be on the table. First is gold. Now, Indians are sitting on more than 25,000 tons of idle gold in homes and in their lockers. So if you simplify the rules around depositing that gold with banks and India imports less of it, that'll directly cut into a $72 billion import bill. Second, if we limit how much Indians can send abroad, so the LRS limit is about $250,000 per person, temporarily tightening that, especially for foreign holidays, which are the single biggest category of outflows, keeps more dollars inside India. Third, a special NRI deposit scheme where you ask the Indian diaspora to park their foreign money savings with Indian banks at attractive rates. Now, India has done this many times before. In 2013 alone, that scheme pulled in $34 billion in a matter of weeks. In fact, on this particular measure, we've already seen reports suggesting that RBI could allow public sector banks to issue foreign currency bonds to attract inflows and support the rupee. And the fourth one, fix the tax treatment for foreign investors that are buying Indian bonds. Now, a concessional 5% tax rate was given. That expired in 2023, and now it's back to 20%. So if you bring back a stable, lower rate, that could make India more attractive to long-term global capital. So, you have the PM's appeal on one hand, that's being seen as a precursor. There are various steps on the table, and now we have to see if a formal policy measure follows through. Here are Soumya Kanti Ghosh, who's the Group Chief Economic Advisor at State Bank of India, on what he made of all of these measures.
Some sort of an decline in the foreign exchanges use could actually go a long way in preserving the current account deficit. Because just some number I want to tell you, I think at $100 per barrel, if that is the average, the current account deficit hits 1.5%, growth hits around 6.6%, and inflation hits 4.6%, which is the current assumptions of the Reserve Bank of India. So any numbers beyond 110 actually pushes the current account deficit towards 2%. And the danger is actually when the crude touches 120 to 130. But these are assumptions for the full year. So in my sense, at this current level, yes, there are concerns on the growth. If you remember the 2013 taper tantrum crisis, there were several steps. There was a bouquet of steps apart from the short-term interest rate hike of 300 basis points. Then there was the FCNRB deposit window. Then there was also restrictions on the LRMS, basically that capital account transact, which the Honorable Prime Minister has been talking about. So I think there were some restrictions. All of this came through. And after that, I think rupee staged a smart recovery. So whatever steps the government or the central bank will take, I think that will be in unison. And we don't rule out some of the steps which were similar to what happened during the 2013 crisis. The overall capital account outflows in the LRMS regime last year could be well in excess of US 20 billion, out of which 75% actually is because of factors like equities, immovable properties, travel, and other things.
All right, so that's about the macroeconomic impact that could happen and the steps that can be taken, but no one feeling the heat more than the jewelry companies. Remember, over the last 12 months or so, every quarter the jewelry companies would come ahead and report extremely strong growth, so over 40 to 50% for FY26 for most players, a large part of it led by higher gold prices, but also not as many declining buyers. So there was the appetite for jewelry in India, and we import about 60 tons of gold per month. The Prime Minister's appeal to resolve not to purchase gold for a year, defer gold purchase to save Forex, has all these guys worried. The stocks up for you anywhere between high single digit to low double digit sort of decline. Analysts believe that, this is going to pave the way for curb in gold imports or maybe a rising customs duty on gold imports as well, as it was in the case of 2012 to 2013, where it was increased from about 2% to about 6%. This morning we spoke with Senko Gold, who did say that, given the sort of commentary that has come by, there is a possibility that there would be a gold import duty hike. And were that to happen, the gold volume imports could actually reduce by about 10 to 12%. On an average, they were about 700 tons, and now it could be about 550 tons in this year because of this. 50% of the gold in India for jewelry consumption is actually led by old gold exchange. So not particularly sure if something like that would impact their overall business or not. Import of gold for jewelry consumption is down 20% already, given the sort of high prices that we've seen. And they are, as an industry, working on lower weight, lower carat jewelry. But for now, the comments coming in from Prime Minister have definitely had a big impact on all these jewelry players, the stocks of which had outperformed earlier itself. So let's hear out what Subankar Sen, who's the MD and CEO at Senko Gold, had to say to us this morning.
Based on our Prime Minister's thought process, if there has to be certain policies that has to be done in order to discourage, import of gold, duty hikes could be a possibility. But till it is being done, these will only be, speculation whether it will happen or not. Out of the import of 700 to 800 tons, about 20-25% of the gold gets used up for exports, and the remaining 75% is used up in either domestic consumption for jewelry or for investment. So it will maybe create a dent of about 10 to 12% reduction in terms of the volumes that gets imported.
Some more recovery on the markets now. It's a 100-point recovery from the lows of the day. 23,950 is where the index currently stands at. So the bulls still not looking to throw in the towel just yet. Still a 220-point cut, but a 100-point recovery from the lows of the day. Take a short break. On the other side, Nilesh Shetty from Quantum Advisors joins in with more. Stay tuned.
Welcome back. We're trading with about a 240-point cut on the frontline index, a bit of a recovery from the kind of lows we saw earlier. 23,932 is where we're at. Let's bring in Nilesh Shetty from Quantum Advisors to discuss market fundamentals and his top sectoral picks. Nilesh, thanks very much for being here. You know, the big focus point today, of course, has been the Prime Minister's call on cutting back fuel use, avoiding foreign travel, avoiding gold buying. In light of all of this, of course, we're seeing the reactions in the street today. Any changes in allocation you would look to make, sectors that would lose favor over the near term on account of what's happening, sectors that would probably gain?
Yeah, I mean, what the Prime Minister said was not a surprise. It should have been sort of said 2 months ago. But given that we were in the state election mode, it's something that they did not want to say publicly for a while. But once the elections are over now, I think you would see measures coming through. I think the way the currency is falling, and given that India is not at the top of the list for any FPI globally, given the taxation, I think you will see a lot more restriction on a currency use outside. And of course, the fuel price hike is yet to pass through. They have so far refrained from doing it, but I doubt it'll persist for long. I think you should see some action on the fuel price hike as well, especially in an El Nino year. I expect inflation to move higher from where it is. So the portfolio is built bottom up. We don't take sort of macro calls, but incrementally we have done allocations to insurance company, cash logistics company. Again, these are individual names that at different points in time have come below a buy limit. But at an overall level, we continue to have large allocations in financial services, which includes banks, private sector banks, and insurance companies. We continue to allocate more in IT services. We think the market has sort of overreacted to the AI risk to these companies, and where valuations now are one of the lowest we've seen in the last 20 years. Dividend yields are closer to 4-5%, which is perhaps one of the highest we've seen from these companies. So that's where the portfolio stands for us.
What about capital goods companies, Nilesh? You saw the results from ABB India and the slew of downgrades that the stock has received earlier today. Of course, not asking you for a specific stock recommendation, but with the kind of run-up that these companies have seen, then the subsequent underperformance, where does your stance is on these capital goods companies? Where does your preference lie, be it the transmission companies or the power generation companies and so on?
Yeah, the valuations for these companies are now sort of similar to what we see, or at least what we saw in that 2005 to 2007 cycle. And the Capex to GDP is nowhere close to the number that was sort of visible then. I know there is a lot of play on renewables impacting the grid and sort of Capex related to that. And then eventually data centers impacting sort of power demand in India. But especially on the power demand, when we did the numbers, it could add incrementally 1-2%. So for these companies to re-rate the way they have done, it looks like massive sort of euphoria has been built into these numbers, and the actual numbers may sort of underperform investor expectations. So we actually have zero allocation to that bucket purely on valuations. Again, there is a long-term structural trend in India where the Capex continues to grow as India builds out infrastructure. But given they are almost 2 standard deviations above their long-term averages, we have been cautious, and we have no allocation to that bucket.
A two-part question, Nilesh. One on financials, the other one is on consumption. Both of them interlinked in the sense that with the Prime Minister's comments coming in, do you think there could be a sort of impact on credit growth going forward? And to that extent, could there be some sort of problems in the financial sector? And again, on the consumption space, consumer staples facing a fair amount of inflation, taking price hikes, but consumer discretionary, which was doing well, now there have been calls to exercise restraint out there. How do you view the current news piece and your investments, if at all, you have in these spaces?
So on financials, I mean, there could be some sort of increase in credit costs if sort of the economy worsens slightly. But the point is the valuations are sort of one of the best we've seen in the last 20 years for that bucket, especially on the private sector banks. So it's unlikely that the stocks will see downside from current levels. And if there is any sort of positive news on credit growth or sort of credit costs, you should see us a re-rating. So we remain very, very bullish on that space. In terms of consumer discretionary spend, see, especially after GST cut, we saw a big pickup in that bucket, be it autos, be it consumer durables, which may derail in a higher inflationary environment. So we actually use the rally to trim some of our holdings there, especially in the auto sector. But if they were to derail, again, it is a near-term issue. We don't doubt the long-term India story, but if they were to derail and you see valuations correct in that bucket, we will add to that bucket.
Nilesh, specifically on jewelry, I mean, you spoke about consumption broadly, but specifically on the jewelry company names, any views? I mean, again, following as we've been doing on the PM's advisory to limit gold purchases. Near-term headwind, do you think?
It will be, but again, jewelry, there is one company which trades at like 5x of the rest of the pack, purely on, and that is purely because of governance reasons. So to get well-governed companies at reasonable valuations is not easy. There's one high-quality company which trades at the valuation that it does. So in our value portfolio, it's difficult to sort of own that name. But apart from that, that story of informal to formal, sort of allowing them to grow structurally at a certain rate, that continues. The problem is a lot of the smaller names are not that well governed in terms of governance norms for these companies, which makes them difficult to own in a portfolio.
Nilesh, thank you for sparing time and joining us today with your views on these sectors that are making headlines in today's trading session. By the way, the index still looking to hold on to that 23,950 mark, still a 240-point cut. Be interesting to see whether this recovery gets sold into as we go into the second half of the trading session. Take a short break, back with more on the other side, particularly so on Jyoti Labs. That stock too is down 11%.
Welcome back. 1% lower for the frontline index, down about 250 points for the Nifty. Among all the stocks which are losing, one of them that stands out in particular is Jyoti Labs, now down about 11% with huge volumes on the downside. And the bigger reason for that is the announcement that the company made over the exchanges. There was an unscheduled board meet, and they said that in that, Henkel, the foreign collaborator of the company, has decided not to renew their license for Prill and Fa, which have been with the company since 2011. Remember, Fa isn't a material contributor to the sales of the company, but Pril is their anchor brand for dishwashing liquids. As of their last quarter's performance, dishwashing accounted for nearly about 31% of their sales. Remember, this includes dishwashing bars and dishwashing liquids. Assuming that it does about half of that via liquids, it could be almost 12 to 15% of their sales. So with the brand license for Pril not being renewed, how do growth prospects for this company stand out going forward is something that we will see. Fourth quarter numbers weren't particularly good on the top line front. Either the stock, given today's fall and the recent underperformance, down about 55% from its peak. So that's about Jyoti Labs. But that's all the time that we have on this edition of Trading Hour. We'll leave it to the team of Halftime Report to take all the market action forward. Thank you so much for watching from Ritu, Hormaz and me.
Stock slip as West Asia concerns ripple through PM's call for reining in use of imported items, even as Trump rejects Iran's peace plan. Consumer, discretionary and realty are the big drags, even as healthcare ekes out gains.
PM Modi has appealed to citizens to cut use of fuel, defer travel and limit purchases of items like edible oils to rein in the current account deficit. This comes even as there's little headway in reopening the Strait of Hormuz.
Jewelry stocks take a beating after Modi calls on citizens to put off all gold buying for a year. This follows recent reports on banks seeing delays in permissions to import the yellow metal.
Tata Consumer delivers Q4 FY26 volume growth far ahead of estimates and guides for double-digit growth in sales and EBITDA in FY27. The beverage and food major eyes a 30% jump in growth businesses. It reports cheers the street with investors giving it a thumbs up.
Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra, with me Sonal Bhutra and Vinny Motiwala. Well, it is turning out to be a start to the week, which we don't really like at this point in time. So we have the Nifty, which is down over 240 odd points. We have the mid-cap index, which is down around 0.7%, and the Bank Nifty, which is down around 1% at this point as well. Just want to point out, however, that it's not all red, because if you look at the entire healthcare and pharma index, that in fact is doing well today. It's fairly resilient, you'd have to say, and it has been if you look at it on a month-to-date as well as year-to-date basis. So the BSE Healthcare Index, for example, is up around 4.9% on a month-to-date basis and has rallied around 7% this year. Similar case for the Nifty Pharma Index, which is up around 4% month-to-date and is up around 6.6% on a year-to-date basis. Compare this with the Nifty, which is down around 0.3% month-to-date and is down around 8.4% year-to-date, and the Mid-Cap Index, which is up around 2.7% month-to-date and is up around 1.6% on a year-to-date basis. So yes, the pharmaceutical healthcare stocks are being fairly resilient as compared to at least these indices and maybe a couple of the frontline indices such as the Bank Nifty, the Realty Index, the FMCG Index, for example.
That's true, Ekta. Hi, girls. Good afternoon. And that's why maybe it's called the defensive space, right? When the other market is not doing so well, pharma is the place where people are hiding for now. An important week in terms of a lot of macro data. We have the CPI data tomorrow on 14th. We do have the WPI data and the trade deficit figures on 15th. Of course, they'll be backdated. Things have changed now again. A lot happening in the energy market with crude oil prices at $105 a barrel and lower lows for the rupee as well. We'll keep tracking that for you because that continues to be the big story. And this is at a time when earnings are trickling in. Q4 did not see that big an impact of whatever happened with West Asia crisis. So maybe a lot of the investors are looking forward with what happens in Q1 now.
Absolutely, that's what they're looking for. And most of the times when I've heard at least the capital good players talk in conference calls as well, they've spoken about how they will also, the companies themselves are also assessing the situation and see the impact that comes in Q1. So that'll be key to watch out for. But on that note, we have a very exciting lineup for you all on the show today. And we'll start by putting the spotlight on the Prime Minister's appeal amid the ongoing West Asia crisis and bring you the top voices. What are they saying in terms of the impact? And in our Movers and Shakers segment, we will focus on Lupin, Industries, ABB India, a lot more on why they're moving around. And in our commodities corner, we'll have Manisha Gupta, who will be speaking with Khushbu Ranawat of GJEPC. So we'll stay tuned in for that conversation on commodities as well. But starting with the first segment for today, let's go to Vivek, who's here to tell us which are the stocks that are moving around in the trading session. Good afternoon, Vivek.
Well, good afternoon. We started off the session on a very weak note. Advanced decline ratio quite weak, but a little bit of a bounce back as far as some of the broader end of the market stocks are concerned. In terms of individual names that we're tracking, first on the list is Tata Consumer, very strong set of numbers. The management has given a strong guidance. Sales revenue growth will continue in FY27 and EBITDA growth will be ahead of the top line growth. Stock clearly cheering that 5% higher. The other stock, of course, is MCX, a very strong Q4, very strong data coming in terms of ADTO premium growth. On the back of that particular stock high by almost 3%. After the run-up, the stock is already seen in the anticipation of the results. Birla Corporation, one of the top gainers as far as the NSE 500 is concerned, an outperformer within the cement pack in terms of the results. And Idea, after the relief coming in as far as AGR dues are concerned, that particular name continues to outperform today, the top mid-cap gainer. On the other hand, quite a few drags as well. First on the list, of course, has to be ABB, significant margin miss as far as street expectations were concerned. Most of the brokerages that track this particular name have downgraded their rating on the stock. Stock down almost 10% today. SBI follow-on selling seen after very weak NIM performance and NIMS. That particular stock down by another 4% after the 6% down ticket. So most of the gold finance companies, gold-related themes doing very weakly in the session today. Titan, Kalyan Jewellers, even some of the gold financials like Muthoot and Manappuram seeing significant selling pressure. Have a look at Lupin. The results did come out out on Thursday, but there has been significant EPS downgrades coming for FY27. Key competition in key products in FY27. Street not liking that, almost 5% lower. Escorts, very cautious guidance given as far as tractor growth outlook is concerned for FY27. Again, 6% lower on this particular name. Bharti Airtel, Street doesn't like the capital allocation plan. As far as hiking stake in Airtel Africa is concerned, down 4%. And lastly, Jyoti Labs, some negative news flow coming in terms of one of its key brands. Henkel has decided not to renew Print as well as FAR, both of the brands of the company. That stock taking it on the chin, down almost 10% today.
Okay, all right, Vivek, lots of stocks which are under pressure in today's trading session. Thanks very much for bringing us that entire comprehensive list. But the other one which is under pressure today is Kalyani Steels. It is after reporting what was a weak set of Q4 numbers. The revenue has slipped around 11%. Other expenses have surged more than 26%. To talk more about this, we have R.K. Goyal, who is the MD of Kalyani Steels, joining in now. Mr. Goyal, thank you very much for taking the time out. Well, revenue is down 11%. Can you just tell us why exactly has revenue declined? What has been the impact of the West Asia crisis on your business? Have you been facing any kind of gas and fuel issues which has impacted business this quarter?
Good afternoon. First of all, our revenue is down basically because during the year we had to reduce the price based on the OEM settlement. And due to that, even though we are utilizing more than 100% of our capacity, the revenue has gone down. But however, you will see that our EBITDA margins are intact, or rather a little bit upwards direction only. So there is no impact on our profitability. Yes, sales revenue will be dependent on the raw material prices and the settlement with the OEMs.
Okay, so what has the settlement with the OEMs been, sir? How much lower are the prices, or how much have you cut the prices basis your conversations there? If you compare it with markets and you do a quarterly or a 6-monthly revisions, right? When was it last done? By how much? And when is the next one due?
You see, we had reduced the price in the beginning of the financial year and middle of the financial year. But now we are due for a big increase. The raw material cost, including ferroalloys, has gone up substantially. We are in final stage of negotiations, and we may get a substantial increase anytime, and that should be able to offset our increased cost. Now, after this breakout of war between US, Israel and Iran, there is a good sizable increase in ferroalloy prices and of course the fuel prices, which has increased our cost. But this price increase will be able to offset the same.
So what is this price increase? What's the percent that you would be looking at? You said it will be a significant increase. So what is that?
You see, it is still in negotiation. We have not finalized. Until it is finalized, I don't think it is appropriate to announce on a media like TV.
What is it absolute per ton number maybe? Would it be, what would the number be per ton? If you could help us with that figure at least.
I think it will be, the price increase will be better than what we had to reduce during last year. But then it will be by and large offsetting our cost increase only. It will not improve the margins further.
All right. So net, your margins should be within this range of around 20 to 21% based on the price hike that you're taking?
Yes, it will be at least what we were getting last year, and by and large the same.
Okay, this is about pricing. There's a big one that is upcoming because of whatever we've seen in terms of raw material price hike. That is one part of the business. The other one has been the Capex that you've been talking about, the Odisha project. It's been going on for a long time. Can you give us a sense on the progress here? Have you received the EC? What's the timeline now with the new Capex? Are you putting in more money here?
You know, as far as our Odisha project is concerned, we are still awaiting for EC. And we have complied by all the requirements, but then finally it is the central government, MOEF, and a little role, whatever has to be played by the state government. But we are getting good support from the state government, and now we are expecting anytime we should get clear. And beside environment clearance, it is the forest clearance also. So we are waiting for both these issues to be cleared, and once that is cleared, then we'll go to the board for approval of the project.
Sir, these expansion plans, cash on books currently at 450 crores, right? Big expansion plans in Odisha. So how does that change as well? What is the debt maybe that we'll keep an eye out on for the company?
I think the free cash in our books is much, much larger than the number you mentioned and sizable. And with the debt, with the incentives, everything put together, Kalyan Steel will be able to manage this project well. It will be able to fund it appropriately.
Okay. Well, so, you've spoken about the margin guidance that you have at around 20 to 21%. You're probably going to stick to that. Just give us a sense in terms of what the revenue would look like, the trajectory would look like going into FY27 based on what you are seeing when it comes to demand at this point?
It is again, it will go up to the extent we get the price increase. It's very simple. Because we are already utilizing 100% capacity, maybe few thousand tons we are able to produce more by some efficiencies, further improvement in efficiencies and all, but it will not go up significantly. It is only to the extent of price increase. And if I mention that number, which is not finalized, then it is not appropriate. You please appreciate that.
No, we do appreciate that, Mr. Goel. This will happen in the future. So that is not something you can tell us. But can you quantify, coming back to that price hike again, what happened on 1st April and 15th April? How much of a price hike had been taken? And just trying to understand, what is the cost structure now? How much have prices increased by? Is it purely a price problem, or you are seeing some shortage of fuel availability as well? If you can answer both these parts of the business right now.
Okay. Now, as far as we are concerned, we are shortage of capacity. We have more business. We have to literally say no to many of our customers or cut down the quantities as far as the volume part is concerned or production part is concerned, and we are able to operate at more than 100% of the capacity. Now, as far as the turnover part is concerned, it will go up, as I mentioned earlier, to the extent we get the price increase, it will go up only by that. But at the same time, we are bringing more efficiencies, so we'll be able to produce few thousand tons more. And to that extent, the turnover will also go up and profit will also go up.
Okay, sir, turnover will go up, profitability will go up. Could you help us with maybe numbers, if it's possible, the numbers that we would watch out for in FY27 on these fronts?
Suppose, I'm just giving an example, it's not an exact number. Price increase goes up by 10%, then the turnover will also go up by 10%.
Okay. All right, Mr. Goel, we're going to leave it on that note. Always a pleasure speaking with you. Thanks very much for joining in and speaking with us. So that is Kalyani Steels. That stock is down around 4% today, but if you look at it on a 1 month basis, it's risen around 23%. So it's done well along with a lot of the Nifty metal stocks, or the metal index rather, on the indices. But we'll take a short break. On the other end, we're going to put the spotlight on our What's Trending segment, the Prime Minister's appeal amid the ongoing West Asia crisis. We'll bring you the top voices, what they are saying and the impact. Stay tuned.
Welcome back. You're still tuned into Halftime Report. Well, of course, the big trending story that we've been tracking is tensions escalating in West Asia. And now with that, there are fears growing over disruption in global oil supplies. Prime Minister Narendra Modi has issued national advisory addressing a public gathering in Hyderabad. And Prime Minister Narendra Modi framed the appeal as an economic and national responsibility. Modi urged citizens to use petrol and diesel sparingly, travel by metro, opt for carpooling and adopt electric vehicles wherever possible. The Prime Minister also stressed on reducing gold purchases, saying gold imports consume a large amount of foreign exchange. He also suggested avoiding non-essential foreign travel, overseas vacations and destination weddings abroad while promoting domestic tourism. He urged farmers to reduce the use of chemical fertilizers by 50% and adopt solar-powered irrigation pumps instead of diesel-run systems. He also stressed the importance of reducing edible oil consumption, linking it to both national economic interests and public health. The Prime Minister also proposed reviving work from home, online meetings and video conferences that were developed during the COVID-19 pandemic. In fact, let's listen into what Union Minister Ashwini Vaishnav and Bharti Enterprises had to say on all this.
It's very important that we as citizens also play our role in this entire effort. We as citizens, as our Prime Minister has asked all of us to, can reduce our expenditure on everything that requires foreign exchange to be spent. So I'll request all of you to take cognizance of Honorable Prime Minister's call to the nation, and within your own means, within your own enterprises, within your own businesses, try to do whatever best you can.
I think we in the industry need to play our role. We need to play our part. We have employment of millions of people. We can take his message forward in a very deep and meaningful way. We need to get away from this obsession of import of gold. We need to lower our energy costs. We need to move more faster towards renewable energy in our industry. And importantly, we need to vote with our feet within our country. Spend more here, put more Capex here. We need to invest more. This is not the moment to shy away. This is the moment to invest, double down in our own country, because the underlying growth is there. This is a continent of consumers, large young population wanting more products and more services. And let's give them more from India, make in India, from India, serving India.
We also spoke with Senko Gold Survankar Sen, who believes there is a possibility of gold import duty hike given PM's commentary. Listen in.
Based on our Prime Minister's thought process, if there has to be certain policies that has to be done in order to discourage, import of gold, duty hikes could be a possibility. But till it is being done, these will only be, speculation whether it will happen or not. Out of the import of 700 to 800 tons, about 20-25% of the gold gets used up for exports, and the remaining 75% is used up in either domestic consumption for jewelry or for investment. So it will maybe create a dent of about 10 to 12% reduction in terms of the volumes that gets imported.
Okay, let's also listen in to the SBI Chief Economic Advisor Soumyakanti Ghosh and what he had to say on the LRS outflow.
If you remember the 2013 taper tantrum crisis, there were several steps. There was a bouquet of steps apart from the short-term interest rate hike of 300 basis points. Then there was the FCNRB deposit window. Then there was also restrictions on the LRMS, basically that capital account transact, which the Honorable Prime Minister has been talking about. So I think there were some restrictions. All of this came through. And after that, I think rupee staged a smart recovery. So whatever steps the government or the central bank will take, I think that will be in unison. And we don't rule out some of the steps which were similar to what happened during the 2013 crisis. The overall capital account outflows in the LRMS regime last year could be well in excess of US 20 billion, out of which 75% actually is because of the factors like equities, immovable properties, travel and other things.
Okay, Forex continues to be the big talking point, and while we are at LRS, just to give some perspective on what happens with mutual fund investing now. Now remember, the liberalized remittance scheme allows an outflow of $250,000 per person per FI, that's $250,000. But if we talk about mutual funds, the industry-wide cap is at $7 billion. And most of the AMCs, in fact, the entire industry has exhausted that limit. So if you wish to go ahead and invest in international funds, there are very limited options because most of them have exhausted that limit already. This has led to periodic sudden suspension of fresh lump sum and SIPs as well. Industry has close to 61 international funds, and a lot of them have been done away with these subscriptions coming by as well. The recent ones have been PGIM AMC. They've shut subscriptions in their international funds. The other one was Nippon India AMC. These are only some of the names. Many of them have actually shut it. The overseas ETF caps is at $1 billion. So basically, those are fund of funds which would be investing, say, in an Asia fund, a Taiwan fund. These also have been exhausted, these limits so far. What is the alternate now if we wish to invest in international funds? It's the Gift City fund. Now, you do have a lot of funds which are coming up there. That's a limited number so far because it has just started. You have DSP Gift City fund. There is DSP Global Equity Fund, Edelweiss Greater China Fund, this PPFAS and Mirae Asset Global Allocation Fund as well. Again, these are just some of the names, and they do have minimum investment limits. For some of them, it's $5,000. That is the minimum amount that you have to invest in order to take exposure to international markets. Of course, this is under the umbrella of that $250,000 LRS limit, but it's different from the mutual fund limit that we have. But for now, a lot of the investors have not gotten the exposure to international funds because of these limits being exhausted. So just wanted to put that forth, that international investing, yes, a lot of people are talking about it, but comments coming in from Prime Minister Modi and these limits which are already there and some of the funds.
Yes, and already been exhausted.
Yeah.
So there's a huge demand which is coming in for that.
Absolutely huge demand there. But on that note, we're going to zip into a very short break. Up next, we'll come back with Rajesh Palwe of Axis Securities, who will share his trading strategies, levels that we're keeping an eye out on. Stay tuned in. Welcome back to Halftime Report on CNBC TV 18. Nifty obviously through the day had recovered from the day's lowest point, but we're still below the 24,000 mark, right? We're at 23,950 approximately there. 240 point downtick still on the Nifty 50. But in the world of F&O, what are we keeping an eye out on? Let's go across to Mangalam, who's at the F&O desk to take us through all those details. Mangalam.
Well, we have recovered from the lows, but we're still not out of the woods, and that's exactly what the data points are telling you. The Nifty Bank, the mid-cap index, all of them lower in today's trading session, and all of them lower with a rising India VIX and worsening advanced decline ratio tells you that there is still a lot of imminent fear in the market right now. So any sort of recovery may see a fair amount of selling. So if you look at, the rising volatility, India VIX is up in nearly double digits. We have the market breadth, over 2,200 stocks in the red for about 800, 900 in the green right now. And through the course of the day, the Nifty's broken important levels. The 50-day moving average obviously is what it is below right now, just shy of that 24,000 mark. The 20-day moving average is something that it broke on Friday's trading session itself. Active options, more call writers than put writers, tells you that the market will face more supply than demand at lower levels. If you look at the options, the range that the street is working with is 23,800 to 24,100.
Okay, all right, Mangalam, thanks very much for that. So just watch out for the DB Corp numbers. Net profit is up around 19% on a year-on-year basis. So good performance coming in. 62 odd crores is what they've reported. Stock holding up with a gain of around 0.5%. But let's continue to talk about the markets. We have Rajesh Palvia, who's a technical analyst, joining in on the show now. Rajesh, hi, welcome to the show. Well, it's definitely a tough day for us. So just tell us what your Nifty strategy would be, considering that it's below 24,000 at this point.
Yeah, hi, good afternoon. So Nifty has broken the important support area of 24,000 in opening itself and now slipped below to 20-day moving average also. Short built-up is clearly there in the data. Looking at the weekly option expiry of 12th May, the major call writing activity has been witnessed at 24,000, 24,100 strikes. So these levels are likely to act as a major supply zone for any kind of minor pullback if it's come. Put writers have shifted their position on the lower strike. So the major support is now shifted to 23,800, 23,700, which are important to watch for in the near-term perspective. So till Nifty not able to take out 24,100 level, I think trend is likely to exhibit slightly on the weaker side for especially for the Nifty. But many stock specific action is taking place. Some of the sectors where continuity of uptrend is there. So where investor and traders are focusing and trading activities happening in those stocks. Bank Nifty is looking slightly weaker as Bank Nifty has already broken the important support area of 55,000 level. Though there was some recovery from the lower level, but still till Bank Nifty is trading below to 55,000 level. I think we may see, most of the banking stocks may face a supply pressure at higher level, and maybe we could see lower level for Bank Nifty towards 54,500, even 3,300 level also. So I think Bank Nifty looks weak compared to the Nifty, but some of the pockets like FMCG, Pharma, these stocks are still looking attractive. I think one can find out opportunity here.
Okay, so Pharma and FMCG is where you're finding some opportunity. By the way, DB Corp is surging. That stock should come up for you on the screen. It's up 4% after the numbers. So strong showing there. They say their advertising revenues grew 6% on a YY basis. Circulation revenue, however, stood flat. It's the ad revenue growth that the street has liked. But of course, the outlook going forward will be very, very important because this, of course, saw a lot of advertising spends coming in because of state elections. We'll have to see whether that continues in Q1 as well or not. For now, the stock at the day's high. Rajesh, you said a lot of stock-specific action is something that you're looking at. What are some of the specific bets that you have?
First is from the FMCG basket, and Marico is clear outperforming stocks from that basket. Continuity of uptrend is there. Stock is almost hovering at the all-time high trajectory. So the way stock is exhibiting its strength, we believe that the buying interest is still there in this counter, and possible upside towards 865, 875 we may see for Marico. So one can buy and accumulate. On the downside, one needs to keep his stop loss towards 830. The second stock is from the pharma space, that is Torrent Pharma. Stock managed to give breakout of its previous swing high of March 2026. And looking at the breakout, we believe that, if it continues to trade above 44.70 level, I think the upward trajectory for this stock would be around 4600 to 4630. So Torrent Pharma is buy. On the downside, 4460 needs to keep as a stop loss.
Okay. Rajesh, thank you so much for joining us this afternoon, talking to us about the trading strategies and individual stocks as well. Thanks so much for that. But on that note, we're going to slip into a very short break. On the other side, Manisha Gupta will be speaking with Khushbu Ranawat of Gems and Jewelry Export Promotion Council on PM Modi's advisory amid the West Asia crisis. Stay tuned in.
Welcome back. Well, for the markets, we're weak at this point. We have the Nifty, which is down around 240 odd points, and the mid-cap index, which is down around 470 odd points. Just want to point out one particular stock again from the pharmaceutical space, which is holding up quite well. Sun Pharma, which is up around 1.4%. And to put it into perspective, that stock, in fact, has rallied around 15% from the time they had announced the acquisition of Organon, which is $11.5 billion. That took place on the 27th of April. So before that, on the 24th of April, which is a Friday, the stock closed at around 1,620 odd rupees. So it's rallied quite smartly since then. Stock holding up with a gain of around 1.4% at this point as well. But let's go across to Manisha. She's going to take us through what she's tracking in the commodity space. Manisha, over to you.
Well, thank you so much for that. I have a guest as well with me, Khushbu Ranawat. She is the chairperson, West Region at Gems and Jewellery Export Promotion Council. Khushbu, hi, thank you so much for joining in. And the one thing that we are very closely tracking since morning today has been the PM statement over the weekend, where he did mention about, or rather requesting public at large to not buy gold and gold jewellery. I mean, the sense that I'm getting in from the industry is that perhaps for the next month or a couple of months, the ministry will watch out on what the buying and the sales are, and then perhaps we could be looking at a policy measure. One, how are you looking at the statement, and what's your sense? At this point in time, it's only an advisory, it's not mandatory, but do you see a policy coming in that effect?
Hi, Manisha ji. Thank you for having me over. I believe the Honorable Prime Minister's statement comes from a piece of economic caution and fully understand the concern regarding foreign exchange conservation and important import dependence. Because India is importing about 700 and 800 tons of gold annually, translating into an import value of nearly 4 to
Okay, I think we should.
All right. Yeah, I think we'll connect with you again, Khushbu. There is some technical error because of which we're not able to hear you properly. We'll just try doing that. But of course, as Manisha mentioned, it's just an advisory. It's not a rule as of now. And the question is whether it becomes a policy very soon, because of which a lot of these jewelry stocks, those should come up for you on the screen, the likes of Titan, Kalyan Jewelry, all of them are lower in trade. Gold also on the M6 is at 1,52,150 rupees per 10 grams. So that's the kind of moves that we are seeing in the stock markets and the commodity markets as well on the back of Prime Minister Modi's advisory that came by. Actually, we'll do one thing. We'll slip into a short break. When we come back, we'll try reconnecting with Khushbu and to understand what happens with the entire jewelry sector. Stay tuned for that.
Khushbu Ranawat now joins in to talk about the PM's statement on gold. Khushbu, hi, we couldn't hear you earlier, but you were making a point on the Honorable Prime Minister as of now has only given this as a suggestion or a request. Going forward, what is the industry anticipating?
So yes, thank you, Manisha ji, for having me over. We truly respect Honorable Prime Minister's decision, and we understand his concern regarding foreign exchange conservation and import dependence. I would like to repeat that India consumes roughly 700 to 800 tons of gold annually, translating into an import value of nearly 4 to 5 lakh crore depending on gold prices. But any slowdown in jewelry demand impacts not only retailers, but also carriers, artisans, machine operators, designers, logistics workers, wholesalers, and thousands of MSMEs across the country. India is home to 300,000 jewelry businesses, including manufacturers, wholesalers, retailers, artisans, polishers, setters, casting units, and logistics supporting ecosystems. Nearly 60 to 70% of the industry workforce is connected to MSMEs. Family-run units and artisan clusters spread across cities such as Mumbai, Surat, Rajkot, Kolkata, Jaipur, Coimbatore, Thrissur, and Hyderabad. It's going to affect a lot of us in the industry. And we truly believe that we need to now work on how we can recycle gold within India itself. India's temple reserves have 25,000 to 30,000 tons of gold, and I believe World Gold Council is also working towards the same.
Oh, absolutely. Khushbu, I get your point that a lot of people and their livelihoods could get impacted if, if this actually would go through the same way. But as you said, yes, there are various solutions as well to this. We don't really have to import all the gold. What I do also understand is that nearly 50% of new gold that is coming in is being bought is in exchange of the old gold as well. And as you mentioned about the household gold as well, what are the suggestions that if you had to make to PM to work on or to the ministry or to the concerned authorities, what would they really be?
We respect their decision and we respect their statement. But we also ask everybody that gold is not only in India a trade commodity. It's part of our culture. It's part of our weddings. It's part of our homes. And it's a belief that gold will always rise. And it has. It has shown that hype. And in the last 2 years, gold has proved itself also. It's crossed over 1,50,000 for 10 grams of gold. And that's a lot of money. And gold is already a luxurious item. So we should respect the culture that comes within India for gold.
You talked about recycled gold. Also, you also talked about the gold monetization scheme that we had earlier did not really work through. What in a better frame could that perhaps work? How do you see the household gold coming back into the markets, getting that recycled?
The gold monetization scheme did not work, has a lot of its own other things that we could improvise as a government, and we can surely, as BJPC, come forward with some initiatives where we can advise the government for policies the way we can recycle gold better. But today's period also has required us as manufacturers to innovate. We are innovating with a lot of lightweight jewelry, different caratages. So it is a lot of old gold that is being recycled. In fact, if we see the import of gold has reduced over the last year. It is a lot of consumption within India itself. So yes, we will work on a policy that may be better and that could encourage our consumers to invest within India itself.
Khushbu, the statement from the PM comes in at a time when we are readying ourselves for major exhibitions and wedding season and festivals going across.
Absolutely. We need to have less dependence on imported raw gold, but stronger growth in the Indian jewelry manufacturing, exports, craftsmanship, and employment. And we as an industry need to unite and figure out how we can help each other with this tough time.
Okay, an interesting chat there. Surely important to watch out for in terms of gold, and any slowdown, obviously, there will impact artisans as well as industry workers. That is also key from here on. Manisha, as well as Khushbu, thank you so much for joining us on the show. Manisha, thank you so much for taking us through that conversation as well. But now it's time to move on and talk about equity markets again, our movers and shakers segment now, and we are tracking a whole host of stocks that are buzzing around. First up, Ekta Lupin. That's the one in focus today as well. What is the reason behind this for today?
Well, yes, Lupin is in focus because it held its conference call, and after that, the street seems to be a little concerned with regards to FY27 and how that would shape out. So Guidance post the conference call indicates that FY27 revenue growth is expected to be in terms of high single-digit growth. US revenue in FY27 is likely to post high single-digit or low double-digit erosion. It remains, however, on track to deliver that $1 billion or marginally higher revenue. Now, remember that FY26 was an excellent year for Lupin. So FY27, we're going to see a bit of a shave off, and that's what the street is concerned about. Similar case for the margins, which came in at 32% for FY26. FY27, they've said that they're guiding for 25%. Margins have factored in competition for Mirabegron, one of their key drugs, as well as Tolvaptan, R&D expenditure to increase, impact from the West Asia war as well. Brokerages are also concerned with regards to what Lupin has reported. So, for example, Nuvama has downgraded Lupin to hold from buy after the recent rally with limited upside left, according to them. They have a target price of 2,600 odd rupees, and earlier it was around 2,550 odd rupees.
Okay, 5% lower on Lupin. That's the word coming in from the management and brokerage commentary as well. ABB India, that is the other loser in trade, reported numbers. What did you make of that? A 9% cut now.
Yeah, so the number's quite weak, right? Or miss on terms of the expectations from the street as well as the CNBC TV 18 poll. When you look at it, revenue just saw a growth of around 5%. The automation segment execution seemed to be a concern over there, and there was a bit of a slower execution, so that impacted the segment, and weak performance came in over there. Order inflow, that stood at 25%. Where did the orders actually come in from? What was doing well in terms of segments over there? Data centers, railways, renewables, utilities, infrastructure, that did well. Do not forget, the company has also now completed the sale of the robotics business, right? There was a separate division that was the robotics automation. Now that has gone off because that's according to the ABB parent. That was the plan. So that has moved out and they sold that part of the business. Key highlights that came in on the con call. The company said that the revenue and profitability of the company was impacted this quarter was mainly because of the West Asia conflict. Margins impacted because of what? Raw material inflation, rupee depreciation, revenue mix, as well as pricing pressure that came in. And they've given a guidance for PAT margin, PAT margin guidance, I beg your pardon, and that is maintained at around 12 to 15% range. The company has taken some price hikes. They think that in some other segments also they may be looking at taking more price hikes going forward. And data centers, that's been the exciting part. Now that accounts for around 12% of their book. But large orders, large projects, there seems like there's some delay in decision making coming in from the clients as well. So that is something that they'll watch out for in two segments, automation as well as the industrial capex. Competition, that's intense in some of the areas and some geographies coming in on the global front from Japan, Korea as well as China. And because of this weak number right now, we've seen brokerages downgrade the stock as well. Prabhudas Lilladher has downgraded the stock to a hold. We have Nuvama that's downgraded the stock to reduced rating, and Motilal Oswal also has downgraded the stock to a neutral rating. So a lot of downgrades that have come in and 9% decline in the stock.
Okay, all right, Vinny, thanks very much for that. But let's go across to Nigel. Rain Industries is doing very well today. Nigel, tell us more.
Well, Rain Industries is doing well. And remember, we have mentioned in the past that it's a bit of a play with regard to aluminium. It can be called a so-called aluminium ancillary. The reason I say this is because they make CPC as well as CTP, which is coal tar pitch, and both of them are used in the aluminium segment. Now, the numbers look very, very good. On the top line, there's a growth of close to around 20%. How did that happen? They have three big segments. One is their carbon segment, which is CPC as well as CTP, that's coal tar pitch. Out there you had a growth of more than 20%. And we have some indications with regard to pricing. There, Nalco as well told us that the prices had moved from around 45,000 per ton to around 52,000 per ton. My calculated numbers are around 53,000 rupees per ton. So that segment got a big booster shot because of higher pricing and higher volumes. Then this other smaller part of the business is the advanced material business, which also did well. Growth of close to around 19% of them, and margins expanded out there. The sole point of the business, which wasn't very, very good, is the cement business. That continues to struggle, but that's more an industry-wide problem. You put everything together, the margins have moved to around 15%. That's not a number I've seen in many, many quarters. So there's a sharp improvement in the operational profit. The absolute number close to around 700 crores. They were doing close to around 350 crores earlier, and margins moves to around 15%. They reported a net profit that compares with the net loss, but the big trigger from here on is the operational performance could be good because I understand CPC prices as well as CTP prices are doing well, and both of them go into aluminium. Offtake is something that we'll be tracking. The smaller part of the business, which is the advanced materials business, needs to improve from here on, but the crucial trigger will be refinancing of their debt that's up for you in the screen. refinancing or repayment is important. Otherwise, the stock trades at around 5 times odd EV upon EBITDA, which is not very expensive, and the operational performance could improve. But reduction in interest costs is something the street will track very closely. Stock up and about.
Oh, yes, 16% higher on this one. The other stock on the higher side is Advanced Enzymes. Ekta, tell us more.
Well, yes, reacting to its Q4 numbers, the revenue is up around 22% this time. The margins have expanded to 31% and the profit is up 69%. The human nutrition business was up 24% for the quarter. Animal nutrition was up 19% on a year-on-year basis. Their bioprocessing, which is small, was up 17%, and their specialized manufacturing was up 17%. So all of these segments, in fact, grew in double digits. Domestic sales, which is 52% of the business, was up 51% on a year-on-year basis. International sales also was a bit flattish, however, this quarter, but grew. And interestingly, the company has launched its own nutraceutical brand, Welfa, which they are saying is going to be a growth driver, and they continue to explore inorganic growth as well. So as you can see, Advanced Enzymes up around 12%. We take a short break, but get you a lot more on the markets and stock-specific action on the other side.
Welcome back to Halftime Report on CNBC TV 18. As of now, Nifty 23,950, around the level where we started the show, right? Not much of a move, but slight bit of a recovery from when we started it, and obviously from the day's lowest point we are seeing a bit of an up move, but let's watch out for whether we see a further up move, whether this momentum continues. Broader end of the market, that also is similar, seeing a bit of a recovery from that day's lowest point, and we're seeing names like AkzoNobel. Look at that, that's seen a bit of an up move in the last 1 hour specifically. We've seen Infosystems, that's also seen a spike up, so that is all that has seen an up move in the broader end of the market. JSW Infra, LIC Housing, all these are the names that are moving around in the trading session. But as of now, we'll keep an eye out on the Nifty, where that's going to be headed in the second half of the trading session. But with that, it's a wrap on this edition of Halftime Report. Thank you so much for tuning in. Up next to Business Lunch.
Stocks have slipped as West Asia concerns ripple through in the Prime Minister's call for reining in the use of imported items, even as Donald Trump rejects Iran's peace plan. Consumer discretionary and realty are the big drags, even as healthcare manages to eke out some gains. Prime Minister Narendra Modi has appealed to citizens to cut use of fuel, defer travel and limit purchases of items like edible oils to rein in the current account deficit. This comes even as there is little headway in reopening the Strait of Hormuz. Jewelry stocks have taken a beating after Prime Minister Modi calls on citizens to put off all gold buying for a year. This follows recent reports on banks seeing delays in permissions to import the yellow metal. Tata Consumer delivers a fourth quarter volume growth far ahead of expectations and guides for double-digit growth in sales and EBITDA in FY27. The beverages and foods major eyes a 30% jump in the growth business. The report cheers investors. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia. And of course, the big story of the morning that we are tracking is that these tensions escalating in West Asia and fears over growing disruptions in global oil supplies. Prime Minister Narendra Modi has issued a national advisory. Now, addressing a public gathering in Hyderabad, Prime Minister Modi framed the appeal as an economic and national responsibility. Now, he also urged citizens to use petrol and diesel sparingly, travel by metro, opt for carpooling and adopt electric vehicles wherever possible. Now, the Prime Minister also stressed on reducing gold purchases, saying that gold imports consume a large amount of foreign exchange, and also suggested avoiding non-essential foreign travel, overseas vacations and destination weddings abroad while promoting domestic tourism. Now, he urged farmers to reduce the use of chemical fertilizers by 50% and adopt solar-powered irrigation pumps instead of diesel-run systems. And he also stressed on the importance of reducing edible oil consumption, linking it to both national economic interests and public health. Listen into what he had to say.
साथियों, हमें पेट्रोल डीजल का उपयोग कम करना होगा। शहरों में जहां मेट्रो है, वहां हम तय करें कि हम मेट्रो का ही उपयोग करेंगे। ज्यादा से ज्यादा मेट्रो में ही जाएंगे। अगर कार में ही जाना जरूरी है, तो फिर कार पूल करने का प्रयास करें और भी लोगों को साथ बिठा ले। अगर हमें कहीं सामान भेजना हो तो कोशिश करनी है कि वह ज्यादा से ज्यादा रेलवे गुड्स के जो ट्रेन होती है, रेलवे की सर्विसेज से भेजे। एक जमाना था जब संकट आता था, कोई युद्ध होता था, तो लोग देश हित में सोना दान दे देते थे। आज दान की जरूरत नहीं है, लेकिन देश हित में हमको ये तय करना पड़ेगा कि साल भर तक घर में कोई भी फंक्शन हो, कोई भी कार्यक्रम हो, हम सोने के गहने नहीं खरीदेंगे, सोना नहीं खरीदेंगे। विदेशी मुद्रा बचाने के लिए हमारी देशभक्ति हमें चुनौती दे रही है और हमें इस चुनौती को स्वीकार करते हुए विदेशी मुद्रा को बचाना होगा।
You just heard the Prime Minister there speaking on a whole host of subjects, and the impact has been felt on the markets, particularly the jewelry stocks. All of them have taken a very, very sharp knock in today's trading session. Take a look at Titan, that's down 6.5%. Kalyan Jewelers is down 9%. Senko is down 9%. PN Gargil is down 7.75% as well. So losses ranging anywhere between 6.5% to 10% for all of these jewelry names. And the foreign travel or the travel and tourism stocks have not been spared either. Now, Indigo is down close to 5%. TBO Tech is down 4%. Ixigo or Let Revenues Tech is also down around 2.5%. 2.5%, and Yatra Online, all of these travel portals seeing losses of anywhere between 2.5% to 5%. But of course, the positive impact is being felt on stocks where he also recommended or encouraged use of electric vehicles, and all of these electric vehicle linked names, be it Ather Energy, the stock has already doubled over the last 12 months, actually more than tripled over the last 12 months. That is extending its gains now, up 7%. Ola Electric and JBM Auto are recent underperformers, but Ola Electric is up 3%, JBM Auto is up 4%, and Electra Green Tech too has seen gains of anywhere between 3 to 4%. But of course, the fuel conservation measures has also had an impact on the oil marketing companies, HP, BP, IOC, all of them trading with losses of around 2 to 2.5%. But that is also having more to do so with the fact that oil prices are rising in the global markets. And the other aviation names or airport linked names, be it SpiceJet, of course, not the most frequently traded or the spoken about stock, but GMR Airports too is trading with losses of close to 3% now. Sub 100 is GMR Airport. So that's the situation of all the stocks that the Prime Minister spoke about and the impact of them. The market, though, seeing some bit of recovery over the last few minutes, but that recovery is as of now getting sold into. The index now at 23,918 was trying to see some recovery towards that 23,950 mark, but that has now gotten sold into, and now again the bulls are fighting to defend that 23,900 mark on the downside. 23,854 is the low of the day. So the bulls would hope that at least even if we end lower for the day, we manage to end above that 23,800 mark, which has been this lower end of the range of 23,800 to 24,300 that the Nifty has found itself in for a better part of the last 7 to 10 trading sessions. So that's the situation of the market as of now. But continuing with the big story, Union Minister Ashwini Vaishnav has backed the Prime Minister's call to the nation, urging businesses to take cognizance of his message, and also urged citizens to cut down on expenditures involving forex spends. Listen in.
It's very important that we as citizens also play our role in this entire effort. We as citizens, as our Prime Minister has asked all of us to, can reduce our expenditure on everything that requires foreign exchange to be spent. So I'll request all of you to take cognizance of Honorable Prime Minister's call to the nation, and within your own means, within your own enterprises, within your own businesses, try to do whatever best you can.
Meanwhile, Sunil Bharti Mittal, the founder and chairman of Bharti Enterprises, Hero Enterprises Sunil Kant Munjal, and Apollo Hospitals' Shobhana Kamineni also backed the Prime Minister's call to the nation. Listen in.
I think we in the industry need to play our role. We need to play our part. We have employment of millions of people. We can take his message forward in a very deep and meaningful way. We need to get away from this obsession of import of gold. We need to lower our energy costs. We need to move more faster towards renewable energy in our industry. And importantly, we need to vote with our feet within our country. Spend more here, put more Capex here. We need to invest more. This is not the moment to shy away. This is the moment to invest, double down in our own country, because the underlying growth is there. This is a continent of consumers. Large, young population wanting more products and more services. And let's give them more from India, make in India, from India, serving India.
Considering that we are one of the largest importers of energy in the world, it's only sensible that we start to conserve energy and start to see how we can be more efficient. I think there are two aspects to it. One is, whether Reserve Bank intervenes constantly or not. But the fact is, there has been inflation, there has been an impact on currency. Unfortunately, the Indian currency has suffered more than many others because of our peculiar situation. To my mind, I think it's more a natural drift would be a better approach, which is what also the Reserve Bank appears at this moment to be taking. But I guess they know this situation better than most of us.
I think austerity is really the call of the hour because we have to protect. It's not about our own country growing because we have wonderful growth ahead of us and a great future. But it's the external dark clouds that create this situation. People must travel and we must help the economy keep moving. I think it's better not to do it just for, if you can just be there for a national cause and maybe reduce one trip a day. I don't think that it's this doomsday call, and we should not take that as a nation, that this is, that what we have to do is we have to work together.
Numbers from Canara Bank flashing at the bottom of your screens. The net interest income's up 4% from last year. The net profit, though, is down on a year-on-year basis. That is also because of the fact that there has been a substantial decline in the other income from 6351 crore to 4824 this time around. Asset quality has improved, though, compared to the previous quarter. So that is a positive. Of course, the net NPA numbers are relatively flat, but the gross NPA numbers from 2.08 have come down to 1.84 this time around. The provisions number for the quarter has also seen a decline. That is also from 2414 crores to 991 this time around. So despite the fall in provisions, the net profit is down on a year-on-year basis, but that is also attributable to the fall in the other income component for Canara Bank. It'll be interesting to see what kind of slippages number the lender puts out. That is, of course, following up with the results that SBI reported on Friday, and after which the stock took a beating, is still taking a beating today as well. But for now, Canara Bank prima facie numbers look okayish. The stock, though, is off the highs of the day, unsurprisingly so, because there has been a fall in the net profit from last year due to lower other income. Asset quality is largely stable. Provisions are down on a sequential basis, and the net interest income has gone up by 4% from last year. We'll get you more details once the slippages number and, of course, the guidance for FY27 comes in. But let's now go across to Ritu to understand what the Prime Minister's message could mean for the Indian macros. Ritu.
Well, the big question now being asked in policy circles is whether the Prime Minister's appeal is a precursor to more formal economic measures being announced. Now, if you look at just these four items that the Prime Minister brought up, petrol, gold, edible oil, chemical fertilizers, they cost India a combined $241 billion in imports just last year. Petrol and diesel, $135 billion, gold, $72 billion, and every dollar that is spent importing these widens our trade deficit and it puts pressure on the rupee, and that pressure is very real right now. Our current account deficit is projected to widen to more than $54 billion. The rupee is already down 10% in the last year. Forex reserves, while still healthy at $691 billion, which is roughly 11 months of import cover, have already slipped $38 billion from the February peak, with RBI drawing down reserves to defend the rupee. Now, we've been in this situation before. In 2013, for instance, during the taper tantrum, the rupee fell 14 rupees against the dollar in just over 100 days, and the current account deficit hit its worst ever 4.8% of GDP. And in response, gold import duties were hiked, the overseas remittance limit was cut, and RBI launched a special NRI deposit scheme, which pulled in billions of dollars in a matter of a few weeks. Now, that 2013 playbook is back on the table, so we looked at a few potential measures that can be considered. First is gold. Indians, as we know, are sitting on 25,000 tons of idle gold in homes and in lockers. If we simplify the rules around depositing that for meaningful purpose with banks, we will have to import less of it. That will cut down our import bill. Second, limiting the LRS, how much money Indians can send abroad. The current limit is $250,000 per year. Temporarily tightening that, especially for foreign holidays, which is a big category of outflows, will keep more dollars inside India. Third, a special NRI deposit scheme, and this is already being talked about, which is asking the Indian diaspora to park their foreign currency savings with Indian banks at attractive rates. We've done this before. In 2013, for instance, the scheme pulled in $34 billion. So that is something that could be on the table. And fourth, importantly, fix the tax treatment for foreign investors that are buying Indian government bonds. Now, a concessional 5% tax rate was there. It expired in 2023, and now it's back to 20%. So if we bring back a stable, lower rate, which could make India more attractive to long-term global capital, that could help. So the key thing to watch now is whether this stays a public appeal from the Prime Minister or whether some of these ideas begin to find their way into policy in the weeks and months ahead.
Ritu, thank you for that update there. Let's also now listen to what SBI's Chief Economic Advisor Soumyakanti Ghosh had to say on this LRS outflow.
If you remember the 2013 taper tantrum crisis, there were several steps. There was a bouquet of steps apart from the short-term interest rate hike of 300 basis points. Then there was the FCNRB deposit window. Then there was also restrictions on the LRMS, basically that capital account transaction, which the Honorable Prime Minister has been talking about. So I think there were some restrictions. All of this came through. And after that, I think rupee staged a smart recovery. So whatever steps the government or the central bank will take, I think that will be in unison. And we don't rule out some of the steps which were similar to what happened during the 2013 crisis. The overall capital account outflows in the LRMS regime last year could be well in excess of $20 billion, out of which 75% actually is because of the factors like equities, immovable properties, travel, and other things.
We also spoke to Senko Gold, one of the stock that has taken a beating in today's session. The MD and CEO Suvankar Sen, who believes that there is a possibility of a gold import duty hike given the Prime Minister's comments. Listening.
Based on our Prime Minister's thought process, if there has to be certain policies that has to be done in order to discourage, import of gold, duty hikes could be a possibility. But till it is being done, these will only be, speculation whether it will happen or not. Out of the import of 700 to 800 tons, about 20-25% of the gold gets used up for exports, and the remaining 75% is used up in either domestic consumption for jewelry or for investment. So it will maybe create a dent of about 10 to 12% reduction in terms of the volumes that gets imported.
Let's take a short break here on Business Lunch. More news and updates on the other side. Stay tuned. Welcome back. Now, US President Donald Trump has rejected Tehran's response to the American peace proposal as totally unacceptable. Now, this even as Iranian drones continue targeting Gulf neighbors, as Israeli PM Benjamin Netanyahu warns that the conflict is not over. CNBC's Dan Murphy has the latest on this. Dan.
President Trump rejected Iran's response to the US peace proposal as totally unacceptable. According to Iranian state media, Tehran had submitted its response to Pakistan on Sunday. President Trump did not provide further details, but according to Iran's Tasnim news agency, Tehran had called for the immediate end to all hostilities and a guarantee of no further aggression. It also called for sanctions to be lifted and for an end to the war on all fronts, alluding to Israel's military reactions in Lebanon. The Israeli Prime Minister Benjamin Netanyahu, in an interview on CBS's 60 Minutes, said the Iran war is not over until Iran's stockpile of enriched uranium is taken out. Meanwhile, Iran continued drone attacks on its Gulf neighbours over the weekend. The UAE intercepted 2 Iranian drones, while Kuwait said its air defences encountered hostile drones that entered its airspace. Also at the weekend, Qatar saying a cargo vessel travelling from Abu Dhabi was hit by a drone attack in Qatari waters on Sunday. Qatar's defence ministry saying it caused a fire, but there were no reported injuries, and the vessel was able to continue on its journey. The ministry did not specify where the attack originated from and has now advised vessels to transit with caution.
Dan Murphy, thank you for those updates there. Now, the stage is set for a landmark US-China summit. President Trump is set to commence a much-awaited 2-day state visit to Beijing on the 13th of May, with Treasury Secretary Scott Bessent already in Asia, laying the groundwork on trade ahead of his departure. Also in tow will be the representatives of the American corporate giants. CNBC's Emily Tan has more on this.
This morning, just a couple hours ago, we did hear from Xinhua making the announcement for the Chinese side that U.S. President Donald Trump will be making a state visit from May the 13th to the 15th, and that coming through from Xinhua, that is the state-run news agency. Now, ahead of this state visit, we are hearing now that Treasury Secretary Scott Bessent will be traveling to North Asia. He's going to be first making a stop in Japan today, where he will meet Japanese Prime Minister Sanai Takaichi and the finance minister. He will then head to Seoul on Wednesday, where he will be meeting with Chinese Vice Premier He Lifeng. Now, we've seen this before. This is a pattern. In the run-up to the summit between the two leaders, Trump and Xi, this happened in Busan last year. We had Bessent and He meeting in Kuala Lumpur to talk about trade. It's guided by an important consensus reached by the two heads of state in Busan and previous phone calls. They're going to be addressing economic and trade issues of mutual concern. So that will bring us to Thursday and Friday, when President Trump is going to be in Beijing. In fact, he's going to be there late night on Wednesday, Air Force One pulling into Beijing. Now, in terms of the itinerary, this is what we know so far, that he's going to be arriving, of course, Wednesday evening, and then on the 14th, a welcome ceremony and a bilateral meeting with President Xi Jinping, which is expected to take the whole day. He's going to be visiting with the Temple of Heaven, and there's going to be a state banquet with the CEOs that are going to be accompanying President Trump on this trip. We do now know some names. We're expecting Boeing to be there and a big Boeing deal. Citi's Jane Fraser has confirmed to CNBC in an interview that she will be there as well. I've also learned that Visa CEO is going to be there applying for a payment license in China. We also know that expect Apple and Nvidia to be there as well. So this is a big week, and we're going to be looking ahead to Thursday and Friday when the Trump summit is going to be taking place in Beijing. So we're going to be talking about this all week. That is what we know so far.
A couple of results that came in just a few minutes ago. Numbers from Canara Bank. There you can see slippages have increased on a sequential basis to 2,800 crore from 1,900 crore, and that has had an impact on the stock, which has now slipped to the lows of the day from a surge of around 3.5%. The stock is now down 2% as we speak. So for Canara Bank, slippages have increased on a sequential basis, and numbers from UPL were also flashing at the bottom of your screens just a few minutes earlier, and that stock too is seeing a bit of a reaction now, 1.75% higher from UPL. Of course, we'll get more details on the company's guidance and so on, but the margins for UPL have been, well, slightly short of expectations at 19.9%. The CNBC TV 18 poll was pegging the figure at 20.9. The profits, of course, 1,061 crore. The revenues, though, are ahead of expectations. The operating performance is something that will be important. The revenues are ahead of expectations. The EBITDA number is also ahead of expectations. And the margins may have expanded on a year-on-year basis, but they fall marginally short of what the CNBC TV 18 poll had projected for UPL. The stock, though, for now continues to do well, and all eyes will be on whether the company has any bullish guidance to issue for FY27, and that will be something that the stock will be at the street will be watching out for as well. Take a short break. Back with more on the other side. Looking back, 23,950 is where the index currently stands. So yet again, there is some recovery from a lower level. So it's a 50-point recovery from where we started off the show at, when the index had slumped to levels of 23,900. And now we are seeing some recovery there from lower levels. The numbers have just come in from Canara Bank, from UPL, and from Sham Metallics as well. So numbers, of course, over 200 companies will be reporting results this time around. Canara Bank has now moved into the red. So it's an almost 5% decline from the highs of the day. UPL, though, has now moved to the day's high, 3% higher on UPL. The street continues to await more commentary on the guidance. Of course, another result reaction. Meanwhile, Sham Metallics too has slumped to the day's low, 1.5% lower now on Sham Metallics. And the other result reaction was Affle 3i. Now, that stock earlier known as Affle India, that stock is the top gainer on the Nifty 500 today, 11.5% higher on the stock, and that is the top performer in today's trading session. So positive earnings reaction in an otherwise weak market. With that, we take your leave on this edition of Business Lunch from me and the team. Thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Vivek Iyer. A lot of earnings coming in. It's been a busy day, but of course, a busy day otherwise for the markets as well. Digesting the comments coming in from Prime Minister Modi on energy conservation, restricting gold imports and international travel as well. A lot of it that is impacting the markets. For now, 230 points lower on the Nifty, and the Bank Nifty taking a similar cut of around 500 points. Hey, Vivek.
Good afternoon, Sonal. Absolutely right. Like you mentioned, a lot of sectors, that are directly impacted by the PM's comments are seeing quite a bit of selling pressure. But otherwise, there's been a bit of a recovery, especially in the FMCG pack, select earnings, which have been good. So that's something that supported the market. But a lot lined up on the show, so let's start off the top headlines. Market continues to trade lower, but is significantly off the day's low. The Nifty is seeing cuts of nearly 1%, trading around 23,950 mark. Auto, realty and oil and gas lose ground, while IT and pharma see positive trade.
As India continues to grapple with the macro fallout of the West Asia war, PM Modi pushes for spending restraints, urging Indians to postpone gold purchases for a year. Management of Senko Gold flags a 10 to 12% reduction in volumes in the case of probable import duty hikes. Jewelry stocks crash in trade.
Strong Q1 results and shares of Rain Industries rallying high. The earnings are at a multi-quarter high. The company logs over 80% growth in EBITDA. Debt too narrows sequentially.
Cautious FY27 guidance leads shares of Lupin to bleed. Company eyes revenue growth in high single digits and margins at 25% versus 32% in the year gone by. Nuvama downgrades stock to hold from a buy, citing limited upside potential from the current levels.
Shares of Jyoti Labs plummets following the company's disclosure that Henkel will not be renewing licensing agreements for Prill as well as Far brands beyond this month.
All right, these are the top headlines that we are tracking. Markets continue to be the big story. There is a wee bit of recovery from the lows, courtesy some of these FMCG names. Pharma continues to do well. But a lot of stock-specific moves that we are seeing. Of course, we'll discuss that in greater detail. For now, at the 23,950 mark for the Nifty, we do have UPL's Q1 FY27 guidance. Okay, so they've given a Q1 guidance instead of an FY27 guidance. Revenue growth at 10 to 14% and EBITDA guidance at 14 to 18%. The stock has surged to the day's high. Maybe not for the entire year, considering that there's been a lot of uncertainty, and that's one of the reasons why we are not seeing a full year guidance coming in from UPL. But Q1, the outlook at least is positive. There's a debt reduction that has come by as well, and that's why the stock is surging at the day's high. But let's now talk about other stocks in focus. This is our special segment, Mid-Cap Movers. Upasana is joining us to take us through the mid-caps that are moving around in trade. Upasana.
Well, certainly the mid-cap index continues to remain under pressure. Now, first up, let us look at some of the volume buzzers in today's trading session. Quick Heal volume is at 8 times the weekly average, up nearly about 5%. Next up is Sterlite Technologies, up nearly about 5%. Birla Corp also trading on high volumes, up nearly about 8 times the weekly average, and the stock is up nearly about 8% in today's trading session, followed by Ather Energy, which is also seeing an uptick of nearly about 7.5%. And lastly, JBM Auto also trading on high volumes, such as 10 times the weekly average, and the stock is up nearly about 4%. Now, let us look at some of the key stocks that are in focus on in terms of mid and small cap earnings. Who are the key volume buzzers here? Grindwell Nortel, overall strong results reported by the company. The stock is up 8%. Saskin Technologies, 20% up move is what we are seeing on the back of stellar Q4. Mind you, the company's revenue has doubled on YoY basis. Advanced Enzyme Technologies also has reported a good set of numbers, up nearly about 12% there. And Rain Industries has reported a multi-quarter strong results this time around, and we can clearly see the stock surging as high as 15% in today's trading session. Now, on the flip side, let us look at some of the key top losers. Now, jewelry stocks have taken a hit as PM has urged the citizens to defer gold purchase by a year to save Forex. So, for the likes of Kalyan Jewelers, Senko Gold, all these companies have taken a hit of nearly about 5 to 10%. Tejas Networks also in focus, down nearly about 6%. Whirlpool, Aeroflex Industries and Jyoti Labs, all these counters seeing a hit of nearly about 5 to 10%. So all in all, these are the stocks that are trading and on our radar today.
Well, thank you so much, Upasana, for joining us, giving us a sense of all of the top movers as far as the mid-cap end of the market is concerned. But moving on, DB Corp gains in trade after reporting a good set of Q4 numbers. Margin expansion has driven PAT growth. To discuss this and more, we have Girish Agarwal, promoter and director of DB Corp. Mr. Agarwal, thank you so much for joining us once again. Well, it's been a healthy quarter despite fears of it being a slightly muted quarter, especially in terms of margins. Give us a sense, number one, of how sustainable is the margin expansion, especially given the steep price increase as far as raw material and print prices are concerned.
See, this quarter we have grown by almost 6% on the advertising revenue. And in the month of April, as we speak, which we have closed, we have seen a strong double-digit growth. So I'm very confident that if this war situation, which looks like that getting over soon, if that happens, then I think the advertising revenue are looking strong. Newsprint is certainly a concern, but if the war situation gets over, then newsprint will also get eased out.
Okay, so what are the current prices? How much have they risen, say, versus February to March? And what is the situation in April so far? Ad revenue growth has been 5% for quarter gone by, but it has been flat if you look at the yearly number. What are you guiding for in FY27 now that we don't have many state elections coming by? And of course, corporate India is in a very confusing situation with the West Asia war.
See, if you look at the last year, overall, we have closed flat. But if we remove the Lok Sabha election impact, then we are at a growth of around 6%. So this year, we believe that if things, whatever we believe that should get resolved faster, we are hopeful that we should be able to grow by almost strong single digit. At the same time, that's on the top line. But at the same time, on the newsprint prices, in this quarter, we are going to see around 6 to 7% growth in terms of newsprint prices. And we are hopeful that by the second quarter and third quarter, the situation normalize, and then we should be back to normal.
Okay, just a follow-up here, Mr. Agrawal. The last time when we had spoken to you, you had indicated that the revenue growth will be high single digits. Was it also considering the Lok Sabha elections and impact of that? Because now it's been flat. Or that 6% considers the high single digit growth that you had spoken about?
Yes, considering that. But we were expecting that including the Lok Sabha thing, we should have gone by at least 5-6%. But I think post-Diwali, the whole market slightly went down in terms of real estate advertisers and even the education and all that. So, and even the March month wasn't really that good. So we are hopeful, but this year, the way April month started, we are very positive on the full year going forward.
Okay, Mr. Agarwal, you said you're positive going into FY27. You have given us a guidance of high single-digit top-line growth. Now, give us a sense of the ad environment right now. You said that there has been some moderation as far as spends are concerned. Can you quantify what is it that you're anticipating, and a little bit on which segments you're seeing ads from? You said realty is under a bit of pressure.
See, we are expecting the education should grow. We are expecting real estate should grow. Automobile should grow. And what we have seen in the month of April. Now, jewelry, what has happened yesterday with the statement of Prime Minister, would see a muted quarter. But going forward, things should further improve there also. So except the government advertising spend, I think most of the other categories should be doing very good. Like April was pretty good.
Okay, April was pretty good. The government side is not doing so well. So you are, the conversations that we've been having with companies, and it's uncertain. So we can't really ask for a lot of guidance in terms of what would happen next, considering nobody knows what happens next. Despite that, you're confident of more private revenues coming in from the ad side?
Yeah, absolutely. Because see, you have to understand the fundamentals of our country are under control. Now, we are facing problem because of the Forex and all the war issues. And I'm hoping that all the reasonable people will get it resolved faster.
Okay. Mr. Agarwal, let's come to the radio part of the business especially. This is one space where there has been significant growth in terms of number of stations you've added, but both on the EBIT as well as on the bottom line, there's been a bit of a loss. Is this because of accelerated investments? When can we expect a break even here?
So out of the 14 stations which we acquired, we have already launched around 7. And 7 are in the pipeline in next 2 months' time. And we have done a very strong cost control in these new radio stations. And we are hopeful that they should do the operational EBITDA break even within this year itself.
Okay, within this year itself. What happens on the bottom line then from next year? Does that become positive as well? What are your plans with the radio business from here on? What's the current growth that you're seeing? Do you think it would increase considering the situation that we are in, or generally the entertainment, or I would say, the media space that we are in currently? How big is radio going to be for you?
See, frankly speaking, radio is actually like an entertainment space because it's not media. There's no news on radio, which we've been talking to the government for the last many years. So radio, we should consider entertainment space only. And since the entertainment space is growing, we hope radio should also grow.
What is your indication? How big of that an opportunity would be for you?
Strong single digit. I won't really go double digit on radio because there's no big indication for radio to grow double digit.
Okay, now coming to the digital part of the business, MAUs have grown significantly, so you've seen a lot of traction over there. Going forward, can you quantify numbers for us in terms of how exactly you're able to break even there? What kind of top-line contribution can this particular segment give you?
In digital, our focus is on acquiring more customers. As you know, we are not focusing on subscription over there. Advertising revenue is doing it, but I'm really not very gung-ho about the advertising on the digital platform because we don't really overburden our readers with the advertisements on our app. So what we are focusing is on the consumer acquisition, giving better experience to the consumer and giving best of the possible news. Like as on a daily basis, on a monthly basis, we upload almost 50,000 news on a daily basis on our digital platform and almost 1,000 plus videos. And that's the biggest offering anybody under the sun can offer. So we are improving that, increasing that furthermore to go more deep down in all the 14 states where we are present.
Mr. Agarwal, a quick last question, just to quickly summarize what we've been asking you. Top line growth, you said high single digit. Can you give us a number for the corresponding EBITDA margin, PAT, as well as ad revenue growth you're targeting for FY27?
See, last year our EBITDA margin was 28% without even considering the election impact. If I take the election impact out, I was at 31% EBITDA margin. And I hope this year going forward, we should continue this, but for the newsprint prices. So if I adjust the newsprint prices furthermore on that, anything in the range of 26% plus should be the number.
Okay, and what about the ad revenue growth?
High single digit.
High single digit. Okay, sorry, my bad. All right, Mr. Agrawal, thank you so much for joining in today. Always a pleasure speaking with you. That's the word coming in from DB Corp, talking about how March, of course, saw some impact. We did see that in April, but April had started on a good footing, and they expect newspaper print prices to come off from the current levels as well. The stock, though, was up around 5% at a point in time, has come off from those levels. So we'll slip into a short break and get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back. You're still tuned into Midcap Radar, where it's the Pharma, IT and FMCG pack, which has led to some recovery. Of course, the Pharma pack has been doing well since the word go. A lot of these stocks are on our radar. But life insurance, that is one sector where the data for the month of April is out. It looks like Axis Max Life has outperformed the peers. Let's talk about more of these numbers and get to Yash. Yash, tell us more.
Well, if you look at all the life insurance stocks today, all of them have put a smart recovery as far as the trading session is concerned, and that's on the back of the April numbers which the company reported. As you rightly pointed out, Axis Max Life Insurance seems to be the strongest, largely because it's grown at a stronger rate. On a base which was already very strong, on a base which was already high. Hence, it is an outperformer as far as the industry is concerned. I'll speak about specific numbers. As far as HDFC Life is concerned, the company has grown its new business premium at 30% on a year-on-year basis. Annualized premium equivalent growing at 24%. Retail AP growing at 25%. Axis Max Life Insurance, new business premium growing at 18%. AP growing at 15%. Retail AP growing at 21%. ICICI Prudent Prudential Life Insurance, new business premium, that is growing at 26%, APE at 36%, retail APE growth at 25%. SBI Life, the new business premium has seen a very strong growth of about 80%. That's largely because of the renewal premium growth. APE is growing at 10%, retail APE is growing at 120%. Canada HSBC Life, new business premium seeing a growth of 23%, APE at 10%, and retail APE also seeing a growth of about 10%. Finally, LIC, the new business premium for the company in the month of April has grown at 38%, APE at 31%, and retail APE growing by 19%. The reason why I say Axis Max Life Insurance has seen a strong growth is because it's growing at a base of already 25% growth, growing another 21% on that, making it an outperformer as far as the entire industry is concerned. But overall, a good month for the entire life insurance sector.
Well, thank you so much, Yash, for joining us, giving us a sense of all of the key insurance data in the month gone by. Well, one stock that's taken it on the chin today is from the capital goods space, and that's ABB India. Sharp margin contraction is something that the street hasn't liked. Let's go across to Winnie for a fine print of these results.
Hi, afternoon. So for ABB India, obviously the numbers aren't that great as one was expecting it to be, right? Below what the street was expecting, below our CNBC TV 18 poll. Now, revenue just saw growth of around 5.7%. Automation segment specifically in that saw a decline of 14%. Motion segment saw only a 5 to 6% growth. Electrification, that saw better growth of 15%. But automation segment mainly saw that impact that came in because of impacted by weak and slower execution. So that's a concern that came in here. Now, overall, EBITDA margins, that, like you mentioned, has seen a contraction coming in of around more than 500 basis points. What impacted the EBITDA margins of the company? When you talk about that, it is mainly raw material inflation, revenue, rupee depreciation, revenue mix change, as well as pricing pressures. These are the factors that impacted the margin of the company. Order inflow was stable. The company highlighted in the con call that they saw good orders coming in on the data center front, railways, renewables, utilities, infrastructure segment that did well. Now, apart from that, do not forget the company has completed that sale of its robotics side of the business as well. So that will no longer be a segment coming in the company. The company in the con call has given a PAT margin guidance of around 12 to 15%. They expect it to remain in this range. They said that they've taken price hikes already in the past, but they expect furthermore price hikes going forward as well. 12% of their order book currently comes in from the data center business, but there are large projects which are seeing some bit of a delay in terms of the expectations that come in over there, and decision cycle as well. And brokerages have downgraded the stock. So we have seen Prabhudas Lilladher, Nuvama, as well as Motilal Oswal, which have downgraded ABB India.
Well, thank you so much, Vinny, for joining us. We have a whole slew of EPS downgrades coming in as far as ABB is concerned. But one name from the sports space that I'm seeing is actually JSW Infra. Now, remember JSW Infra amidst the mid of Q4, and while the West Asia war was going on, had given an update to the exchanges saying that their Fujairah terminal in West Asia was impacted, and that had led the street to believe that Q4 could be quite weak. But despite that, the management and the company has managed to go ahead and meet its EBITDA guidance that it had given at the start of the year. Now, looking at the numbers themselves, revenue is higher by almost 18.9%. When you're looking at the EBITDA, up 20%, profitability margins expanding 50 basis points, and profitability hit by the one-off impact of 68 crore actually fell 18%. Now, in terms of the cargo volume guidance, against an expectations of a decline due to the hit, it actually went up almost 1% on a year-on-year basis. And granular details on FY27 guidance has been given. The management has guided for a 6850 crore worth of revenue in FY27, with EBITDA expected to come in at 3,000 crore. One thing to watch out for in JSW Infra would be the fact that the promoter stake would need to come down, and whether there is a QIP going forward is something that the street will keep an eye out for. JM Financial has gone ahead and raised their target price. They say key triggers would be the tariff hike at the Mangalore port, ancillary services, strong group cargo performance from the JSW group, and a ramp up in logistics. On the back of that, stocks doing quite well, up almost 4%.
Oh, yes. So that stock is on our radar. 4% higher at the day's high as we speak. PVR Inox's numbers. Net profit has come at 186 crore rupees versus a loss. Of course, it did see a lot of hits in the quarter gone by. The Dhurandhar sequel and a lot more of them, and that's the reason we are seeing a net profit here. Of course, internals in terms of what the footfalls were like, what has been been the revenues there? And of course, now food has become a big business for them. So what kind of revenue growth have they seen there? And yeah, so we'll watch out for their commentary, what happens in the quarters to come. And did you watch Devil Wears Prada? Because that falls in this quarter.
Not yet.
Parenting taking over you. Okay. So that's about PVR. Of course, we'll get in more details. But for now, we'll slip into a short break. Yes, the revenues are up 26% to come at 1,547 crore rupees. That's a good number. The EBITDA is up 56% for the quarter gone by at 452 crore rupees. And it's a profit this time, as we indicated earlier, versus a loss in the same time last year. So that is PVR Inox for you for now. The stock absolutely flat with some negative bias, but it has come off from the highs of the day. So watching out for the internals, that will give a sense of what the operational metrics have to say. So yes, the stock has come up from the highs as we speak. We'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back. You're still tuned into Midcap Radar. A lot of stocks which are on our radar. Watch out for the Bank Nifty as well as an index. That should come up for you on the screen. There is a wee bit of recovery that you should keep on your radar. And it's down 388 points. When we started the show, Nifty Bank was down 500 points. So there's definitely a recovery which is underway. Vodafone Idea is one of the stocks that I'm tracking. 9% higher on that one. A big surge. And the stock has been doing well since last couple of trading sessions. But a lot of stocks which are reacting to their earnings, management commentary, brokerage commentary as well. Lupin is one of them on the back of a cautious guidance. Ekta, tell us more.
Well, yes, Lupin is in focus because of caution coming in from the management post the call. So, for example, they've said that the FY27 revenue growth is expected to be in high single digits. US revenue in FY27 is likely to post high single digit or low double digit erosion. They remain on track to deliver revenue of $1 billion, which is expected to be or maybe marginally higher. So that is in terms of similar levels in terms of what they reported this time. Remember that FY26 was very good year for Lupin in terms of numbers. So that is expected to come off because of competition in key drugs. So EBITDA margins are guiding 25%. FY26, remember, was 32%. Margins have factored in competition for key drugs such as Mirabegron as well as Tolvaptan. R&D expenditure increase as well as impact from the West Asia war. Nuvama has written on it. They've downgraded Lupin to hold from buy after the recent rally. They say that there is limited upside left. The target price is 2,600 now. And they're raising, however, their FY 27-28 estimated EPS by 3% and 1% each. Competition in Spiriva generic over the next 12 months would be a surprise for them.
Well, thank you so much, Ekta, for joining us. Well, PVR, after a very sharp fall, has once again recovered and now back to the flat line. In fact, up almost 1%. But Ekta, after Lupin, the other name that you've been tracking is Advanced Enzyme. It's a strong set of results as far as Q4 is concerned. Take us through the internals.
Well, yes, revenue up 22%, EBITDA margins have come in at 31% and profit at around 45.2 crores. So it's been an improvement on all parameters, top-down improvement for Advanced Enzymes. Human nutrition up 24% year-on-year. Animal nutrition up around 19%. Bioprocessing, which is a small segment, is up 17%. Specialized manufacturing up 17%. Domestic sales, which is around majority of their business, was up 51% year-on-year. And international sales came in at 97 crores. The company has launched its own nutraceutical brand called Belfa, and they have indicated that they continue to explore inorganic options.
Okay, 11% higher on that stock. Thank you, Ekta, for bringing us all those details. So those are some pharma stocks on our radar. With that, it's a wrap on this edition of Midcap Radar. Stay tuned. When we return, we'll have your stocks on the other side.
Beyond market headlines to understand the reasons for the day's movers and shakers and get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
The Hang Seng is down 0.5%, yes, but the Taiwanese index is up 0.6%.
हम सोने के गहने नहीं खरीदेंगे, सोना नहीं खरीदेंगे.
This is essentially the large import item numbers. Oil imports were $135 billion in FY26.
We don't rule out some of the steps which were similar to what happened during the 2013 crisis.
Import of gold, duty hikes could be a possibility.
The Nifty is going to start down by how much? 23,900.
The mix of earnings and valuations is still not in India's favor.
The growth in interest income has been higher than the interest expenses.
All our segments have done well.
The consumer come back into discretionary. You've seen the pressure across all QSRs.
I think we in the industry need to play a role.
The market's a deep shade of red right now.
So if you bring back a stable lower rate, that could make India more attractive to long-term global capital.
So we have the Nifty, which is down over 240 odd points.
Well, that is the day so far, and it's been, in the red through the course of the day, but it's not looking bad. 200 points lower on the Nifty. We're at about almost 24,000, 23,970. Market breadth is a little negative. 2:1 in favor of declines, 2 advances. This is Closing Bell. We are coming to you a half an hour before scheduled 2:30 start. And we're coming to you from the CNBC TV 18 Moti Oswal studios. I'm Prashant. With me, my colleagues Nigel and Reema. Guys, hi.
Hi, afternoon. A minor recovery from the day's low. We still are struggling below the 24,000 mark on the Nifty, down close to about 200 points, but the day's low was 23,850. So from that level, there's been a recovery of about 100 odd points. Mid-caps is staring at a cut of about 0.5%. The advance decline ratio is negative. We've got one stock advancing for two in the red, but lots of single stock action on very large volumes. Gold companies like Kalyan Jewellers down 9, urban companies, Swiggy, banks like SBI on the way down. Eternal is under pressure. So big moves seen in individual names.
Well, that's right. A couple of stocks actually that are reacting to news in the last 90 minutes or so. I think UPL has moved to the high point of the day, so that one comes up for you on the screen. I think Saskin as well as another stock, I think that came out of the numbers, if I'm not mistaken. So that one as well should come up for you on the screen. So there are individual stocks that are doing a thing of their own. Otherwise, markets under pressure, down but not out, I think is what we could say. Saskin locked up a circuit, 20% up, I think, in reaction to its number. So individual movers, not too bad given the cues that we had this morning. The rupee weakness, that's going to become a bit of a worry with the rupee moving towards the 95.5 odd mark. I think the low of today is around 95.2 and we're holding around those levels. Last 90 minutes, let's see whether the bulls want to fight back.
Absolutely. Let's bring in Mitesh, who's with us with a quick sense of what he's got going. Mitesh, good afternoon. Good to have you with us here. Thanks for joining in. Just a quick word on the trades that you would take and how is it looking?
Good afternoon, Prashant. What on the index? So I think today also we kind of held on to that range of 23,800, 850. The low for the day is around 23,845. So I think let's see. I think the bias is still sideways. But in case we start closing below 23,800, then I think I'll be more worried. So for the time being, a neutral view on the index, but on stock side, ATM is a buy for me. That's a buy with a stop below 1180 for targets of around 1245, 1250 on the upside. And Bharti Airtel is a sell call on the negative side. So would recommend selling here with the stop just around levels of 1800 for targets of 1720.
Okay, thank you very much for that. Bharti Airtel has been one of the big drags today, down 3.5%. One of the largest contributors to the Nifty fall along with Reliance Industries. And the reason is the company in the morning intimated to the exchanges that along with the numbers on the 13th of May, they will also consider reorganization of the shareholding of their subsidiaries. One of their subsidiaries is Airtel Africa. Analysts are speculating that Bharti Airtel will acquire 16% of the stake held by Bharti Enterprises, that's the Sunil Bharti Mittal Group company, in Airtel Africa, which means, and for that is roughly valued at $2.83 billion, which means Bharti Airtel will have to spend that kind. There will be an outgo from Bharti Airtel to that tune, and I think that is causing some concern in the street. Bharti Airtel's stake in Airtel Africa, though, will go up. to 78%. But that's the news coming in on Bharti Airtel. We'll wait by. We'll know more details on 13th along with numbers.
All right. Well, Rima, let me give you a quick check in terms of what's going on in the F&O markets. Then, a couple of indices actually have recovered considerably from the lows of the day. And I think we should get the FMCG index up for you. Tata Consumer came out with a good set of numbers. We're looking at traction on, HUL as well. So that index actually has recovered considerably from the low point of the day. The Nifty IT index as well is showing some signs of life. Remember, the recent low is close to around, 28,000. Out from there, it's seen a bit of a bounce, though it's not out of the woods. But that as well in today's trading session has fought back a little bit. The India VIX, it was showing signs of bursting away. It went till around 19. And from there, it's cooled off a little bit. I like that. I don't want the VIX to run away. In fact, I wanted it to move closer to around the 15-odd mark. But the kind of cues that we had, one would not have been surprised if we went to around 19, 19.5. From the highs of the day, it's cooled off. That's good. The PCR, that's somewhere in the middle, 0.95 odd the last time I checked, the put-call ratio. So that's more or less in the middle of that range of around 0.6 on the downside, around 1.6 on the upside. Options data comes up for you on the screen. The 23,900 put. The premium, remember, is still up. From around 40 bucks, it's at around 68 rupees or thereabouts. So the previous trading session, it was close to around 40 rupees. However, from the highs of the day, it had gone to around 140 rupees, 150 rupees. So just pull up that strike again, the 23,900 put. Premium's holding around 68 rupees, but it's down drastically from the top. There is a mix of activity out here because there is some writing as well that we are seeing, because the key support level is around 20,800, and it seems those writers are betting on this 23,750 to around 20,800 holding out. Remember, the last few trading sessions, we've gone to 23,800 and seen a bit of a bounce from there. On the upside, 24,000 call, though, that's seeing a fair bit of writing. Premium at the start of today or as of Friday was close to around 280 rupees. That's come down to around 95 rupees. However, the day's low was close to around 60, 65 rupees. So at the lows of the day, there appears there was some, out of the money call buying out there. But otherwise, the writers are more active at this particular strike, which is telling you that 20 DMA is going to be a resistance. 24,150 to around 24,200, stiff resistance out there. In terms of stock futures, Vodafone Idea, I recall when we were tracking the rolls from last series to this one, I had highlighted this stock that it appeared there were some positive rolls on this particular one. There was some action that we saw on expiry day as well. It's coming for about a short covering. I think we should get the futures plate up for you. Vodafone Idea. The futures plate, stock is up, open interest lower, and we have been highlighting that the rolls were positive as well. Inox Wind has seen a bit of a rally in the last few trading sessions. That's coming for some unwinding of positions in trade today. And finally, MCX already had a good run. Those numbers look pretty good. And there's a big surge in terms of delivery as well as fresh open interest build up with the stock strong. So that appears there is some fresh buying out there. Not such a bad trading session. The bulls are counting on this 23,800 mark holding out.
Well, the reason why Vodafone Idea is quite excited in trade is there was a Reuters article, which basically, this happened about 2 days back, which basically said that Vodafone PLC could sell 3% of its stake in Vodafone Idea. But the money that it gets from selling that stake will go back into the company, into Vodafone Idea, and that can give the company close to about 3,500 crore. The timing of the transaction is still unclear, but that was the news on Vodafone Idea. I think it came on Friday, and Friday also towards the end. The stock was excited, and today as well, up 9.
How much do they own in Idea?
About 16%, Vodafone PLC.
Okay, all right. Canada Bank reported numbers just a while back. Ritu is here with details on the numbers. Ritu, take it away.
Well, Prashant, as we've been seeing with most other PSU banks, it's the treasury income hit that is showing up in the bottom line. For Canara as well, there was a decline in profits for the quarter and for the year as well. The drag mainly coming in from lower operating profit, lower net interest income, and of course that treasury hit. What supported any further decline in profits was a bit of a actually more than 31% decline in provisions year on year. So PAT decline of almost 10% year on year. The core income, that is the net interest income, grew by almost 4% and about 6% sequentially. What was very good though in the numbers is advances growth of about almost 15.2, 15.3% year on year. And that is the strongest number that we've seen from Canara Bank since I think FY23. What was not as strong was the deposit growth. That was only about 9.7%, which continues to lag. Asset quality ratios improved quite strongly. So the gross NPA fell to about 1.84% from 2.94% from the previous year. Net NPA also improved to 0.43%. Credit costs also improved to 0.59%, and the provision coverage is also pretty healthy. But what did rise is the slippages in this quarter. Remember, SBI so far has been the only large bank that has reported a rise in slippages in the quarter. Pretty much everyone else has shown a decline. For SBI, it was because of rise in the agriculture book NPAs. From Canara Bank, we're yet to hear the management commentary on what has led to that increase of about 2,800 crores in slippages in total for the fourth quarter. Margins improved sequentially, so that was good. Margins have risen to 2.54% from about 2.45% in the previous quarter. What helped the margin was a lower cost of deposits and the lower cost of funds as well. And finally, the bank has also declared a dividend of 4.2 rupees per share.
Thank you very much for that. Dipan Mehta, Director, Elixir Equities, is also joining in on the show. Dipan, PSU banks, what's your overall read, particularly State Bank of India, down for the second day in a row and down badly?
Yeah, Rima, good afternoon and thank you for having me on your show. I've been saying time and again that the entire banking industry has become a red ocean. And we are seeing that in the results this time. I think across the board, large cap banks have found going extremely difficult and they have lost market share. Their growth rates have been in single digit. Pre-provisioning profit also has been pretty stagnant. The only reason some of the banks, including SBI, have been able to improve on the net profit is because of lower provisions, and that cannot last forever. So my view on large cap banks is extremely circumspect, right from SBI, HDFC Bank, Axis Bank, ICICI Bank. We need to be a bit careful over there. A few small cap banks, I think they will do well because of low base effect and overall expansion into new products and geographies. But the better way to play lenders is through multi-product NBFCs. But over there also, I suspect that there'll be increased competition and challenges going forward. So my view on SBI now is quite, I would say, cautious. Certain other PSU banks, I would remain invested because they still have some more potential. But on the whole, we need to get a bit more circumspect on the banking industry.
All right, Dipan, I'm going to throw some, a couple of broader market stocks actually to you if you track any of them. Rain Industries, the stock is up close to around 16%. You've seen this before, when the cycle turns, the company does well, but otherwise very, very volatile. It can correct by 20% as well. We've seen in the past and go up to 20% as well, as we have seen in the recent past. What's your view on this name? CPC and CTP, that's coal tar prices as well as CP coke prices have moved up considerably. They have a cement business out there. The street likes the numbers, but debt is very, very high. The other one is Sasken from the broader markets. That as well is holding, I think it's a 20% upper circuit out there. Any view on either of these names? Smaller, not widely tracked companies, but if you have a view?
I think, markets react immediately to good numbers, and we have seen that in both these companies. Rain Industry, certainly a very good position, but if you hold it long enough, 3-year, 5-year, 10-year, and ride it through the cycles, then because of pure expansion of capacity, higher volumes, you will see that this company is giving good returns going forward. The trick in Rain Industries is that they are going in for new types of material, high value-added material, which kind of go into electric batteries as well. Let us see how that plays out. But nonetheless, they are trying to move up the value stream. And if that works out well for them, then you could end up re-rating of the earnings as well. Sasken, I think, very good set of numbers, out of the blue completely. And the acquisition which they have done, I think, has provided to be extremely good for the company. And look, I think as we are understanding this AI disruption, we are realizing that there will be some winners, and maybe Sasken could be one of the winners because they're not in their products, their services may not get disrupted as much by AI. In fact, they could benefit from AI, considering that they are into embedded software services. So I think one needs to go a bit deeper into business models. But if you look across the board, it's Sasken, Persistent, Coforge, Oracle Financial Services, which appear to be the winners in this software services industry, which is facing so much of disruption.
All right. There's a flash at the bottom of the screen. Government, this is from Bloomberg, which essentially says that no plan to hike duty on gold and silver. This is according to a government official, unnamed official. So I'm assuming this is a source story coming in on Bloomberg at this point in time. There's another flash, which I think we just put out, saying essentially the US trade team perhaps is going to visit India. No dates given, perhaps. Remember, the visit of US Secretary of State Marco Rubio is expected to be later this month. I think the 23rd or the 24th of this month. And before that, could we see some action, etc.? We don't know. That's the one. So US team expected to come next for BTA talks. Dates are yet to be decided. So we'll see. UPL reported numbers as well just a while back, and Ria has got details here. Take it away, Ria.
Well, yes, a good quarter reported this time around for UPL. Revenue and EBITDA growth has been above estimates. The revenue growth of 18% has been driven by strong volumes this time around, supported by favorable Forex, although partially offset by pricing pressure seen in the quarter this time around. The net profit has also gone up by around 18%, although this is lower than estimates of 45% growth for the quarter. If you look at the full year, there's been a beat on all fronts compared to the guidance that the company had given. Revenue has seen a growth of 11% versus the guided range of 4 to 8% growth. EBITDA also up 18% versus the company's guidance of 12 to 16%. And this time around, we have seen a broad-based EBITDA growth, largely led by UPL Corp as well as Advanta, which is the seeds business of the company. And we've also seen broad-based growth across all regions this time around. Importantly, the net debt to EBITDA has also come down to 1.6 times for FY26. And going forward, the company has guided for a revenue growth of 10 to 14% for Q1 of FY27, along with a 14 to 18% EBITDA growth.
Thank you very much for that. Dipan, numbers look good. Company continues to deleverage. Guidance looks okay, 10 to 14%. But they've missed guidances in the past. They've got a history of that. But do you think they've turned the corner? Q4 was okay. Guidance looks fine. What's the call on UPL?
It's a very complicated company and too many moving parts. And the management keeps on doing some restructuring or the other. They will merge, demerge, and stuff like that. And the earnings volatility is a bit too much for me. I think there are better plays in the agrochemical industry, domestic focus plays, some export-oriented plays also. Prefer PI industries, although that's also going through its own challenges. But prefer other companies to UPL. But what works in favor of UPL is all these overseas acquisitions which they have done. They have done when the rupee was anywhere from 40 to 80 or so. And now when they are converting all those revenues back into Indian rupees and presenting to us, somewhere the rupee depreciation is playing in favor of the numbers which are declared in Indian rupees. It's not that the stock is extremely cheap also, trades at I think kind of high 27 times or thereabout trading 12 months. So sure, I mean, there could be a trading rally in UPL at any point of time. But I don't think that I would classify it as a steady, long-term compounding story. In last 10-year, profits have grown in low single digit, So something is amiss over there, as I feel, considering the kind of potential industry the potential in the industry is operating in.
Got that. Dipan, stay with us. We have the management of PVR now joining in. They reported numbers just, I think, about 30-40 minutes back. We have Mr. Ajay Bijli joining in, and we also, he's Managing Director at PVR, and Gaurav Sharma, CFO at the company with us. Gentlemen, great to have both of you here. Thank you very much for joining us. EBITDA growth is very strong. Margins seem to have improved quite a bit, 29.2% compared to 23.5%. EBITDA coming in at about 452 crores compared to about 290 crores, all numbers year on year. Mr. Bijli, if I can start with you, sir, for the October to December period, I think it was Dhurandhar and ex-Dhurandhar. Was that spillover seen in Jan to March as well?
No, I think I need to demystify this. It is not only Dhurandhar. Dhurandhar only came in the fourth quarter for 11 days. So I think it's like a cricket match where people just remember what Virat does or what Rohit Sharma does. They don't look at what others chip in to make a successful outing for any cricket team. So I think there are a lot of contributors like Border 2. There were a lot of in the fourth quarter, and in the third quarter as well. There was Kantara 2. There were other Hollywood films that did very well. Avatar was there. So I think the beauty about what has happened in the last year, and it continues to show momentum in the first quarter as well, is that people are back and they want to watch movies on the big screen. And of course, good content is important, but every content doesn't have to be a mega blockbuster. And one a very interesting data point came that this year, contribution from mega blockbusters, I'm talking about the overall industry. The overall industry box office was about up by 8% from last year to close to 13,500 crores. 20% came from mid-budget movies. and 19% came from mega blockbusters, as opposed to last year where 30% came from mega blockbusters. When I say mega blockbusters, it means all movies which have done more than 500 crores of business. So I think it's very encouraging and heartening to see that momentum is back, to come back and see the movies on the big screen. It doesn't matter what the budget is.
And when you say last year, you mean last FY? This there is the comparison.
The financial year which has gotten over, compared to 24-25.
Okay, got it. You know, there have been some good movies. Michael, I think, is still perhaps playing. There's Hail Mary, which I think has done well for you. There are lots of others. The pipeline seems good, Mr. Bijli?
Yes, absolutely. You know, India, the quantitative quantity is so much that the supply side is always very robust. And even going forward, you know, this has only been encouraging for the film fraternity. It's been encouraging for the film fraternity in India. It's been encouraging for Hollywood. So when they see results, when they see movies doing so well, then obviously more investment is made into bigger movies. This year we've got King of Shah Rukh, we've got Ramayan Part 1, which is going to be a massive movie, probably the most expensive movie ever made. We've got Odyssey, we've got Love and War. There's a Salman movie, there's a Batwara 2, Batwara, which is a Lahore, earlier called Lahore, of Sunny Deol. So lots of films are coming. Drishyam 3 is releasing now. There's a movie called Paddy, which is releasing this quarter. So the lineup is very, very strong. Hollywood has got Spider-Man, it's got Avengers, Dune 3 is coming. And for our circuit especially, Hollywood is a very big contributor.
And occupancy was how much, sir? In the the quarter that you've reported, and so far this quarter, what's occupancy been at?
Well, the year has ended at about 25, Gaurav, 25.2 or something?
Here is 26.2% occupancy.
26.2 has been the...
And this quarter was 24% occupancy.
But too early to comment just now because we're still in beginning of May. But as you mentioned, Devil Wears Prada 2, Project Hail Mary, spillover of Dhurandhar, and Bhoot Bangla. All these movies are running at a good occupancy at the moment.
And I saw a couple of these, and I must say the PVR theatres were pretty full. The occupancy looked a lot more than the 26%. But Mr. Bijli, what were the ad revenues? In Q3, there was a sharp drop. Have we seen a recovery? Do you have a guidance for FY27? And Gaurav, if you could tell us, has the company turned debt-free? You were guiding and talking about it.
Gaurav, why don't I let you answer both?
I think, advertisement revenue for the quarter 4 was 15% higher as compared to last year, quarter 4. Overall, full year advertisement revenue has been 4% higher also because of, quite a few big films, especially from South India, like Toxic and a few others got postponed as a result. The buzz that gets generated when a big film comes in, which generates ad revenues, got impacted a little bit. Yes, on debt, I think we have achieved negligible net debt levels. We have a net debt at a overall consolidated level of about 169 crores. As against cash EBITDA of about 970 crores. And, the momentum is strong. The capital intensity has come down. Operating cash flows have, improved significantly. So we are well on track to become a net cash positive company in near future.
All right. Hi, gentlemen. Hi, Ajay, as well as Gaurav. And good to see you, Lynn. Nigel on this side. I'm looking at the average ticket prices. That's moved up by roughly around 20%. The average spend as well has moved up by 20%. Was it the Dhurandhar effect or something else?
Yeah, Dhurandhar is one movie. Why is everybody attributing everything to Dhurandhar only?
Will it get more expensive than from here? Ajay, what do you think? 280
rupees ATP for a 3 to 4 hour experience is still expensive. What's happening? CNBC is not paying you guys enough. Look at the infrastructure that you guys get. Everybody gets.
So it moves up from here then?
Sorry?
The average ticket price moves up a little bit from here. You expect it to stabilize at these levels. And you give us an occupancy guidance as well for the coming year.
I think guidance is tough to give because it's difficult to tell what movies. But, we are very happy that we did 26.2% occupancy. And if you look at the, lineup, which is there, I think there's no reason for us to have lesser occupancy than what we've achieved just now. But ATP, average ticket price on a serious note will be 4-5% increase probably will be there next year as well. Gaurav, just correct me on the numbers.
I think, big films with a lot of excitement and compelling content drives the ticket pricing and therefore drives demand and therefore the ticket pricing. And as Mr. Bijli mentioned, the lineup is very strong for next year.
Inflation linked more than anything else, really.
Okay, all right. What about, ad spends, ad revenues? That was up close to around, I think, 15% and 4% for FY26. How do you see that number shaping up in 27?
I think our strategy is to focus on, certain pockets when big films come in and mega blockbusters, films like Toxic, Ramayana, which generate a lot of excitement amongst advertisers and marketeers. And, we are able to lock in media sales deals, structured around these big films. The growth trajectory, particularly for Hindi and English films, is very, very strong. And we are pretty hopeful that we will see a very strong growth in ad revenues in next financial year.
Mr. Bijli, there is the PVR, the subscription model, right? PVR Passport. How's that doing? I mean, are you putting energy and effort behind it to sort of grow it?
I think Passport, we have this 99 rupee offer on Tuesdays. I think the Passport has been discontinued.
I see. I see. Is it? I mean, if I were to take a parallel in television, right? I mean, one is being dependent on bumpy and lumpy ad sales. The other is growing a subscription model. You didn't think that was perhaps is that something you could kind of sort of cultivate and build as a or there was no there was little uptake in that.
Yeah,
that's why you gave it up. Yeah,
experiments have been made, but I think people don't want to pay upfront, for a lineup of movies. I think when movies come, they make their own sort of judgment, what they want to see, what they don't want to see. But what I like about the Indian market and the way PVR Inox is placed in it is that there's enough quantity of films in India as opposed to markets internationally. If you look at US, you look at UK, you look at so many markets which is very dependent on Hollywood, they are having a bit of a volatile time. But India's got 1,500 films that come through the system. So I think the supply side is very robust. And, keeping that in mind, people are free to choose what they want to see and what they don't want to see. Everybody's got very disparate and heterogeneous tastes. So I think that's why subscription models all over the world really haven't worked.
Gaurav, with the company becoming near cash positive or will turn cash positive very soon, what is next on the capital allocation plan? How many screens are you looking to add next year? Are you looking at, increasing the dividend payout? What's next?
We have a very strong growth pipeline of new screens. In last year, we opened about 93 new screens. Next year, we are hoping that we'll cross the 100 new screen openings for the full year. And bulk of these will come from FOCO and asset-light models. We will also be prioritizing expanding in Tier 2 and Tier 3 markets where multiplex penetration is still low. And, we will be coming out with new formats to cater to those markets, which are, more affordable and better positioned for these markets. And of course, renovation is a key priority for some of our high-value cinemas, which are, which were opened a few years back. So we'll be redeploying our capital in renovation in those properties.
All right.
So that's, yeah.
All right. Just wanted to quickly ask you about the CCI investigation in the virtual print-free. How much it used to contribute as a percentage of your mix? I believe it's not very, very large. And is there any movement with regard to that investigation?
CCI, the matter is still ongoing. And, this is with regard to the virtual print fee, which is paid by the producers for Hindi films that are released across the country. It's not only PVR Inox, all other exhibitors charge it. It's less than 1% of our total top line. And as of now, we are fully cooperating with the authorities. At this point, there is no new material update to share on that front.
Okay. All right. Always a pleasure talking to you all, gentlemen. Thanks a lot for joining in. I need to give you all feedback. I was in the interiors of Maharashtra, Latur, Nanded, and, I went to see a regional film, which is Raja Shivaji. It was running houseful, due disclosures, with regard to a bit of family involved in that, as well as it's co-produced by Geo Studios as well. But the excitement out there, it was running full over the weekends. Wow. That was something, the interiors of Maharashtra. So good on you guys. You'll have expanded out there as well.
Thank you. Thanks a lot.
Thanks so much.
Thanks, guys. Thank you.
Okay, all right. Well, time to slip, I think, to a short break. We'll continue our focus on the markets as well as on stocks that are moving around. Stay with us.
Welcome back. Still down 1% on the benchmark indices. One stock which is climbing higher and higher today is Tata Consumer. Had a gap up opening, built on it, and now 7.5% gain on that. Manglam is now here to quickly recap the numbers and tell us the way forward.
Well, it was a solid beat that has come in from Tata Consumer. In fact, this has been the result of the season so far. If you look at year on year, the revenue was up 18%, the EBITDA up 28%, net profit also up over 20%. What was good was the 16% underlying volume growth that the company reported. And this was against expectations of about 10.5%. And revenue growing at 5,400 crores versus expectations of 5,200 crores. EBITDA at shy of 800 crore mark. The street was working with a number of 750 crores. And the net profit too, a good 20-25% beat as against street expectations. The India beverages, there the volume growth was between 3 to 6% as expected at around 4%. But the foods business saw 15% volume growth as against 10 to 12% expectation. And this was led by Sampann, which grew by about 69% as against expected 35 to 40%. Now, the management joined us this morning and they are hopeful of a double-digit revenue growth with EBITDA growing faster than the revenue growth, implying further room for margin upside as well. And at the same time, their growth businesses, which account for nearly 30-31% of their current business right now, is likely to continue growing at 30%. And they have believed that, going forward, even the international business will report high single-digit growth along with margin expansion. So all these factors, along with good management commentary and the fact that there are tailwinds for the FMCG sector right now, has drawn some capital to Tata Consumer, and that stock is doing extremely well. The top Nifty gainer today.
Okay, all right, Manglam, thanks a lot for that. Deepan, what's your view on Tata Consumer? As Manglam said, numbers look strong. Management commentary as well was fairly optimistic. Your view, stock is bursting away. The top gainer on the Nifty today.
That's right, Nigel, but to the stock price, I just add the P multiple. It'll put things in perspective. 80 times trailing 12 months. I mean, for a consumer product company, 80 times, I don't know, it just seems to be just far too expensive. And mind you, a lot of the product categories are reaching maturity, and like beverages, international business. You cannot expect these businesses to grow at double digit for a long period of time. Occasionally, you'll have a good quarter, benefits from, say, better productivity in advertising or low raw material prices. But this is not a company which I think justifies 80 PE multiple, given its business model and its presence. So I just feel that it's great. If you own it, I would remain invested because the current is there, but the momentum is there. But fresh investment, I'm not so sure.
Any view on gold companies after the sell down that we're seeing today?
I think that the gold companies, the gold jewelry companies, they have had a great time last few quarters or so. And maybe the cycle is peaking out over there. So I would look at increasing exposure to the gold jewelry companies. Although there's one exception which comes to mind, usual disclosures, we and our clients are invested, so our views are biased. And that company is Sky Gold, which is not a retail gold jewelry chain per se, but it supplies jewelry to all of these retail chains and has got a solid manufacturing base as well. So we are more positive on a company like Sky Gold, which is a B2B company, than perhaps a B2C company. And they benefit from increasing the distribution and the increased number of stores which come in. They require more and more inventory. And that's where Sky Gold comes into play. So I would say that jewelry companies, on the whole, a bit cautious, although long-term investments, investors may remain invested, but fresh investments, wait for a correction. There could be a soft quarter, 1 or 2 quarters down the line. But on the whole, I think, as I said, be selective. We have identified one company called Sky Gold, which looks interesting to us.
Interesting. All right. Got that, Deepan. By the way, keep an eye on the bottom of your screen. We have some source-based information that's coming in. Tiger Global block deal is likely. There was a lock-in with regard to Grow. The company, remember, it listed in, I think, in November 2025, that will be. I think we should correct that. And the lock-in is ending. And Tiger Global may be looking at either trimming or selling its entire stake. We'll try to get in, whoever is bringing this particular story. And it will be at a discount of around 5 to around 7%. One of our researchers or reporters are bringing us the story. We'll try to get you the latest on that front. Explains why the stock has moved to the low of the day. In fact, in the last few trading sessions, it's corrected from around 215 to 20 to this mark. So keep an eye on that. 1.2 lakh crore market capitalization, 5% block could be due. We'll wait for further details on that particular front. But let's focus on Senko Gold. Well, that's plunged in trade today after our Prime Minister Narendra Modi's appeal on avoiding gold purchase for a year. Earlier today, we caught up with Mr. Sen, the MD and CEO at Senko Gold, to decode the impact. Let's hear out what he had to tell us.
Based on our Prime Minister's thought process, if there has to be certain policies that has to be done in order to discourage, import of gold, duty hikes could be a possibility. But till it is being done, these will only be, speculation whether it will happen or not. Out of the import of 700 to 800 tons, about 20-25% of the gold gets used up for exports, and the remaining 75% is used up in either domestic consumption for jewelry or for investment. So it will maybe create a dent of about 10 to 12% reduction in terms of the volumes that gets imported.
All right, Deepan, wanted to know what do you make of Grow? When it listed, it was expensive, 150, 160 rupees, I recall at that time. Stock went up to around 220 and, it's one of those plays on the capital market theme. There's a large trade that's in the offing, and that lock-in as well does end tomorrow, as the flashes were telling us. Do you think if it shows some weakness, it's a good time to get in? Or do you think there are plenty of better opportunities out there? You rather avoid this one?
No, Nigel, I think that Grow is in a league of itself. And there's great potential to do cross-selling of products as well, be it margin trade funding or mutual funds or some of the other financial products as well. And the kind of position which they are in, the market share, the cost of acquisition of customers, I think it's phenomenal. I think they are completely different from a lot of other listed stockbroking companies. So very positive on Grow per se. It's one of those companies which was making losses for many, many years, and then once it reached a critical point, a lot of the increases in revenues are flowing straight to the bottom line, giving full advantage of operating leverage. And I would look at such corrections if you're looking at the stock to make an investment. I would look at such corrections in positive frame of mind. And if it continues to sustain 15-16% type of growth rate, which is certainly possible, we are looking at basically volumes gradually going up because the values going up, new investors coming in, then I think it is still attractively valued.
Okay, look to buy a reasonable dip on Billion Brains. That's a growth stock today is under severe pressure. Many of the platform companies are weak. Urban Company, Swiggy, Eternal, Bisho down 2.5%, and all these are falling on large volumes. Dipan, thank you very much for joining in. We'll connect later this week. We will slip into a break and we'll continue our focus on the market. Stay tuned. Welcome back. Let's connect once again with Mitesh and get in a few more trading ideas. Mitesh, any more stocks that have popped up?
Very clearly, the stocks which I like are from the pharma pack. I've been recommending them. Today, I think I didn't have any recommendations. So Biocon comes on the radar as a BTSC. Keep the stock at 390 and look for a target of around 400. While Canara Bank in the last couple of hours has declined and some kind of a breakdown has been effected. So Canara Bank is a STBT. Keep a stop at about levels of 132 and a target of around 124 can be looked at.
Any view on TCPL, Tata Consumer?
So I have actually, had some positions in the morning which I have booked. So in that sense, there was vested interest, but the stock still looks good to me. See, the stock has gapped up and gone into all-time highs, and therefore, if you take a slightly medium-term perspective, I think 1350 is the target which I have in mind. For traders who want a fresh entry, I think wait for some kind of pullback, if not today, because today you get now closing session, but tomorrow most likely if you get it, around 1230, 1225 would be a good entry point, and keep a stop below 1190.
Thank you very much for that. Let's talk about ABB India. It's been under pressure from the start. Go stock still down nearly about 10%. Vinny joins in with some more numbers and analysis.
Hi, afternoon. So obviously we know it's a weak set of numbers that's coming from the company, right? Revenue is just a 6% growth, mainly impacted by the automation segment. That's seen a decline of around 15% in terms of revenue on a year-on-year basis. Weaker execution, slower execution was the main concern that came in here. EBIT margins of individual segments, if you look at that, motion segment, that EBIT margin has seen a contraction. Electrification, that's seen a contraction. Automation, that's also seen a contraction. Main reason of why overall the EBIT margin and overall the EBITDA margin of the company, if you look at it, that's seen a reduction is because of raw material inflation that's come in, rupee depreciation, change in their revenue mix as well as pricing pressure that has continued for the company. And West Asia conflict, the company highlighted in the con call, that is also a reason for the impact coming in terms of the revenues also being muted in terms of a growth there. In the con call, the company has highlighted that the PAT margin guidance would be in the range of 12 to 15%. So they're maintaining that guidance of PAT margin. Apart from that, price hikes they've taken in some segments, and they will consider taking some more price hikes in other segments. That will be key to watch out for. Now, a negative point that also came in the con call was that large projects, the ordering continued, but there seemed to be some delay in decision making from clients. So delay in decision making, especially in the automation as well as the industrial capex side, for large orders is a bit of a worry that comes in terms of the revenue visibility. Though order book this time continues to be strong, the order inflow also continues to be strong at 25% growth, mainly driven by data center segment, railways, renewables, utilities and infrastructure. That will be the driver of the company. Robotics has now been sold off as well. But we've seen a lot of downgrades coming in today as well from brokerages, whether you look at Prabhudas Leeladhar, Nuvama, or even Motilal Oswal. All of them have downgraded the stock. So that's a bit of a worry now. In the near term, maybe we could see some challenges.
All right. Vinny, thanks very much for that. Well, there is ABB, stocks down sharply. Grow is the story that we just put out. Yash is getting the details. So an early investor, Tiger Global, will sell its entire 5% or a part of that 5% stake as the lock-in opens up tomorrow, the 6-month lock-in. Yash is here with the details. Yash, take it away.
Well, that's correct, Prashant. So Tiger Global, as you rightly mentioned, an early investor in the company is likely to sell either a part of the 5% stake which it holds in Grow or the entire 5%, entirely depending on the demand which it receives through a block deal. We understand that's expected to happen in the current week itself. The company listed on stock exchanges in November 2025. The 6-month lock-in period for investors ends tomorrow. And right after that is when that large action can be expected as far as the company is concerned. What we've been given to understand in terms of pricing is that Tiger Global could look to sell, as I said, partially or entire 5% stake that it holds in the company at about 5 to 7% discount to the previous day's closing price. So that's an important one to watch out for. We've written to Tiger Global as well as Grow on this particular development. A response from both parties remains awaited.
All right, Yash, thanks very much for that. That is Grow for you at this stage. Well, Mitesh is with us. Mitesh, any thoughts on this one? Grow, 194?
So I think, technically, the history is slightly limited. But very clearly, if you look at it, I think, the stock has had a very good rally and just looks like connecting from those levels. I think around 170, 175, to me, it looks like that's where the bigger support comes in. And therefore, the stock could stop declining over there, and that would be a good entry.
Affle is a stock that's moving up. Came out with numbers post-market hours on Friday or Saturday morning. Good set of numbers. Revenue growth, 20%. Profits went up by 16% on a year-on-year basis. And today they had their conference call where the company says they're on course to deliver a medium-term target of 20% revenue on an organic basis. They're achieving growth despite some temporary disruption due to geopolitical tensions, which required some recalibration. So holding on to their growth guidance of 20%. And they've also shortlisted 4 companies where they're doing some deeper due diligence on account of acquisitions. The company said they may do more than acquisition. The acquisition could be small, medium or large in size. And the company would look is doing that, is issuing some warrants at an issue price of 1487, to Affle Holding to prep for a potential acquisition. Street seems to like this particular development. The Affle conference call, some of the takeaways, 20% growth and looking at some more acquisitions. One set of stocks doing very well are the entire EV-related stocks. So Ather Energy up 6.5%. You've got JBM Auto surging 6.5%. Ola Electric, relative to the others, is a little more subdued, a 3% gain. But these are stocks moving up on very large volumes. As a part of Prime Minister Modi's appeal, it's cut back on travel, use metro, carpooling, but also switch to electric vehicles. And that's getting reflected in the stock price. Mitesh, Ather has had a one-way up move. From the start of the year, up 30%. In the last 1 year, it's a 220% increase in Ather. Is there anything in the charts?
See, one, obviously, I think the stock is making higher lows, but also the fact that, The stock today managed to get past the recent concession zone of 940, 950. Now, from a trading point of view, as long as it's above 950, I think good chance that we'll see 1030, 1040 immediately, and then maybe even higher levels. From a slightly longer point of view, I think the stock actually, it's been making 52-week highs for the last many weeks now. And the stock, and difficult to have a target because we don't have historical levels, but if you take the extensions of the current moves, I think this could be a stock which could head towards 1200 plus levels in the next few months. So very positive on the stock. And from trading point of view, but I think 940, 950 was the support level to keep a stop below that and try for at least a near-term target of 1030, 1040.
Garden Reach and Mazgaon are down 3.5%, 4% each. How are they looking, Mitesh?
So the entire shipbuilding stocks, they've had a good rally in the last few weeks. Mazgaon, I think today has had some kind of a minor breakdown. There was this pivot at about 25.80 and a moving average at about 25.95. I think that range is getting broken. So maybe it could give some more declines. I think I would possibly hope that the stock kind of comes down to about 2400, about 2370. That's the next support area. And that's if the stock stabilizes, I think it will be a good long trade. GRC comparatively is a stronger stock. It hasn't broken below its averages yet. So for the time being, I think after rally, it looks like to be getting sideways in a range of about 2780 to roughly about 3090 to about 3100.
Okay, all right, Mitesh, thanks very much for that. Well, we spoke with the management of MCX earlier. Exchanges have done very, very well. I mean, it would be a straight competition between what has done better, BSE or MCX. One, of course, is stock, the other is commodities. But in any case, we had the BSE management, by the way, with us as well towards the end of last week. So this is the MD and CEO of MCX, Pravina Rai, talking about the numbers and the outlook going forward. Listen in.
We said that we're going to get ready, and we were getting ready for a 10x growth. We spoke of 10 billion transactions a day, and we were at about a billion a day at that time. We've already seen and handled 2 billion transactions a day as the kind of peaks that we've seen in these quarters. So I will say that that journey towards 10x is very much on the way. Now, this has been delivered with a lot of work on technology, investments on technology, continuous improvements on technology, because this is not just simple, steady, slow volume growth. We're seeing spurts, and the kind of market requirement requires us to be able to handle those. So we've invested very significantly in the last couple of years to the tune of close to 400 crores. And we will continue to have those kind of investments in the year ahead as well.
Okay, that's MCX. Many other stocks are doing well. We spoke about Rain Industries earlier, but CE Info, that's Map My India, the India equivalent to Google Maps, that's surging nearly 15.5%. You've got IOL Chemicals, Munjal Auto, Northern Arc, Advanced Enzymes. These are all stocks with double-digit up moves on very, very large volumes. Merck Electronics is another one, 7-8% gain. Lots of momentum backing this one. And on the way down, it's Jyoti Laboratories, which deserves mention. The company announced to the exchanges about the company has disclosed that Henkel will not renew the licensing agreement for Pril, which is the company's flagship dishwashing brand, and it forms a key part of their dishwashing portfolio. So Henkel will not renew the licensing agreement for Pril and Fa beyond 31st of May 2016. And the company's had this tie-up with them for close to about 15 years. That will not be extended. And I think the street is disappointed. The stock is down nearly 10%. We will get into a break. On the other side, Rajesh Kothari of Alpha Accurate Advisors joins in. Stay tuned.
Okay, welcome back. Rajesh Kothari is with us, Managing Director, Alpha Accurate Advisors. Rajesh, good afternoon. Good to have you with us here. Thanks for joining in. What a brilliant move from the lows of March, Rajesh. And I think we chatted about some of it when you were on Editors Roundtable more than a few weeks back. And I think after that as well, which gets us to now. At least at a Nifty level, there is this kind of feeling that every time you go a little further away from the 24,000 level, you get pulled back to 24,000, down or up. What's your sense, Rajesh? What's the environment like after the sharp bounce from the lows?
I think, as we are now in the mid of the corporate earnings season, the most important thing, everybody's watching the earnings, and it's earnings specific, company specific, sector specific, the broad movement. And the good thing is that if you look at the broadly, despite, I would say maybe 15 to 20 days of March, which is very difficult for corporate India, the earnings season is reasonably in line with estimates. If you look at the banking, the credit growth is improving. That's the most important thing. We all were waiting for it. And it's, of course, one of our large sectoral holding. So we are seeing the improvement in credit growth. Asset quality remains still one of the best. Net interest margins, they were under pressure. Everybody knew that. But probably from going forward, that pressure will ease. If you look at consumer, the rural demand is improving after a long time. And that's, again, I would say one positive read-through from this fourth quarter earnings. If you look at capital goods, that is one of the strongest, I would say, sector. And the momentum, as well as, the overall, the order inflow growth, both are continuing. IT, I think everyone is expecting, and IT is one of the most disappointing results. And we were probably expecting, and probably we are ready for it. So that continues, that disappointment continues. If you look at chemicals, we are seeing the broad recovery in chemical after almost very disappointing last 2.5 years. So I think every sector has its own positives and negatives. Coming to your specific question, why the Nifty, the upside is kind of at every point, you feel there is a resistance, because the bulk of the large caps which are under pain, they belong to Nifty. For example, IT is the largest sector, and that belongs to Nifty. If you look at mid and small cap, the IT weightage is much lesser. And therefore, the mega cap growth is kind of under pressure, be it FMCG for last 2 years, be it IT sector for last 2 years, or be it one or two, big giants, be it in banking or be it in oil and gas. Their growth is kind of a capped growth, and that gives natural, speed breaker for the Nifty momentum. But net, the earnings season so far is good, and market is also rewarding in the quality growth rather than the momentum growth, and that's good news for alpha fund managers like us.
Rajesh, the war has gone on longer, and there is no resolution in sight. There is a possibility it lingers on. Are we underestimating the extent of EPS cuts or the impact in Q1, Q2? I know market is penciling in that there will be an impact, but no one thought that it would go on till the middle of May, and we don't know how long it's going to go on. So is there a risk of EPS downside? And is that going to put a lid on the market?
Yeah, you are absolutely right. And I think that remains the risk factor, and everybody is monitoring it very closely. But think of it a little bit, maybe 2 quarters down the line, how market normally looks at forward looking rather than backward looking. So yes, these short-term disappointments, some transition pain creates the short-term volatility. But irrespective of what happens, very important thing, the organized players, and within that the market leaders, they're basically going to gain more market share in this entire pain. So whenever inflation goes up, market rewards the market leaders, because market leaders have a pricing power. Whenever inflation goes up and then interest rate also goes up, market rewards zero debt balance sheet. Market doesn't reward the high leverage balance sheet. And therefore, as I said, last quarter as well, that therefore we always focus on these two combination: market leadership, kind of an oligopolist kind of a structure, and with an under-leveraged balance sheet. That's a super combination to mitigate the high inflation risk as well as to mitigate the high interest rate risk. And I think that's what is going to happen even this time. After a long time, we are going to see, again, double-digit nominal GDP growth, because inflation is going to be a little bit higher. And I think probably, there are no more rate cuts and probably no more rate hikes as well. So it's going to be kind of a muted interest rate environment. But credit growth is improving, which is a good news for all of us from the economy perspective. And I think the market is, rewarding earning visibility. It is rewarding domestic demand story. Look at EMS theme. We have been talking about it from last 1.5, 2 years. It has been rewarding extremely well. So market is rewarding strong cash flows. It is rewarding category leaders and very importantly, capital efficient growth. And market is punishing weak guidance, margin compression stories. And of course, there are some few heated sectors where the earnings growth is much lower compared to what everybody thought. And that is definitely getting punished.
Hi, Rajesh, good to see you in. Any couple of stocks you can name that you'll have added to the portfolio? We'll be putting a disclaimer out for our viewers, but if you could name it, something that you'll have either increased weightage or, some new entrant into your portfolio with the due disclosure.
So what we are doing, we are looking at auto ancillary space very closely. And this is a space where we've been adding, a few names. And these companies are not only into catering to the automobile, traditional auto sector, but they are also now catering to the aerospace kind of a theme. So that's the one auto ancillary theme in general. I would not able to give the name, but there are one or two very interesting companies within this space where they're catering to aerospace. Similarly, on our overall energy, and the future AI and data center related theme on which we have been very bullish from last 3.5, 4 years, we have added one more name, which is a mid-cap name. And again, that company is one of the top 3 and the key beneficiary of this entire, data center related theme. So there are interesting companies in each of these kind of a sub pockets, which we always try to identify to capitalize on tailwinds. And of course, these companies are market leaders, so not taking any risk on the balance sheet, as well as not taking risk on the, the overall, the market structure and the growth structure. So there are always interesting themes. If you look at the many mid and small cap companies in the fourth quarter, generally people say that bad times, these companies deliver very poor growth. But as I was mentioning last time, that mid and small caps India have transformed. The average median profit size of mid cap company is 1,000 crores. Average median profit size of small cap company is 400 crores, but they are still tagged as mid and small cap. So these companies are now becoming giants. They are debt free, many of them. ROE is 15% plus. And there are enough opportunities in this space to create the alpha for medium to long term.
In software, would you mind naming what you own? I think it's about 15% of your portfolio, right?
No, sir. Software is just, I would say, about almost 0% or 2% of the portfolio as per last disclosed portfolio. We do not have any software services in our mid and small cap product. We own 1 or 2 product companies within software. So we own software platforms. We do not own any IT services names in our mid and small cap. In our multi-cap, we have been underweight IT sector for quite some time, and we maintain our negative view on IT sector in general.
Across the AUM, software is negligible, and whatever you own, it's product companies.
No, in multi-cap, we own few large IT services company, but we have been underweight on our multi-cap. And in mid and small cap, we have a close to 0 exposure to IT services.
So in multi-cap, what is the weight?
About 4.2%.
I see. Got it. And engineering broadly is the biggest weight in the capital goods engineering.
Yes. So, capital goods, banking, consumer, particularly consumer discretionary, automobile, including auto ancillaries. These 4 are generally the large, weightages across our portfolios.
How much, just out of curiosity, I know Hitachi we've discussed long, how large has that become now? The stock's done so phenomenally well. So I'm assuming it's outpaced your inflows, the inflows that you're getting. So it's become outsized percentage of your fund?
No, we have a discipline, prudent risk management. So we keep trimming and we do not allow stock to cross particular weightage depending upon its own in the market cap buckets. But yes, as you rightly said, it is rewarded as handsomely and, it is crossing our limits. So we keep trimming whenever the limits gets crossed.
That's got to be painful to trim a stock which keeps going up.
I think it's a good problem to handle, right?
Yeah, no, there are worse problems, but this is a good problem in that sense. You still own Canes, right, Rajesh? Or
no?
No. Okay, so I'm looking at some maybe an earlier fact sheet. Hitachi, I was pretty sure. Got it. In the EMS space, you did mention EMS has done so well. I mean, I think today there was a JP Morgan note or someone, they were talking about names like Sirma and Avalon and a few others which are trading at lifetime highs, and they're basically turning. They think not very much materially has changed. in the last 2.5, 3 months. This is this morning. What do you own in that space, EMS, and what's the comfort level now?
So we own both these names for quite some time, and of course the stocks have rewarded us handsomely, and the valuations have now moved up compared to our entry valuations. But the growth, remains very strong. The theme remains very strong. The tailwinds are strong. Government of India is supporting the Make in India, and the PLI benefits helps you to, improve your return on capital employed, which otherwise can be very challenging when you are into a very high investment phase. So I think both these companies have very strong capabilities. One of the companies already announced their numbers, and our numbers have been very, very strong delivery. So I believe this is a good theme. EMS is a good theme. There is a lot of support, and that results into, please understand, the Nifty earnings growth is going to be 12-13% for FY27. Am I right? So we need to have the right companies which can deliver 20% plus growth. Because without growth, you will not get the PE. So growth first is most important. And there are pockets what we need to identify in each of that, where the growth can be more secular rather than just 2 quarters growth. So EMS is one theme which we have been saying from last 1.5 to 2 years, that this theme will deliver 25-30% kind of a compounded, or maybe even 30-40-50% growth. In the initial, it can be more front-loaded over the next 3, 4, 5 years. So FY24 to FY29, we see this growth can be 30-40% compounded. And that's going to be the entire theme for the entire, all the companies, generally speaking, in that coverage. Of course, within that, there are a few companies which will be more winners. 1 or 2 can be laggards. So we need to identify it right. And so net, we are positive on this theme.
Okay, continue to hold on to these two as well. Fair enough. Rajesh, we'll leave it there. Thank you very much. Appreciate you joining us. Yeah, full recommendation.
This is a disclaimer. These are not the recommendation, and we may, reduce, we may exit depending upon view on the companies. So please put that disclaimer.
Well, you said it. Thank you very much, Rajesh. Appreciate your time, and thank you very much for joining us here on CNBC TV 18. Markets are down about 370 points. So 23,815, and if you look at the market breadth, I think it's gone a little worse. Maybe it has 2:1, maybe a little worse than 2:1, and some more selling has emerged as we come closer to the end. So 235 or so. We were at about 23,950. And we're at about 23,800, 23,820 now. So another 100-point dip coming through in the last 40-odd minutes of trade. There's 20 minutes to go for close, though. We'll take a break. We're back. We'll get you a quick dealing room check with Nimesh, and we'll get you some trading ideas as well. Stay tuned.
Welcome back. Well, some weakness creeping in. The Nifty is down 350 points. Eternal has moved to the low point of the day. Mahindra & Mahindra as well is struggling a little bit. Good time to get in Nimesh on our special segment D3 Chatter. And Nimesh, what are you picking up in terms of dealing room chatter?
Hi, Nigel, under pressure for the markets, largely on back of fresh macro concerns and the fact that there is still no clarity as far as the geopolitical risk is concerned. So a bit of profit booking, I would say, no panic selling, so to speak. But yes, there is a bit of profit booking after the recent move we saw in many of those mid-cap names of late. So that stands out. In terms of flows, clearly it's a sell day on the banking side. So a lot of the financial names are under pressure, especially the PSU banks is where my sense is there is aggressive selling from larger institutions today. Technically, 24,300 is acting as a very strong resistance. So a meaningful upside can only happen once the Nifty crosses those levels. And because of the earnings, you're seeing very sharp reactions to earnings as well. ABB is a classic example. On the other side, UPL after the earnings have seen a bit of reaction. So this earning reactions is going to continue. But from a flow perspective, it is selling today, but largely on the financial names.
Got it. All right. What about individual stocks?
So as I said, there is selling in PSU names. SBI and Canara Bank, these two names stands out in terms of aggressive selling. In fact, SBI in the last two days post the earnings is down nearly 10%. And today, Canara Bank also saw a very sharp reaction after earnings, largely on back of sell flow. So those two stands out in terms of aggressive selling. Now, a couple of small cap names where there is board meet scheduled for fundraising. Paramount Communication and Amic Forging. Both are buzzing for the last couple of days, largely on back of fundraising. I understand some large influential investors are likely to put money via preferential in both Paramount as well as in Amic Forging. So that's the reason why they are buzzing off late. Third, Sona BLW. After the recent correction post earnings, seen a bit of a pullback in that name as well. The buying has resumed is my senses. And there is a chatter of some corporate development as well. A potential tie-up with a global MNC is a buzz as far as Sona BLW is concerned. And the last couple of names where there is buying today, IIFL Finance as well as PTC India. Both have seen delivery-based buying in today's market. So watch out for delivery volumes, will be on the buy side. And there is genuine buying from institutions in both IIFL Finance as well as PTC India.
All right, thanks a lot for that, Nimesh. Well, the markets have come very, very close to that crucial support zone of around 23,800. I think what's happened in the last few minutes is the Nifty Bank, the largest component of the Nifty, that's seen a bit of a nosedive. And you have HDFC Bank that's moved lower. You have Reliance Industries as well that has moved lower. So there's nowhere really to hide from the Nifty itself. Explains why now we've approached that level. HDFC Bank, sharp downtick out there. And Reliance Industries as well. Now, this is the crucial support zone. Let's see whether or not it takes support yet again. Mitesh Thakkar is back with us. Mitesh, what are your fresh trades?
So I think, I've already shared the BTSC estimated trades, but something which I would want to comment is on the indices. So Nifty is very close to 23,800. The Bank Nifty is also very close to about, or just trading below 54, 455 zones. What I would recommend, if people have long positions, and which is what we also have more on the long side and stock basis, people can initiate some put spreads on the Nifty. So that is what we have done. Disclaimer, there is a position over there. But yeah, I think it looks like, in case we continue this decline and start getting below 23,800 on the Nifty, then there's a good chance that 23,500 or in a worst case scenario, even 23,200 could be tested. So getting you some kind of put spread on the Nifty might not be a bad idea.
Got it. Okay. And individual stocks?
See, individual stocks, something which I could recommend possibly is State Bank of India. I think Nimesh was also talking about that. Yesterday there was a negative candle. Today is a continuation candle. So STBT here at the stop at 980 for targets of 950.
Okay, Mitesh. Sorry.
Rima, just thanks a lot, Mitesh, for that. Just wanted to, point out, Rima, a couple of stocks. I recall when we did our market check in the first minute, Quick Heal was a stock, I think that was up 10%.
Okay.
Stock has moved into the red. So from the broader markets as well, individual stocks have come in for selling, as is the case with the smaller name, Sambhav Steel Tubes. That as well, I recall, was up close to 6-7%. That as well has given up considerably from the highs of the day. So there is some nervousness that's coming into the broader markets. The breadth of the market has worsened a little bit as well. The street is worried whether or not there's going to be any big curtailment that will be announced post-market hours. I think that's the reason why we're seeing some bit of nervousness. And the rupee anyway has moved back to the lows of the day. So no reason for the FIs to start making a re-entry into the Indian markets. I guess that as well is a niggling worry. Can't have the rupee at 95.3 and expect flows to reverse.
Absolutely. And it doesn't help matters that the French index, that's the CAC, is also down nearly 1%. So there is some global pain that the markets are reeling in. But there's been a sudden downturn in the markets. The question is whether 23,800 holds as a support. But the last 10-15 minutes, and it's not even expiry today, but we've seen a big fall in the markets. Amrish Baliga, independent market research expert, is now joining in on the show. Amrish, is it the fear that we could see, up until now, it's just a passionate appeal from Prime Minister Modi to cut back? But do you think that, more than just appeal, we might see actual measures, steps which could hurt? And is that what the street is worried about?
Yes, I mean, clearly, I think yesterday, Prime Minister Modi's statement was more of an indication of what is to come. I mean, although he requested that we reduce expenses, especially fuel-related, as far as your gold is concerned, we were told not to buy new gold. So I think it will be a reset for the jewelry sector, although positive for EVs. And at the same time, I think there's an indication that there could be a price hike as far as the oil is concerned. Retail prices of petrol and diesel would be raised. So from that point of view, could be slightly positive for the OMCs. As far as tourism is concerned, especially international tourism, I think it's quite negative because there could be a tax coming in as far as that is concerned, because this asking people not to travel will not really stop people from traveling. So there could be a tax coming. So foreign travel curves could be there. So I think overall it is a bit negative from the market perspective. So I think today's fall is more to do with our PM statement than what's happening on the geopolitical issues as far as US and Iran is concerned. Because there it's more of a rhetoric, and I don't think that rhetoric is going to crack the markets unless there's an action. Action could be a fresh start of another war. I mean, like that could actually crack the markets, or they reach a settlement, which should be a positive trigger for the markets.
All right. Hi, Amrish. Good to see you. When restrictions on foreign travel, that's what our Prime Minister said. And besides that, he was also encouraging rail freight movement, which in turn could be a positive for a couple of companies. Maybe Concord. We had spoken about this morning as well. To our guest, Dharmesh Kant, at that point of time. But do you believe Concord is well placed at these prices of around 530 rupees after seeing the sharp correction from the recent top?
Absolutely, Nigel, because in the container terminal operator business, I mean, they are the largest. They have a 58% market share. They operate about 67 terminals, have 18,400 wagons, 57,000 plus containers. They're increasing that capacity to about 70,000 containers and 100 terminals by 2028. Which means upside scalability is quite high. And they're increasing the value-added services like terminal handling and logistics solutions, which are margin accretive. The dedicated freight corridor is now fully operational up to JNPT, which in fact was a bottleneck earlier. So it's about 2,843 kilometers. And this will aid that double stack container movement as well as faster evacuation. Cement container transport also is a huge opportunity for them. As of now, only 10% of cement is being transported via railway network. Now, Concord has signed a MOU with Adani's and Ultratech to transport 1 lakh tons of cement per month. So this is a huge positive. And they have also signed a MOU with the Vadhavan Port for developing and managing common rail handling operations. So this should get commissioned by 2030, which is another trigger in the future. So overall, I'm expecting a 13% revenue CAGR over the next 3 years. Expected EPS for FY28 is about 24. And from that point of view, the target price is 690.
Okay, we're getting in the AMFI numbers for the mutual fund data for the month of April, and the total net equity inflows have come down by, I think, about 6-7%. It stands at 38,400 crore. The comparable number in the prior month was more than, I think, close to about 39 and 41,000. So that's important. There has been a decline in the overall inflow in the month of April as compared. There you have 38,400 compares with 40,400 crores. So net equity inflows have come down in the month of April. And this is at a time when markets had rebounded, particularly the mid and small caps had rebounded in the month of April. The AUM continues to grow month after month and now stands at 81 lakh crore plus. Mid-cap inflows have been strong, commensurate with the kind of rebound that we had in April from March lows. So mid-cap inflows has been about 6,600 crore, which compares with 6,000 in the prior month. Large cap and small cap numbers will also come up for you on the screen. Amrish, you want to quickly comment on the April numbers? Overall, equity inflows are down.
No, I think it's decent, although it's a bit down from earlier. And this can be attributed to the fact that people surely would be, looking to book some profits after the sort of a move which we have seen. So because of which the inflows also would have got affected. So I think that's the only reason.
Okay, they're just trying to get some more reactions on this. Mid caps and small caps have seen an improvement, a pickup in inflows on a month-on-month basis. So April better than March. Both mid caps and large caps. Sorry, mid-cap and small-cap, large-cap fund inflow has come down by nearly 500 crore. So 2,500 crore compares with 3,000 crore on a month-on-month basis. Sandeep Bagla, CEO of Trust Mutual Fund, is joining in. Sandeep, overall equity inflows are down 5%. Does that come as a surprise?
No, it does not come as a major surprise. I think while the equity markets bounced back quite smartly, the news flow reflected the kind of uncertainty in global markets, especially in terms of Brent, and I think the Straits of Hormuz has become a main topic of discussion. So I think people are aware that there's going to be uncertainty in equity markets, and I think which is the reason why we are seeing. So it's not a surprise really.
Do you expect the weakness in inflows to continue? What are we seeing so far in the first 11 days of May?
I wouldn't say it's weakness of inflows. I think it is just that people are getting a little cautious about it. I think people are still very constructive, but I think people are a little cautious. So I think this tepidness in the trend will continue for some more time to come. I think we require, people are waiting in the sidelines to invest, but people have, instead of putting in lump sum money, I think people are now breaking it over different installments over a period of 3 to 4 months. So I think this amount of uncertainty in the global markets would lead to some amount of softness in inflows.
All right, stay with us, Mr. Bagla. Well, let's welcome Mr. DP Singh as well, Deputy Managing Director and Joint CEO at SBI Mutual Fund, who joins us. Hi, Mr. Singh. Thanks a lot for joining in. Well, we've got the equity flows coming in at ballpark around 38,000 crores. That compares with around 40,000 crores. What is your initial reaction to these flows?
Actually, it's similar to what it was last month. Actually, if you look at last month's number, it was the SIP trigger of month of February also, it was 40,000 crore. Now it is 38,000 crore, more or less 7,000-8,000 crore more than the trigger amount. So the trend is continuing, and I'm not seeing much in this number. This is a business as usual.
Okay, business as usual. It's 1 month right now that we've seen a minor 5% decline in the equity inflows. Large caps have been a bit muted month on month. Mid caps and small caps continue to see inflows. Thank you very much, both of you, for joining in, Mr. Bagla and Mr. Singh. We will slip into a very short break. We'll come back and we'll also be closer to market ending. Counting down to today's trading session, looks like 23,800 by close, 360 points down on the Nifty. Sensex sliding nearly 1,300 points. In conversation with Ambrish. Ambrish, all these gold jewelry companies have taken a big slam down. Titan, PN, Guard Gear, even the smaller ones like Sky, RBZ. Any view, any stock that you would buy, or do you think this sector could go through some more pain before there is value emerging?
Well, there would be some more pain because most of the top line basically comes from, absolutely new jewelry and sale of gold. And if there is some sort of a nudge to ban that, they will have to change their business model completely, which I think Titan had done some time back, basically recycling of old jewelry. I think that would be the model, at least in the foreseeable future. So I think most of them will take a hit to a certain extent. So right now, I will not really go out and buy at this point of time. There could be some more correction.
All right. Ambrish, quick word about the exchanges. BSE as well as MCX, both the numbers look very, very good. But MCX is building on to those gains in today's trading session. Your view?
I would be positive on both the exchanges. Clearly, the number of investors like in the market, are rising. The turnover is rising. So clearly, I think the revenue for the exchanges will continue to move up, at least in the foreseeable future, if you're talking of the next 5 to 10 years, maybe more. So even at these levels, I would look at buying both BSE and MCX from a longer term perspective.
Any other stock that you would recommend? There is a big fall in ABB. This was a favorite. Stock has been doing well, but today it's under pressure. Do you have a view here?
Yeah, ABB has fallen basically because of the sort of earnings. But then the way I see it is this could be just a blip, maybe a quarter or two. So I would wait for slightly lower levels because of these earnings. We could see some more correction out here. So either 5 to 8% sort of a fall, I would look to buy that.
Okay. All right. Ambrish, we appreciate you joining in and giving us your take on a whole host of stocks. Well, it was that sort of day for the markets. The Nifty staged a bit of a pullback. There were two factors that weighed. One was the cautionary comments that came in from Prime Minister Narendra Modi, and the second factor was crude oil prices spiked. That in turn gave rise to some weakness in the Indian rupee, and the rupee breached the 95-odd mark in today's trading session. But individual stocks came in for a pounding. A few of them would be the jewelers, because Prime Minister Narendra Modi said that maybe the purchase of the gold needs to be pushed just in the near term. So postponement of gold purchases and some fear that there could be some curbs with regard to import duty of gold. That's what weighed on Titan, Kalyan as well as Senko. A few other losers include the likes of IndiGlobe Aviation, because there is some kind of a push with regard to, postponing even your foreign travels. That in turn had a great impact on IndiGlobe Aviation and SpiceJet as well in today's trading session. SBI saw some follow-through selling. Remember, in Friday's trading session, it was down close to around 6%. Today, it was down another 4%. Eternal as well did come in for a bout of profit-taking, and Reliance Industries ended in the red. On the flip side, Tata Consumer was the result of the day. That ended high with a gain of close to around 8%. And Coal India, the street is a little bit skittish whether or not that OFS will come about or not. For the time being, the dip got bought into in today's trade. It was up close to around 1.5%. From the broader markets, Saskin, you had Drain Industries, both of them reported a rather good set of numbers. You had Birla Corp as well that reported a good set of numbers. So all those stocks ended well in the green. The stocks of the past 45 days have been Sterlite Technologies and HFCL. They didn't disappoint today. Both of them continued their upward trajectory. Big gains is what we saw on both those two names. On the flip side, Urban Company was under pressure. Ujjivan Small Finance Bank was under some pressure. And also you saw some of these sugar-related names that actually ran up in the last couple of weeks. They came in for profit-taking. Sri Renuka Industries, that stock was lower in trade today. Grow, that's Billion Brains. Our colleague Yash had reported there could be a large trade in the offing. So that stock was down close to around 5% in trade today. But otherwise, a weak trading session. The bulls will be eyeing defense of around the 23,500 to around 23,800 odd mark. For today, the bounce got sold into. So the bulls will say they live to fight another day. We'll wrap up with this edition of Closing Bell. You stay with us. A special Markets Forward comes up.
Hello and welcome to this special Markets Forward. For the next 30 minutes, we will focus on implications of Prime Minister Narendra Modi's appeal to citizens as the Iran war threatens to reshape India's growth outlook. Well, in a rare and direct message, the Prime Minister urged Indians to take 5 key steps: reduce unnecessary fuel consumption, postpone non-essential gold purchases for a year, avoid international travel, cut import dependence, essentially save on foreign exchange, cut back on edible oil usage as well. The message is clear. India must prepare for what might be a prolonged period of elevated energy prices, which of course will result in external vulnerability. Sources tell CNBC TV 18 that unlike COVID, the conflict in West Asia, of course, it poses a bigger threat to India's current account deficit. It's not so much about growth, but the CAD, which perhaps is on the minds of policymakers as well. India imports over 85% of its crude oil needs. The big question now, can India limit the impact if the conflict drags on? We have a panel of experts joining us in just a bit from now, but my colleague Ritu is here with me to take you through the next 30 minutes of the program. Ritu, good afternoon. The only talking point today all day, starting 8 in the morning, was what will follow the Prime Minister's appeal. Will it be limited to appeal, or will it be actually followed by measures? And you have if I can call it a scenario analysis of what perhaps is possible. Options. Take it away.
Hi, Prashant. Well, yes, that's been the big question in the policy and market circles. Is this going to be a precursor to formal steps to manage dollar outflows? Now, just look at the 4 things that the Prime Minister brought up: petrol and diesel, gold, edible oil and fertilizers. Just put these 4 together and India imported more than $240 billion worth of these last year. Every rupee cent importing these has put pressure on trade deficit and the rupee, which is very real. Now, we already have a playbook from the 2013 taper tantrum. So let's look at some of the potential measures that could possibly be on the table. First is gold mobilization. The idea is to really bring that idle household gold that's sitting in lockers and in banks into the formal system by easing the hurdles. Second, the LRS scheme temporarily tighten how much money Indians can send abroad every year for things like foreign holidays, for instance, which the Prime Minister spoke about, and that keeps more dollars within the country. Third, a special NRI deposit scheme, something that India has used before through the FCNRB deposit. Before that, the resurgent India bonds to attract foreign flows into India. And fourth, make Indian government bonds much more attractive to foreign investors by restoring a lower tax rate. Remember, we had a concessional 5% tax rate, which expired in 2023. Now it's back to 20%. So will that be relooked at? For now, this is just an appeal from the Prime Minister. But of course, markets are going to be watching for whether this follows through into policy action in the coming weeks and days.
Okay. All right. Ritu, thanks very much for that. Let's bring in our panel now to look at some of this stuff, right? And some of this stuff in greater detail. So we have Sameer Narang, who's with us. And he's, of course, with ICICI Bank. Sanjay Parekh is founder and chief executive officer at Soham Asset Managers. Chandresh Jain looks at rates and foreign exchange at BNP Paribas. Gentlemen, thanks very much, all 3 of you. Welcome to the program. So, let's just do one quick round with all 3. Sameer, you think the appeal is a precursor to hard steps?
Well, Prashant, if oil prices remain at current levels or even go up, then we would have to look at some measures of, containing our current account deficit. As you pointed out, it is likely to go up materially if oil prices remain above $100 or even go higher. So we would require some measures to restrict our imports in interest of the broader macroeconomic stability.
Sameer, that's a yes?
Yes.
Okay, and we'll get to what specifically in a bit. Sanjay, what's your sense?
Need to increase petrol diesel prices, and it should be done because ultimately anyway it will show up in interest rates, and the cost of capital going up is far more expensive even for the government, who is the largest borrower. So it doesn't throw a good signal when 10-year is so firm and can go up further. So while it's very difficult, even if we take $30-40 impact on 5 million barrels a day, somebody has to pay for it. And I think, to curtail demand, we need to increase prices. And it will be a bit inflationary, but we need to do that.
Yeah. Actually, I was saying in the morning, it was surprising it's not happened so far. They've been kind of holding back maybe elections, but it's been a few days since the elections also finished. Chandresh, what's your sense? First cut, should we expect measures?
I think the measures should come definitely, but I'm not sure how much they will increase the petrol prices locally. Because if you start doing that, then it will increase inflation on a whole basket. And probably India doesn't want to do that. So ideally what they should do is that they increase the petrol prices slightly, but at the same time, government provides some kind of a fiscal support for the people.
Samir, very briefly, we're in a very different position on the macro front compared to what we were during the taper tantrum, including the kind of reserves that we hold. Which of these various measures that are on the table, from gold mobilization to tax relief to LRS remittance cuts or whatnot, do you think will be most effective in the current environment?
I think, a couple of measures. One would be, of course, if you recall, Ritu, in 2013, we had also put in an 80-20 scheme for gold exports and imports. So whatever we, import, 20% had to be exported. And at that point in time, we were importing around 1,000 tons prior to this measure. And once that measure was put into place, imports fell materially by, I think, around 30%. So what you should see is that some of these schemes are actually fairly effective in terms of ensuring or moderating the impact on the external account. Number two, your point that, yes, we are in a very, very different position from 2013. Our current account deficits were consistently, notching higher, led by higher imports because of, the Capex boom that was, the power Capex boom that was undergoing in the country, as well as the fact that we were importing a lot more of gold. This time around, the starting point on inflation is very low, unlike around 10% in the previous cycle in 2013. We are starting at 2%. Our current account deficit has been around 1%, barring the Russia-Ukraine war year when it was around 2%. So, in essence, we are starting at a very good position. However, there is no room to be complacent. It's best that we restrict, our external account or the current account deficit, because capital inflows into the country over the last 2 years have been fairly muted. We have seen a BOP deficit over the last 2 years, and this year perhaps also will be third consecutive year of a BOP deficit. So it definitely requires some steps to restrict it. But in general, the macroeconomic backdrop is fairly comfortable and favorable over the medium term.
So Samir, on gold, what is, for oil, it's fairly straightforward price increases. On gold, what exactly is your expectation?
I think the earlier scheme, which required whatever you import, 20% of that you need to export, was fairly effective in curbing, imports. And as you can see, Prashant, in 2022-23, we were importing $35 billion, dollars worth of gold. Now it's in excess of 70. It's exactly doubled, actually, to $72 billion, more or less. So that's a sharp jump. But these measures may not come if, within a few days, the energy crisis is solved and, oil prices come down. That's the only problem. Yes.
Yeah, but that's like you don't know. It's like, I was say it's like a game without an innings. It's just sort of, endless. We don't know when this is going to come to an end, but we know it'll come to an end. But I think 2 months have passed, and I think you perhaps need to start to act and maybe reverse it if the war ends and prices come off. Sanjay, I don't know if you have exposure to the entire gold theme here. I don't think so. But if these measures, as Samir was pointing out, were put into place, what's the impact to your mind from overall perspective, if you want to share that impact, and from a financial stock market point of view?
Yeah, so, clearly market is worried because of rupee depreciation, particularly global investors. They would certainly refrain when you see rupee depreciating. And they have this issue of, the taxes are in rupee terms where the returns are in dollar terms. So they have a ask of, taxes on dollar returns, which is a genuine ask. And I think government should consider that because ultimately we'll need capital flows, and, we are dependent on FIIs. FII still own $650 billion broadly. And from they moving out, and we are quite vulnerable, right? Even a $5 or $10 billion impact is impacting rupee in this situation. So we need to, listen to them, their concerns. At least this is a doable thing of they being taxed on dollar returns. And if rupee tomorrow appreciates, they will actually make more dollar returns, right? So it will be a level playing field. But that is what I think is possibly they should consider. But also the signaling, we can't signal as if we are into panic zone. That will give a very wrong signal to the global investors.
You talked about the FI taxation bit. I was going to come to that in a bit. But on gold, my question was on gold, what Samir was referring to. If an earlier gold scheme is reintroduced, there's some talk, maybe import duty hikes, etc. Any impact of that? We had, by the way, we'll play out sound bites of Senko, a gold company predominantly in the eastern part of the country, saying, 10-15% kind of volume hit is possible. But that's just anecdotal. Any thoughts?
Yeah, gold, honestly, I don't have a very clear view. So I'll go with Samir, on that. But anything which reduces pressure on our currency will be welcome from the market point of view.
Sanjay, just to close the loop on that, we're talking about the Prime Minister saying don't buy gold for a year at a time. At least for retail investors, it's been a well-performing asset class compared to what we've been getting from the equity markets. Is that a bit at odds? And typically when you tell people not to do something, they tend to sort of move towards that.
Yeah, yes, psychologically, yes, but I just go back a little bit. Nilesh Bhai had sent an article of, how can gold be recycled, and it was a very good article, actually, very well thought as well, that can we have this gold which is lying in the lockers and a lot of it unaccounted for, and if we can have let's say 100 grams of gold, 70 grams of gold can be recycled as normal, and the 30 rupees can be given through a long-term bond. Effectively, that the investor will feel that I got my 100 rupees back, but it's a very backdated bond, which the NPV of that will certainly be very minimal. So such schemes to recycle gold, which is lying in all this locker, a lot of it unaccounted for, is an option. But I don't think government right now would act in a knee-jerk manner to do such a drastic step.
Samir, very quickly on these dollar bonds, etc., that are being, foreign depositors, for them to also come to India with banks offering attractive rates. Again, it's a very different situation. In 2013, US rates were near zero. Now they're at near 4%. The kind of rates that banks will have to offer to make these bonds attractive to these depositors, will that really be feasible in the current environment, Samir?
Ritu, I think as you gave your initial remarks, you spoke about the Resurgent India bond as well in 1998, which was issued by SBI. So you could have a situation in which we are issuing bonds instead of, commercial bonds by, banks to raise dollars from the international market instead of FCNRB deposits. So it is possible that we take the latter route. Even in 2013, there was a component of that that was raised by banks, and we could revert to that kind of route in which maybe a 5-year bond is being raised. There, given that domestic rate or 10-year is at 7%, if we offer, a dollar-denominated rate of around, a similar range for a 5 to 7 year bond, it is possible that it will find takers, given that the US 10-year is around, 4.3, 4.4%.
Will it distort, dollar borrowing for other corporates? Samir?
I think, Prashant, most of the corporates are utilizing the domestic, route for raising resources, particularly for credit, because landed price in India is cheaper right now as against abroad, because as Ritu spoke about, global rates are much higher because of the US Fed's rates where they are. So in a way, it may not distort it materially because it'll be a small dip in the ocean any which ways, and it'll be a one-time issuance just to stabilize the external account. But all of this perhaps may not be required if the crisis, comes to an early end, perhaps. So, but that is an option definitely on the table.
Yeah. Chandresh, you want to add to it? This on what the RBI may do on the monetary side?
I think the FCNR route, particularly, people are talking about, can RBI go back to those kind of measures? But you rightly pointed out that, 2013, we had US rates almost close to 0%. And market was able to leverage a lot because of low rates globally. And that's why a lot of inflows came on FCNR route that time. But now when global rates are so high, it's not easy to leverage. And therefore, even if RBI think about FCNR route or these bonds, we might not see similar kind of inflows what we saw in 2013. So probably I think RBI will refrain from these kind of measures.
Okay, Samir, on the point of what if the war gets over quickly, I had the Eurasia Group's Pramitpal Chaudhary earlier today, and I asked him, he said, well, he says at least a month. I mean, every month I speak to him, he says at least a month. So, it's hope that we all hope, fingers crossed, that this gets done sooner. But 2 months down and the clock is ticking as we speak. Take a quick break here. I just want to play out Senko Gold sound bites. We had them in the morning early on, 8:30. This is their assessment of the situation. We'll see on the other side.
Based on our Prime Minister's thought process, if there has to be certain policies that has to be done in order to discourage, import of gold, duty hikes could be a possibility. But till it is being done, these will only be, speculation whether it will happen or not.
Welcome back to this Markets Forward special. We're in conversation on the implications of the West Asia conflict in India. Let's bring in our guests again, Sanjay Parekh, Chandresh Jain, and Sameer Narang still with us. Sameer, most of these measures that we're talking about, LRS, remittances, what happens to gold, some of these tax-related measures, very much capital account-related measures. What about the real problem, the current account, importing as much as we're doing and exporting lesser than we should? What are some of the policy measures that could actually fix that bigger problem rather than just this band-aid sort of solution on what's happening on the capital front?
Again, very interesting question, Ritu. But as you know, energy imports in the short run are very inelastic, and in the long run, you can change behavior or, your importing requirement by building capacity. And we have done very well for instance, in renewables. Our 50% or more than 50% of the grid is on renewables, as against many other Asian countries which have relied heavily on gas-based imports. So we've not seen much shortages in terms of power production in the country as against many other countries. But there are areas for improvement, such as as electric vehicles, where our penetration levels are in single digit, around 8% of volume sales last year was in EVs, as against maybe half in a few countries and global average of 25%. So that would perhaps bring down the intensity of, petrol and diesel consumption in the country. Second bit is, for instance, in case of India, the entire rail network has moved to electric, platform now, as against heavy usage of diesel a decade back. So we made these incremental changes because of which incrementally the carbon footprint of the country is coming down. But these are long-term policy measures. In a short span of time, we can only cut consumption by changing our mobility, as in reducing the need for maybe a little bit more of work from home or using more of public transport. But over the longer run, it is the policy directives or, more investments required in alternative fuels and capacity building there that can cut in the long run the need for more, energy imports.
The other, of course, is coal as well, right? Coal is here to stay in that sense. But we have enough of coal. Samir, on immediately in terms of what can happen, right? This LRS, you think that'll be tinkered with? Limit $250,000, maybe limits brought lower, any other kind of, measures outbound, taking dollars out of the country?
Large number, in my opinion, to move the needle to that extent. Maybe it will help at the margin. It depends on, what level of escalation we are looking at. But I think incrementally, yes, possible that we may, tweak it a little bit for a couple of months or a couple of quarters. But that's not a very large number per se. But yes, it can help at the margin if we do tinker.
Sanjay, do you think it's a possibility? And, some of that stuff will go to what you were talking about earlier. You don't want to sound like you're panicking, right?
Absolutely. We should not, because I think we're not in such a precarious scenario. And then, at a point, let rupee find its own level. And, and we can see it even appreciating later when crude comes down, right? But only one point, because we tracked oil as an oil analyst from 95. What is painful is that we will need oil, even at the 6.5-7% growth rate. Today, we are importing 5 million barrels of oil. So we will, after 10 years also, I believe we will still need a large part of oil if we're not self-sufficient. So the learnings of this should be that we should really have policies where our oil and gas production significantly goes up. It will reflect in 2, 3, 4 years from now. But even at the cost of, all the large oil majors in India, global majors, we should have a policy which is more attractive to the oil and gas producers, That policy, I really believe, having closely watched, that it could have been a little more liberal towards the investors. And we could have attracted a lot more investors in this segment, which has not been the case.
Well, Chandresh, from a rupee support point of view, what about the low-hanging fruits, these OMCs that are biggest sort of, buyers of dollars? How much pressure is getting added because of that? And, why not a special window for them as was done earlier?
I think that's very much possible. We are seeing that in other parts of the world as well, where a lot of these usual buyers of dollars, they have been asked to buy dollars directly from the central bank so that there's no pressure on their local currency. So India definitely could do that on that front. I think FX reserves are still sufficient, I would say. So if OMCs have to buy dollars, I think RBI can provide them easily.
Okay, it's a discussion we can go on with. We'll see what actually comes through. But as we are wrapping up, gentlemen, this is source-based information, but OMCs, the first quarter, this is what we understand. In the first quarter, OMC losses are set to wipe out the entire profit of FY26. So the government, this is source-based information, but Q1 OMC losses are likely to be between 1 to 1.2 lakh crores. And half of the first quarter OMC losses are due to LPG. So at least in terms of increasing prices for the consumer, perhaps that's the first measure which we're likely to see before some of the others that we discussed. Samir, thank you very much for joining us. Great getting that perspective. Sanjay, thank you very much for being here and getting that sort of detailing out. Chandresh, thank you very much for being here as well. Well, that's it from Ritu and me here on this program. Thank you very much for staying with us. More coming up on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The big stories that we're tracking for you this evening.
देश के प्रति अपने कर्तव्यों को निभाना वो भी देशभक्ति होती है.
Prime Minister Modi says India's economy faces challenges, appeals to citizens to cut fuel use, revert back to work from home, hold back on foreign holidays and buying gold for a year. Government sources say households will need to share the burden of high oil prices and flag the current account deficit as the biggest challenge. Jewellery stocks take a beating after the Prime Minister asked citizens to put off gold purchases for a year. Consumer Durable Index declines the most. On the other hand, shares of electric vehicles and green mobility companies rally after the Prime Minister urges the shift to EVs. Sharp fall on Dalal Street as the Sensex and the Nifty lose over 1%. Nearly 6 lakh crore rupees in market cap wiped out today. The rupee weakens against the dollar, breaching the 95 mark. The ceasefire between US and Iran shows signs of fraying. President Trump says Iran's response to the US peace proposal is totally unacceptable. Iran says US demands remain unreasonable. Brent crude prices breach $105 a barrel. President Trump to meet China's Xi Jinping in Beijing on Thursday. Trade, rare earth export, curbs AI to Taiwan to top the agenda. This will be the first face-to-face meeting between the two economic superpowers since the US-Iran war began. The union government notifies the new labour codes 4 months after releasing draft rules. No criteria for minimum wage, which the centre says will be notified separately. A floor wage will be fixed in consultations with state governments.
A new era of a real, secular, social justice starts now.
Tamil Nadu's new Chief Minister Vijay takes oath as MLAs along with 93 first-time legislators from his party. Vijay visits former Chief Minister Stalin at his residence, marking the first significant engagement across the political divide since the change of guard. West Bengal's new Chief Minister Suphendu Adhikari approved 6 projects in his first cabinet meeting. Transfers land to the Border Security Force for erecting a fence along with the Bangladesh border. Also approves immediate implementation of the census exercise. Well, let's go straight to the big story this evening. Now, Prime Minister Modi has appealed for restraint on fuel usage, foreign travel and gold buying as the Middle East crisis continues to rattle global oil markets. The Prime Minister was speaking at a rally in Hyderabad yesterday, and he highlighted that curbing dependence on imported fuel was now a national necessity. He urged people living in metro cities to opt for carpooling, prioritize travelling by metro trains. He also recommended resorting to COVID-time measures like work from home and virtual meetings. Now, remember, oil imports account for close to 90% of India's domestic needs. This has also led to a multi-billion-dollar spike in the import bill. The Prime Minister also stressed on reducing non-essential gold purchases for a year to reduce the pressure on foreign exchange outflows. He also appealed to citizens to avoid non-essential foreign trips for at least a year to help conserve foreign exchange instead. Now, the Prime Minister urged citizens to promote domestic tourism. He also urged farmers to cut the use of chemical fertilizers by 50% and adopt solar-powered irrigation pumps instead of diesel-run systems. He also stressed the importance of reducing edible oil consumption, linking it both to national economic interests and public health. Meanwhile, sources in the government have told CNBC TV 18 the West Asia conflict will have an impact that needs to be borne by households, the government and OMCs. Now, they flag current account deficit as the biggest challenge that faces the economy. So a fuel price hike seems imminent. The quantum and the timing continue to be uncertain. Take a look.
साथियों, हमें पेट्रोल डीजल का उपयोग कम करना होगा। शहरों में जहां मेट्रो है, वहां हम तय करें कि हम मेट्रो का ही उपयोग करेंगे। ज्यादा से ज्यादा मेट्रो में ही जाएंगे। अगर कार में ही जाना जरूरी है, तो फिर कार पूल करने का प्रयास करें और भी लोगों को साथ बिठा ले। अगर हमें कहीं सामान भेजना हो, तो कोशिश करनी है कि वह ज्यादा से ज्यादा रेलवे गुड्स के जो ट्रेन होती है, रेलवे की सर्विसेज से भेजे। एक जमाना था जब संकट आता था, कोई युद्ध होता था, तो लोग देश हित में सोना दान दे देते थे। आज दान की जरूरत नहीं है, लेकिन देश हित में हमको ये तय करना पड़ेगा कि साल भर तक घर में कोई भी फंक्शन हो, कोई भी कार्यक्रम हो, हम सोने के गहने नहीं खरीदेंगे, सोना नहीं खरीदेंगे। विदेशी मुद्रा बचाने के लिए हमारी देशभक्ति हमें चुनौती दे रही है और हमें इस चुनौती को स्वीकार करते हुए विदेशी मुद्रा को बचाना होगा।
It's very important that we as citizens also play our role in this entire effort. We as citizens, as our Prime Minister has asked all of us to, can reduce our expenditure on everything that requires foreign exchange to be spent. So I'll request all of you to take cognizance of Honorable Prime Minister's call to the nation, and within your own means, within your own enterprises, within your own businesses, try to do whatever best you can.
पेट्रोल डीजल का तो देश के इंटरेस्ट में प्रधानमंत्री जी ने अपील किया है, आप सब लोगों ने सहयोग करना चाहिए। जैसे अभी बहुत लोग अपने एक आदमी गाड़ी में घूमता है, उसके बजाय अभी ट्रांसपोर्ट सिस्टम में पब्लिक ट्रांसपोर्ट अच्छा करके हम गाड़ी में बजाय पब्लिक ट्रांसपोर्ट का यूज करें, मेट्रो का यूज करें। ये भाव प्रधानमंत्री जी का है, देश के इंटरेस्ट में उन्होंने बात की, आप जरूर उसको अनुरोध करिए।
The IMF has noted that supply shock triggered by the Middle East crisis poses a serious threat to the global economy, even if the conflict were to end tomorrow. The lasting impact of the damage to infrastructure and supply disruptions will continue to impose high costs for quite some time to come. Every additional day of disruption can potentially translate into significant economic costs for the world economy, with cascading effects on energy supply, fertilizers, food security, and global prices. Amidst such unsettled and turbulent global backdrop, India stands out as a clear outlier of resilience and renewal.
These are all very, very dramatic appeals, if not a directive. If the Prime Minister is making this appeal, what is the true situation which India is facing? I think it's important that the government takes the people of this country into confidence. To do that, they must call for a session of Parliament and apprise us of what is happening, because this is not normal. No other country has given this kind of advisory, directive, appeal.
And staying with the Prime Minister's appeal, several industry leaders have come out in support of the Prime Minister's appeal for energy austerity and stressed on the need to double down on investments. Sunil Mittal said there is a need to get away from the obsession of gold imports. Sunil Kant Munjal has called for conserving energy as a sensible move. Shobna Kamineni of Apollo Hospitals says that while energy austerity is the need of the hour, it is not a doomsday call. Take a look at Corporate India reacting.
I think we in the industry need to play our role. We need to play our part. We have employment of millions of people. We can take his message forward in a very deep and meaningful way. We need to get away from this obsession of import of gold. We need to lower our energy costs. We need to move more faster towards renewable energy in our industry. And importantly, we need to vote with our feet within our country. Spend more here, put more Capex here. We need to invest more. This is not the moment to shy away. This is the moment to invest, double down in our own country, because the underlying growth is there. This is a continent of consumers, large young population wanting more products and more services. And let's give them more from India, make in India, from India, serving India.
Considering that we are one of the largest importers of energy in the world, it's only sensible that we start to conserve energy and start to see how we can be more efficient. I think there are two aspects to it. One is, whether Reserve Bank intervenes constantly or not. But the fact is, there has been inflation. There has been an impact on currency. Unfortunately, the Indian currency has suffered more than many others because of our peculiar situation. To my mind, I think it's more a natural drift would be a better approach, which is what also the Reserve Bank appears at this moment to be taking. But I guess they know this situation better than most of us.
I think austerity is really the call of the hour, because we have to protect. It's not about our own country growing, because we have wonderful growth ahead of us and a great future. But it's the external dark clouds that create this situation. People must travel, and we must help the economy keep moving. I think it's better not to do it just for, if you can just be there for a national cause and maybe reduce one trip a day. I don't think that it's this doomsday call. And we should not take that as a nation, that this is, that what we have to do is, we have to work together.
Home now, after the COVID pandemic, this has probably been the first time there has been some policy push or maybe an indication towards work from home. Do you think that is going to impact efficiency of our corporate sector?
No, I don't think that will impact efficiency. I think we have lived through COVID times. Technology is far more developed. Yes, in some cases it is much better if people are there collectively, but for a few months if people have to work from home or use technology more extensively, I don't think it will impact productivity in any way.
Based on our Prime Minister's thought process, if there has to be certain policies that has to be done in order to discourage, import of gold, duty hikes could be a possibility. But till it is being done, these will only be, speculation whether it will happen or not. Out of the import of 700 to 800 tons, about 20-25% of the gold gets used up for exports, and the remaining 75% is used up in either domestic consumption for jewelry or for investment. So it will maybe create a dent of about 10 to 12% reduction in terms of the volumes that gets imported.
Well, a gamut of reactions there coming into the Prime Minister's appeal. Remember, this is still a national advisory. None of this is mandatory. The question, though, is that was the Prime Minister's speech a precursor to measures that the government may announce? We're, of course, going to be tracking this very closely. But let's go on to the top global story this evening. Crude prices are surging as President Trump has dismissed Iran's response to the U.S. proposal to end the war, and Israel Prime Minister Netanyahu warning that the war will continue. Here's the latest developments. Trump has called Iran's counter-proposal, and I quote, totally unacceptable. He also posted a long statement on Truth Social alleging that Iran has been playing games with the US and the rest of the world for 47 years, adding, and I quote, Tehran will be laughing no longer. End of quote. This came soon after he reiterated that the war would end quickly. Iran has refuted Trump's claims that its demands were excessive. The country's foreign ministry spokesperson Ismail Bagay has maintained that the US continues to have unreasonable demands. He added, and I quote, the offer was generous and responsible. Bagay claimed stability and security in the region have been undermined after Trump's rejection. Wall Street Journal reporting that Iranian counter-proposal called for nuclear issues to be negotiated over the next 30 days. Tehran also reportedly proposed to have some of its highly enriched uranium diluted and the rest transferred to a third country, something that Iran's state media has since refuted. The country also refused to accept the dismantling of its nuclear facilities. Furthermore, Iran called for the US to lift the blockade on the Strait of Hormuz. Meanwhile, Israel's prime minister has warned that the war will continue as long as Iran had a stockpile of highly enriched uranium. Netanyahu said in an interview on CBS's 60 Minutes that there are still enrichment sites that have to be dismantled. When asked how the uranium should be removed, he said, and I quote, you go in and take it out, end of quote. He added that Trump told him he wanted to do this as well. Netanyahu's comments and Trump's dismissal of Iran's proposal have pushed Brent crude above the $105 mark. Iran's foreign ministry spokesperson has warned European countries against deploying warships to the region to open the Strait of Hormuz. Reuters reporting that 3 oil tankers have exited the strait with their trackers turned off. According to Iranian media, a vessel loaded with Iraqi crude and bound for Vietnam sailed through the waterway through the route designated by Iran. Amidst the heightened tensions, Iran's foreign minister Sayed Abbas Araghchi is expected to visit India this week. He will attend the BRICS foreign ministers meeting in New Delhi. Araghchi has spoken with External Affairs Minister S. Jaishankar 4 times since the conflict began. Iran had earlier indicated interest in pushing for a coordinated BRICS response on developments in West Asia. On to today's market action. Markets witnessed a sharp fall today with the benchmark indices dropping over 1.5%. The Sensex down over 1,300 points and BSE-listed companies erased market cap of nearly 6 lakh crore rupees. So 1,300 on the Sensex, 360 on the Nifty, 870 on the Nifty Bank, and the mid-cap index down by about 650 points. Nigel joins us now to bring us up to speed on the market action. Nigel, of course, the West Asia conflict and Trump calling Iran's proposal unreasonable, unacceptable, that had a part to play, but also the comments coming in from the Prime Minister.
Well, it was a weak trading session for the Nifty today, and it was under pressure from the word go, actually. A couple of factors played out. Cautionary comments coming in from Prime Minister Narendra Modi over the weekend. And also you had crude oil that spiked because there was no concrete resolution coming in from the United States and Iran. Let's focus on the domestic queue first with regard to what Prime Minister Narendra Modi had to say. He said that he resolved not to purchase gold for close to around a year. And because of that, it was a bit of a sentiment hit for stocks like Titan, Senko, as well as Kalyan. Keep in mind, the street is bracing for some kind of duties on gold imports, and that's why those stocks are under pressure. Our Prime Minister also urged Indians to limit foreign travel, and that in turn had an inverse, impact on Interglobe Aviation as well as on Indian hotels. Both of them were under pressure in trade today. But there were a couple of outperforming sectors that ended more or less on the flat line and in fact moved into the green as well. The Nifty Pharma Index was up and about. The FMCG index as well did pretty well. The problem for the Nifty was we saw a bit of a pullback, but that quickly got sold into. And that's because the larger names like an SBI did real under pressure post its numbers, so that stock was down. Big boy Reliance Industries as well did drift towards the lower end, towards the end of the trading session. Though there were a couple of bright spots. You had solid results coming from Tata Consumer, top gainer on the Nifty. From the broader markets, Rain Industries as well as Saskin, both of them were up anything between 13 to around 20%. But there were some weak numbers as well that we got from the broader markets. ABB, Urban Company, both of them were under pressure in trade today. The problem for the market is that FI flows have been seeing aggressive outflows, and the rupee breached the 95-odd mark. You'll require some stability on the rupee for the FI flows to come back in. So we'll have to track that. But for today's trade, the breaching of the 95-odd mark made investors a little bit nervous. Now, the way ahead is going to be what are the measures that we actually see from Prime Minister Narendra Modi as well as from the central government? Will there be some kind of regulations in place, some kind of curtailment in place? Those measures will be tracked. Remember, the Nifty is approaching a very, very crucial zone of around 23,500 to around 23,800. The bulls will not want this mark to get breached on the downside.
All right, Nigel, many thanks for joining us. Now, Reliance Industries is set to be reworking the listing structure of Jio Platforms from the previously planned offer for sale to a full fresh issue. Reports suggest that this shift has been made because investors are not keen to sell and want to stay invested for the long term. Reliance now plans to raise fresh funds totaling 2.5% of the company's size. On to CNBC TV 18 exclusive. Private equity giant Tiger Global is looking to sell 5% stake in Grow via a block deal. Sources have said that this could be expected this week. Tiger Global could sell its stake in Grow at 5 to 7% discount to the current market price. Remember, Grow listed in November of 2025 and the 6-month lock-in period ends tomorrow. We will head to a break, but up next, the Union government notifies the new labour codes 4 months after releasing the draft rules. That and more when we return. The union government has notified the new labour codes 4 months after releasing the draft rules. No criteria for minimum wage has been set. The centre says that will be notified separately. Rachna joins us now with the details. Rachna, what does the fine print say?
Well, India has waited nearly a decade for this moment. 29 old labour laws have been consolidated into 4 new labour codes. The final central rules that make these codes operational have now been notified by the Labour Ministry. So now a worker in the organised sector gets a statutory right to minimum wages. Gig and platform workers receive formal recognition for the first time. Fixed-term employees become eligible for gratuity after just 1 year instead of 5. And women workers can now take up underground work and hazardous jobs on equal terms with men. This also comes with a set of protection. Every worker must receive a mandatory appointment letter. Wages must constitute at least 50% of total remuneration. Working hours are now capped at 48 per week, and overtime requires worker consent and must be paid at double the normal rate. Social security benefits will be Aadhaar-linked and portable across states, which is hugely beneficial for migrant workers. But the formula for calculating minimum wages has been quietly dropped from the final Code on Wages Central Rules 2025. And it's not like it's been left to states or a committee. It has simply been omitted for now. Now, experts warn that without a clear methodology linked to the cost of living and regional realities, the national floor wage risks becoming an arbitrary number. States will be free to set their own minimum wages above this floor, whose basis itself remain undecided for now. So for nearly 30 crore workers in the unorganized sector, the framework is now in place, but enforcement depends on states notifying their own rules, and most are yet to do so. India's labour laws needed this overhaul, but what remains in question is whether a reform this sweeping can leave its most fundamental guarantee, a transparent minimum wage, unfinished like this. So we will keep an eye out for more as and when it's notified.
Yes, we certainly will. Rachna, many thanks for joining us. Now, President Trump will head to China to meet Chinese President Xi Jinping in Beijing on Thursday. Trade, rare earth export curbs, AI and Taiwan are expected to be on top of the agenda. This will be the first face-to-face talks between the two economic superpowers since the US-Iran war. CNBC's Yunus Yoon brings us the curtain raiser from Beijing.
China has finally confirmed President Trump's visit to China this week. This is typical of the Chinese, these kind of last-minute confirmations. But also remember, of course, that this summit had been delayed once before. Now, the White House over the weekend had described President Trump's visit as a visit of tremendous symbolic significance. He's going to arrive on Wednesday evening. On Thursday, he takes part in a welcome ceremony as well as a bilateral meeting with President Xi Jinping. He'll be visiting the Temple of Heaven with the president and a state banquet. On Friday, the two are going to be having a discussion, a bilateral discussion over tea, and then go into a working lunch. Now, as Dom and Dan were just discussing, the Iran war is expected to take center stage. In fact, that White House official had said that they expected President Trump to raise the issue of China's support for Iran, including revenue as well as some weapon support. And the U.S. Treasury on Friday had announced that they were going to impose sanctions on a number of companies, including those in Hong Kong as well as in China, for their alleged support. The U.S. Treasury Secretary Scott Bessent is also in the region. He's meeting with the Japanese Prime Minister, and he's expected tomorrow to meet with the Chinese Vice Premier, who's been his counterpart, Dom, in these discussions ahead of the trip of President Trump into China.
Yunus Yoon, many thanks for joining us. That is the latest there from Beijing. We will, of course, track the Xi-Trump meeting. Remember, get the CNBC Edge right here on CNBC TV 18. That is a wrap on this edition of Business 360. The news will continue right here on CNBC TV 18. We're back in a minute with more. Stay tuned.
At WeWork, India presents CNBC TV 18, The Titan Summit, co-presented by PhonePe. Meet the investors behind businesses built to endure. 4 influential investors, 1 conversation shaping the next phase of India's investment cycle, sharing the ideas, decisions and strategies powering India's next era of growth. Don't miss the conversations shaping India's economic future. Register now.
Welcome to Indianomics. The election headlines and upsets are over. It is time now for counting the cost. Cash transfers, free electricity and bus rides announced by Vijay's TVK in Tamil Nadu will cost an additional 2.2% of Tamil Nadu's GDP, taking the total freebie bill in the state to 2.6% of the state's GDP. The BJP's promised transfers to women and youth in Bengal imply additional spend of 3.4% of Bengal's GSDP and take the total freebie bill to 4.5% of Bengal's GDP. The UDF's promises in Kerala increased the freebie budget by 0.5% of GDP. That is from 0.9% before the poll to 1.4% of Kerala's GSDP. And Assam's freebies amount to 1.7% of Assam's GSDP. There the same government has come to power, so there is no increase. Now, what does all this mean to the fiscal deficit and more importantly to interest rates, which will hit all of us? This is not just for the states. Given the higher burden by the, fiscal burden is going to be higher because of falling revenues of states, and they are falling because of excise duty cuts on petrol and diesel. So the fiscal burden is likely to be higher, the borrowing could be higher. Joining me to explain the impact on the state finances and on us are three economists and fixed income experts. Madhavi Arora, economist from MK Global, Mr. M.R. Madhavan, the co-founder and president of PRS Legislative Research. He is also formerly an economist and a bond trader. And Rahul Goswami, the head of fixed income, CIO fixed income at Franklin Templeton. Gentlemen and Madhavi, welcome and thank you very much for sparing time for us. Madhavi, we are basing our first numbers on your report. So tell us exactly what will be the impact on Bengal first, because that's where there is a dramatic number. According to you, a 3.4% of GDP in terms of expenditure is going to rise. So take us through what it can mean for Bengal's fiscal deficit and interest rate cost.
Hi, Lata. So I think the political battle was largely fought on account of the fact that, freebie economics is a new way to go. It started off since from MP election 2023, and it has continued in each and every election where, the way elections are fought is largely on account of freebies. West Bengal is no different. In fact, was actually, as you mentioned from our report, we are looking at the incremental budget impact or incremental fiscal cost rather of as high as 3.4% of GDP, given whatever schemes that they had, laid out in terms of the freebies. Now that comes over and above the already budgeted schemes, which were costing somewhere around 1% of GDP. I'm not saying that if TMC had come in power, it would have been any different, but the details of the BJP agenda appears to be really stretching the West Bengal map to the extent that we probably would be looking at the fiscal deficit, if at all this has to really be sort of accounted for in the current FD, it would easily cross more than 5%. Now that obviously will not happen because of the FRBM targets that they have to follow. But at the same time, if I look at this year's interim budgets of Bengal, they were targeting around 2.9% fiscal deficit as against 3.5% in 2026 RE. They were looking to improve, but given the constraint that they would have in hand in terms of fulfilling even partial segment of this, the cash transfers and employment aid and travel to women and all of that, would be a big strain for this state. Let's remember that the state also has a very high debt to GDP ratio versus the average state's peer. It's close to around 38%. And if I look at the interest cost of West Bengal, as a percent of GDP, it's around 2.5% plus as a percent of GDP, as against the average state of 1.7, 1.4, 1.8% of GDP. So the strain is pretty much there in terms of community expenditure from the state's point of view, plus this freebie-nomics that they'll have to probably, fulfill would imply that you're really lurching at a situation where there could be a compromise on, at least in the near term, on other productive investments that they could probably be doing. Okay. But again, the medium term things could change. The near term impact would be definitely negative for the state, which is having a very high debt to GDP ratio, very high interest cost, and the incremental budget policy impact of the promises could be as high as 3%+.
Okay, wait 1 minute. You know, I have a similar report, not on poll promises, but a report on state finance from Citi also. Now, Citi is arguing that almost all the states in FY27 are assuming a higher revenue growth than is even credible. The revenue growth is going to be slow primarily because people will pay lower GST. There has been GST cuts. Then there is excise duty cuts, and excise is from the shareable pool. So do you think the fiscal strain is going to be more because revenue will be less? And do you give a chance that actually the borrowing will be higher than what the states are telling us?
So that could be possibly the case. So if you look at the state finances in general over the last 2 or 3 years, in fact, we had done the study with regard to how states perform pre and post the election in the last 5 years. We've realized that post-election, on average, there's been a 1 percentage point increase in fiscal deficit. It could be different state-wise, but there's been a clear trend which is an upside. Now, and to a large chunk, that has actually happened also on account of the revenue deficit. Yes, because they were able to actually curtail their so-called promises to some extent, like states like Maharashtra, where if they had actually gone ahead with the full-fledged poll promises, the fiscal deficit would have actually crossed 4%. But what we saw was that from the starting point of 2.2%, it ended up close to 2.9% because they ended up really trimming their schemes and making them more constrained in terms of the spend. But clearly, the revenue side of the state fisc is actually a bigger problem than these freebinomics because they can be still managed and they can be still delayed in some form or the other. But the revenue strain is pretty much there with regard to own tax revenue. SGST pressures are pretty much real. In fact, the center has realistically taken a much lower growth of GST as against states, as you mentioned. So I think the revenue side slippage could also be a very serious problem for state finances as you go ahead.
So will they borrow more? I want to come to the bond markets. I already had a discussion with Rahul, and he was worrying about how the SDL, the rates, yields on state loans has, the spread over the central government bonds has increased so much. And, corporates have to borrow above the state loan rate. So cost of capital increases for all of us. Are you expecting that total SDL issuance, state bond issuance, will be higher this year than what states are projecting?
Yes. Although we're not looking at net borrowing to be more than 9.4 trillion, but on the gross basis, we're looking at more than 13.5%, which was a number pre these election outcomes. So it could actually have an upside in terms of borrowing. We were looking at around 3.1% FD for FY27 for state aggregate. But I think there could be a risk of around 20% upside on this.
Madhavi, I'll come to you now. Let me get the market angle very quickly. Rahul, see, 9.1 trillion of new bonds is what the total state borrowing is coming to. Now, I have a Citi report which says that they won't be surprised if it becomes 13 trillion because revenue shortfall is severe. Excise duty cuts have been announced. So, first of all, how will even this 9.1 trillion impact bond yields? And if it were higher, what will be the upshot?
So, Lata, thank you for calling us. So, we have seen 9.1 trillion is the net supply by the state governments on their borrowing side. And apart from that, they have to fund the redemptions, which is close to 4 lakh crores. So 9.1 plus 4 is 13 lakh crores. There is possibility that the fiscal deficit actually for the states will be close to 3.1, 3.15% because of lower growth and lower revenue against their expectations or against their projections. So we could actually see state borrowings going to 14.2 to 14.5 trillion INR. Obviously, we are struggling with the central government borrowing this year, gross supply at 17 trillion INR and states at 14 trillion. So total 31 trillion INR is not a small number. And we are seeing some strains that, or some signs that the state governments for the benchmark securities for against 5-year and 10-year, their spreads are actually close to 70, 75 basis points, which is historically at a high level if you see this quarter. This quarter, the present quarter or the first quarter of the financial year is the lowest supply for state development loans. And if in this quarter, the 10-year, 5-year spreads, respective tenor spreads are at 70, 75 basis points, this does not augur well. And you could actually see that spreads moving potentially higher to 90 to 100 basis points over a period of time.
Okay.
But yeah, we have seen like say 5-year GOI trading at 6.7%, and yesterday RBI auctioned state development loans for 5-year at 7.4%. So 70-75 basis points historically in the first quarter of the financial year is actually a higher spread, and we won't be surprised if the spreads actually widen to 90 to 100 basis points.
Okay.
We also have to keep in mind that 90% of the fiscal deficit for the states is funded by market borrowing, whereas for central it's in the range of 70 to 72%.
Yeah.
So there could be a change if things go typically potentially disturbing the market normalcy. Then we could see that states may get opportunity to lower their market borrowing as part of the total funding of fiscal deficit. But yeah, we'll have to see around that.
Okay.
But for that to happen, we think that spreads first will go up and then probably corrective measures.
Okay.
May be
Okay. I just want our viewers to understand that, somebody promising freebies in West Bengal or promising freebies in Bihar or Tamil Nadu is not something that is not affecting us. It is going to make the general cost of borrowing higher for all of us. All NBFCs will have to pay more than state government loans, and we borrow from NBFCs. So our cost of borrowing is rising. Let that sink in. Mr. Madhavan, let me come to you now for the developmental question. I want to tell you that PRS represents legislative research. They do impact of parliamentary acts on us, on you and me, and on the economy. Mr. Madhavan, do you think, therefore, the quality of state expenditure will decline? They will have, more committed to salaries and to freebies, and very little will be available for, say, bridges and railways and metros, for which we Mumbaikars at least are thirsting.
Yes, but we have to actually look at these things with a bit of caution. Firstly, election promises are not always implemented. So it may not be as bad as what it looks like.
Okay.
Second, they are sometimes implemented. For example, if you look at what happened in Karnataka over the last few years, Karnataka has moved from a revenue surplus state to a revenue deficit state in the last few years after they did the 5 promises, 5 guarantees they implemented. So it does have had some impact. I would actually caution on making serious conclusions about increasing borrowings and increasing fiscal deficit and looking at the overestimate of states for their own revenue. So we have looked at data for the last 8 to 10 years. And on average, if you look at the revenue receipts that states project in their budget estimate to what happens actually, and this is a 10-year data, they typically overestimate by 10%.
Ooh.
And then what happens? So they overestimate revenue receipts by 10% and therefore have budgeted accordingly. There is a hard constraint on fiscal deficit at 3%. So they cannot spend more. So what happens is they end up squeezing the revenue expenditure because they can't do much about the revenue expenditure. I'll just explain that. So they end up squeezing the capital expenditure. The reason they can't do much about revenue expenditure is about 62% of that last year's budget. I mean, I'm looking at 25-26 because we don't have the 26-27 budgets for all states yet, especially the ones which have gone for elections. So 25-26, if you look at all states, 53% of the total revenue receipts went towards salaries, pensions, and interest. So that is committed. You can't do anything about it. A further 9% went towards subsidies, which theoretically you can do something about, but politically it's very difficult. So you're actually left with only 38% of the budget of the revenue receipts to actually do anything, to do everything else.
Okay.
And that will also get squeezed if you increase subsidies or cash transfers or whatever you may call.
So chances of
freebies is a word
chances of state capex going down drastically is very high at this point in time.
Yeah, the risk is of capex going down.
Okay.
Because that's the only thing that they can cut. They can't cut revenue expenditure. Much of it is committed. So if you get less receipts, and you can't actually borrow more.
Okay.
State governments need to get the permission of central government for borrowing if they have any loans from the central government.
Fair point. Okay. So what you're saying is that this is a devil and the deep sea choice. On the one hand, states may have to borrow more purely for freebie expenditure. On the other hand, their developmental expenditure may also decline. Their Capex, not a very good choice. But what are the options? Will Capex increase because of central transfers under the interest-free scheme? All those questions after the break. Welcome back. We've been discussing the fiscal impact of election promises, and my guests, Madhavi Arora, M.R. Madhavan and Rahul Goswami, have been pointing out to two important ramifications. Fiscal deficit of states are likely to rise. Their ability to spend on Capex is likely to shrink, and much more important, the extent to which the spread of state bond yields over central government bond yields is likely to rise. This will have two implications. First of all institutions will prefer to buy state loans because they are also semi-sovereigns. So actually the central government yields also will rise because of less demand. And the bigger impact is that market yields will rise and all of us will have to borrow more expensively, banks and NBFCs included. I'm continuing the conversation with Madhavi, Rahul and Mr. Madhavan. Gentlemen and Madhavi, thank you for your patience. Madhavi, will there be an impact on overall government Capex this year? The central government is also going to be constrained by higher subsidy bill and likely lower revenues because GVA or EBITDA of all companies is likely to be hit. And of course, there is a chance that the burden is going to be higher for the centre. So Capex of centre and states will be lower this year. Should we be prepared for it?
Lata, to some extent, there's been an improvement in states' Capex, which is largely led by those state loans which were given by the centre. Just for that, I think what we realize is the overall public sector Capex story actually had peaked in FY24, which is reached close to 6%. It includes PSU as well. Since then, it has been declining, and the new normal for centre plus state Capex is now somewhere close to 5%. That may not necessarily change. In fact, could only be going down at the margin. But I'll just add one interesting point to the discussion with regard to certain states which were recently, which we recently underwent elections, especially states like MP and Orissa. Both of these states, which were NDA-led state, actually had seen the quality of spend improve in 2 years post the election. So we actually saw the revenue expenditure to capital expenditure ratio is actually improving, even though Capex was largely sideways. So that's an interesting point to also note that certain states are, also incrementally spending a bit decently well into capital expenditure. But yes, I think to a large extent, the public sector Capex story had already peaked in 2024-25, and since then we actually are seeing a tapering off of that number because of the revenue constraint, both from the center and the states side. And if there was no the interest-free transfers of loans from center to states, the Capex of states would have been actually much lower. But that said, these so-called states which were basically won on account of freebie economics, as Madhavan also was mentioning, actually had not necessarily spent fully in terms of their Capex, and the Capex have also been relatively decent compared to what was feared. And their recos have improved.
That's very important.
Capex ratio.
That's very important, Madhavi, what you're saying, that we shouldn't overstate the problem, because this interest-free transfer to the states has ensured that state Capex is not severely hampered. Madhavan, would you agree that although that comes tied to Nal Se Jal or to some projects like that, overall state Capex has been supported by this central transfer?
Of course, there has been a huge increase thanks to this SASCI loans from states, and in fact, I'm looking at the numbers. Actually, it's about 0.3% of GDP that it has, 0.3 to 0.4% of GDP has been funded through these transfers. So it's not a inconsequential number, and states do themselves spend some. And in fact, interesting that Madhavi talked about Orissa. Some of these states, especially Orissa, Jharkhand, and Chhattisgarh, have had a bonanza in the last few years thanks to the mining money. So the revenue receipts has gone up significantly. And if you see, these are states which have a significant revenue surplus. Orissa is showing a revenue surplus of close to 3% and a fiscal deficit of over 2%. So it's actually having a Capex of more than 5% of GDP. So that's the sort of numbers that you are seeing in some of these states.
Well, that's important that there have been some, other relieving factors that has improved developmental expenditure of the states as well. It is not all gloom and doom, and the freebies also are not implemented as promised. But Rahul, last word to you. Do you think that this entire borrowing program of states will even pass through? Given the mood of the bond markets, at the moment, it doesn't seem to have much of an appetite for government bonds. Even last year, the Reserve Bank had to do, some 6 lakh crore of OMOs to push the government borrowing, indirectly at least. Do you think, OMOs are not done for state loans, but will it have to be done?
See, at some point of time, instead of doing OMOs, I think government may allow states to access other sources of funds instead of reducing the reliance on market borrowing from 90% to 85% to 80%. As far as otherwise the sovereign bond demand is concerned, this year much better demand from bank we witnessed last year. Last year with RBI support only, mainly we saw that the inflation being so benign, RBI was in a position to support through the OMO bond purchases. But this year that may not be the case. But RBI is making sure that liquidity remains abundant. We have already close to 4.25 lakh crores of surplus liquidity in the system. Plus, we are expecting 2.8 to 3 lakh crores of RBI dividend to come in by end of May. So you'll have core liquidity, which is close to 1.75%, close to 2% of NDTL. So liquidity-wise, we'll be comfortable, and we think that RBI looks a very difficult situation for RBI to be able to do OMO for state development loans. As we discussed yesterday also, Lata, that the number of securities are so huge for state borrowing, for state loans, that it is very difficult to implement the OMO operation for a state. But yeah, RBI may find ways to support the state government borrowings if the case requires or if the situation becomes so.
Okay. But would you say, just one number I want from you, Rahul. At the moment, Government of India 10-year bonds itself are at 7%. And if the spread of the state government bond is 75 basis as of now, The states are borrowing at 7.75. You're saying it can even go to 7.9. If that is the case, then NBFC costs are going to rise, right? CP, CD and NBFC costs will rise this year.
See, CDs, we are seeing that 1 year CD for banks continues to trade around in the range of 730, 740 range. That's the last primary issuance that happened for a premium state-owned bank. And we have seen if the CD itself is trading at 7.3, 7.4 for 1 year, NBFC obviously has to be, basically an investor will ask premium over that. So 40 to 50 basis point is a fair premium if you are talking to NBFC for 2 year, 3 years security.
Okay, fair enough. We are talking about a shorter tenor, so it will not be perhaps 7.9, but there is this upward bias that may come into the
bias because of the shortage.
Out of time, Rahul. Out of time, Rahul.
Okay.
We have to wind up. Thank you very much, Madhavi, Rahul, and Madhavan, for adding to our understanding of what these poll promises mean to state finances and to our own borrowing or market borrowing. At least the likelihood of a re-rating of India because of fiscal discipline now looks pushed back because of the state finances. That's it on this edition of Ingenomics. Thanks for watching.
Hello and welcome to News Center. I am Ashmit Kumar. Now, Prime Minister Modi has appealed for restraint on fuel usage, on foreign travel, on gold buying as the Middle East crisis continues to rattle global oil markets. Now, speaking at a rally in Hyderabad yesterday, Prime Minister Narendra Modi highlighted that curbing dependence on imported fuel was now a national necessity. He urged that people living in metro cities should opt for carpooling and prioritize traveling by metro trains. He also recommended resorting to COVID-time measures such as work from home and virtual meetings. Remember, oil imports account for close to 90% of India's domestic needs. India has led to a multi-billion-dollar spike in its import bill. That's the Iran crisis causing that spike. The Prime Minister also stressed on reducing non-essential gold purchases for a year to reduce the pressure on foreign exchange outflows. He also appealed to citizens to avoid non-essential foreign trips for at least a year to help conserve foreign exchange. Instead, the Prime Minister urged citizens to promote domestic tourism. He urged farmers to reduce the use of chemical fertilizers by 50% and adopt solar-powered irrigation pumps instead of diesel-run systems. He also stressed the importance of reducing edible oil consumption, linking it to both national economic interests and public health. Meanwhile, sources in the government have told CNBC TV 18 that the West Asia conflict has led to households will need to share the burden of high oil prices as they flag a current account deficit as the biggest challenge.
साथियों, हमें पेट्रोल डीजल का उपयोग कम करना होगा। शहरों में जहां मेट्रो है, वहां हम तय करें कि हम मेट्रो का ही उपयोग करेंगे। ज्यादा से ज्यादा मेट्रो में ही जाएंगे। अगर कार में ही जाना जरूरी है, तो फिर कार पूल करने का प्रयास करें और भी लोगों को साथ बिठा ले। अगर हमें कहीं सामान भेजना हो तो कोशिश करनी है कि वह ज्यादा से ज्यादा रेलवे गुड्स के जो ट्रेन होती है, रेलवे की सर्विसेज से भेजे। एक जमाना था जब संकट आता था, कोई युद्ध होता था, तो लोग देश हित में सोना दान दे देते थे। आज दान की जरूरत नहीं है, लेकिन देश हित में हमको ये तय करना पड़ेगा कि साल भर तक घर में कोई भी फंक्शन हो, कोई भी कार्यक्रम हो, हम सोने के गहने नहीं खरीदेंगे, सोना नहीं खरीदेंगे। विदेशी मुद्रा बचाने के लिए हमारी देशभक्ति हमें चुनौती दे रही है और हमें इस चुनौती को स्वीकार करते हुए विदेशी मुद्रा को बचाना होगा।
Government just reduced some 10 rupees on both about a month ago on excise on MS and HSD, which drilled a big hole of 1,60,000 crores in its budget revenue. Now that is something which government has borne on its own budget just to prevent this shock. So government uses all sorts of tools. Many countries have done rationing. They have done different kind of thing. India has been a kind of again a oasis of comfort. No rationing has been done. Albeit government has appealed to citizens not to panic, and we are doing that same today. There is no need to panic. We have sufficient supplies. There is no rationing in place. It's not going to happen. We have 60 days of stock. So same thing which we have been repeating over the last 60 days, they hold true even today.
We need to get away from this obsession of import of gold. We need to lower our energy costs. We need to move more faster towards renewable energy in our industry. And importantly, we need to vote with our feet within our country. Spend more here, put more Capex here. We need to invest more. This is not the moment to shy away. This is the moment to invest, double down in our own country, because the underlying growth is there. This is a continent of consumers, large young population wanting more products and more services, and let's give them more from India.
It is call to action. It will make some difference, but I'm not very sure that it is a needle-moving thing. It is going to help India to escape. It will complement government's efforts. I think how the consumption comes down is by increasing the prices. I have a feeling if you want to curtail the import, you have to enhance the duty.
Well, joining us now to discuss this further is with us Mr. R. Chandrasekhar, former NASSCOM President and former Telecom Secretary. Also with us, Mr. Ravi Gosain, the President of the Indian Association of Tour Operators. And also, Mr. Narendra Taneja, Energy Expert. Mr. Taneja, coming to you. I just want to get a sense, given the commentary that we've seen since morning, coming in from both the government leaders as well as the private sector, I want to get a sense from you. How much will these initiatives, which of course are voluntary at this stage, there's no mandate that has been issued by the government, how much will it move the needle in terms of, one, reducing energy consumption, and two, reducing the Forex outgo?
Well, I think it's important to note that the Prime Minister's appeal has come on the eve of his visit to Abu Dhabi, in the United Arab Emirates, which, as you know, is a significant exporter of energy and also, oil and gas to India. And the entire region, if you look at very carefully, UAE is one country we have got very, very close ties with. So his visit is coming at the time when, the entire region is still on the boil and the energy prices are going up. So there is a connect. There is a message, of course, for domestic audience, but there is also a message, for the countries in that region, particularly the United Arab Emirates. That's, I think, very important to notice. Second, I don't really think we need to panic, but the important thing is that so far the government has shielded the ordinary consumer, the industrial consumer, to the extent possible. The result is that look in our neighborhood, the West in Pakistan, Bangladesh, or many other countries in the Asian region, prices have gone up of petroleum products, fertilizer, and just the list just goes on. While here the government has shielded to the extent possible. Now, however, when you look at Government of India's company like Indian Oil, Bharat Petroleum, Hindustan Petroleum, for that matter, the private sector company engaged in this business, they are feeling the heat, most particularly the Government of India companies. So there are two options. You rationalize taxes to the extent you can. However, now time has come probably to pass on the burden to the consumers, both the industrial consumer, commercial consumer, and also domestic consumer. So I think the Prime Minister is prepared for that. Look, that time has come when we're going to pass on the burden. We have shielded the consumer to the extent possible, shielded economy to the extent possible. But now beyond this, the economy can't afford, the government can't afford. That's number one. Number two is, at the same time, he has talked about, to conserve energy, to go for carpooling and all that in order to create this thing. My sense is that, like many other countries, India is also preparing for long haul. Probably the analysis is that this is not going to end anytime soon. And if the war comes to an end, the gun goes silent, the impact and the effect is going to last for several months to come. So the Prime Minister has also prepared the Indian consumer and Indian economy for that this is going to be long run, long haul. Be prepared, even if the war ends, the impact and the effect is going to be long lasting. I think so. It's a multiple kind of targets that Prime Minister, has basically, gone to, and at the same time prepare. But as the Petroleum Secretary, I personally also don't think we need to panic. But petrol, diesel prices and LPG prices are going to go up, and also fertilizer. That is a highly sensitive commodity, but government will have to take a view on that too.
That's an important clarification, that there is no other way except for this burden to be passed on to the consumer. So the next logical question, Mr. Taneja, that many are asking is that, given that sources within the government are indicating that the losses on the books of OMCs for just the first quarter of FY27 is likely to be north of 1 lakh crore rupees, if that's the burden that they're looking at, what is the quantum of hikes that we can expect in the days, weeks to come?
Well, there are two ways to look at it. One was, you can't pass on the burden, the entirely in one go, but it will depend on the overall situation. But let's not forget the mandate that these companies have, most particularly like Indian Oil, Bharat Petroleum, Hindustan Petroleum, or for that matter, private sector refiners and distributors. The mandate is to go out around the world, secure oil, bring that oil, ship that oil, process it, refine it, distribute. It's a massive, massive task. And they are dealing at the time when practically all other countries, most particularly developed countries, are going to the same sources and ready to offer whatever price they want in order to secure oil supply. So our company has to compete with them, compete with like Japan, with China, with the West Europeans and other, stronger economy. So how do you do that if your own balance sheet is weak? If your financial situation is weak? I mean, we know it. I'm sure all the oil exporters, they also know that. So how are you going to get credit? How, for instance, you're going to say, all right, look, please prioritize us because we are the third largest buyer of oil in the world. All this is not going to cut much ice unless you, the buyer, these companies I'm referring to, are financially strong. So I think it's important, one, how do you make sure that these companies remain strong? And that's by passing on the burden, but at the same time managing, because since oil is a political commodity the world over, more so in our country, that you do it in such a way that people don't come out or hit the street. At the same time, these companies' financial health is protected. If these companies are not there in a good form, in a good financial shape, how are they going to basically go out and secure oil for the Indian economy, for the Indian consumer?
Right, so balancing act required in terms of the quantum of the hike. We, of course, can only speculate at this point. Moving forward, Mr. Chandrasekhar, let me come to you. One of the appeals that was made by the Prime Minister was also for work from home. He drew the corollary to, of course, what we'd seen a few years back at the time of the pandemic when there, of course, a work from home had been introduced. We saw a statement from NASSCOM indicating that, look, there is already remote hybrid models of work being deployed by the IT industry. The question I want to ask is there more that's required, or is the industry already ahead of the curve?
Well, I think the industry has, in fact, post-COVID, continued with its hybrid model. And that has been optimized based on the roles which people play, how much, what kind of combination is required to ensure that the clients get continued and uninterrupted services. So a lot of optimization is already there based on all of these factors. And the room for further maneuver is a little limited. Perhaps during a crisis period, some little greater emphasis on work from home might be possible. But I think given that it's already very much in place, that is a little limited at this point. However, I think there are a lot of other things which the PM has said, which I think are extremely important. And in my view, it would be a mistake to think of this only in terms of energy and the costs and how do you reduce that. It's obviously the most important and the most visible thing right now. But there were several other things which the PM said, which indicate that there's a recognition that the crisis is not going to go away, as the previous speaker had said, and that measures are required. And as the saying goes, never let a good crisis go waste. So what the PM also talked about was, things which have not attracted as much attention about, for example, using less of fertilizers, buying more of domestically manufactured products. And if we really want to use this crisis, I think this is a great opportunity to really do, to bring in reforms which actually push this agenda. For example, the agenda of precision agriculture, the agenda of encouraging domestic manufacturing, encouraging greater competition, greater foreign investment, and greater access to external technology, but unbridled competition at home. So there are a lot of things. And while the short term will naturally focus on the energy and how much more you can push the work from home agenda, I think the other things are slightly longer term, but equally important and probably even more important in the long term. We should take the lesson from 1991, how the crisis was used for a tremendous boost in the longer term.
Sure. Mr. Gusain, coming to you again, one of the aspects which again was a part of the Prime Minister's comprehensive appeal was to avoid unnecessary leisure travel overseas. That was his appeal. He said that why don't you travel within the country, travel domestically. Given that it is voluntary, again, there is no mandate at this point. Mr. Gusain, what is the impact that you're expecting, if any at all? And do you expect any pain, especially as far as airlines and their international operations are concerned?
See, I think in any case, we must understand that this appeal from Prime Minister is for the larger national interest. This year, we already see a hike in prices when you go overseas, whether it's airfare, hotels, or local transport, because fuels are increased in everywhere outside India. So prices are already, when we see it's 30 to 40% high than compared to last year. So people are already, we see 10 to 15% of slowdown compared to last year. So I think now people will explore destination within India. And also what I suggest that government should also look into the factor that inbound tourism can be promoted so we can have some kind of Forex inflow to country.
But Mr. Gusain, are you expecting any immediate impact, at least in the near future, if it comes to bookings of tourists going overseas, or at least bookings on airline tickets, and any pain that the airlines could see in the near term in the couple of next quarters?
So definitely we will see that in any case, like I said, airfares are quite high compared to what it used to be. Like prices are almost 50 to 60% higher. And people are more concerned about the price hikes and all. They are also checking if they can delay their travel. So it was before the Prime Minister made any appeal. So in any case, this appeal will also have impact because as a responsible citizen, people will also think about it. So I think there will be some reduction in travel.
There is some reduction in travel expected. Mr. Chandrasekhar, let me come back to you. One big thrust of the government clearly is to check the Forex outflow. That is something that the government is concerned. Even sources within the government telling us is that the current account deficit is a big pain point going forward, at least in the near term. In terms of big imports, of course, the Prime Minister's appeal coming in for gold, but the second most imported item, not item per se, but rather the sectoral import that we'd seen in FY26 was electronics. So that's electronics components. We're talking about chips, semiconductors. It added up to over $116 billion. Is there some kind of restraint exercise required even as far as the electronic sector is concerned? Mind you, this feeds the big manufacturing ecosystem that we're trying to grow here in the country.
So, Ashmit, I think that, the electronics import bill is very high. There's no doubt about it. And these projections have been around for well over a decade that it's going to keep rising. And it's very difficult to control the consumption because it is a component, it's an input into many products, and it has a lot of knock-on effects on the rest of the economy. The more appropriate way to deal with that is to increase the level of domestic manufacturing. And I think the government has actually taken a lot of steps, whether it is for electronic components or whether it is for semiconductors or whether it is for mobile phones. So there are a lot of measures that have been taken. However, I think there is a lot more which can be done because at the end of the day, it's also about making sure that the electronic manufacturing sector within the country is competitive. And that requires many different steps, encouraging manufacturing, making sure that it is competitive. There are a lot of factors in the domestic economy which impact electronic manufacturing. These have been talked about in great detail. But in the short term, there may even be a need to provide a certain measure of protection to the electronic manufacturing industry while encouraging both competition as well as import of technology rather than import of the products. And over a period of time, I think with a combination of these measures, we have PLI, which has been in place for some time now. And through a combination of these measures, it should be possible to enhance our domestic manufacturing. There is no other choice in the long run but to increase our domestic capability, our domestic manufacturing and domestic technologies in all of these areas. So I think that is important. So I think rather than looking at how do we reduce the consumption, we look at how do we replace imports by domestically manufactured electronic products and electronic components, and how do we strengthen the domestic industry. And I think there are a lot of reports in the past, in the present, in the recent past, which outline a number of measures by which that can be done. And we have to also appreciate the fact that increasingly in today's geopolitics, technology is being weaponized. So in any case, from the geopolitical environment, achieving a measure of technology independence or at least technology self-resilience is necessary. And I think this is a great opportunity to see what we can do more on that front in addition to what's already being done.
Right, Mr. Chandrasekhar, do stay on with us. We're just diving into a very short break. We'll come back and continue this conversation on the Prime Minister's appeal for austerity on the other side. Welcome back. We have with us Mr. R. Chandrasekhar, Mr. Ravi Gosain, as well as Mr. Narendra Taneja. Mr. Taneja, again, coming to you, given, again, we're talking in the near term, in the next days, weeks to come. Give us a sense, now that this conversation is being had in public, is there a concern that perhaps some of these conversations may lead to panic buying, may lead to hoarding, may lead to strain on the existing available inventories of some of these OMCs?
Well, the challenge is there, let's face it. I mean, in terms of, there is a kind of massive disruption in oil supply. There is no doubt about it. People keep on talking about 20% oil flows through the Strait of Hormuz. But when it comes to economies like India, or for that matter, Asian economy, it's much more than 20%, as we all know. The same goes for LNG and even fertilizer. 30% fertilizer flows through the Strait of Hormuz. But in case of countries like, our part of the world, it's actually more than 30%. And at the same time, when it comes to oil from the Middle East, there the biggest challenge is, of course, the prices. I mean, when you look at the computer screen or CNBC or any other platform, you see the oil is $110 per barrel. But when you look at the buying basket price for India is much higher. China is the same story. Japan is actually much, much higher. So I think the concern is, on the one hand, is of course the price, the economics, and at the same time securing it. Because if you don't bring oil from the Middle East, from Russia, it can take 30 days. From America, it takes almost 55 days. From Latin America, it takes almost 53 days. So it's not only the economics, it's the economics of shipping, economics of insurance, and so many other economics. And more or less, the other problem is that all these countries know that, look, you are facing this disruption. So the negotiations, get tougher. So therefore, there are challenges as far as that is concerned. However, I think it will depend on two things. First of all, communication on the part of the federal central government in terms of how do you handle in perception, communication, and so on and so forth. But more importantly, it will depend on the quality of governance in various states across the country. I mean, the states will have actually take upon themselves to make sure there is no hoarding or there is no panic or people are not basically, taking advantage of it, which in most cases in an economy like us, actually falls on the poorest sections of the society. So therefore, I think is the Prime Minister made his appeal. I hope that the Ministry of Home is working on it. I hope the state governments are working on it, making sure that there is no panic. And if there is any panic, there is no hoarding. It's not easy. We saw that in case of LPG 4 or 5 weeks ago, but that was handled well. But right now, I think with this and austerity measures and everything, is on not only economics of commodities, is the international diplomacy, how do we handle it? And at the same time, it depends on the quality of governance. As we know, we are a kind of country, country where the quality of governance in some states, for instance, in the south, is better than the quality of governance in some other states, in other parts of the country. So the federal government, central government will have to work on it. In situation like this, when you talk of austerity, when you talk of shortages, when you talk of disruption in a commodity without which nothing moves, that is oil, I think the quality of governance, especially at the level of states and district, becomes the most important part.
Sure. Mr. Chandrasekhar, coming to you again, given the fact that we have no light at the end of the tunnel, we've seen again commentary coming in from Washington, from Tehran, no firm commitments with respect to the resolution of this issue. Given the strain that that's causing on the balance sheets, on the fiscal front for countries like India, is it only a question of not if, but rather when we'll begin to see some form of austerity measures being mandated from the government? Is that what your anticipation is? So far, we've seen other countries introduce measures, whether it's fuel rationing or fuel caps. Do you see that expected? Do you expect that in the days, weeks to come?
Well, as we just heard from the other two gentlemen on the panel, Mr. Taneja and Mr. Gosain, the price impact of the war on travel costs, on fuel costs, and the likely increases, they themselves act as a check to a certain extent. Now, that's a call which the government will have to take, whether that moderation is sufficient or further stringent restrictions in terms of controlling the quantum of consumption, whether at an individual level or at a sectoral level. All that is something which the government will need to weigh. And depending on, the progression of the war and how it goes, and if by chance, we all hope so, but if peace is achieved, then how much time it will take to restore the status quo that existed previously. So based on all of these measures, the government will have to decide how much of price moderation will suffice, how much of more stringent rationing would suffice. But I would come back to the point that, this is also a time to lay the foundations for a longer term sustained response to this kind of a situation, because geopolitics has changed in a way that it's not going to go back to where it was. And the kind of threats to sovereignty are rising. The denial of whether it is products like petroleum or technologies, in areas like electronics, in AI, in semiconductors. In a lot of these areas, I think we really have a lot of things to ponder over. So this is the time to lay some foundations for the longer term. The Prime Minister specifically mentioned about reducing the use of fertilizers. That requires both, of course, the manufacturing capacity is already there. But if you want to moderate it, then you need things like precision agriculture, and you need the policy which actually subsidizes the fertilizer and indirectly encourages greater and less restrained use of fertilizers. So all of these factors will have to be actually brought together and addressed in a carefully considered manner, considering not the short term, but the medium and the longer term.
Right, Mr. Chandrasekhar, Mr. Taneja, Mr. Gusain, thank you so much for joining us and sharing your insights. So clearly an appeal being made, but the government also careful in pointing out that there is no mandate, there is no rationing of fuel as of right now, no restrictions as of right now. We'll, of course, have to see whether that continues going forward in the days, weeks to come. Thank you once again to all of our panelists for joining us. And with that, it's a wrap on this edition of News Center. More news and updates will continue right here.
Hello and welcome to this special Markets Forward. For the next 30 minutes, we will focus on implications of Prime Minister Narendra Modi's appeal to citizens as the Iran war threatens to reshape India's growth outlook. Well, in a rare and direct message, the Prime Minister urged Indians to take 5 key steps: reduce unnecessary fuel consumption, postpone non-essential gold purchases for a year, avoid international travel, cut import dependence, essentially save on foreign exchange, cut back on edible oil usage as well. The message is clear. India must prepare for what might be a prolonged period of elevated energy prices, which, of course, will result in external vulnerability. Sources tell CNBC TV 18 that unlike COVID, the conflict in West Asia, of course, it poses a bigger threat to India's current account deficit. It's not so much about growth, but the CAD, which perhaps is on the minds of policymakers as well. India imports over 85% of its crude oil needs. The big question now, can India limit the impact if the conflict drags on? We have a panel of experts joining us in just a bit from now, but my colleague Ritu is here with me to take you through the next 30 minutes on the program. Ritu, good afternoon. The only talking point today all day, starting 8 in the morning, was what will follow the Prime Minister's appeal. Will it be limited to appeal, or will it be actually followed by measures? And you have if I can call it a scenario analysis of what perhaps is possible. Options. Take it away.
Hi, Prashant. Well, yes, that's been the big question in the policy and market circles. Is this going to be a precursor to formal steps to manage dollar outflows? Now, just look at the 4 things that the Prime Minister brought up: petrol and diesel, gold, edible oil and fertilizers. Just put these 4 together and India imported more than $240 billion worth of these last year. Every rupee cent importing these has put pressure on trade deficit and the rupee, which is very real. Now, we already have a playbook from the 2013 taper tantrum. So let's look at some of the potential measures that could possibly be on the table. First is gold mobilization. The idea is to really bring that idle household gold that's sitting in lockers and in banks into the formal system by easing the hurdles. Second, the LRS scheme temporarily tighten how much money Indians can send abroad every year for things like foreign holidays, for instance, which the Prime Minister spoke about, and that keeps more dollars within the country. Third, a special NRI deposit scheme, something that India has used before through the FCNRB deposit. Before that, the resurgent India bonds to attract foreign flows into India. And fourth, make Indian government bonds much more attractive to foreign investors by restoring a lower tax rate. Remember, we had a concessional 5% tax rate, which expired in 2023. Now it's back to 20%. So will that be relooked at? For now, this is just an appeal from the Prime Minister. But of course, markets are going to be watching for whether this follows through into policy action in the coming weeks and days.
Okay. All right. Ritu, thanks very much for that. Let's bring in our panel now to look at some of this stuff, right? And some of this stuff in greater detail. So we have Sameer Narang, who's with us. And he's, of course, with ICICI Bank. Sanjay Parekh is founder and chief executive officer at Soham Asset Managers. Chandresh Jain looks at rates and foreign exchange at BNP Paribas. Gentlemen, thanks very much, all 3 of you. Welcome to the program. Let's just do one quick round with all 3. Sameer, you think the appeal is a precursor to hard steps?
Well, Prashant, if oil prices remain at current levels or even go up, then we would have to look at some measures of, containing our current account deficit. As you pointed out, it is likely to go up materially if oil prices remain above $100 or even go higher. So we would require some measures to restrict our imports in interest of the broader macroeconomic stability.
Sameer, that's a yes?
Yes.
Okay, and we'll get to what specifically in a bit. Sanjay, what's your sense?
Need to increase petrol diesel prices, and it should be done because ultimately anyway it will show up in interest rates, and the cost of capital going up is far more expensive even for the government, who is the largest borrower. So it doesn't throw a good signal when 10-year is so firm and can go up further. So while it's very difficult, even if we take $30-40 impact on 5 million barrels a day, somebody has to pay for it. And I think, to curtail demand, we need to increase prices. And it will be a bit inflationary, but we need to do that.
Yeah. Actually, I was saying in the morning, it was surprising it's not happened so far. They've been kind of holding back maybe elections, but it's been a few days since the elections also finished. Chandresh, what's your sense? First cut, should we expect measures?
I think the measures should come definitely, but I'm not sure how much they will increase the petrol prices locally. Because if you start doing that, then it will increase inflation on a whole basket. And probably India doesn't want to do that. So ideally what they should do is that they increase the petrol prices slightly, but at the same time, government provides some kind of a fiscal support for the people.
Sameer, very briefly, we're in a very different position on the macro front compared to what we were during the taper tantrum, including the kind of reserves that we hold. which of these various measures that are on the table, from gold mobilization to tax relief to LRS remittance cuts or whatnot, do you think will be most effective in the current environment?
I think, a couple of measures. One would be, of course, if you recall, Ritu, in 2013, we had also put in an 80-20 scheme for gold exports and imports. So whatever we, import, 20% had to be exported. And at that point in time, we were importing around 1,000 tons prior to this measure. And once that measure was put into place, imports fell materially by, I think, around 30%. So what you should see is that some of these schemes are actually fairly effective in terms of ensuring or moderating the impact on the external account. Number two, your point that yes, we are in a very, very different position from 2013. Our current account deficits were consistently, notching higher, led by higher imports because of, the Capex boom that was, the power Capex boom that was undergoing in the country, as well as the fact that we were importing a lot more of gold. This time around, the starting point on inflation is very low, unlike around 10% in the previous cycle in 2013. We are starting at 2%. Our current account deficit has been around 1%, barring the Russia-Ukraine war year when it was around 2%. So, in essence, we are starting at a very good position. However, there is no room to be complacent. It's best that we restrict, our external account or the current account deficit, because capital inflows into the country over the last 2 years have been fairly muted. We have seen a BOP deficit over the last 2 years, and this year perhaps also will be third consecutive year of a BOP deficit. So it definitely requires some steps to restrict it. But in general, the macroeconomic backdrop is fairly comfortable and favorable over the medium term.
So Samir, on gold, what is, for oil, it's fairly straightforward price increases. On gold, what exactly is your expectation?
I think the earlier scheme, which required whatever you import, 20% of that you need to export, was fairly effective in curbing, imports. And as you can see, Prashant, in 2022-23, we were importing $35 billion, dollars worth of gold. Now it's in excess of 70. It's exactly doubled, actually, to $72 billion, more or less. So that's a sharp jump. But these measures may not come if, within a few days, the energy crisis is solved and, oil prices come down. That's the only problem. Yes.
Yeah, but that's like you don't know. It's like, I would say it's like a game without an innings. It's just sort of, endless. We don't know when this is going to come to an end, but we know it'll come to an end. But so do you. But I think 2 months have passed, and I think you perhaps need to start to act and maybe reverse it if the war ends and prices come off. Sanjay, I don't know if you have exposure to the entire gold theme here. I don't think so. But if these measures, as Samir was pointing out, were put into place, what's the impact to your mind from overall perspective, if you want to share that impact, and from a financial stock market point of view?
Yeah, so, clearly market is worried because of rupee depreciation, particularly global investors. They would certainly refrain when you see rupee depreciating. And they have this issue of, the taxes are in rupee terms where the returns are in dollar terms. So they have a ask of, taxes on dollar returns, which is a genuine ask. And I think government should consider that because ultimately we'll need capital flows, and, we are dependent on FIIs. FII still own $650 billion broadly. And from they moving out, and we are quite vulnerable, right? Even a $5 or $10 billion impact is impacting rupee in this situation. So we need to, listen to them, their concerns. At least this is a doable thing of they being taxed on dollar returns. And if rupee tomorrow appreciates, they will actually make more dollar returns, right? So it will be a level playing field. But that is what I think is possibly they should consider. But also the signaling, we can't signal as if we are into panic zone. that will give a very wrong signal to the global investors.
You talked about the FI taxation bit. I was going to come to that in a bit. But on gold, my question was on gold, what Samir was referring to. If an earlier gold scheme is reintroduced, I mean, there's some talk, maybe import duty hikes, etc. Any impact of that? We had, by the way, we'll play out sound bites of Senko, a gold company predominantly in the eastern part of the country, saying, I mean, 10-15% kind of volume hit is possible. But that's just anecdotal. Any thoughts?
Yeah, I mean, gold, honestly, I don't have a very clear view, so I'll go with Samir, on that. But anything which reduces pressure on our currency will be welcome from the market point of view.
Sanjay, just to close the loop on that, I mean, we're talking about the Prime Minister saying don't buy gold for a year at a time. At least for retail investors, it's been a well-performing asset class compared to what we've been getting from the equity markets. I mean, is that a bit at odds? And typically when you tell people not to do something, they tend to sort of move towards that.
Yeah, yes, psychologically, yes, but I just go back a little bit. Nilesh Bhai had sent an article of, how can gold be recycled, and it was a very good article, actually, very well thought as well, that can we have this gold which is lying in the lockers and a lot of it unaccounted for, and if we can have let's say 100 grams of gold, 70 grams of gold can be recycled as normal, and the 30 rupees can be given through a long-term bond. Effectively, that the investor will feel that I got my 100 rupees back, but it's a very backdated bond, which the NPV of that will certainly be very minimal. So such schemes to recycle gold, which is lying in all this locker, a lot of it unaccounted for, is an option. But I don't think government right now would act in a knee-jerk manner to do such a drastic step.
Samir, very quickly on these dollar bonds, etc., that are being, foreign depositors, for them to also come to India with banks offering attractive rates. Again, it's a very different situation. In 2013, US rates were near zero. Now they're at near 4%. I mean, the kind of rates that banks will have to offer to make these bonds attractive to these depositors, will that really be feasible in the current environment, Samir?
Ritu, I think as you gave your initial remarks, you spoke about the Resurgent India bond as well in 1998, which was issued by SBI. So you could have a situation in which we are issuing bonds instead of, commercial bonds by, banks to raise dollars from the international market instead of FCNRB deposits. So it is possible that we take the latter route. Even in 2013, there was a component of that that was raised by banks, and we could revert to that kind of route in which maybe a 5-year bond is being raised. There, given that domestic rate or 10-year is at 7%, if we offer, a dollar-denominated rate of around, a similar range for a 5 to 7-year bond, it is possible that it will find takers, given that the US 10-year is around, 4.3, 4.4%.
Will it distort, dollar borrowing for other corporates? Samir?
I think, Prashant, most of the corporates are utilizing the domestic, route for raising resources, particularly for credit, because landed price in India is cheaper right now as against abroad, because as Ritu spoke about, global rates are much higher because of the US Fed's rates where they are. So in a way, it may not distort it materially because it'll be a small dip in the ocean any which ways, and it'll be a one-time issuance just to stabilize the external account. But all of this perhaps may not be required if the crisis, comes to an early end, perhaps. So, but that is an option definitely on the table.
Yeah. Chandresh, you want to add to it? This on what the RBI may do on the monetary side?
I think the FCNR route, particularly, people are talking about, can RBI go back to those kind of measures? But you rightly pointed out that, 2013, we had US rates almost close to 0%. And market was able to leverage a lot because of low rates globally. And that's why a lot of inflows came on FCNR route that time. But now when global rates are so high, it's not easy to leverage. And therefore, even if RBI think about FCNR route or these bonds, we might not see similar kind of inflows what we saw in 2013. So probably I think RBI will refrain from these kind of measures.
Okay, Samir, on the point of what if the war gets over quickly, I had the Eurasia Group's Pramitpal Chaudhary earlier today, and I asked him, he said, well, he says at least a month. I mean, you know, every month I speak to him, he says at least a month. So, you know, it's hope that we all hope, fingers crossed, that this gets done sooner. But 2 months down and the clock is ticking as we speak. You know, take a quick break here. I just want to play out Senko Gold sound bites. We had them in the morning early on, 8:30. This is their assessment of the situation. We'll see on the other side.
Based on our Prime Minister's thought process, if there has to be certain policies that has to be done in order to discourage, import of gold, duty hikes could be a possibility. But till it is being done, these will only be, speculation whether it will happen or not.
Welcome back to this Markets Forward special. We're in conversation on the implications of the West Asia conflict on India. Let's bring in our guests again, Sanjay Parekh, Chandresh Jain, and Samir Narang still with us. Samir, most of these measures that we're talking about, LRS, remittances, what happens to gold, some of these tax-related measures, very much capital account-related measures. What about the real problem, the current account, importing as much as we're doing and exporting lesser than we should? What are some of the policy measures that could actually fix that bigger problem rather than just this band-aid sort of solution on what's happening on the capital front?
Again, very interesting question, Ritu. But as you know, energy imports in the short run are very inelastic. and in the long run, you can change behavior or, your importing requirement by building capacity. And we have done very well for instance, in renewables. Our 50% or more than 50% of the grid is on renewables, as against many other Asian countries which have relied heavily on gas-based imports. So we've not seen much shortages in terms of, power production in the country as against many other countries. But there are areas for improvement, such as electric vehicles, where our penetration levels are in single digit, around 8% of volume sales last year was in EVs, as against maybe half in a few countries and global average of 25%. So that would perhaps bring down the intensity of, petrol and diesel consumption in the country. Second bit is, for instance, in case of India, the entire rail network has moved to electric, platform now, as against heavy usage of diesel a decade back. So we made these incremental changes, because of which incrementally the carbon footprint of the country is coming down. But these are long-term policy measures. In a short span of time, we can only cut consumption by changing our mobility, as in reducing the need for maybe a little bit more of work from home or using more of public transport. But over the longer run, it is the policy directives or, more investments required in alternative fuels and capacity building there that can cut in the long run the need for more, energy imports.
The other, of course, is coal as well, right? Coal is here to stay in that sense. But we have enough of coal. Samir, on immediately in terms of what can happen, right? This LRS, you think that'll be tinkered with? Limit $250,000, maybe limits brought lower, any other kind of, measures on outbound, taking dollars out of the country?
Large number, in my opinion, to move the needle to that extent. Maybe it will help at the margin. It depends on, what level of escalation we are looking at. But I think incrementally, yes, possible that we may, tweak it a little bit for a couple of months or a couple of quarters. But that's not a very large number per se. But yes, it can help at the margin if we do tinker.
Sanjay, do you think it's a possibility? And, some of that stuff will go to what you were talking about earlier. You don't want to sound like you're panicking, right?
Absolutely. We should not, because I think we're not in such a precarious scenario. And then, at a point, let rupee find its own level. And, and we can see it even appreciating later when crude comes down, right? But only one point, because we tracked oil as an oil analyst from 95. What is painful is that we will need oil, even at the 6.5-7% growth rate. Today, we are importing 5 million barrels of oil. So we will, after 10 years also, I believe we will still need a large part of oil if we're not self-sufficient. So the learnings of this should be that we should really have policies where our oil and gas production significantly goes up. It will reflect in 2, 3, 4 years from now. But even at the cost of, all the large oil majors in India, global majors, we should have a policy which is more attractive to the oil and gas producers, That policy, I really believe, having closely watched, that it could have been a little more liberal towards the investors. And we could have attracted a lot more investors in this segment, which has not been the case.
Well, Chandresh, from an rupee support point of view, what about the low-hanging fruits, these OMCs that are biggest sort of, buyers of dollars? How much pressure is getting added because of that? And, why not a special window for them, as was done earlier?
I think that's very much possible. We are seeing that in other parts of the world as well, where a lot of these usual buyers of dollars, they have been asked to buy dollars directly from the central bank so that there's no pressure on their local currency. So India definitely could do that on that front. I think FX reserves are still sufficient, I would say. So if OMCs have to buy dollars, I think RBI can provide them easily.
Okay, it's a discussion we can go on with. We'll see what actually comes through. But as we are wrapping up, gentlemen, this is source-based information, but OMCs, the first quarter, this is what we understand, in the first quarter, OMC losses are set to wipe out the entire profit of FY26. So this is source-based information, but Q1 OMC losses are likely to be between 1 to 1.2 lakh crores. And half of the first quarter OMC losses are due to LPG. So at least in terms of, increasing prices for the consumer, perhaps that's the first measure which we're likely to see before some of the others that we discussed. Samir, thank you very much for joining us. Great getting that perspective. Sanjay, thank you very much for being here and getting that sort of detailing out. Chandresh, thank you very much for being here as well. Well, that's it from Ritu and me here on this program. Thank you very much for staying with us. More coming up on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The big stories that we're tracking for you this evening.
देश के प्रति अपने कर्तव्यों को निभाना वो भी देशभक्ति होती है.
Prime Minister Modi says India's economy faces challenges, appeals to citizens to cut fuel use, revert back to work from home, hold back on foreign holidays and buying gold for a year. Government sources say households will need to share the burden of high oil prices and flag the current account deficit as the biggest challenge. Jewellery stocks take a beating after the Prime Minister asked citizens to put off gold purchases for a year. Consumer Durable Index declines the most. On the other hand, shares of electric vehicles and green mobility companies rally after the Prime Minister urges the shift to EVs. Sharp fall on Dalal Street as the Sensex and the Nifty lose over 1%. Nearly 6 lakh crore rupees in market cap wiped out today. The rupee weakens against the dollar, breaching the 95 mark. The ceasefire between US and Iran shows signs of fraying. President Trump says Iran's response to the US peace proposal is totally unacceptable. Iran says US demands remain unreasonable. Brent crude prices breach $105 a barrel. President Trump to meet China's Xi Jinping in Beijing on Thursday. Trade, rare earth export, curbs AI to Taiwan to top the agenda. This will be the first face-to-face meeting between the two economic superpowers since the US-Iran war began. The union government notifies the new labour codes 4 months after releasing draft rules. No criteria for minimum wage, which the centre says will be notified separately. A floor wage will be fixed in consultations with state governments.
A new era of a real, secular, social justice starts now.
Tamil Nadu's new Chief Minister Vijay takes oath as MLAs along with 93 first-time legislators from his party. Vijay visits former Chief Minister Stalin at his residence, marking the first significant engagement across the political divide since the change of guard. West Bengal's new Chief Minister Suvendu Adhikari approved 6 projects in his first cabinet meeting. Transfers land to the Border Security Force for erecting a fence along with the Bangladesh border. Also approves immediate implementation of the census exercise. Well, let's go straight to the big story this evening. Now, Prime Minister Modi has appealed for restraint on fuel usage, foreign travel and gold buying as the Middle East crisis continues to rattle global oil markets. The Prime Minister was speaking at a rally in Hyderabad yesterday, and he highlighted that curbing dependence on imported fuel was now a national necessity. He urged people living in metro cities to opt for carpooling, prioritize travelling by metro trains. He also recommended resorting to COVID time measures like work from home and virtual meetings. Now, remember, oil imports account for close to 90% of India's domestic needs. This has also led to a multi-billion-dollar spike in the import bill. The Prime Minister also stressed on reducing non-essential gold purchases for a year to reduce the pressure on foreign exchange outflows. He also appealed to citizens to avoid non-essential foreign trips for at least a year to help conserve foreign exchange instead. Now, the Prime Minister urged citizens to promote domestic tourism. He also urged farmers to cut the use of chemical fertilizers by 50% and adopt solar-powered irrigation pumps instead of diesel-run systems. He also stressed the importance of reducing edible oil consumption, linking it both to national economic interests and public health. Meanwhile, sources in the government have told CNBC TV 18 the West Asia conflict will have an impact that needs to be borne by households, the government and OMCs. Now, they flag current account deficit is the biggest challenge that faces the economy, so a fuel price hike seems imminent. The quantum and the timing continue to be uncertain. Take a look.
साथियों, हमें पेट्रोल डीजल का उपयोग कम करना होगा। शहरों में जहां मेट्रो है, वहां हम तय करें कि हम मेट्रो का ही उपयोग करेंगे। ज्यादा से ज्यादा मेट्रो में ही जाएंगे। अगर कार में ही जाना जरूरी है, तो फिर कार पूल करने का प्रयास करें और भी लोगों को साथ बिठा लें। अगर हमें कहीं सामान भेजना हो, तो कोशिश करनी है कि वह ज्यादा से ज्यादा रेलवे गुड्स के जो ट्रेन होती है, रेलवे की सर्विसेज से भेजे। एक जमाना था जब संकट आता था, कोई युद्ध होता था, तो लोग देश हित में सोना दान दे देते थे। आज दान की जरूरत नहीं है, लेकिन देश हित में हमको ये तय करना पड़ेगा कि साल भर तक घर में कोई भी फंक्शन हो, कोई भी कार्यक्रम हो, हम सोने के गहने नहीं खरीदेंगे, सोना नहीं खरीदेंगे। विदेशी मुद्रा बचाने के लिए हमारी देशभक्ति हमें चुनौती दे रही है और हमें इस चुनौती को स्वीकार करते हुए विदेशी मुद्रा को बचाना होगा।
It's very important that we as citizens also play our role in this entire effort. We as citizens, as our Prime Minister has asked all of us to, can reduce our expenditure on everything that requires foreign exchange to be spent. So I'll request all of you to take cognizance of Honorable Prime Minister's call to the nation, and within your own means, within your own enterprises, within your own businesses, try to do whatever best you can.
पेट्रोल डीजल का तो देश के इंटरेस्ट में प्रधानमंत्री जी ने अपील किया है, आप सब लोगों ने सहयोग करना चाहिए। जैसे अभी बहुत लोग अपने एक आदमी गाड़ी में घूमता है, उसके बजाय अभी ट्रांसपोर्ट सिस्टम में पब्लिक ट्रांसपोर्ट अच्छा करके हम गाड़ी में बजाय पब्लिक ट्रांसपोर्ट का यूज करें, मेट्रो का यूज करें। ये भाव प्रधानमंत्री जी का है, देश के इंटरेस्ट में उन्होंने बात की, आप जरूर उसको अनुरोध करिए।
The IMF has noted that supply shock triggered by the Middle East crisis poses a serious threat to the global economy, even if the conflict were to end tomorrow. The lasting impact of the damage to infrastructure and supply disruptions will continue to impose high costs for quite some time to come. Every additional day of disruption can potentially translate into significant economic costs for the world economy, with cascading effects on energy supply, fertilizers, food security, and global prices. Amidst such unsettled and turbulent global backdrop, India stands out as a clear outlier of resilience and renewal.
These are all very, very dramatic appeals, if not a directive. If the Prime Minister is making this appeal, what is the true situation which India is facing? I think it's important that the government takes the people of this country into confidence. To do that, they must call for a session of parliament and apprise us of what is happening, because this is not normal. No other country has given this kind of advisory, directive, appeal.
And staying with the Prime Minister's appeal, several industry leaders have come out in support of the Prime Minister's appeal for energy austerity and stressed on the need to double down on investments. Sunil Mittal said there is a need to get away from the obsession of gold imports. Sunil Kant Munjal has called for conserving energy as a sensible move. Shobna Kamineni of Apollo Hospitals says that while energy austerity is the need of the hour, it is not a doomsday call. Take a look at Corporate India reacting.
I think we in the industry need to play our role. We need to play our part. We have employment of millions of people. We can take his message forward in a very deep and meaningful way. We need to get away from this obsession of import of gold. We need to lower our energy costs. We need to move more faster towards renewable energy in our industry. And importantly, we need to vote with our feet within our country. Spend more here, put more Capex here. We need to invest more. This is not the moment to shy away. This is the moment to invest, double down in our own country, because the underlying growth is there. This is a continent of consumers, large young population wanting more products and more services. And let's give them more from India, make in India, from India, serving India.
Considering that we are one of the largest importers of energy in the world, it's only sensible that we start to conserve energy and start to see how we can be more efficient. I think there are two aspects to it. One is, whether Reserve Bank intervenes constantly or not. But the fact is, there has been inflation. There has been an impact on currency. Unfortunately, the Indian currency has suffered more than many others because of our peculiar situation. To my mind, I think it's more a natural drift would be a better approach, which is what also the Reserve Bank appears at this moment to be taking. But I guess they know this situation better than most of us.
I think austerity is really the call of the hour, because we have to protect. It's not about our own country growing, because we have wonderful growth ahead of us and a great future. But it's the external dark clouds that create this situation. People must travel, and we must help the economy keep moving. I think it's better not to do it just for, if you can just be there for a national cause and maybe reduce one trip a day. I don't think that it's this doomsday call, and we should not take that as a nation, that this is, that what we have to do is, we have to work together.
Home now after the COVID pandemic, this has probably been the first time there has been some policy push or maybe an indication towards work from home. Do you think that is going to impact efficiency of our corporate sector?
No, I don't think that will impact efficiency. I think we have lived through COVID times. Technology is far more developed. Yes, in some cases it is much better if people are there collectively, but for a few months if people have to work from home or use technology more extensively, I don't think it will impact productivity in any way.
Based on our Prime Minister's thought process, if there has to be certain policies that has to be done in order to discourage, import of gold, duty hikes could be a possibility. But till it is being done, these will only be, speculation whether it will happen or not. Out of the import of 700 to 800 tons, about 20-25% of the gold gets used up for exports, and the remaining 75% is used up in either domestic consumption for jewelry or for investment. So it will maybe create a dent of about 10 to 12% reduction in terms of the volumes that gets imported.
Well, a gamut of reactions there coming into the Prime Minister's appeal. Remember, this is still a national advisory. None of this is mandatory. The question, though, is that was the Prime Minister's speech a precursor to measures that the government may announce? We're, of course, going to be tracking this very closely. But let's go on to the top global story this evening. Crude prices are surging as President Trump has dismissed Iran's response to the U.S. proposal to end the war, and Israel Prime Minister Netanyahu warning that the war will continue. Here's the latest developments. Trump has called Iran's counter-proposal, and I quote, totally unacceptable. He also posted a long statement on Truth Social alleging that Iran has been playing games with the US and the rest of the world for 47 years, adding, and I quote, Tehran will be laughing no longer. End of quote. This came soon after he reiterated that the war would end quickly. Iran has refuted Trump's claims that its demands were excessive. The country's foreign ministry spokesperson Ismail Bagay has maintained that the U.S. continues to have unreasonable demands. He added, and I quote, the offer was generous and responsible. Bagay claimed stability and security in the region have been undermined after Trump's rejection. Wall Street Journal reporting that Iranian counter-proposal called for nuclear issues to be negotiated over the next 30 days. Tehran also reportedly proposed to have some of its highly enriched uranium diluted and the rest transferred to a third country, something that Iran's state media has since refuted. The country also refused to accept the dismantling of its nuclear facilities. Furthermore, Iran called for the U.S. to lift the blockade on the Strait of Hormuz. Meanwhile, Israel's prime minister has warned that the war will continue as long as Iran had a stockpile of highly enriched uranium. Netanyahu said in an interview on CBS's 60 Minutes that there are still enrichment sites that have to be dismantled. When asked how the uranium should be removed, he said, and I quote, you go in and take it out, end of quote. He added that Trump told him he wanted to do this as well. Netanyahu's comments and Trump's dismissal of Iran's proposal have pushed Brent crude above the $105 mark. Iran's foreign ministry spokesperson has warned European countries against deploying warships to the region to open the Strait of Hormuz. Reuters reporting that 3 oil tankers have exited the strait with their trackers turned off. According to Iranian media, a vessel loaded with Iraqi crude and bound for Vietnam sailed through the waterway through the route designated by Iran. Amidst the heightened tensions, Iran's foreign minister Sayed Abbas Araghchi is expected to visit India this week. He will attend the BRICS foreign ministers meeting in New Delhi. Araghchi has spoken with External Affairs Minister S. Jaishankar 4 times since the conflict began. Iran had earlier indicated interest in pushing for a coordinated BRICS response on developments in West Asia. On to the day's market action. Markets witnessed a sharp fall today with the benchmark indices dropping over 1.5%. The Sensex down over 1,300 points and BSE-listed companies erased market cap of nearly 6 lakh crore rupees. So 1,300 on the Sensex, 360 on the Nifty, 870 on the Nifty Bank, and the mid-cap index down by about 650 points. Nigel joins us now to bring us up to speed on the market action. Nigel, of course, the West Asia conflict and Trump calling Iran's proposal unreasonable, unacceptable, that had a part to play, but also the comments coming in from the Prime Minister.
Well, it was a weak trading session for the Nifty today, and it was under pressure from the word go, actually. A couple of factors played out. Cautionary comments coming in from Prime Minister Narendra Modi over the weekend, And also you had crude oil that spiked because there was no concrete resolution coming in from the United States and Iran. Let's focus on the domestic queue first with regard to what Prime Minister Narendra Modi had to say. He said that he resolved not to purchase gold for close to around a year. And because of that, it was a bit of a sentiment hit for stocks like Titan, Senko, as well as Kalyan. Keep in mind, the street is bracing for some kind of duties on gold imports, and that's why those stocks are under pressure. Our Prime Minister also urged Indians to limit foreign travel, and that in turn had an inverse, impact on Interglobe Aviation as well as on Indian hotels. Both of them were under pressure in trade today. But there were a couple of outperforming sectors that ended more or less on the flat line and in fact moved into the green as well. The Nifty Pharma Index was up and about. The FMCG Index as well did pretty well. The problem for the Nifty was we saw a bit of a pullback, but that quickly got sold into. And that's because the larger names like an SBI did real under pressure post its numbers, so that stock was down. Big boy Reliance Industries as well did drift towards the lower end, towards the end of the trading session. Though there were a couple of bright spots. You had solid results coming from Tata Consumer, top gainer on the Nifty. From the broader markets, Rain Industries as well as Saskin, both of them were up anything between 13 to around 20%. But there were some weak numbers as well that we got from the broader markets. ABB, Urban Company, both of them were under pressure in trade today. The problem for the market is that FI flows have been seeing aggressive outflows, and the rupee breached the 95 odd mark. You'll require some stability on the rupee for the FI flows to come back in. So we'll have to track that. But for today's trade, that breaching of the 95 odd mark made investors a little bit nervous. Now, the way ahead is going to be what are the measures that we actually see from Prime Minister Narendra Modi as well as from the central government? Will there be some kind of regulations in place, some kind of curtailment in place? Those measures will be tracked. Remember, the Nifty is approaching a very, very crucial zone of around 23,500 to around 23,800. The bulls will not want this mark to get breached on the downside.
All right, Nigel, many thanks for joining us. Now, Reliance Industries is set to be reworking the listing structure of Jio platforms from the previously planned offer for sale to a full fresh issue. Reports suggest that this shift has been made because investors are not keen to sell and want to stay invested for the long term. Reliance now plans to raise fresh funds totaling 2.5% of the company's size. On to a CNBC TV 18 exclusive. Private equity giant Tiger Global is looking to sell 5% stake in Grow via a block deal. Sources have said that this could be expected this week. Tiger Global could sell its stake in Grow at 5 to 7% discount to the current market price. Remember, Grow listed in November of 2025 and the 6-month lock-in period ends tomorrow. We will head to a break, but up next, the Union government notifies the new labour codes 4 months after releasing the draft rules. That and more when we return. The union government has notified the new labour codes 4 months after releasing the draft rules. No criteria for minimum wage has been set. The centre says that will be notified separately. Rachna joins us now with the details. Rachna, what does the fine print say?
Well, India has waited nearly a decade for this moment. 29 old labour laws have been consolidated into 4 new labour codes. The final central rules that make these codes operational have now been notified by the Labour Ministry. So now a worker in the organised sector gets a statutory right to minimum wages. Gig and platform workers receive formal recognition for the first time. Fixed-term employees become eligible for gratuity after just 1 year instead of 5. And women workers can now take up underground work and hazardous jobs on equal terms with men. This also comes with a set of protection. Every worker must receive a mandatory appointment letter. Wages must constitute at least 50% of total remuneration. Working hours are now capped at 48 per week, and overtime requires worker consent and must be paid at double the normal rate. Social security benefits will be Aadhaar-linked and portable across states, which is hugely beneficial for migrant workers. But the formula for calculating minimum wages has been quietly dropped from the final Code on Wages Central Rules 2025. And it's not like it's been left to states or a committee. It has simply been omitted for now. Now, experts warn that without a clear methodology linked to the cost of living and regional realities, the national floor wage risks becoming an arbitrary number. States will be free to set their own minimum wages above this floor, whose basis itself remain undecided for now. So for nearly 30 crore workers in the unorganized sector, the framework is now in place, but enforcement depends on states notifying their own rules, and most are yet to do so. India's labour laws needed this overhaul, but what remains in question is whether a reform this sweeping can leave its most fundamental guarantee, a transparent minimum wage, unfinished like this. So we will keep an eye out for more as and when it's notified.
Yes, we certainly will. Rachna, many thanks for joining us. Now, President Trump will head to China to meet Chinese President Xi Jinping in Beijing on Thursday. Trade, rare earth export curbs, AI and Taiwan are expected to be on top of the agenda. This will be the first face-to-face talks between the two economic superpowers since the US-Iran war. CNBC's Yunus Yoon brings us the curtain raiser from Beijing.
China has finally confirmed President Trump's visit to China this week. This is typical of the Chinese, these kind of last-minute confirmations. But also remember, of course, that this summit had been delayed once before. Now, the White House over the weekend had described President Trump's visit as a visit of tremendous symbolic significance. He's going to arrive on Wednesday evening. On Thursday, he takes part in a welcome ceremony as well as a bilateral meeting with President Xi Jinping. He'll be visiting the Temple of Heaven with the president and a state banquet. On Friday, the two are going to be having a discussion, a bilateral discussion over tea, and then go into a working lunch. Now, as Dom and Dan were just discussing, the Iran war is expected to take center stage. In fact, that White House official had said that they expected President Trump to raise the issue of China's support for Iran, including revenue as well as some weapon support. And the U.S. Treasury on Friday had announced that they were going to impose sanctions on a number of companies, including those in Hong Kong as well as in China, for their alleged support. The U.S. Treasury Secretary Scott Bessent is also in the region. He's meeting with the Japanese Prime Minister, and he's expected tomorrow to meet with the Chinese Vice Premier, who's been his counterpart, Dom, in these discussions ahead of the trip of President Trump into China.
Yunus Yoon, many thanks for joining us. That is the latest there from Beijing. We will, of course, track the Xi-Trump meeting. Remember, get the CNBC Edge right here on CNBC TV 18. That is a wrap on this edition of Business 360. The news will continue right here on CNBC TV 18. We're back in a minute with more. Stay tuned.
Hello and welcome to this very special episode of Startup Street Future Female Forward. I'm Shruti Mishra. As India builds the next chapter of growth, innovation and entrepreneurship, one thing is becoming increasingly clear. The future cannot be built without women leading from the front, because the power of equity lies in building new India equitably. We are back with HSBC Presents Future Female Forward, co-presented by Cognizant, now in Season 4. Today on the show, we spotlight women who are not just building businesses, but reshaping the future of consumer India. From redefining luxury with lab-grown diamonds to building science-led skincare designed for Indian consumers, to backing the next generation of breakout startups through venture capital. Today's guests are leading a powerful new wave of women-led entrepreneurship. 3 women, 3 very different journeys, one common theme: building the future of consumer brands in India. So let's get going. They say diamonds are a woman's best friend, but today the conversation around luxury, aspiration and ownership is changing rapidly, led increasingly by women consumers and women entrepreneurs. My first guest is looking to ride that shift with her lab-grown diamond brand, Limelight Lab-Grown Diamonds. Set to launch 25 new stores in the first quarter of FY26, Limelight Lab-Grown Diamonds is taking its retail footprint to over 85 stores nationwide as demand for sustainable and more affordable luxury picks up across both metros and Tier 2 markets. Founded as an early mover in the category, the company is now betting big on consumer education, omni-channel expansion and a wider push towards what it calls future-forward luxury. Joining me now is Pooja Madhavan, the founder and MD of Limelight Lab-Grown Diamonds. Pooja, welcome to Startup Street. We're seeing rapid consumer adoption of lab-grown diamonds across India. Like I mentioned earlier, you're opening 25 stores in just the first quarter of FY26 and targeting 200 stores by 2027. Which markets are driving this demand? Metros or Tier 2? And how are you buying, how are you seeing the buying patterns evolving across geographies?
Thank you so much for having me today. Yes, indeed. In fact, India has been a very surprising market when it comes to the adoption of lab-grown diamonds. We clearly did not expect the adoption to happen so quickly in our country, but it is the metros and the Tier 2 cities combined that are, sort of picking up in terms of consumer demand. Particularly Tier 2 cities is where we see a lot of strength. Of course, metros is where the confidence comes from. Consumers in the metros are building the confidence for the category, but Tier 2 cities is where we see the consumption, the spending power, and the excitement to buy diamonds. And we as India as a market, we have been consuming diamonds. Only less than 4% of Indian women have actually adorned diamonds so far. So we are a market that has been extremely aspirational for diamonds, and lab-grown diamond is a category that's enabling women across the country to fulfill their diamond dreams and buy as much as they like for utility purposes and not for the lockers.
Absolutely. And one of the biggest challenges that has remained in this category has been consumer trust and education. And even today, many buyers still compare lab-grown diamonds with natural diamonds. How difficult has it really been to build awareness and change mindsets in India?
Yes, it is indeed very difficult because you're not shifting a short-term shift, a short-term mindset. It's been a mindset that's been driving us for more than 100 years. The diamond category has existed for a very long time, and a lot of international companies have worked very hard in promoting an exaggerated diamond dream. I think what the technology has now brought in is being able to commoditize this product and actually know what its real worth is. And the reality of the situation is that lab-grown diamonds are identical. They're the same. We often use the analogy of test tube babies to explain it to consumers that one doesn't love an IVF baby lesser than a naturally born, because at the end of the day, both are humans. The same way both these diamonds are produced and they're made of carbon. In fact, lab-grown diamonds that are produced in India are actually superior in quality. They're the best form of diamond you can ever get. This is some of the information that actually has to be put out to the audiences. It's been tough, but I think the new consumer is very smart. The digital world is very small. Everybody has information on their fingertips, so they're being able to understand the facts and figures better.
Sure. And Pooja, you've built this business alongside your co-founders, including male co-founders in leadership. As a woman founder in the luxury and retail space, what has the entrepreneurial journey been like for you personally? Were there moments where you felt you had to work harder to establish credibility? And do you think the funding and scaling journey is different for women founders in consumer businesses? Were there biases or assumptions you had to navigate while building Limelight in a category that was traditionally dominated by legacy players?
I think first and foremost, because I didn't belong to this industry to begin with, of course, I had a far bigger hurdle to cross over. I had to learn the tricks of the trade. But along with that, of course, it's difficult when you're a woman standing up in a man's world. But I think resilience, creativity, and consumer trust have sort of built over time and have become my strengths. I think the times are changing. Everybody around you is sort of accepting, women entrepreneurship across different industries. And the same works for diamonds.
Absolutely.
And diamonds are our best friends. So, I mean, it's high time that women, sort of lead the change.
Sure, and I want to talk to you about that. This is also a Future Female Forward special. So I want to ask you, are we seeing more women consumers make independent jewelry purchase decisions today? And how is that changing the kind of products, price points, and branding strategies companies like yours are building around?
Yes, of course, it is absolutely changing. Self-purchasing is becoming a very, very big category. I mean, in the US, we have seen approximately 30% of the sales contribute from self-purchases. We are seeing a similar trend pick up in, India as well. Of course, it's not to the same extent, but it is rising very, very rapidly, which is why there is, a lot more utility products, a lot more of regular, earrings, regular necklace sets, pendant sets, bracelets, tennis bracelets, huge variety of designs which are coming in these along with, the regular engagement rings and related jewelry. But self-purchase is becoming very important. And it's no longer, why should we wait for a he to buy us a diamond? So we're buying our diamonds.
Absolutely. Sure, Pooja. Globally, the category is also seeing pricing pressure as production scales up. How do you maintain premium positioning and healthy margins in a market where prices could keep falling? Also, if you could take us to your current revenue and growth numbers that you're seeing.
Sure. I think firstly, it's a big myth that prices are falling. Firstly, the prices have actually stabilized in the lab-grown diamond sector for almost over a year now. So it's a myth that has been created, by, different lobbyists in the industry, but it is not factually correct. Secondly, from a retail price point, we don't face, a lot of pressure from, consumer perspective, because consumers are seeing a huge amount of value difference and value addition that lab-grown diamonds itself brings to the table. Thirdly, from our revenue and our projection standpoints, we are currently at, so we closed FY26 at 265 crore top line, and this year we're aiming for about north of 500 crores top line. And just to add to that, yesterday's news and today's news with, Prime Minister Modi ji also speaking about, what we need to do for our country and what needs to be driving growth. I think the fact that, we are being, sort of guided that, gold is something that we have to sort of steer away from. I think lab-grown diamonds is, going to be the consumer's, ultimate best option because it gives you the bling, it enables you to wear jewelry, it enables you to enjoy a huge amount of jewelry in the same price points. And at the same time, it is
absolutely
अपने देश का डायमंड है तो वो पहनना ही चाहिए.
अपने देश का डायमंड है तो वो पहनना चाहिए. On that note, Pooja, let me wrap up our conversation. Many thanks for joining us on Startup Street today.
Thank you so much. Thank you.
Well, moving on from diamonds, let's now move to dermatology. My next guest is looking to redefine beauty through science-led skincare, clinical research, and product built specifically for Indian skin, climate, and lifestyles. Her startup, Chosen, has raised $5 million in Series 8 funding led by Fireside Ventures with participation from Bold, L'Oreal's corporate venture capital arm, and Alchemy Growth Capital. The company says it is India's first exposome-based skincare brand combining dermatology, clinical research, and evidence science-led product development for melanin-rich skin. To tell us more, joining me now is Renita Rajan, founder and CEO of Chosen. Renita, welcome to Startup Street. Now, Chosen describes itself as India's first exposome-based skincare brand. For viewers, break that down for us. What exactly does exposome-based skincare mean? And why do you believe Indian skin needs a fundamentally different approach?
Thank you for having me. That's a great point to start with about exosomes. We are born with a genetic blueprint, so to say, and that is called the genome. So we know that this is something that works for us over a period of years. However, there's been a lot of data that's come in the last maybe about 2 decades where it talks about our skin behaves very differently because we are exposed to a completely different set of conditions. While there has been small acknowledgements here and there for Indian skin types, for melanin-rich skin, for skin of color, the larger play world over has been about Caucasian skin. While we also focus on trends, now it's a time for Indian skin to literally sit at the table and dictate what we will be using, for how long we will be using something, and what benefits we can get. So I think the entire come away from being very genome-led to being very exposome-led.
All right, picking up from what you just said, you're focusing on 4 key domains: pigmentation, texture, contour, and hair aging, specifically for melanin-rich skin. How underserved, Renita, is this segment globally? And do you believe India can then emerge as a major innovation hub for skin of color science?
I think we have a fair enough representation. 1 in 5 to 6 of us is having the Indian skin type to start with.
Yes.
So the population is there. How have we been served so far has been largely by Western dictates and largely by market trends, more than need-driven, rather it's awareness-driven. So then it's time for us to set the needle back to need, where clinical skincare can actually contribute to deciding, okay, Indian skin ages by pigmentation, ages by contour change, texture change, and hair and scalp aging. And that is what's been clinically proven, and that's where we are focusing on.
Sure. Renita, this is a space that is getting increasingly crowded with celebrity brands, D2C startups, and global beauty giants all competing for consumers. In that environment, how do you build differentiation around clinical rigor and science-led products?
Awareness has been the one that's creating the clutter in the industry. Rather, if you think about how dermatology started, it was need-based. Or if you go approach a clinic or a doctor, you're going there because you have a certain need. So now this, maybe in the last 2 decades, it has been moving away from need to an awareness-based consumption. Now, this awareness itself has created a need. So we've been consuming a lot of skin lightening creams without understanding what their long-term harm can be. And so these are the people that are ending up in the clinics requiring a dermatological solution. So the awareness itself is channeling into a need and starting to answer questions based on need. What do patients really have? What do clients really want? How does Indian skin age in the future? How do we anticipate these problems? I think it's time to put the focus back on need and not just follow what trends dictate.
Okay. All right. Renita, let's talk about the fresh capital that has come in. What does the next phase of growth look like for you? Are you looking at offline expansion, deep R&D, international markets? And what scale are you targeting over the next few years?
In terms of the heaviness of R&D that has gone into building Chosen, in terms of the extensive clinical data that has gone into building Chosen, the capital is received at a right time that helps more and more dermatologists be part of this research and development, so to speak, translating clinical insights into actual products that will be used today, deliver results, and be safe in the long term. The most important question that we're trying to answer in research and development is around how does whatever product that we use, whatever consumption that we use, whatever nutraceutical we put into our body is safe for the long term. To that extent, we don't have population data in India, and R&D will be primarily the R&D, and people driving R&D will be the focus of this funding round.
All right. I also want to talk to you, Renita, about your entrepreneurial journey. What were some of the toughest transitions while moving from being a dermatologist to building and scaling a venture-backed brand? And as a woman founder, did you find yourself having to work harder to establish credibility with investors, consumers, or even the industry?
I think that's been quite the learning journey for someone that's been working in a business to work on the profession or on the business. It's been quite a transition. Luckily, I would like to acknowledge my initial days with Spark. That was a women entrepreneurship program from Peak 15 that basically kickstarted this. Then I also had fantastic help from women along the way, the cohort itself. And then, of course, right now I find myself working with a great set of investors who really provide who really fill the gaps in for me. So I think finding the right ecosystem has been the biggest learning from here.
Okay, finally, Renita, when you look at women founders building in health, beauty and wellness today, what are the structural gaps that still need to be solved, whether it is access to capital, networks, mentorship or leadership opportunities? And what advice would you give to more women looking to build science-led businesses out of India?
The first thing I think is to be confident that your idea is valid. I think for many women with our conditioning, the idea is it valid is the first place we stop at. And the second thing would be to channel the network, because any idea needs to be validated and a network makes a great difference. And the third idea is that the network itself opens access, and you have to probably work within the circle of competence to understand how your idea can serve the community. This connect sometimes is missing whenever we are very deep in professions like mine, and making the right connects and network makes a difference.
Well, on that note, Renita, I'll have to wrap up our conversation. Many thanks for joining us on Startup Street today, and wish you the very best with all your growth plans. Well, on that note, it's time for us to head into a short break. We've spoken about building new age consumer brands and creating differentiated products for Indian consumers. But what does it really take to scale these businesses in today's funding environment? And are enough women founders getting access to capital and mentorship? We find out on the other side. Stay tuned. We'll be right back. Welcome back to Startup Street, Future Female Forward Special. My next guest is one of the few solo women general partners in India's venture capital ecosystem, and someone betting big on the next wave of consumer startups emerging from India. Through Rukham Capital, she has backed over 30 consumer-focused brands across categories, while also actively supporting women-led businesses in sectors ranging from food and lifestyle to beauty and health tech. At a time when the startup ecosystem is recalibrating around profitability, capital efficiency, and founder resilience, Rukham Capital is looking beyond just funding, building platforms around mentorship, storytelling, and founder support. Joining me now is Archana Jahagirdar, founder and managing partner of Rukham Capital. Archana, welcome to Startup Street. You entered venture capital from a journalism and a storytelling background, very different from the traditional finance-heavy VC playbook. How has that shaped the way you evaluate founders and build conviction in businesses?
I think as a woman GP, one of the most important things is that you have to get a foot in the door, and a lot of women don't really go into finance. And if they do go into finance, they don't really go through the entire journey. But having said all this, I want to point out that Mike Moritz, who was one of the key partners at Sequoia in the Silicon Valley, was also a journalist and led some of their most successful investments, including in Google. So I don't think it's so unique. It's unique in India. But I think, as a VC ecosystem gets sort of set out, and it's really, really nascent still in India, I think we need people from different backgrounds to be able to assess businesses from, different viewpoints. Early stage businesses are a lot less about numbers. It's a lot more about being able to see with very fuzzy sort of information, data. It's much more about being able to see vision. The data, the numbers, sort of kick in after post-investment. It's not a pre-investment sort of requirement often where we come in.
Yes. Archana, like I mentioned earlier, Rukham Capital has built a portfolio of over 30 consumer-focused startups across categories. What are the big shifts you're currently seeing in India's consumer landscape? Which themes or sectors excite you the most over the next few years?
I think it's a consumer cohort that India is seeing, which is really one of its, I think it's our biggest strength. It's a Gen Z cohort that is coming. India has almost 43% of its population is there, whereas if you compare it to China, China has only 13% of their population, which is Gen Z. Gen Z, the way they're thinking about everything in life, I mean, they grew up in a lot of prosperity compared to, let's say, the earlier generations in India. I'm obviously talking about Gen Z who grew up in middle-class families. There has been a lot of abundance. They are far more secure about jobs, having seen two great disruptions, first with COVID and now, of course, with the war. But I think there is a lot of belief that, they want to buy made in India. So we did a report on the Gen Z cohort behavior. And I think it's really heartening that they are proud of their heritage, of their being Indian, and they want to buy made in India products, which is why it's such a boom in consumer businesses in India.
Sure. All right. Archana, you've bagged several women-led startups, including Go Desi, the Indus Valley, Anti-Norm, and, Fraganote. As one of the few solo women GPs in India, do you think women founders still face a different set of challenges while raising capital? And what structural changes are still needed within the investment ecosystem?
Let me start by what I do. Like, even I have to raise capital, right? I mean, we raise money from limited partners and then we deploy it through a blind pool. Now, the traditional sort of, capital does reside with the old boys network. There are very few women LPs. There are very few women who are on the decision-making side as to how to allocate to GPs. So the bias actually starts from that point itself. Now, having said that, when I come to women founders, I mean, there's no two ways about it. It is much harder. I think there are a handful of funds. There's us, there's Fireside, where we've, I think, actively gone out to invest in women founders. And of course, women founders are very competent. I don't think, we need to make concessions necessarily. I think they're competent. I think their voice needs to be heard. They need to be given a fair chance. And I think women need to be given a fair chance. But is it hard? Yes, definitely it's hard. Harder for women founders because they also come up against the same issue that I talked about, the old boys network. I mean, the old boys network, I mean, it's a crazy gatekeeping that happens over there. So there's a lot of things, how men sort of interact, socialize, where deals get done. It's very male dominated.
Absolutely.
So yeah, it's tougher. There's no two ways.
Okay. Beyond funding, Archana, you seem deeply involved in mentoring and founder building through initiatives like Startup Table with AJ and Women in Action. Why was it important for you to create these platforms? And do you think the startup ecosystem still romanticizes success while underplaying, founder struggles?
Look, I think the ecosystem has to be built for something larger, bigger to emerge. There is nowhere in the world. I mean, if you look at different countries where startups have become a movement, not just a occasional, sporadic sort of a success story here and there. What does that mean? It means that you've got to support founders, whether you invest in them or not, because, all of us have a certain limitation as to how many companies that we can back because of the amount of capital that we are deploying. So, but it's important that how do people get some of those well-meaning interventions from a point of perspective, investor perspective, because the entire VC, this capital is very, very new in the Indian ecosystem. And there's still a lot of scarcity of this capital available. So therefore, it's important
Absolutely.
to sort of educate and be available as a voice of reason for founders who are trying to build. You know, this binary that gets created, bootstrap versus funded, I think is all really not a very sensible way of talking, because money makes money. So unless and until you have access to risk capital, you can't build large businesses. If you don't build large businesses, you are under threat of being irrelevant, you know, like what...
Yes, absolutely.
AI. I mean, SaaS was super hot, just a few years ago. You know, if you invest in a SaaS company, you know, you were golden as an investor, you were golden as a founder. Today, the same SaaS companies are thinking about their future because AI has disrupted it. In the startup ecosystem, quick. Speed is important.
All right, Archana, very quickly, one final question. You know, Rukham Capital is currently investing through Fund 2. What does the next phase of growth look like for the firm? Are you looking at larger check sizes, new sectors, or even expanding beyond India?
So larger check sizes and definitely newer sectors. I think that excites us. I think for businesses, India is a golden market because there are very few homogenized markets like India. And I think, you know, an Indian founder will understand the Indian consumer better. I think it is highly risky to get into a market where you don't understand the consumer. It's also very expensive to enter a new market. I was recently in Palo Alto and in New York, and, you know, even American investors agree that entering the American market, especially for consumer businesses, is extremely expensive. But if you had the money, the nuances of the American consumer is not so visible and apparent to us. So I think we should be sensible to our advantage with the kind of capital that Indian consumer companies are raising. At a certain point in their journey, maybe there'll be an opportunity to go. And that's how, I mean, you build businesses. You first dominate in your home market. And then, of course, you look out for newer markets, because that's how you get newer growth and you do grow at a really, really healthy rate of growth. So I think it's sensible to focus on
Archana.
what we have.
Yeah, we're pressed for time. Thank you so much for joining us on Startup Street today, and wish you the very best with Fund 2.
Thank you so much for having me.
Well, with that, it's a wrap on this special edition of Startup Street, Future Female Forward. More news and updates coming up on the other side. Stay tuned.
We do have history right here on stage. In 160 years, the BMC has never had a woman at the helm, never had a woman at the top. Ashwini Bide, thank you so much for breaking the ceiling finally. You know, was that something that you were thinking of when you finally sat in that chair? Did this thought occur to you that I'm making history?
Initially, it didn't, because as a women member of Indian Administrative Service, I always thought that, okay, I've always have been on the equal footing. But many people started telling me that you are the first woman commissioner. Initially, I felt, what's the big deal in it? But then I realized that in 160 years, if not a single woman has been made commissioner, then there is certainly something.
There is certainly a big deal in that. There is a very big deal in that. But, you know, as you've navigated your way through the civil services, as you've navigated your way to the very top as far as the BMC is concerned, what have been some of the toughest challenges that you've had to encounter on account of your gender? And I know that there are challenges that civil servants face on account of, you know, the environment around us. But specific to your gender, what have been some of the biggest challenges you've had to face?
Frankly, Shirin, in Indian administrative service, we experience less of gender disparity because being in the administrative service itself puts you little ahead of the race. And as far as IAS is concerned, women's presence has always been there.
Yes.
The percentage has now recently increased, but presence has always been there. And we have heard stories of many of our senior officers working their way up to
when will India see a woman cabinet secretary?
But yes, there is, and even Maharashtra took a lot of time to have its first women chief secretary. But many other states, there have been many women chief secretaries actually. So at times there is some kind of a glass ceiling, but if you look at the opportunities which the service provides, even to women officers, frankly, I have never experienced that kind of disparity or any different treatment by people. But yes, there were certain posts which were always, considered that women may not be able to perform on those posts.
Which posts were these?
Even the municipal commissioner post, for that matter, in very early days, even the collector's post, people thought that women won't be able to, perform. But then it has become a norm now. So there is I think it takes some time for people to understand that there's no difference. Finally, an administrator is an administrator in spite of the gender, and the performer won't have any gender as such. If there is a performer, that person would perform, but that understanding takes some time. And some of the posts which look that only men can handle them. Maybe the municipal commissioner's post is like that. Even MMRDA commissioner, for that matter. Housing boards, because these posts are they are considered that they have to handle many complex things which involves too much of engagement with people, political parties, the influential people in the community, and at times people feel that women may not be able to navigate through those troubled waters. So, but once you break that ceiling and once that myth is broken, then I think it becomes a normal thing. Then that time probably people would think, why even we had thought of that the women won't be able to accept that.
You're dealing with the large infrastructure projects in Mumbai. In fact, you're also called the metro woman. In India, the biggest problem with infrastructure is it just doesn't get done on time. There are time overruns, there are cost overruns. Is it good to have a woman in place to ensure that we actually get the job done?
If that is the case, then probably I must say that yes. But there are multiple reasons why infrastructure projects don't get on time. What is needed is a very focused kind of leadership for that. And at times people allow things to the providence, allow things to happen on their own. But maybe when I took over, because when I came in infrastructure, that was in 2008. And since then, I have been continuously working in urban infrastructure. And my own lesson was, unless you own it, unless you take responsibility of it, and don't look at it as a regular administrative thing, the projects won't move. And from that perspective, I worked on all these projects like the CEO of a private company who would always think of the cost and time overrun, and who would always think of the lost profit. In government companies, we don't think much about profit, but the cost and time overrun is something which we have to think about. And each and every problem which comes in the way needs to be dealt with immediately. And that dynamism in the decision making, I can't leave, I can't leave it to the next officer who takes over. So I worked with that attitude, and that worked well. And most of the projects which I took over or I started, they got completed in a reasonable time frame. Not exactly on time, because there were multiple issues. So I think the women leadership brings that sense of accountability, and that sense of ownership. And that makes a lot of difference.
We've got a lot of young people, young women here in this audience, and many who are watching us online and on TV. As someone who's navigated the civil services, what would you leave us with in terms of things that we should be mindful of? What have been some of your sort of, non-negotiables to help you, as you said, navigate the very tricky, often difficult waters? What would you leave us with?
Civil services, the kind of field you have to work in is always very chaotic because there are too many noises, too many voices, and you have to pay attention to each one of them. And so around you there is always a chaos. So what you need to do is find a method in that madness. And to do that, you need to first listen to all the voices, all the noises, absorb them, and then try to understand what exactly is important, what exactly matters, which actually will find a way out. So if you don't listen to it, at times what happens, the chaos is so much that people stop listening to that. And they find their own way out to deal with it. But it doesn't work that way. So basically, one has to be very, very patient. One has to be a good listener, understand what the problem is, and go in the details of that. And don't leave it to anyone. But one must understand that in this kind of administration, there is no one single and straightforward answer. There is no tailor-made solution. You have to find that solution. Because there are multiple stakeholders, multiple viewpoints. One particular thing, somebody tells you a story, and then you think that, yes, there is a truth in this story. You start acting on it, and then two other components or members would come and they will tell you a different story. So you have to be always mindful of that, what exactly. And the principle of natural justice needs to be followed thoroughly. You need to listen to all and then find a solution. Secondly, you need to work on the details because the devil is in the details. You can't go basis the superficial information and make your decision. Second is you need to always review your own decisions. There is no harm if you need to change your decisions. You need to look at the thing in a completely different perspective. There is no harm in that. So that you should be ready to. Don't be so harsh and hard on yourself as well as on the situation. And the most important part is taking ownership. Taking ownership, being accountable for what you are seeing. And the thing more important than this is being very, very honest and transparent. If you follow all these things, then probably you find the right way even among the chaos and find a solution to problems. And once you are a problem solver, then I think every issue in administration can be easily solved.
As many of our speakers here this evening spoke of the perfection penalty that women often burden themselves with and society also burdens us with, as you've navigated a very high-achieving career with also managing, your family and so on and so forth, what have been some of the challenges that you've had to administer and how did you get past those?
I think this trap of being a perfectionist, that initially I was also influenced by that, but slowly you realize that you don't need to. You need to navigate both, you need to manage both. And I was blessed with a very, very supportive family because that matters a lot. And if your family understands what exactly is your job, responsibilities on your job, if I'm answerable to my job 24/7, then I need to have that kind of freedom and that kind of support from the family, which I had. But at the same time, one also needs to prioritize because there are moments when your office and your work becomes very important. That time you can't even pay attention to your family requirements. But there are moments when your family matters a lot and you can certainly keep office and the work demands slightly away. So that kind of prioritization has to be done. And what exactly you need in life, because you can't have best of
everything at all times.
So so you need to be fair, you need to be balanced with yourself also. We need to moderate our own expectations. And then try to give justice to all. And sometimes, if there are failures, sometimes you commit mistakes. then you should be sympathetic to yourself.
Be sympathetic to yourself. I think that is a very important message that you're sending at Ashwini Bide. I want you to leave us with perhaps, give us an anecdote from all these years of working with politicians, or working with, the who's who. What has been that one most interesting anecdote that you will leave us with, where you had to use all of your skills to sort of navigate through?
I don't think there is any one single thing, but I have been working in public life for past many years. I worked in rural areas, I worked in semi-urban areas and urban areas, and then a metropolis like Mumbai. And the kind of projects I have worked with, every time you need to convince people why we are doing a particular thing and in a particular way. So dealing with people, dealing with political representatives, dealing with non-governmental organization, dealing with civil society and the citizen groups, it has always been a very exciting journey, sometimes very frustrating, sometimes, you just don't know how to deal with it. But every experience has been a learning experience. And there are many such occasions which I could narrate. But one particular thing I remember at this juncture, that when we were doing the first metro line, which is done by through a public-private partnership, but my responsibility was to make the right-of-way available to them. And making that right-of-way means clearing the road, clearing the space where the metro piers can come. And at one of the locations, there were multiple religious structures belonging to various religious communities were there. And they were occupying part of the road, which was, and they were supposedly, we wanted to remove them, at least partially. And then all kinds of, the religious organizations came forward and they started fighting. I could convince some of them, but one particular religious structure was there, where one of the local ministers was very, very adamant that they won't change that. So I had to literally fight, and I said nothing doing, because only for this a small portion, the project can't be held up. Whatever I said, it reached the minister. Once he called me and he said, it is not correct the way you are doing, and I will put a breach of privilege motion against you, and I will see to it that how you complete this metro project, because you can't do this without fulfilling these expectations. So I also told him, I was younger that time, and I had that fighting spirit, and I said, sir, this project is approved by the cabinet, and you are member of the cabinet. So if you want to cancel it, please take it back to cabinet, get it cancelled. But so long as it is not done, I am not scared of your empty threats, and I will also see to it that the project is completed. But I will also tell you to give advantage to the minister. He also, that was one particular moment. Probably some people must be sitting in front of him. He wanted to show them that he is supportive of them. He's the boss. But then we met after a few days on some other meeting, and he asked me, you said something like this to me. I said, but I was not wrong. You tell me whether I was wrong. And then he accepted. And he said, yes, okay, let us forget, and we'll see. I will help you in getting that structure cleared. So many such events, many such incidents happen in public life. But overall, our society, it's a pluralistic society. There are so many voices and so many streams of thought. But after some time, you need to have that patience, and you need to understand the knack of bringing people together. And making them agree on certain minimum,
Do you think women do that better?
I think so.
The power of persuasion.
Yes, power of persuasion.
The power of persuasion. Ashwini Bide, thank you so much. Ladies and gentlemen, a big round of applause for a woman who's made history here in Mumbai. Ashwini Bide, the first Municipal Commissioner of Mumbai.
Thank you. Thank you so much.
Thank you very much.
What begins as a small business can become something far greater. Today at CNBC TV 18 Future Female Forward, we take the next leap in partnership with IMFA's Sakhi Seed Initiative, a commitment to back women at the grassroots, where resilience becomes enterprise. By identifying, funding and mentoring women micro-entrepreneurs. The journey begins with a 1-month application window, open to 200 women entrepreneurs. Women between 20 and 50 with family income under 6 lakh per annum and independently running a business for over 2 years can apply. Applications will be onboarded, evaluated by the jury and guided by the IMFA Advisory Committee, with CNBC TV 18 as the independent third party. Selected entrepreneurs will receive rupees 5 lakh support in 2 phases of funding. XIMB as knowledge partner will conduct structured mentorship, practical workshops, and business guidance for growth and sustainability. Because when women lead enterprises, communities thrive and the nation grows. CNBC TV 18 Future Female Forward with IMFA Sakhi Seed. Powering women, building businesses, shaping the future.
Well, as we promised, Future Female Forward is not just about conversations, it's about action, and we're so proud that we're taking our conversations to action. Thank you very much to Shefalika. Thank you very much to each one of our members of our advisory committee. And I can tell you, we've been having rigorous calls. We had an hour-plus long call deciding and discussing what the parameters would be, what the eligibility criteria should be before we actually hand out these grants to the micro-entrepreneurs that we're hoping to create. So Shefalika, over to you. Now we're pretty much at rollout stage. So what should people expect from this program?
Well, thank you, Shireen. And first of all, I'd like to thank the members of the advisory committee. The AV very quickly did show you the intent behind the Sakhi Seed initiative. It is about highlighting, the credit that is not available easily to the women entrepreneurs in the rural areas or the credit micro entrepreneurs. And what is now in store for us, that we will be announcing the applications by the end of the month. It'll be a month-long process during which we do an outreach program for people to apply, for women to apply. And it was going to be based on the parameters that we showed. We were looking for women within a certain income level. She must have showed us a certain proof of concept where she has worked for 2 years, but we're not holding her to having any formal registrations or, formal books of accounts, because what we need to understand is these are women who are invisible to the system. Yeah. So we're trying to bring them into the system. We're trying to showcase that they are capable, they have the domain skills, but they do not have the business skills. And that's where we bring in our partner XIMB, who is going to do a mentorship program with them on business acumen, on finance discipline, on the compliances, and of course, the tech skills required for business.
Dr. Shutapa, how excited are the students at XIMB? Because they're going to be working with these women who are selected for the grants.
Very, very excited. I told you, I sent a small photograph, and really the excitement there. And we are really happy to be partnering with the non-financial component of the structured mentorship. Also, as a teacher, really also important is the documentation for the 2 years that with our partner we are going to do. I'm looking forward for some, real learning coming out of that. Yeah. And if that could be replicated as a model and a way forward for us. So very, very happy. And thank you. It's been a long partnership with
and thank you for coming on board as our knowledge partners on this. Chetna ji, you, of course, she runs India's first all-women's bank, Mandeshi Mahila Bank. And of course, the credit gap continues to exist. What have been some of the important learnings, insights along the journey of starting Mandeshi and where we are today at this point in time, Chetna ji?
Thank you. Thanks for this opportunity. And actually, I would say like this whole Sakhi Seed thing. India has a very successful narrative as far as digitization is concerned, right? Everywhere in the villages, you will see women selling vegetables, will have a QR code, and there would be a transfer. But that success of SHG is there. But that success does not come to individual women entrepreneur. Why? Because no credit score, no collateral. Nobody is ready. These women are courageous. I always say that when women start business, everything starts from no from them. Household, family says, no, you won't be able to do it. No network, bankers will say no loan, no credit score, no collateral. But I said, like when I was coming here, I was talking to women, and when I told about this whole concept of Sakhi seeds who are going to invest in women, you know what our women said, Shireen? They said, we had a courage. They have shown the courage. But capital never showed the courage.
I couldn't agree more with you on that.
Capital never showed the courage. So I say that Sakhi seed is the beginning of showing the courage from capital side. And I'm sure that, Sakhi seed will also teach the supply side that there is digitization, there are soft collaterals. Even women do not own property, they can create wealth and invest in that wealth. Country is definitely going to grow. And I would say, Shireen, another thing is, everyone we say that it will take 135 years to close the gender gap, right?
Yeah.
World Economic Forum, we say that. How many of us are going to wait for that? No, right? Anyone, would you like to wait for 135 years? No, tell at least no now. Yeah? So our women do not want to wait for 135 years. They will create jobs with Sakhi seeds. Thank you so much, Shafalika.
Ladies and gentlemen, a big round of applause to Shafalika, Chetna Galasina, Neha, and Dr. Shutta. Thank you so much for joining us here this evening. We do have history right here on stage. In 160 years, the BMC has never had a woman at the helm, never had a woman at the top. Ashwini Bide, thank you so much for breaking the ceiling finally. Was that something that you were thinking of when you finally sat in that chair? Did this thought occur to you that I'm making history?
Initially, it didn't, because as a women member of Indian Administrative Service, I always thought that, okay, I've always have been on the equal footing. But many people started telling me that you are the first women commissioner. Initially, I felt, what's the big deal in it? But then I realized that in 160 years, if not a single woman has been made commissioner, then there is certainly something.
There is certainly a big deal in that. There is a very big deal in that. But, as you've navigated your way through the civil services, as you've navigated your way to the very top as far as the BMC is concerned, what have been some of the toughest challenges that you've had to encounter on account of your gender? And I know that there are challenges that civil servants face on account of, the environment around us. But specific to your gender, what have been some of the biggest challenges you've had to face?
Frankly, Shireen, in Indian Administrative Service, we experience less of gender disparity, because being in the administrative service itself puts you little ahead of the race. And as far as IAS is concerned, women's presence has always been there.
Yes.
The percentage has now recently increased, but presence has always been there. And we have heard stories of many of our senior officers working their way up to...
when will India see a woman cabinet secretary?
But yes, there is... and even Maharashtra took a lot of time to have its first women chief secretary. But many other states, there have been many women chief secretaries, actually. So at times there is some kind of a glass ceiling, but if you look at the opportunities which the service provides, even to women officers, frankly, I have never experienced that kind of disparity or any different treatment by people. But yes, there were certain posts which were always, considered that women may not be able to perform on those posts.
Which posts were these?
Even the municipal commissioner post, for that matter, in very early days, even the collector's post, people thought that women won't be able to, perform. But then it has become a norm now. So I think it takes some time for people to understand that there's no difference. Finally, an administrator is an administrator. In spite of the gender, and the performer won't have any gender as such. If there is a performer, that person would perform, but that understanding takes some time. And some of the posts which look that only men can handle them. Maybe the municipal commissioner's post is like that. Even MMRDA commissioner, for that matter. Housing boards, because these posts are they are considered that they have to handle many complex things which involves too much of engagement with people, political parties, the influential people in the community, and at times people feel that women may not be able to navigate through those troubled waters. So, but once you break that ceiling and once that myth is broken, then I think it becomes a normal thing. Then that time probably people would think, why even we had thought of that the women won't be able to accept that.
You're dealing with the large infrastructure projects in Mumbai. In fact, you're also called the metro woman. In India, the biggest problem with infrastructure is it just doesn't get done on time. There are time overruns, there are cost overruns. Is it good to have a woman in place to ensure that we actually get the job done?
If that is the case, then probably I must say that yes. But there are multiple reasons why infrastructure projects don't get on time. What is needed is a very focused kind of leadership for that. And at times people allow things to the providence, allow things to happen on their own. But maybe when I took over, because when I came in infrastructure, that was in 2008. And since then, I have been continuously working in urban infrastructure. And my own lesson was...
Hello and welcome to News Center. I am Ashmit Kumar. Now, Prime Minister Modi has appealed for restraint on fuel usage, on foreign travel, on gold buying as the Middle East crisis continues to rattle global oil markets. Now, speaking at a rally in Hyderabad yesterday, Prime Minister Narendra Modi highlighted that curbing dependence on imported fuel was now a national necessity. He urged that people living in metro cities should opt for carpooling and prioritize traveling by metro trains. He also recommended resorting to COVID-time measures such as work from home and virtual meetings. Remember, oil imports account for close to 90% of India's domestic needs. India has led to a multi-billion-dollar spike in its import bill. That's the Iran crisis causing that spike. The Prime Minister also stressed on reducing non-essential gold purchases for a year to reduce the pressure on foreign exchange outflows. He also appealed to citizens to avoid non-essential foreign trips for at least a year to help conserve foreign exchange. Instead, the Prime Minister urged citizens to promote domestic tourism. He urged farmers to reduce the use of chemical fertilizers by 50% and adopt solar-powered irrigation pumps instead of diesel-run systems. He also stressed the importance of reducing edible oil consumption, linking it to both national economic interests and public health. Meanwhile, sources in the government have told CNBC TV 18 that the West Asia conflict has led to households will need to share the burden of high oil prices as they flag a current account deficit as the biggest challenge.
साथियों, हमें पेट्रोल डीजल का उपयोग कम करना होगा। शहरों में जहां मेट्रो है, वहां हम तय करें कि हम मेट्रो का ही उपयोग करेंगे। ज्यादा से ज्यादा मेट्रो में ही जाएंगे। अगर कार में ही जाना जरूरी है, तो फिर कार पूल करने का प्रयास करें और भी लोगों को साथ बिठा ले। अगर हमें कहीं सामान भेजना हो, तो कोशिश करनी है कि वह ज्यादा से ज्यादा रेलवे गुड्स के जो ट्रेन होती है, रेलवे की सर्विसेज से भेजे। एक जमाना था जब संकट आता था, कोई युद्ध होता था, तो लोग देश हित में सोना दान दे देते थे। आज दान की जरूरत नहीं है, लेकिन देश हित में हमको ये तय करना पड़ेगा कि साल भर तक घर में कोई भी फंक्शन हो, कोई भी कार्यक्रम हो, हम सोने के गहने नहीं खरीदेंगे, सोना नहीं खरीदेंगे। विदेशी मुद्रा बचाने के लिए हमारी देशभक्ति हमें चुनौती दे रही है और हमें इस चुनौती को स्वीकार करते हुए विदेशी मुद्रा को बचाना होगा।
Government just reduced some 10 rupees on both about a month ago on excise on MS and HSD, which drilled a big hole of 1,60,000 crores in its budget revenue. Now that is something which government has borne on its own budget just to prevent this shock. So government uses all sorts of tools. Many countries have done rationing. They have done different kind of thing. India has been a kind of again a oasis of comfort. No rationing has been done. Albeit government has appealed to citizens not to panic, and we are doing that same today. There is no need to panic. We have sufficient supplies. There is no rationing in place. It's not going to happen. We have 60 days of stock. So same thing which we have been repeating over the last 60 days, they hold true even today.
We need to get away from this obsession of import of gold. We need to lower our energy costs. We need to move more faster towards renewable energy in our industry. And importantly, we need to vote with our feet within our country. Spend more here, put more Capex here. We need to invest more. This is not the moment to shy away. This is the moment to invest, double down in our own country, because the underlying growth is there. This is a continent of consumers, large young population wanting more products and more services, and let's give them more from India.
It is call to action. It will make some difference, but I'm not very sure that it is a needle-moving thing. It is going to help India to escape. It'll complement government's efforts. I think how the consumption comes down is by increasing the prices. I have a feeling if you want to curtail the import, you have to enhance the duty.
Well, joining us now to discuss this further is with us Mr. R. Chandrasekhar, former NASSCOM president and former telecom secretary. Also with us, Mr. Ravi Gosain, the president of the Indian Association of Tour Operators, and also Mr. Narendra Taneja, energy expert. Mr. Taneja, coming to you. I just want to get a sense, given the commentary that we've seen since morning coming in from both the government leaders as well as the private sector, I want to get a sense from you. How much will these initiatives, which of course are voluntary at this stage, there's no mandate that has been issued by the government, how much will it move the needle in terms of, one, reducing energy consumption, and two, reducing the Forex outgo?
Well, I think it's important to note that the Prime Minister's appeal has come on the eve of his visit to Abu Dhabi, in the United Arab Emirates, which, as you know, is a significant exporter of energy and also, oil and gas to India. And the entire region, if you look at very carefully, UAE is one country we have got very, very close ties with. So his visit is coming at the time when, the entire region is still on the boil and the energy prices are going up. So there is a connect. There is a message, of course, for domestic audience, but there is also a message, for the countries in that region, particularly the United Arab Emirates. That's, I think, very important to notice. Second, I don't really think we need to panic, but the important thing is that so far the government has shielded the ordinary consumer, the industrial consumer, to the extent possible. The result is that look in our neighborhood, the West in Pakistan, Bangladesh, or many other countries in the Asian region, prices have gone up of petroleum products, fertilizer, and just the list just goes on. While here the government has shielded to the extent possible. Now, however, when you look at Government of India's company like Indian Oil, Bharat Petroleum, Hindustan Petroleum, for that matter, the private sector company engaged in this business, they are feeling the heat, most particularly the Government of India companies. So there are two options. You rationalize taxes to the extent you can. However, now time has come probably to pass on the burden to the consumers, both the industrial consumer, commercial consumer, and also domestic consumer. So I think the Prime Minister is prepared for that. Look, that time has come when we are going to pass on the burden. We have shielded the consumer to the extent possible, shielded economy to the extent possible. But now beyond this, the economy can't afford, the government can't afford. That's number one. Number two is, at the same time, he has talked about, to conserve energy, to go for carpooling and all that in order to create this thing. My sense is that, like many other countries, India is also preparing for long haul. Probably the analysis is that this is not going to end anytime soon. And if the war comes to an end, the gun goes silent, the impact and the effect is going to last for several months to come. So the Prime Minister has also prepared the Indian consumer and Indian economy for that this is going to be long run, long haul. Be prepared, even if the war ends, the impact and the effect is going to be long lasting. I think so. It's a multiple kind of targets that Prime Minister, has basically, gone to, and at the same time prepare. But as the petroleum secretary, I personally also don't think we need to panic. But petrol, diesel prices and LPG prices are going to go up, and also fertilizer. That is a highly sensitive commodity, but government will have to take a view on that too.
That's an important clarification, that there is no other way except for this burden to be passed on to the consumer. So the next logical question, Mr. Taneja, that many are asking is that given that sources within the government are indicating that the losses on the books of OMCs for just the first quarter of FY27 is likely to be north of 1 lakh crore rupees. If that's the burden that they're looking at, what is the quantum of hikes that we can expect in the days, weeks to come?
Well, there are two ways to look at it. One was you can't pass on the burden, the entirely in one go, but it will depend on the overall situation. But let's not forget the mandate that these companies have, most particularly like Indian Oil, Bharat Petroleum, Hindustan Petroleum, or for that matter, private sector refiners and distributors. The mandate is to go out around the world, secure oil, bring that oil, ship that oil, process it, refine it, distribute. It's a massive, massive task. And they are dealing at the time when practically all other countries, most particularly developed countries, are going to the same sources and ready to offer whatever price they want in order to secure oil supply. So our company has to compete with them, compete with like Japan, with China, with the West Europeans and other, stronger economy. So how do you do that if your own balance sheet is weak? If your financial situation is weak? I mean, we know it. I'm sure all the oil exporters, they also know that. So how are you going to get credit? How, for instance, you're going to say, all right, look, please prioritize us because we are the third largest buyer of oil in the world. All this is not going to cut much ice unless you, the buyer, these companies I'm referring to, are financially strong. So I think it's important, one, how do you make sure that these companies remain strong? And that's by passing on the burden, but at the same time managing, because since oil is a political commodity the world over, more so in our country, that you do it in such a way that people don't come out or hit the street. At the same time, these companies' financial health is protected. If these companies are not there in a good form, in a good financial shape, how are they going to basically go and secure oil for the Indian economy, for the Indian consumer?
Right, so balancing act required in terms of the quantum of the hike. We, of course, can only speculate at this point. Moving forward, Mr. Chandrasekhar, let me come to you. One of the appeals that was made by the Prime Minister was also for work from home. He drew the corollary to, of course, what we'd seen a few years back at the time of the pandemic when there, of course, a work from home had been introduced. We saw a statement from NASSCOM indicating that, look, there is already remote hybrid models of work being deployed by the IT industry. The question I want to ask is there more that's required, or is the industry already ahead of the curve?
Well, I think the industry has, in fact, post-COVID, continued with its hybrid model. And that has been optimized based on the roles which people play, how much, what kind of combination is required to ensure that the clients get continued and uninterrupted services. So a lot of optimization is already there based on all of these factors. And the room for further maneuver is a little limited. Perhaps during a crisis period, some little greater emphasis on work from home might be possible. But I think given that it's already very much in place, that is a little limited at this point. However, I think there are a lot of other things which the PM has said, which I think are extremely important. And in my view, it would be a mistake to think of this only in terms of energy and the costs and how do you reduce that. It's obviously the most important and the most visible thing right now. But there were several other things which the PM said which indicate that there's a recognition that the crisis is not going to go away, as the previous speaker had said, and that measures are required. And as the saying goes, never let a good crisis go waste. So what the PM also talked about was, things which have not attracted as much attention about, for example, using less of fertilizers, buying more of domestically manufactured products. And if we really want to use this crisis, I think this is a great opportunity to really do, to bring in reforms which actually push this agenda. For example, the agenda of precision agriculture, the agenda of encouraging domestic manufacturing, encouraging greater competition, greater foreign investment, and greater access to external technology, but unbridled competition at home. So there are a lot of things. And while the short term will naturally focus on the energy and how much more you can push the work from home agenda, I think the other things are slightly longer term, but equally important and probably even more important in the long term. We should take the lesson from 1991, how the crisis was used for a tremendous boost in the longer term.
Sure. Mr. Gusain, coming to you again, one of the aspects which again was a part of the Prime Minister's comprehensive appeal was to avoid unnecessary leisure travel overseas. That was his appeal. He said that why don't you travel within the country, travel domestically. Given that it is voluntary, again, there is no mandate at this point. Mr. Gusain, what is the impact that you're expecting, if any at all? And do you expect any pain, especially as far as airlines and their international operations are concerned?
See, I think in any case, we must understand that this appeal from Prime Minister is for the larger national interest. This year, we already see a hike in prices when you go overseas, whether it's airfare, hotels, or local transport, because fuels are increased in everywhere outside India. So prices are already, when we see it's 30 to 40% high than compared to last year. So people are already, we see 10 to 15% of slowdown compared to last year. So I think now people will explore destination within India. And also what I suggest that government should also look into the factor that inbound tourism can be promoted so we can have some kind of Forex inflow to country.
But Mr. Gusain, are you expecting any immediate impact, at least in the near future, if it comes to bookings of tourists going overseas, or at least bookings on airline tickets, and any pain that the airlines could see in the near term in the couple of next quarters?
So definitely we will see that in any case, like I said, the airfares are quite high compared to what it used to be. Like prices are almost 50 to 60% higher. And people are more concerned about the price hikes and all. They are also checking if they can delay their travel. So it was before the Prime Minister made any appeal. So in any case, this appeal will also have impact because as a responsible citizen, people will also think about it. So I think there will be some reduction in travel.
There is some reduction in travel expected. One big thrust of the government clearly is to check the Forex outflow. That is something that the government is concerned. Even sources within the government telling us is that the current account deficit is a big pain point going forward, at least in the near term. In terms of big imports, of course, the Prime Minister's appeal coming in for gold, but the second most imported item, not item per se, but rather the sectoral import that we'd seen in FY26 was electronics. So that's electronics components. We're talking about chips, semiconductors. It added up to over $116 billion. Is there some kind of restraint exercise required even as far as the electronic sector is concerned? Mind you, this feeds the big manufacturing ecosystem that we're trying to grow here in the country.
So, Ashmit, I think that, the electronics import bill is very high. There's no doubt about it. And these projections have been around for well over a decade that it's going to keep rising. And it's very difficult to control the consumption because it is a component, it's an input into many products, and it has a lot of knock-on effects on the rest of the economy. The more appropriate way to deal with that is to increase the level of domestic manufacturing. And I think the government has actually taken a lot of steps, whether it is for electronic components or whether it is for semiconductors or whether it is for mobile phones. So there are a lot of measures that have been taken. However, I think there is a lot more which can be done because at the end of the day, it's also about making sure that the electronic manufacturing sector within the country is competitive. And that requires many different steps, encouraging manufacturing, making sure that it is competitive. There are a lot of factors in the domestic economy which impact electronic manufacturing. These have been talked about in great detail. But in the short term, there may even be a need to provide a certain measure of protection to the electronic manufacturing industry while encouraging both competition as well as import of technology rather than import of the products. And over a period of time, I think with a combination of these measures, we have PLI, which has been in place for some time now. And through a combination of these measures, it should be possible to enhance our domestic manufacturing. There is no other choice in the long run but to increase our domestic capability, our domestic manufacturing and domestic technologies in all of these areas. So I think that is important. So I think rather than looking at how do we reduce the consumption, we look at how do we replace imports by domestically manufactured electronic products and electronic components, and how do we strengthen the domestic industry. And I think there are a lot of reports in the past, in the present, in the near recent past, which outline a number of measures by which that can be done. And we have to also appreciate the fact that increasingly in today's geopolitics, technology is being weaponized. So in any case, from the geopolitical environment, achieving a measure of technology independence, or at least technology self-resilience, is necessary. And I think this is a great opportunity to see what we can do more on that front, in addition to what's already being done.
Right, Mr. Chandrasekhar, do stay on with us. We're just diving into a very short break. We'll come back and continue this conversation on the Prime Minister's appeal for austerity on the other side. Welcome back. We have with us Mr. R. Chandrasekhar, Mr. Ravi Gusain, as well as Mr. Narendra Taneja. Mr. Taneja, again, coming to you, given, again, we're talking in the near term, in the next days, weeks to come. Give us a sense, now that this conversation is being had in public, is there a concern that perhaps some of these conversations may lead to panic buying, may lead to hoarding, may lead to strain on the existing available inventories of some of these OMCs?
Well, the challenge is there, let's face it. I mean, in terms of, there is a kind of massive disruption in oil supply. There is no doubt about it. People keep on talking about 20% oil flows through the Strait of Hormuz. But when it comes to economies like India, or for that matter, Asian economy, it's much more than 20%, as we all know. The same goes for LNG and even fertilizer. 30% fertilizer flows through the Strait of Hormuz. But in case of countries like, our part of the world, it's actually more than 30%. And at the same time, when it comes to oil from the Middle East, there the biggest challenge is, of course, the prices. I mean, when you look at the computer screen on CNBC or any other platform, you see the oil is $110 per barrel. But when you look at the buying basket price for India is much higher. China is the same story. Japan is actually much, much higher. So I think the concern is, on the one hand, is of course the price, the economics, and at the same time securing it. Because if you don't bring oil from the Middle East, from Russia, it can take 30 days. From America, it takes almost 55 days. From Latin America, it takes almost 53 days. So it's not only the economics, it's the economics of shipping, economics of insurance, and so many other economics. And more or less, the other problem is that all these countries know that, look, you are facing this disruption. So the negotiations, get tougher. So therefore, there are challenges as far as that is concerned. However, I think it will depend on two things. First of all, communication on the part of the federal central government in terms of how do you handle in perception, communication, and so on and so forth. But more importantly, it will depend on the quality of governance in various states across the country. I mean, states will have actually take upon themselves to make sure there is no hoarding, or there is no panic, or people are not basically, taking advantage of it, which in most cases in an economy like us, actually falls on the poorest sections of the society. So therefore, I think is the Prime Minister made his appeal. I hope that the Ministry of Home is working on it. I hope the state governments are working on it, making sure that there is no panic. And if there is any panic, there is no hoarding. It's not easy. We saw that in case of LPG 4 or 5 weeks ago, but that was handled well. But right now, I think with this and austerity measures and everything, is on not only economics of commodities, is the international diplomacy, how do we handle it? And at the same time, it depends on the quality of governance. As we know, we are a kind of country, we are a structured country where the quality of governance in some states, for instance, in the south, is better than the quality of governance in some other states, in other parts of the country. So the federal government, central government will have to work on it. In situation like this, when you talk of austerity, when you talk of shortages, when you talk of disruption in a commodity without which nothing moves, that is oil, I think the quality of governance, especially at the level of states and district, becomes the most important part.
Sure. Mr. Chandrasekhar, coming to you again, given the fact that we have no light at the end of the tunnel, we've seen again commentary coming in from Washington, from Tehran, no firm commitments with respect to the resolution of this issue. Given the strain that that's causing on the balance sheets, on the fiscal front for countries like India, is it only a question of not if, but rather when we'll begin to see some form of austerity measures being mandated from the government? Is that what your anticipation is? So far, we've seen other countries introduce measures, whether it's fuel rationing or fuel caps. Do you see that expected? Do you expect that in the days, weeks to come?
Well, as we just heard from the other two gentlemen on the panel, Mr. Taneja and Mr. Gosain, the price impact of the war on travel costs, on fuel costs, and the likely increases, they themselves act as a check to a certain extent. Now, that's a call which the government will have to take, whether that moderation is sufficient or further stringent restrictions in terms of controlling the quantum of consumption, whether at an individual level or at a sectoral level. All that is something which the government will need to weigh. And depending on, the progression of the war and how it goes, and if by chance, we all hope so, but if peace is achieved, then how much time it will take to restore the status quo that existed previously. So based on all of these measures, the government will have to decide how much of price moderation will suffice, how much of more stringent rationing would suffice. But I would come back to the point that, this is also a time to lay the foundations for a longer term sustained response to this kind of a situation, because geopolitics has changed in a way that it's not going to go back to where it was. And the kind of threats to sovereignty are rising. The denial of whether it is products like petroleum or technologies, in areas like electronics, in AI, in semiconductors. In a lot of these areas, I think we really have a lot of things to ponder over. So this is the time to lay some foundations for the longer term. The Prime Minister specifically mentioned about reducing the use of fertilizers. That requires both, of course, the manufacturing capacity is already there. But if you want to moderate it, then you need things like precision agriculture, and you need the policy which actually subsidizes the fertilizer and indirectly encourages greater and less restrained use of fertilizers. So all of these factors will have to be actually brought together and addressed in a carefully considered manner, considering not the short term, but the medium and the longer term.
Right, Mr. Chandrasekhar, Mr. Taneja, Mr. Gosain, thank you so much for joining us and sharing your insights. So clearly an appeal being made, but the government also careful in pointing out that there is no mandate, there is no rationing of fuel as of right now, no restrictions as of right now. We'll, of course, have to see whether that continues going forward in the days, weeks to come. Thank you once again to all of our panelists for joining us. And with that, it's a wrap on this edition of News Center. More news and updates will continue right here.
Hello and welcome to India Business Hour. I'm Shireen Bhan. The top stories that we're tracking for you this evening.
देश के प्रति अपने कर्तव्यों को निभाना वो भी देशभक्ति होती है.
Prime Minister Modi says India's economy faces challenges, appeals to citizens to cut fuel use, revert back to work from home, hold back on foreign holidays and buying gold for a year. Government sources say households will need to share the burden of high oil prices and flag the current account deficit as the biggest economic challenge. The government clarifies that India has 60 days of oil and 45 days of LPG stock, says that OMCs absorbed losses of close to 1,000 crore rupees a day, with under-recoveries running to nearly 2 lakh crore rupees in the first 3 months of 2026. The oil secretary says there has been no fuel rationing, adds there is no need to panic. The West Asia war squeezes OMC coffers. Sources say losses incurred by them in the first quarter of this fiscal may wipe out their FY26 profits. LPG under-recoveries account for 50% of OMC losses. Sharp fall on Dalal Street as the Sensex and the Nifty lose over 1%. Nearly 6 lakh crore rupees in market cap wiped out. The rupee weakens against the dollar, breaching the 95 mark. The ceasefire between the US and Iran shows signs of fraying. President Trump says Iran's response to US peace proposal totally unacceptable. Iran says the US demands remain unreasonable. Brent crude prices breach $105 a barrel. President Trump is all set to meet China's Xi Jinping in Beijing starting Thursday. Trade, rare earth export curbs, AI, Taiwan top the agenda. This will be the first face-to-face talks between the two economic superpowers since the US-Iran war. The union government notifies the new labour codes 4 months after releasing the draft rules. No criteria for minimum wage, which the centre says will be notified separately. A floor wage will be fixed in consultation with state governments.
A new era of a real, secular, social justice starts now.
Tamil Nadu's new Chief Minister Vijay takes oath as an MLA along with 93 first-time legislators from his party. Vijay visits former Chief Minister Stalin at his residence, marking the first significant engagement across the political divide since the change of guard. West Bengal's new Chief Minister Suvendu Adhikari approved 6 projects in his first cabinet meeting. Transfers land to the Border Security Force for erecting a fence along Bangladesh's border. Also approves immediate implementation of the census exercise. Well, let's go straight to the big story this evening. Now, Prime Minister Modi making an appeal for restraining fuel usage, foreign travel and gold buying. This as the Middle East crisis continues to rattle global oil markets. Now, the Prime Minister was speaking at a rally in Hyderabad yesterday, and he highlighted that curbing dependence on imported fuel was now, in his words, a national necessity. He urged people living in metro cities to opt for carpooling and prioritize traveling by metro trains. Also recommended resorting to COVID time measures like work from home and virtual meetings. But remember, this is an advisory, this is not mandatory. Now, oil imports account for close to 90% of India's domestic needs. This has led to a multi-billion-dollar spike in India's import bill. The Prime Minister also stressed on the need to reduce non-essential gold purchase, and he said that don't buy gold for a year if you can help it, to reduce the pressure on foreign exchange. He also appealed to citizens to avoid non-essential foreign trips for at least a year to help conserve foreign exchange instead. Now, the Prime Minister has urged citizens to promote domestic tourism. He's urged farmers to reduce the chemical fertilizers by 50% and adopt solar-powered irrigation pumps instead of diesel-run systems. He's also stressed on the importance of reducing edible oil consumption, linking it to both national economic interests and public health. Meanwhile, sources in the government have told CNBC TV 18 that households will need to share the burden of high oil prices as they flag the current account deficit as the biggest economic challenge. So the question now is a price hike as far as fuel is concerned, when and what the quantum will be. Take a look.
साथियों, हमें पेट्रोल डीजल का उपयोग कम करना होगा. शहरों में जहां मेट्रो है, वहां हम तय करें कि हम मेट्रो का ही उपयोग करेंगे. ज्यादा से ज्यादा मेट्रो में ही जाएंगे. अगर कार में ही जाना जरूरी है, तो फिर कार पूल करने का प्रयास करें और भी लोगों को साथ बिठा ले. अगर हमें कहीं सामान भेजना हो तो कोशिश करनी है कि वह ज्यादा से ज्यादा रेलवे गुड्स के जो ट्रेन होती है रेलवे की सर्विसेज से भेजे। एक जमाना था जब संकट आता था, कोई युद्ध होता था तो लोग देश हित में सोना दान दे देते थे। आज दान की जरूरत नहीं है, लेकिन देश हित में हमको ये तय करना पड़ेगा कि साल भर तक घर में कोई भी फंक्शन हो, कोई भी कार्यक्रम हो, हम सोने के गहने नहीं खरीदेंगे।